This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. "2018 will be fucking great." That's my prediction. I will make it come true. That's my attitude. That's my attitude for every year. But I have to tell you, something about 2018 just feels really, really fucking good. Look at that. 2 F-bombs in like the first 30 seconds. I'm already on a roll. My 3 guests today probably would prefer that I don't use such salty language. And they surely did not inspire me to use that language. I will give some of the credit, a lot of the credit, even though I don't think he cursed a lot. He cursed some. My high school baseball coach, Jake Jacobs, famous in the Washington, D.C. area, an absolute wild man. He probably coached me when he was like 65, 70 years of age. And we had our home base dugout on the first base side. When he would go to coach third base, that man would sprint across the diamond at like 65 years of age. Absolutely loved it. I still remember the man for doing that. Fantastic. I still remember he got in the grill of some like 35-year-old coach back when I was playing high school baseball, and he was ready to fight the guy. And Jake only stood about 5'6". I would not have messed with Jake. That SOB had that look on his face like, damn it, I'm going to kill you to win. I'm going to kill you to win. Loved playing baseball for that guy. Awesome. So there's many places I can find my salty language. Jake might be one of them. There's probably other places. But it's just part of my nature. I can't get rid of it. And occasionally I get the email that says, hey, your language is bad. The kids can't listen. I can't turn you on at work. Can you please change your language? I'm a little bit religious. I'm a little bit this. I'm a little bit that. And every time someone emails me and says that, I just say to myself, fuck. It's true. I cannot clean it up. I'll try my best in 2018 because 2018 is going to be so good. No swearing is needed. And to welcome you into New Year's Day, let me give you a podcast episode that will allow you to listen most of New Year's Day, if that's your choice. 3 of my all-time favorite guests and people. In order: Tom Basso, Charles Faulkner, and Ed Sakota. This is a lot of insight, not only for their content, but for the way they talk, their mannerisms. Inspirational, insightful, peculiar, mercurial. I love the way these guys do their thing. These are the kinds of guests. These are the kinds of insights that I want on this podcast. I don't want everything else that's not so interesting to me. But that does not mean I will stop taking chances. I will have and continue to have great guests on this show, vetted to the best of my ability. But sometimes you just don't know what's going to happen. I like to think that every guest that I've had on so far has given one pearl of wisdom, one piece of insight that made it worth your time. Well, I can guarantee you what follows next is worth your time. Every last, and my first big F-bomb coming into 2018, every last fucking word. I hope you enjoy these conversations with Tom Basso, Charles Faulkner, and Ed Sakota, and have a great new year, because 2018 will be great. Because I have a feeling deep in my gut, 2018 will be awesome.
Well, Jack wanted us to talk on elements of successful trading, so I tried to think of what is it that creates successful trading, and I think Mark mentioned some of the things. I know Market Wizards 1 is one of my top 3 favorite books of all time, because if nothing else, when you read that book, you clearly figure out that there's as many different people as there are in the book, many different ideas of how to trade as there are in the books, different markets, different systems. It can't be any one thing, and as Mark indicated, and I'm sure Bill would agree even, there isn't one single holy grail out there that just does it for you. So I tried to look at the common characteristics. What is it that we have to do as traders to be successful every day of our lives? It seems to break down for me into 3 areas, and from least to most important, I would list them as follows. The least important area is the one that most people spend time on, and that's where do we buy, where do we sell? Call it the strategy, if you want to put a name on it. You have to know where you're going to buy, where you're going to sell, or when you're going to buy, when you're going to sell. If you don't have a clue as to how you're going to do that, you're going to have a heck of a time going through life and just having things hit you over time. You're going to tend to increase your amount of erratic nature. You're going to have good days and bad days, and you're going to be all over the map probably. All of us have a strategy probably, whether it's you're cyclical, or whether you're a fundamentalist, or whether you're breakouts, or whatever you want to do. It doesn't make any difference, I don't think. I think the important thing is that you have something. And I think, as Jack indicated, and I couldn't agree more, it really helps a whole lot to have it suit you. I mean, if you don't have $1 million, don't design $1 million trading system. If you don't know anything about computers, don't go out and buy a computer package and try to run it. Either that, or you better get on a program to learn computers. In other words, try to develop the strategy that you're going to use to fit you. It makes it so much easier. I think the next up on the importance list, and very critical, and we heard a lot about it from John Hill's presentations this morning, is money management. If you don't have some way of saying, that's what Mark's talking about, money management, you got to be able to deal with, so you're going to have losses. If you don't have losses, you're not taking any risk probably, you're probably not going to make any reward. Losses are part of the game. How to deal with them is very, very critical. If you ignore them, they will come to haunt you. I like to limit all of our positions in futures, for instance, to a set percent of equity. I'm willing to risk that much. I always know that if my equity is going down, I'm in a drawdown, I'm committing less and less. As I'm running up, I'm automatically compounding my profits. It gives me a sensible way to not stick my neck out. I can come back and play the game again tomorrow. It also allows me to do one other thing. I can come in every day and I know that all my positions are a certain percent of equity. And the day that Jack was referring to, where the crude oil had gone all over the map overnight, by the end of the day, or as soon as we came in, our risk in the crude oil positions was exactly the same as it was the day before. It tends to help you as a person keep each day somewhat like the previous day. But if you ignore it, it comes to haunt you. This is the problem, I think, with a lot of the simulation software, a lot of the black boxes, the so-called holy grail systems that are advertised. A lot of them will deal with, say, one contract. We'll buy one contract, sell one contract, and it adds up to this much profit after the end of the next 5 years. The problem with that is, in real life, as those profits build up, you have a tendency to have to compound those profits. If you don't build that into what you're doing, then doing your historical simulations and what you intend to do in the future don't even match each other. So you're going to get different results. And that's kind of almost a pointless exercise. Include your money management right in your simulations and really think a lot about being able to come back and play the game again. I think that's very important. And the last one, and the most important of all, and it's the one that probably people spend the least time with, is looking in the mirror and understanding yourself. If you really look at trading, I think, and you alluded to it in your comments on most traders, you'll find that a lot of traders will match up very well to whatever their personalities are. You got a guy that's impatient. It's amazing how he becomes a short-term trader. Somebody that wants excitement, can't get to Las Vegas on the weekend. Boy, markets will provide him all the excitement he wants. There's also any personality trait that you have that might be exploited by the market against you. The markets have a wonderful way of doing that for you. So be careful what you wish for, because you might get it. In knowing yourself, I think of three major things that can really help your efforts in becoming a better trader. One is that self-confidence is extremely important in trading. If you have a lack of self-confidence about either yourself or your trading systems or strategies, it seems to me that the markets will tend to exploit that in you. You'll end up, being nervous about a drawdown period. You'll let go of what you're doing and go on to some, next best idea that is just one more example of something that's about ready to fall apart. And you'll just wander around aimlessly frustrated over the whole thing. And I think self-confidence goes a long way to giving you that courage to stick it out through some of the tougher periods. I think awareness of yourself is very useful. If you can either detach yourself or be aware that you're getting excited, about making too much money, that can be a problem. You get too excited or you get too emotionally set one way, markets are going up and you're long and you're just making it hand over fist. It may cloud your judgment on being able to limit your losses when it comes time to pull the plug on that. You may stay a little too long. You may give up the profit. So being aware of what's going on inside your head is a very interesting thing to think about, and the more you can be aware of what's going on inside of you as a trader, the better off you'll probably be. And then the last thing I'd mention is to think about a state of mind that's something like balanced. In every trade that you decide to do, there's probably some good points and some bad points to think about. There's some reasons why it would go up or go down for that matter. The more you can kind of balance those out, I think the better chance you have at being flexible and not getting married to a trade and finding something going against you, cut it loose. It's not a big deal. You can constantly be changing your mind about things, and keeps you flexible, keeps you with the ability to survive. And the last thing I'd say about trading, and it kind of wraps it all up, and it's a saying that I kind of repeat to myself frequently. So in the hopes of maybe that you would like to repeat it to yourself, I think this could apply to, I say that this applies to not only trading, but probably life, and certainly to golf, which I'm an avid fan of. And that's to concentrate on the process and let the results take care of themselves. What that means is being a trader has a lot of little things that we do every day as traders to be successful. And some of them are very unglamorous. The view of people have of traders is probably different from what really trading is if you really sat down and followed me around all day, or any of the rest of the panel. So concentrating on doing these little things right, that tends to help the results be just fine. To reiterate, get a strategy, watch your risk and volatility, and make sure you can come back and play the game again, and look in the mirror and understand yourself. And with that, I wish you the best of luck in your trades. If you as a trader have a certain comfort level or certain strategy that you're using, I don't care what's fundamental, technical, systems trader, whatever, and if there's only a certain amount, as Bill indicated, that you can pull out of a market that year, and that means you're flat for the year, then a good trader says, well, that's what I pulled out of it, and I'm flat. I think if on the other hand there's hundreds of percent to be had and you make hundreds of percent, it doesn't necessarily mean that you've done a good job trading. Profits and losses are not good trading, bad trading. Good traders are concentrating on the process and whatever their slant on it is, and whether they're trading one market or many markets, they are staying true to whatever they're doing. And then as the market changes, it allows them to pull more or less out of it, to match their style. I'd lump both of what they're saying into money management, which, as I indicated, is very important. And if you don't have something involving that, whether it's stops or whatever Jack's doing, it's tough. You might walk in one day and find out that you can't trade today because you're out of money. I guess I would agree with them, but I'd qualify it in the following way. I'd give you more, maybe the positive side of what to do about it. If you can match what you're going to do, and don't say system, but strategy instead, because you could be a fundamentalist or a systems trader or whatever. Whatever that is, if you can match it to you, you're going to have a much better chance of success. Now, what are the odds of you going and buying that fancy black box for $2,000 or whatever, and having it match you? I mean, for starters, you may not even know what's inside of the thing. First time it has a down week or a down month, you're going to be nervous. It's going to maybe, what happens if it goes through, as John Hill was showing us this morning, some systems that are very successful over time that have 2 years straight of flat profits. But that's normal. That's expected. It wasn't broken, and in fact, over the time period, it made a lot of money. But if you're sitting there, you don't even understand that, then you're not going to have the psychological side to stay with it. You're kind of setting yourself up for a lot of frustration potentially, and if you spent the same amount of time and money just sitting down and saying, what do I want to do myself? What's my way of looking at things? Then it's going to fit you, and you're going to do it, and you're going to be a lot more successful at it. I said something else that occurred to me. A lot of these systems have another, and I'll add in the system writers of the world and most of the, like the meta stocks, a lot of the software that develop systems. You'll find a lot of them are dealing with one contract lots or constant contract lots. If you just do that and you tend to ignore the money management systems that we all talked about, and they talked about this morning in the panel, you're going to tend to set yourself up for having difficulties in actual trading. You'll know where to buy, where to sell, but you won't answer the question of how much do I want to buy, how much do I want to sell. These systems don't tend to get into a lot of that. It's a big danger. And when the systems start addressing those issues, or when the trading software start addressing more of those issues, you may feel a little more comfortable with it. I would agree with Jack, though. I would have no intentions of selling our software. I'm sure these guys have better things to do than to sell that. Are you trading for yourself or for others? For yourself. The answer to that, I think, might be to take a look at yourself and decide where your pain levels are. I've known people that shouldn't be trading, and it's because they can't take a single 1% down. I know other people whose pain levels are extremely high and can go to 50% down. If you can decide where you are going to be uncomfortable with it, and then at that point say, I've had enough of this, I'm out of here, that will be your level. My own level is different from what I have to do for my clients. Since I'm trading client monies, my perception is that most clients have somewhere around a 20% pain level. So I try like crazy to keep the drawdowns less than 20. It's not to say you're always successful at doing that, but that's a good target area to start shooting for. I think most clients in the futures area nowadays are probably, especially the institutional guys, and we have some people here that, for instance, it's outselling institutions all the time. Isn't it a fair statement probably that 15 to 20% returns, if you could do them with any regularity and keep the drawdowns minimal, that'd be reasonably attractive. It's nowhere near the hundreds. In fact, the hundreds of percents, I think they'd throw David out the door maybe. They'd be afraid. So, they might anyway, right? He's been thrown out of quite a few doors. Okay. But that's the answer. It's up to you. No, in my own case, if I hit, let's say I hit a drawdown limit where I say, it's gone too far now. This is unreasonably large for some reason. It's more than I would have expected. That's a time to take a look at what's going on. I guess really dig in and see if I've learned anything, or there's something I've missed, or something I'd like to add, or whatever. As long as I'm in a drawdown and it's an expected situation. In other words, if I'm a long-term position trader in the currencies, let's say, and the currencies are going sideways and I'm getting whipsawed to death, that's to be expected. Then it's not broken. Don't fix it. It's what I would expect to be doing. You told me what the markets are doing, and you asked what do you expect you would be doing right now. I'd be saying I'd be losing money now. Then it's not broken, so don't fix it. So as long as it's normal, I think I don't fiddle with it.
let me continue with my very first episode with Tom Basso on this podcast. Tom, welcome. Thanks for stopping in today.
Well, thanks for having me, Michael. This is the first interview I've done, I think, in about 8 years since I retired.
You know, the great thing about the world of trend trading is that I find that experience doesn't. There's no half-life. It doesn't go away. Like there's a lot of wisdom that we can all pick up from folks that have been down the dusty trail, so to speak. Before. I sometimes hear people tell me, they're like, well, you know, Covel, what are you going to learn from these guys from decades ago? And I'm like, are you serious? Not much changes, Michael. It's the same thing. And I was just looking today to just make sure I knew where everything was, since I haven't been interviewed in so long. I did a Google search on my name and Trendstat, my old firm's name, and I was amazed to find I gave up after 30 pages of results. It was amazing, all the stuff that once it's on the web, it just stays there forever. So it's kind of a trip down memory lane. Yeah. Well, listen, let me jump in, because I think a lot of people have gotten used to this and they like this. They want to know, okay, I can pick up New Market Wizards and I can read this great interview story that Jack Schwager put together with you many moons ago. But I think people, they really want to know, what was Tom Basso like at 13 or 16? What were you thinking about? Like, what were you doing early on? And how did the migration happen, the switch? If you could maybe fill in some of that color, I think it'd be great. Well, I was 12 years old and I was delivering papers, the Syracuse Herald Journal, in the evenings. And I had about 82 subscribers and making about $10 a week. And I had a mutual fund salesman show up at my dad's house. I listened in and started buying mutual funds when I was 12 years old. 12. Okay, that's a head start. Yeah, and by the time I got to college, thanks to the loads, which I did not know anything about at that time, how much this salesman was taking out of the front end, I had gotten back to break even on that position sometime just after I went to college at about 18 years old. And that's just break even. And I realized that the markets went up and down. And I started in junior year of college worrying about where I was going to get a job as a chemical engineer, which is what I graduated from Clarkson University up in Potsdam, New York. I had about 25 different job offers, so I thought one way to look at this might be to just sort of plot the stock of some of these companies and take a look at what they did. And I ended up going to work for Monsanto in St. Louis, and I plotted Monsanto stock, and I ended up starting to trade Monsanto stock because it went up and down. And I realized that it'd be foolish to just buy and hold it, because it seemed to pop up to 40 and go down to 20, and I might as well make money each time it does that, because it didn't seem to get much above 40 those days back in the 70s. That kind of led me more to trying to quantify, how do I do this without having to think too much about it? Because I was a busy guy. I was getting an MBA. I was being a chemical engineer. At that time, I was starting up with the original firm that was the precursor of Trendstat, which was Kennedy Capital, which still exists today in St. Louis, a small cap manager. I sold my share of Kennedy Capital and did Trendstat, but it was an evolution getting into futures and using trend following techniques on futures and getting into currencies, because I ran out of futures capacity, and one thing leads to another, and pretty soon 28 years have gone by and I'm retiring. Okay, now so I've had this problem before. As guys like yourself, they make that whole story really fast, about 30 seconds. Okay, I'm not going to let you off the hook that quick. So at some point in time, you were starting to go down that path, but there had to have been was beyond your own internal studies and looking at charts and observing this up and down nature of trends. Were you being inspired or influenced by anybody that came before you at the time? I would have to say no, really. I was an engineer by background. I was very good with computers. And you got to realize that I never was a broker. I never worked at an investment bank, never was on the floor of any exchange.
I was really started out managing other people's money by way of an investment club, and a lot of the investment club people were kind of lazy, and they left it to two of us to do most of the work. So I was one of those two guys. Being an engineer by background just gave me a real heavy dosage of math and logic and problem solving and how to do things efficiently. And when you're flat running out of time and you realize that if I could, I call it putting myself out of work. I put all human endeavor into two sort of camps of endeavor, sort of the production side of things where you're just grinding out something that you could teach a computer to do basically, but for some reason you've decided to do it as a human being. And the other side of human endeavor is more the creative side, the one where you can't really teach a computer how to create something new or a piece of art or whatever. I realized that with a limited amount of time, if I was ever going to be creative and take trading to a new level and read new books and explore new research angles, that I had to get the actual trading function, the buying and selling, and where am I going to buy and where am I going to sell, how much am I going to buy, how much am I going to sell. I had to get that to a point where it was so cookbook, I could get it done in very short amounts of time so that I'd have any time left to do anything creative. And so I basically set out when back in the days when if you remember the Radio Shack Trash 80, TRS-80 was the first computer I got, and I went from there to the IBM PC and bought an AT after that, and I just kept programming, and my sole purpose was to just put myself out of work in terms of trading every day, and evolved into a very, very automated Trendstat Capital that basically made no decisions by human beings day after day. It was just basically a very, very automated operation covering some 80 futures markets and 30 currency markets and about 20 mutual funds that we traded, and by I don't know how many different strategies or how many different dollars, and it was very complicated. But you just buy another computer and you just crank it.
Well, let me bring you back even further a little bit. So you're self-taught. You are on the outside. You are not a part of the trading floor up in New York City somewhere. You're not on the exchange floor. So talk to me about when it kind of hit you that, okay, well, gosh, there's all these guys out there doing fundamentals. Warren Buffett's a value guy, and you've made the decision that you're going to use price as your core variable. And you're gonna start to code this. So this was all the buying and selling of price as a variable and figuring out how much to bet. That was something that you were trial and error figuring out on your own without really any outside influences.
Yeah, a little bit. The reason I started looking at some of my early, very, very early stuff that I did, like the mutual fund purchase with the low mutual fund manager guy, the salesman, and other purchases of actual stock after that. And I looked a little bit at fundamentals and realized it was a quagmire of accounting information to get through. It took too much time. And I realized that no matter what I did, it seemed like there's always going to be somebody with a lot more time and staffs of people. And I had other engineers at Monsanto we'd be sitting there in lunch and they'd say, what makes you think you can do any better than some Wall Street firm with, teams of analysts figuring all this stuff out? And I got to thinking about that, and I started getting more global and sort of distant from it all, and realizing that everything that all these people do ends up somehow in a what I thought of as a battle. I imagined going back to the Waterloo days, and you got Napoleon and Wellington up on the hills, watching their armies down in the valley. Maybe, and you could watch the front line and sort of going to the left and going to the right, and depending on who's winning at any one point in time. And I thought of that was my picture for what goes on in the marketplace. There's lots of people doing lots of different things, and some of them are buying and some of them are selling, and they all think they're right. They all think they know what they're doing, and they're doing it for a reason. But the sum total of all of that is where the price ends up, or in the case of the battle, where the front line is. So I thought, well, if I could just chart this, then I know where everybody out there that's participating wants to put this price. And if I just watch that and see that it's the battle is being won by one side over the other, like in other words, the buyers are beating the sellers this time around, then I might as well go lean that way because it looks like they are winning the battle. If the sellers are winning the battle, it'd be probably good to go that way. I didn't really think that much more about it than that. And that kind of instilled my thinking into what I did for the rest of my life and still doing today.
You know, we have a mutual friend who is featured in my book that came out last summer, The Little Book of Trading. Actually, two mutual friends featured in that book, Eric Crittenden and Cole Wilcox.
Brilliant guys, brilliant.
And I asked Cole the other day, I said, well, I'm going to be talking to Tom, what would be a good question from your perspective? And he said that you're like, what's coming next? But he wanted you to talk about lessons that you learned about life outside of trading where things didn't work. He said that he had really learned a lot from you about that. And I hope I'm not hitting you blindsided.
No, it's okay. You can ask me anything. The lessons that I learned of things that didn't work.
He must have something that stuck in his head that you had inspired him on.
Well, like for instance, one thing that I was kind of, I guess astonished at is back in the days when I had, just before I retired, I created this, it was like a Cadillac of something like 6 different programs that Trendstat was running across all the markets that we traded, across all the computers we traded. This thing was so diversified. It was a multi-manager fund, basically. However, run by one manager. So all the fees offset. I did all my fee calculations and incentive fees based on the aggregate total of it all. So for one hedge fund, you could get exposure to mutual fund timing of several different techniques. You'd get approach to currencies. You could get into some options trading on agricultural commodities. You got about 80 different futures markets using some like 3 different techniques: long, short term, medium term, and all automated, all offset in a very reasonable fee schedule. Far cheaper than a lot of the fee schedules that people were paying for. And I did 150 appointments. And of course, nobody's ever accused me of being the best salesman in the world. So we could always, put that as a caveat out there. But I did 150 appointments on Market Math, which was the big flagship that we had. And I was the largest investor in Market Math. And it was making some very nice money. That's why I'm retired now. And I got $0 from my 150 appointments, at which time I decided, I am tired of beating my head against the wall. It doesn't seem like these people get it. Now, years later, people who are still in the industry, like Eric and Cole, who I think are brilliant guys, actually, they have told me that there's now more single manager, multi-strategy funds out there now, and that probably I was just a little bit too ahead of my time on that one. But I just, that's an example of something where, as I read the industry and as you become part of an industry, if you're speaking to the professional money manager wannabes that are coming up and trying to figure something out, it seems to me you have to do an exceptionally good job of figuring out what it is your client wants first and then giving it to them, even if that sometimes isn't the best idea over the very long run. But if you want to stay in business and really want to raise a lot of assets so that you can fund those things that you really think are the important things that are the good long-term decisions, you have to consider the fact that a good idea that nobody buys is not going to happen.
Yeah, it's interesting that you bring up that point, because I had caught, and doing a little homework on before we talked today, I had caught an email exchange that you had with Ed Sakota a few years back. And you were commenting on the fact that I guess somewhere on his questions and answers page, somebody had made the comment that you don't like much heat. And I'm going to give you a second here to explain to novices that term. Okay. But and you responded, you said, well, hold on. It's not necessarily that, but I am giving clients what they can handle.
Exactly. One of the biggest things that
I found fault with a lot of money managers in my era, in the early going, and some of them are still out there, some of them have already retired, and some of them have blown up, is this concept that Ed calls heat. I just call it, how much risk are you putting into the portfolio? And I think risk can be measured by a lot of different approaches. The ones that I used were specifically a percent of equity of the risk to the stop loss. So take your risk from where you are to wherever the stop is. That's one form of risk as a percent of equity. The next one is volatility. How fast does a market move up or down each day as a percent of your equity? The third picks up weird guys like Eurodollars, or in the old days, and some high margin, low volatility types of instruments that every now and again go crazy. And if you have too much of them in the portfolio, you're taking on too much risk. Markets are smart enough to add the margin in there, so I had margin as a percent of equity. And I would just do all three of those calculations and take the lower of whichever one came out the lowest in terms of number of contracts. That was how many I did. So I always erred to the conservative side, the least amount of contracts, the least amount of exposure. And by doing that, I think I kept my, I can't say that I lulled my clients to sleep, but I tried not to draw attention to myself in terms of clients looking at things every day and being overly caffeinated and calling me about every other hour, saying, do you see what gold did today or something? I think that was not going to serve the client well, because they're basically going to always be excited when it's up and distraught when it's down. I was trying to level up my psychology of my clients, and I was trying to make sure that my own psychology was very level. I didn't want to get excited either. That's why Jack picked up on the Mr. Serenity thing, I guess. Everything in Trendstedt's life pretty much every day was somewhat boring.
I still remember the first time I walked into Bill Dunn's office many moons ago when I had no clue about this industry. And I thought I was in a CPA's office, an attorney's office. I was like, where am I? Because I literally weeks before that, I had been on Salomon Brothers trading floor at World Trade 7. And I was just like, this is not making any sense. What's going on here? So,
exactly.
But, it's funny. You bring up this, and I brought up that email that you mentioned. But in that same email, you made an interesting comment. And you said that, you talked about the desire to make sure clients could stand the heat. But you mentioned, and this was kind of I guess you were announcing some retirement at that time, but you said that you would approach your own portfolio different. Now, there's people listening to us today who perhaps don't want to be a trend following trader for their own account, and perhaps they want to trade with, put their money with a trend following trader. But for those that hear me say that, where you say, okay, I'm helping clients one way, but I'm willing to do something else for my portfolio. Maybe you can explain that differential. Like what? And I'm assuming you were willing to have a little more volatility and take more risk. I'm assuming. Maybe I'm wrong.
Yeah, exactly right. In terms of my own personal portfolio, which has gotten larger over the years and it spans quite a lot of different markets and things. And because I understand exactly what I'm doing and I understand where my risks are, I can scenario analysis to death anything that I think might happen and feel like I can live with what I'm doing. Take as a good example my mother, who's 83, and less than 100,000 to her name in terms of just retirement and IRAs and stuff like that. She's going to sit there with zero knowledge. She almost is confused by what a CD at a bank is. That's the level of knowledge that she's got. So it's like kind of like the opposite spectrum. When I start talking about anything financial, her eyes glaze over. She has no idea what I'm saying. When you put yourself in the position of what would you do for a person like that and what could they feel comfortable with, I think as a money manager, since you're being paid to manage other people's money, one of your first questions has to be, what are my clientele going to look like and how can I provide them something that I think that they will hire me for and keep me on the books for a long period of time? Otherwise, I think a lot of CTAs in the past especially, is probably more so when I was coming up, there was a lot of very, very high leverage guys and their household names that have either come and gone or are still out there. And I won't spare you the list, but these guys could do 50% in a year, and then they'd lose 20, and then they do 60 up, and then another 27 down, and they're all over the map. And their attitude is, I'm going to trade the way I think is best to trade to make the most amount of money over the long run. And if you want to come along for a ride with me, you're welcome to, Mr. Client. I approached it the other way around. I said, I'm willing to change, to sort of harness myself down a little bit, because my job is to be a money manager. I need to be thinking about what my clients are looking for, not what I might want to do myself, because they're not prepared to do what I would do.
In that harnessing down, though, too, I'm guessing that you saved yourself quite a bit of grief, because while I'm not criticizing any of the guys that took the big risks and did the 50 up and 25 down, I'm sure they heard from their clients a lot more in a negative way, perhaps.
Oh, and they had money come in and out. They'd raise $100 million, and then they'd go down to $50 million, and then they're up to $250 million, and then down to $100 million. I got to believe they must be hiring people, firing people. It must be just a chaotic way to run a business.
Let me jump into, and we can talk a little, and I'm going to come back to some of the big picture trading principles that you've developed over your career. But I wanted to jump into psychology, the psychology of trading, because I have a feeling near and dear to you that is where a lot of the success lies. And whether you're just a flat old entrepreneur or a trader or whatnot, the psychology of how you can make it through each day, I think sometimes maybe we all lose sight of such a basic sounding idea.
I agree, and it's the most important thing, I believe, in investing. It's way ahead of the second most important thing, which would be risk control and volatility control, and basically all your money management side, which is way ahead of the importance of what everybody concentrates on, is doing simulation on buy-sell decision models. That's the least important thing to worry about.
That's not changed, though, Tom. That's still, for the vast majority of folks out there, they still love that.
But basically, the reason's easy to see. I've done studies, and I've been published, and they've been other studies way beyond what I did, where you take markets, do random number generator to buy or sell, put a good stop loss behind it, do good money management with it, and you get a positive return on investment. So if you're flipping a coin to buy and sell, how important can the buy and sell decision model be if you've put good money management behind it, and you end up over time making a slight amount of money with a reasonable amount of risk? But even more so than that, think about the psychology. A lot of people used to think of Trendstat and Tom Basso as a sort of robotic firm. Like we didn't think or we didn't do anything. But in reality, I'm the guy that has the name on the, that owns the company. Any moment I want to, I can change any of those black boxes that we're running, right? So if I don't have good psychology, don't understand what I'm doing, understand, what buttons of mine are tending to be pushed with certain types of market action, and I stay the course, and I know that this is normal, or I know that something else is not normal and I need to do some work on that, I need to understand myself and the psychology that's being thrown into my face in my brain, because if I don't, I'm lost. I could change the models every day if I wanted to, just because they're computers. So the psychology is the most important thing of all, because that will drive what everybody does. It'll allow it forces them to abandon systems that are basically sound systems just because it's on a slight drawdown. They start tweaking things, they overcomplicate things, or they overly simplify things, or they get on a run and get full of themselves and start leveraging too much, and then they blow up. There's lots of different ways it can hit you, but understanding yourself is the most important thing of all.
Let's break that down some, because I think sometimes people want to get down to brass tacks. So when you say understand yourself, so tell me about Tom getting upset or Tom not getting upset. Did you go through your whole trading career on kind of an even keel? Were there ups and downs emotionally? How did you talk to me? Some examples.
Schwager documented this one. It's a well-known example of a situation where there was two different situations, and they both involved silver, strangely. I don't know how that happened, but I was trading silver. This is back probably, I'm in the business maybe 4 or 5 years. And my mom and dad were going to come and visit me down in St. Louis, which is where we were at that time. So I, as a dutiful son, take off the 1 week and play tour guide, and was working as a chemical engineer, running them around. Didn't have time to update my stuff. Missed a silver trade that broke out, but being the good disciplined trader that I am, decided no, breakout already happened. Not going to jump in late. When I updated all my stuff after my mom and dad had left, and I just missed it. And that turned out to be the most profitable trade of any market during the entire year. So it was very frustrating watching it, and I realized that I needed to make sure that didn't happen again, because I didn't want to be frustrated like that. So what I did was I told myself, if I'm going to create a strategy, I have to be able to run it every single day, day after day, and I'm not missing anything. And I haven't missed a trade after that for years and years and years and years, because I put things in place and I put backups in place, and I make sure things are, on stops and whatever I have to do to make sure if I'm going to be, say, talking to you and markets will be open or something, or if I'm taking a vacation, I'm going to Italy this summer, I'll be there 3 weeks. Well, hey, I'm going to have everything taken care of. I'll be trading right through it, and it won't even bother me, and I'll still be on vacation.
So when you use the word frustration, so I think for a lot of people, maybe if they're in that situation, instead of turning around and saying, oh, let's automate the approach. I mean, it sounds like you weren't emotionally upset. It was more of a problem to solve. Is that
exactly.
How you, okay.
It was like an engineer's problem to solve. We got this, I'm a chemical engineer, so think of it as a chemical factory. You got stuff coming in one side, you process it, goes out the other side. And a lot of trading I thought of as chemical engineering too. You got information coming in over satellite, comm links and internet lines and everything else. You process it either manually with your eyes and your brain, or by computer with databases and programming language like we did at Trendstat, and out comes orders that are shipped off to exchanges and brokers and FCMs and wherever they're going. So it's sort of like that little chemical factory. Trendstat to me was my little chemical factory. There was stuff coming in, processing, stuff going out. And when I look at, in the early days, my trading, I thought of it the same way. I've got a lot of information. I've got to get it done every day. I don't have a whole lot of time to do it, so let's make it as quickly and automated as possible. And then I go on and ship orders and go on the rest of my life. So that was what I thought of it as problem solving. But the other example involving silver was probably a little closer to an emotional reaction, I would say. This was a silver trade. My account had gotten up to, I think this was in the early years of trading. I think I was up to I want to say 50 to 100,000. I can't remember the exact number. I hit the same silver upswing that the Hunts were trying to corner, if you remember back to those days. Mm-hmm. Due to silver solely, and I'm the trend follower, I'm going to stick with this, and I've got so many contracts, and man, let your profits run, cut your losses short. And silver's starting to go limit up and down all over the place, and the Hunt stuff comes out and it collapses back, and I've got my stops in, I'm fine, but I saw my account go from 100,000 up to 500,000 in just a month or 6 weeks or something insane. And I saw it in the next 2 weeks go down to 250,000. I ended up making, $150,000 on the one trade. And at that level, it was probably 150% return on my portfolio. This is way before I understood what I understand now. But out of that, I can tell you without a doubt, I was watching silver every day. I almost didn't care about the rest of my portfolio. It was very emotional attachment up and down and all over the place. And I said, wait a second.
You caught yourself with that emotional attachment.
I caught myself with the emotional attachment. I always have had this sort of tendency in my brain to be able to sit back at the end of the day and observe how I interacted with the day. And it's a very useful thing to have sort of an observer self that can sort of be impartial, if you want to think of him that way, and to sit back. It sounds like a split personality, but I'm not meaning to make it sound crazy. You just want to be introspective, and you want to be non-judgmental, and you just want to sit there and say, how did you do today? Were you even keel? Did you do all the things you were supposed to do today? Did you get mad at somebody? Were you overly excited to the point of missing something? Did you get emotional here? Just kind of do a little bit of a counting summary of how'd the day go. When I looked at the silver thing, I decided, I was right in being a good trend follower and putting my stops in and letting the profits run and cutting the losses short. But there was no reason why I had to let my emotions go up and down and all over the place if I just controlled the size of my position. And that led to my very first risk control scheme, which was to say that as the stops got farther and farther away, in the case of silver, my risk got humongous. There was no reason to have however many, I can't remember how many I had. Let's say I had 5 or 10 positions. Maybe I needed 6. Maybe I needed 4. Maybe I only needed 1 contract. During the Gulf War breaking out at Trendstad, I think we had maybe 1 or 2 clients that ended up with 1 crude oil contract on after the volatility went from 32 overnight to 40 and back down and opened up the next day at 22 or something. That was insane volatility, and it just completely kicked all of the positions out of everybody's portfolio because nobody had enough equity to afford even 1 contract. So we took care of the problem easily, and there was no big deal. I think that a lot of people get caught up in the emotion of the thing, and then they just think, well, that's what trading's all about. Jack Schwager even admitted to me that he loves caffeine and coffee, and when he was interviewing me, I think one of the reasons he thought of me as Mr. Serenity is he's just exactly the opposite. He's overly caffeinated and extremely hardworking and very quick, and stay up all night and finish the chapter on the book and all that. And that's not very healthy over the long run, I don't think. And I don't think it helps your trading because you're sitting there trying to cloud your judgment with all these, chemical imbalances in your body from all the emotions that are driving you, and from frustrated to depression to excitement to euphoria to everything else that can happen in trading. And the markets love to push your buttons. So if you can sit back and figure out how your buttons got pushed and figure out a way around that, I think you're well served in trading to do that.
I got an angle here for you. So, are you a golf fan? You golfer?
I just came back from the range, actually.
Okay. So I'm not a huge golf fan, but I followed it enough, and I caught the end of the Masters. Okay, mm-hmm. And obviously this and some of my family's from the South, so this great Southern character, Bubba Watson, hits the shot. Basically lays it all out there, wins the Masters. I take nothing away from him because some of our legendary sports feats are one shot, and you go down in the Hall of Fame with that. But here you are, you're talking about your process. Tom is focused on process. You're not sitting around necessarily thinking about the outcome. You're focused on your process. You're grinding it out. So I look at Bubba's shot and I think to myself, some of the guys that did exceptionally well in the real estate crisis, John Paulson, Michael Burry, guys that are exceptionally smart, made great trades. But maybe you can talk to the person that's listening out there and explain the idea of laying it all on the line in the world of money to try and hit 1 home run versus grinding out a career, and maybe lay out the pros and cons to people.
Well, okay, the making 1 shot, and I think a lot of people have indicated that Buffett sort of falls into this rule in that he has made the lion's share of his profits off of a select few very big home runs that he's hit over his entire career. But he's had plenty of losers along the way too, and that kind of gets glossed over a lot. And the net result of it all is the winners, of course, have more than paid for the losers, as we find in most trend following cases. That's fine. He has a big image that way. But examine the trend stats of the world that are just grinding it out and trying to, keep their clients happy and not do anything too flashy and all that. And, I think I would summarize my image in the industry back in the day probably as boring. I think a lot of people probably would not have gotten too awfully excited. I mean, Jack Schwager wasn't even going to interview me until...
Hold on, it was never boring to you, though, was it?
Well, it was never boring to me.
Okay.
I was doing, I was running a nice business. I thought we had a good clientele. I thought we had a good crew of staff at Trendstat. I enjoyed running the business when I did run it. I'm enjoying retirement now that I'm not running it. I probably would enjoy life every day, no matter what I was doing, probably. But I think that the lesson to be learned here is if you want to hit the home run and all that, that's fine. But let's not consider that Bubba Watson was not running his process. He likes to move the ball. He was out at my club just a few weeks ago. Ended up shooting 67 there from the back tees and made it look easy. Went and shot 58 the next day up at Estancia, which is a pretty difficult desert course. He likes to move the ball, so he can take a shot. He's a lefty. That shot was well in his wheelhouse. He can imagine it. He can hit a wedge, turn it down, and he's going to make that ball go left or right a whole lot more than most people probably could humanly do that. But that's his normal way of playing. So that wasn't out of his comfort level or anything.
That's a really good analogy. You just made me have the light bulb moment, because if you say, I remember there's a trader that I interviewed for a book last summer named Paul Mulvaney, and Paul had his system, his trend following system. And when he came into the fall of 2008, he had no earthly idea that October of 2008 would produce him 40% in the month. However, he was following his process. So I think that's the exact point you're making, isn't it?
Yeah, the same thing true of our currency programs in '97, when the Japanese yen was, I think we were getting down to, the yen dollar was down to, I think it hit 80 or something. It turned around, I forget whether it came down from 150 or then turned around, went back to 140 or something. It was like huge swing one way, huge swing the other way. And I'm sitting in this thing with all of our programs my trade, I'm just rolling it every month, rolling it. I'm in the same trade for like a year and a half. I mean, people think of trading as, okay, you buy today and you sell next week. This was buying and selling over a whole year and a half in commodities, for crying out loud, or currencies. But that made me so much money. It's made the client so much money, and the incentive fees off of that and everything else. I mean, that was probably the record year that I was in the business in terms of the amount of money that Trendstat made. And I had no clue that was going to happen. I'm sort of an amateur economist in terms of I understand a lot about economics, and you watch some of my Facebook posts and you know which way I lean on a lot of things.
You have no opinions, Tom.
Yeah, I have opinions. I have a few. I'm more libertarian by philosophy and all that, but I like to examine economics from the standpoint of how the behavior of the people involved with the decision. If you look at it from that standpoint, you usually can figure out which way economics will go on almost anything that you would propose. And it just seems like so much of what goes on today doesn't do that, and then there's this big surprise when it doesn't work. What? You got to be kidding me. It's not that hard. But
I keep making the case to folks. I say, well, listen, if you believe that we're in this world of chaos, and I can't know what's going to happen in the future, maybe it'll just become this nice, serene environment. But if we are in this world of chaos, what can one do to participate in chaos, or maybe it's not the right word, to actually excel? But I'm going to jump into something for those folks out there that are maybe further along and they want to hear something more interesting. I'm holding in my hands here. Oh, by the way, just before I even say this, I think we met before.
Oh.
I think you'll have to correct my memory. 1996 in Berlin, Managed Futures Association Conference. Were you there?
Yes, I was.
That's where we met, because we sat next to each other. But anyways, that's neither here nor there. Because I was thinking,
I so many people. I'm afraid, Michael. I'm sure I would have remembered you, but I apologize for that.
No. I was just trying to make sure I wasn't completely losing my marbles. So I'm holding in my hands a document that I have done my level-headed best to, and I hopefully you won't have counsel call me up and go, Covel, get rid of that. I've been disseminating this off my websites for eons. When to allocate to a CTA, buy them on sale.
Yes.
Tom Basso, from a few years ago. However, it's amazing how many times today, still to this day, I will talk to traders that are either running their own accounts or trading a fund, and they have this mentality. And I've got a buddy who runs a small fund who literally, there must be some systematic index of trend followers that he actually will look at just for kind of extra guidance, not part of his system, where he kind of thinks that it actually correlates sometimes when his fund starts to gear up on positions. But anyways, why don't I let you kind of you're Professor Tom, and I've got this white paper here in front of me. How would you generally explain this idea to people that are either new or experienced? The idea of buying a trader on sale.
Okay, well, if you figure out what drives trend following is driven by the fact that there's asymmetrical returns. There's big long runs like the Japanese yen trade that I just talked about, whereby sometimes when I total up all of the trend trades over an entire year, maybe 2 or 3 of the trades paid for all the profits. If you could isolate them up, pick them up and say, okay, I could just get these 3 trades, that was the difference between 0 and whatever it is we made that year. All the rest of the trades maybe even netted out to 0. There were some years where it was that close. So if you make the assumption that there's going to be periods of time where the market goes sideways, which the stock market's a good example right now, it seems to me like the last, 3 weeks or so, it's gone nowhere. It's basically in a range and it's bouncing around, and every day it seems like if it's going down one day, it goes up the next day and down again and up again. And during that type of an environment, trend followers are not going to make money because there's no trend to follow. Typically, depending on where your time frames are, unless you're trading each one of those little swings and doing some short-term trend following, there isn't a trend long enough for the kind of once-a-day guy to really catch much. On the other hand, there's going to be periods like back in '97 when the Japanese yen goes crazy, or maybe in the future when the dollar goes down a lot or something like that, whatever. Those types of trades more than pay up for all the losses during the sideways periods. If you then make the assumption that there's always an end to a sideways period, and there's always an end to the profitable period, then it would make sense to look at a trend follower who's trading lots of markets, lots of noise creating drawdowns, lots of trending markets creating profitable periods, to actually sort of, if you want, trade the traders. Rebalance yourself when one trader makes too much money and is getting really, really leveraged and going crazy. Maybe you back off some money there and you spread it amongst other traders that are acting a little more conservative and might be able to hold on to those profits during the next static sideways period where everybody's going to tend to lose money. And vice versa, when you get somebody in a deep drawdown, unless he's changed something, or if you've lost complete, trust in what he's doing, then balance right back into the guy that's on the biggest drawdown, because he's coming up on the next period, which will be his biggest profitable period again. It seems like the industry does exactly the opposite of that. I did another white paper called Performance Gap, which was difference between CTA returns and client returns. And I did the top. It turned out everybody over 75 million and up that had a 5-year track record in the MAR database back in the old days, which doesn't even exist today. I think it's Barclays these days. And out of the 27 CTAs that met that criteria, 27 out of 27 times, and boy is that telling, the time-weighted return that the CTA was actually providing by trading was greater than the dollar-weighted return that the clients actually got by all their chasing the hot track record and pulling it out at the bottom and all the nonsense that clients went through. It's very frustrating and very sad. It saddened me to see basically my clientele out there doing stuff that hurt themselves from making a good return. And I wrote about it, and it didn't seem to do any good to anybody. I don't know.
Well, Tom, psychologically, why would you say that investors don't invest on drawdowns?
I think psychologically because they don't really understand trading. They can't deal with their own psychology. And they don't realize how important psychology is. So what ends up happening is when they see it down, they kind of in the mind, you start extrapolating that dotted line down, 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 down. It's going to be X months before I'm, totally gone or something. And likewise, I think psychology on the upside is, this guy's got a great track record for 5 years, and it keeps going up and up and up and never goes down. And so let's draw that dotted line off the top of the chart. And which one would I rather have? I'd rather, in my mind, have that guy that's going off the top of the chart rather than the one that's going to lose me all my money. I think that's they don't step back from themselves and realize the trap they're putting themselves in. And they don't understand even why trend followers have made money over the long run. I'm sure you get tons of criticisms and hocus pocus and I see some of the Facebook comments, and it's really easy to sit there and plot monthly volatility of, say, a market, which I've done. In TrendStat's case, I took, I don't know how many different markets we did it on, but months where there was large volatility were the months that were profitable by trend following strategies. Months with small volatility were months where the systems basically lost money. So large volatility, profit, low volatility, and low direction, losses. And so it's as simple as, if you looked at a whole year of monthly returns and monthly types of indices in the various markets being traded, you should be almost able to predict what should have been the average CTA's returns for February. Because these following things occurred, it was probably a losing month. Or these things occurred, it was probably a winning month. It was a big winning month or a small winning month. You could actually just judgmental yourself right into it if you had the data and you understood where trend following returns came from. But all these fancy people with all their doctorates and all their computers and staff don't seem to be able to figure that out. And so here I was in TrendStat's case, buying my own programs when they were in a drawdown, and meanwhile my clients are calling up and firing me. And then people would be throwing money into my hedge funds when I was making new highs, and I'm taking some money off the table and giving it away to other managers or doing other things with it, trying to, salt it away to take some off the table and even out my portfolio a bit. And so I found myself doing exactly the opposite of what my clients were doing all the time. And I'm trying to convince them to do what I'm suggesting they do, but they would not hear anything of it.
That was the question I was going to lead to, is that some folks are they're never going to change. It's not going to happen.
And it's one of the several reasons why I just decided, to call it a day and move on to golf and fishing and cooking and dancing and singing and
singing. Hold on, so are you going to sing for us? I was on stage with Ed Sakota doing his banjo last, I think it was a year and a half ago. So you're going to sing for us? What are you singing for us today? Or you're not going to sing?
Oh, I could.
Okay. What kind of singing?
Well, I like "Fly Me to the Moon." And let me live amongst those stars.
There we go. I've got a first. I've actually made news today, right?
Yeah.
Here, let me. I know we only got a few more minutes here. I know I told you I wouldn't keep you past an hour, but
I'm good as long as you want to go.
Okay, well then we'll keep playing here. I've got a lot of different experiences over the years with talking to different folks, and I know you'll probably have some other thoughts on this, but sometimes when I talk to folks that have been in your position, running a successful fund for a long time, nice track record, they say things that most people, I think, from the outside looking in, they don't expect to hear. I'll let you comment on this. So, two examples in the last couple of years that hit me. I had a chance to speak with David Harding over in London several times, and he starts talking about looking to be a cockroach and looking to be like Madonna. And then Salem Abraham is talking about how to avoid a meteor strike. Okay, and clearly they're talking about surviving, so they're worried about surviving. And talk to that notion where because the average person sees the headlines, these guys made all this money and they're da da da, but the reality is to have the chance to make it, you've got to be there still.
Exactly, and one of the things that I think is the only reason probably why you're talking to me right now might be, or one of the reasons that you're able to be talking to me, let's say, is that I was able to, by controlling risk, controlling volatility, avoiding the meteor strike that Salem would talk about, or David's cockroach thing. Both are interesting analogies. I looked at it as I have to play today's game so that I can play the game tomorrow. If I'm out of the game tomorrow, I've done I've done no good for anybody. You've got to be able to keep playing the game, because statistics, it's like the casino. If you're trying to get the statistics on your side, and I think trend following does that well, it does it even better if you use very, very good money management models. Control your risk, control your volatility, control your margin, control the types of markets you select to trade and by which strategies and all those things. That's where a lot of the work is very fruitful. And I think once you have something that you feel comfortable works and you understand how it works intimately, I mean, down into your soul, you know exactly what type of market is going to feed your profits and what type of market you're going to be licking your wounds. But you're able to keep coming back and playing that game tomorrow. As long as you can do that, then the statistics are going to end up working out in your favor over the long run. And you're a survivor. And you can have a 28 or 30-year run in the industry like I did and be around long enough so that people actually recognize your name because you've been at so many MFA conferences or MRA conferences and shaken so many people's hands and had people interview you and been quoted in the Wall Street Journal or whatever. And, it's just because you survived. It wasn't necessarily because you were flashy. I'm
going to jump around a couple of these. You talked about this already. You mentioned the kind of, if you can look at the markets movement, and you consider low volatility and high volatility, you can almost start to figure out where the CTA universe might be making their money. Mm-hmm. But talk to me, and maybe talk to folks out there, the idea that, I regularly see this, where people really truly imagine they're going to make money every month. Somehow or another, they're going to make money every month. And I'm sure there's probably somebody out there, maybe because their server is right next to the exchange server or something, and they've got they're trading on light speed, something that I don't even understand. Exactly. But I've said recently that whenever I see a track record, and part of my background was looking at all these track records, like, well, this is so great. Look at all before I knew anything about trend following, I was like, look at all these CTA track records. This is such a wealth of information. But as time has moved on, I've realized that if a track record exists that shows me making 1% to 2% every month with never a down month, I say to myself, I've either got long-term capital management on my hands, a strategy that's going to blow up, or Bernard Madoff on my hands.
Yeah, I would agree with that. Or a third solution to that, Eric Crittenden would say, you've got a short volatility manager probably. And short volatility would mean it'd be something like selling naked options, for instance. If you sell them far enough out and you sell them far enough away from the money, the vast majority of the time, the option expires worthless, you make that money. So you can produce profits this month and next month and next month and next month and next month. And then you have the long-term capital where somebody's leveraged a whole lot, and that short volatility comes to roost with a very large movement in the markets, and the volatility blows up, and they're short the volatility, so it just kills them. And with the leverage and everything else, 3 years of profits, monthly profits in a row just go down the drain, and they blow up, and they're gone. And so, yeah, I'm very suspicious of track records that are, if they're professing to be trend followers and doing it month after month with profits, my hat would be off to them. You got to be really figuring that one out, because it's a tough nut to crack.
So let me go at Professor Tom again. So I'm showing up at your class, and it's Financial Psychology 101. I'm 18 years old. I really don't know much about anything. Now I'm forcing you to go back in time to how you would communicate to that audience, because in many ways that audience is the general audience out there. So what are you saying on the first day of class when you start the presentation? How are you getting people to come to the point where they're ultimately going to build to hopefully to have your foundation and your background and your knowledge, but what do they have to know in that first week? What are some of the basics that we really want people to get? First day, they don't know anything, Tom.
Yeah, I know. It's difficult. Before you can deal with simple things like what would a moving average do, or what a trend following model might be, or how to control risk or volatility, you'd have to actually know how to put in a stock trade. My mom, for instance, the 83-year-old retiree, would not even know what a stockbroker was, wouldn't have one, doesn't know how to even articulate an order, so she would have a hard time even doing the basic first trade. So you'd have to teach people something basic about the market, how to put a trade in, and the fact that the market is a place where buyers and sellers come together, basically. And once you got past the nuances of whether it's futures markets and you're dealing with ticks, and currency markets you're dealing with pips, and so on and so forth, and you got through that maybe in the first day, you could then get on to the issues or I think the three pillars of success for trading. And one of them is going to be understanding what it is that you're trying to do. And what I mean by that is you're going to have to, each person's going to have to come to some conclusion of why the markets do what they do. There may be those that think economics drives it because they're economics majors, and that's what they want to base everything of their decision on. And you're going to have to come to that conclusion, and then you're going to have to build risk and volatility and portfolio selection around what your comfort level is. And then you're going to have to work on a buy and sell decision model. And once you have those three things together, you have a shot at being successful, even if you're an economist. Wouldn't be my cup of tea, but I'm sure there's economists out there that are doing just fine if they can get everything together. But that's the way I would approach it, is try to teach those three things: the understanding of what you want to do and what makes the markets work from your viewpoint, not from Michael Covel's viewpoint or Tom Basso's. It's basically what drives the individual doing the trade, because it's you who has to decide to stick with the system or abandon it or add new markets or tweak the strategy or all the things that go on. And if you're not comfortable with that, it ain't going to happen. But you also have to have control of what markets you trade. Some are going to make sense to you, some are not. You're also going to have a decision model that could be something like a breakout on a chart or a moving average going over or whatever it is. You're going to have something to trigger your action. And I think those three things, you get those together, you've probably got a shot at least getting into the game.
Well, since it is 2012, and as far as I know with technology and interviews and stuff, I don't know what the rules are. I have no training in anything. I have to ask you, what are you thinking about these days? This doesn't necessarily have to just be an interview. I want to know what is Tom thinking about these days? Besides the fun part, the singing, the golf, the dancing, I know your brain is still thinking about stuff. So what are some of the things that you might want to leave people with today? The kind of the big picture. Maybe it could be a life parable, anything you might want to say that's just near and dear to you right now.
I would say the thing that I think about the most, and I've noticed several Facebook posts by some of the friends that you have and some of the friends that I have these days, and we have some of the same friends. And I'm seeing this over and over again. There's a lot of us out here in the trading world, and hell, you got to figure I've traded 80 commodity markets, I've traded 30 currency markets, I've traded all sorts of ETFs and mutual funds. I used to trade stocks, I used to trade options, I used to trade treasury bonds even. And I sit here in today's environment, we're running up another $5 trillion in debt, we're debasing the dollar with all the QE 1, 2, whatever, quantitative easing. I'm sitting here trying to figure out each day, how am I supposed to financially survive in retirement and protect and grow my assets? And I'm a guy that has traded almost everything that is tradable. And I feel really sorry for the people like my mother, who is confused by a CD, because I am having a hard time coming up with ways, aside from doing my basic trend following stuff and trying to go with the trends that we all do, and in some months having a better month than other months. But you get this feeling like the trend followers of the world are going to nail it, and things are going to go collapsing or go skyrocketing inflation or whatever happens. The trend followers are absolutely going to nail it. But you're going to win the race, and then you're going to look around and say, yeah, but
Yeah, post-apocalyptic.
I sit there and I think, okay, let's see. If you're a successful trader and you're part of the 1% and you're looking at what it is that you're supposed to be doing to position your portfolio, and if you're in a client business, your client's portfolio, so that they can preserve their purchasing power over the long run, what I call net wealth instead of net worth. You got to increase your net worth to keep your net wealth the same in an era where the dollar is getting debased. It's very difficult to see how to do that.
Tom, you're not saying that also. I mean, you've got a few decades of experience here. You've seen many different climates, many different markets, many different socioeconomic political patterns. And are you expressing a feeling about 2012 and going forward that's much different than you felt in your lifetime?
I feel like we're setting up for the potential for some very large moves, which trend followers are going to love. So it feeds your game that you're.
Now, but hold on. Let's just clarify here, so people don't. I don't immediately get the emails. Tom's making predictions. No,
I'm not making predictions at all. I just have the sense that we're straining the financial structure of the country to the point where now debt is over. Is more than 100%. I think it's like 108% GDP. That's getting to be pretty, unusual and rarefied air. In other words, if you look at the economic statistics of the United States and even the rest of the world, we're pushing levels to levels that have not been seen before. When you get that type of stuff, you have the potential for collapses, you have the potential for bubbles, and the bubbles bursting possibly. So you have some very, very high volatility potential. I have no prediction about which way anything is going to go. I hope that trend following would probably be there to capitalize on a lot of those major moves. However, at the same time I'm capitalizing it, I'm concerned that the value of what you have when you're all done with it, while greater net worth than you have today, might not be worth as much to go out and buy anything with it as it does today.
Right.
You feel like in a retirement situation, my grandfather lived to 98. I'm 59 now. So, I'm in great health. I'm enjoying life. But if I were to live to my grandfather's age, 98, I've still got 39 years to go. That's longer than I was in the business. It's pretty interesting to think in those terms, decades. I've got to manage my portfolio and figure out how to, at least keep my net wealth roughly the same so I can continue to enjoy a nice retirement. Well, that's the one thing that crosses my mind more and more lately, and it's a tough puzzle to think about because the solution sort of is out there, in the hands of like the entire country, not just me. I can't control what happens around me. I've even looked at, I traveled all over the world. I've thought about it, what would if I moved to Australia? How would that be? Or Switzerland or Britain or, I've been to all those places and they're all, fine in their own ways, nice places to visit, but I call the USA home. And I like Phoenix, Arizona. I think it's a great place to live. You'd have to be hard pressed to get me out of here. But given that I've made that decision to stay here, and I've got then the state of Arizona and the country of the United States around me, I have to live with, I don't know how many hundreds of thousands of pages of tax code to deal with my taxes, and I have to deal with, all the different economic decisions that are made that I'm pulling out my hair over and saying, yeah, you got to be kidding me. That's a stupid thing to do. And but if we keep making those stupid decisions, I feel like I'm going to be in the middle of this chaotic nonsense, trying to survive along with everybody else, admittedly with maybe more knowledge about what I might be able to do. But right at the moment, it's really hard for me to figure out an easy answer to be able to articulate to someone saying, I think we should do the following 1, 2, 3, 4, 5, and that'll probably set you up to be able to survive fine. I don't think it's just as easy as going out and buying gold coins, for instance, which you see the ads all the time on the television. Or, gold is fine. It might go up, might go down. People may, take your coin in terms of buying something, or they may not want your coin. There's a lot of unknown out there, and I think back in the 70s, 80s, I think the economy was a little bit sort of going sideways. It wasn't really robustly growing. After Reaganomics kicked in, it kind of got good for a while, but then through Clinton years, we sort of did all right. Bush year was okay, and but I think we've strained the system so much now. I kind of wonder whether there isn't some really big moves coming up. And so I would encourage everybody to be a trend follower here, but good luck figuring out how to deal with it. I mean, for instance, the MF Global raised another issue. What if what if you're right? And we had this issue in currency trading all the time. What if the Japanese yen goes to US dollar goes to 10 cents or something, or 10, and you just slay the heck out of it, but the place that you're doing your counterparty, your counterparty risk and all that, can't pay you your profits because they're bankrupt. Right. So you've won the battle, but there's no victory.
I think that's and I'm going to say the unspoken. I know it's spoken by some people for sure, but it seems like it's the unspoken feeling that a lot of people that are awake are having right now, which is like, even if I have a good process, even if I have worked a little bit harder than maybe the folks that are just playing Nintendo or Xbox all day long, that I still might end up in the same place that they are.
Yeah, just about. Yeah, you might be just slightly ahead of them, but you're still having a lot worse time of making your way through your day than you would be normally. I think there's the potential for us all to be dragged. It's kind of like dragging down the 1% to be to the 99, rather than trying to think of raising the 99 up and getting rid of the restrictions to allow the 99% to do better. I think we're approaching it the wrong way in a political sense, but we're also in the process straining the economy and a lot of the different aspects of the markets to where I have I have to hope that my commodity accounts, let's say, that are custodied at a certain FCM, let's say, what if the FCM goes bankrupt? All right, because they've done something that I can't control. I end up making a bunch of money on a big move. They're somehow short that same move or whatever, and they lose their shirt and they can't pay me my profits because their capital's gone. And I went, wow, that's getting pretty out there in your thinking. But I didn't used to think of those types of things as much back in the 70s and 80s. But it seems like we're setting ourselves up for some of those types of scenarios to come to pass, which is worrisome.
I'm gonna ask one more thing though, so I can leave you on a nice, inspirational. Because we all feel that those things. We know there's something wrong. That's the bottom line. We all know there's something wrong. There was a great article in the New York Times the other day about people and their phones, and everyone they don't even talk anymore. Everyone's walking around and their thumbs are the genetic fingerprint of the thumb is changing from doing these little devices, and no one talks. They're all looking down. It's a very weird society right now. Besides the point, let me ask this question about entrepreneurship, because clearly you've been a successful entrepreneur, and I relate to anybody that goes out there and says, man, everybody works for the man in some capacity at some point, but you broke away. You became an entrepreneur. So how is being an entrepreneur, do you ever think about how different that makes you in terms of your thinking, your feeling?
Oh, I do all the time. I guess not so much now, except to just observe people who aren't. There's so many of them. I always had the attitude of a sort of, I don't know where I got this from. Somewhere along the way, I think it almost was back in the years when I was doing some things with Van K. Tharp, has some programs for traders on the psychology of things, and I did some speaking with him for some times, and somewhere along the way I decided that the easiest way for me to deal with my entire life and the universe around me was to take responsibility personally for everything that happened in my life. Everything, even if it was caused by somebody else, to figure out how I could warp my judgment to the point where I could be responsible for that. And if you are responsible for everything, and then you jump to the next line of thinking that you can then take some control of it and change decisions or change your path or do something different, you can move your whole life far afield. I started out as a chemical engineer and I ended up as a currency trader by the time I retired. The immediate question everybody asks is, how the heck did that happen? Well, it was just one day at a time, but I was responsible for everything in my life. And when I realized that things, that my life at Monsanto as a chemical engineer, where back in those days, every 4 years there was booms and busts, and the chemical engineers would be hired in 1 year, and then 4 years later you're getting laid off. I wanted to have backups, so I needed to trade my portfolio, build up my net worth. So I had a backup. So if I did get laid off, I could control my own destiny and live a year or two while I'm looking for another chemical engineering position in tough times. One thing leads to another, and pretty soon you're trading so much money, people notice it, and they want you to manage some of their money, and then you get sucked into the money management business. But you still take responsibility for making that decision to say, okay, I don't want chemical engineering anymore, I'm going to go be a money manager. That's all within your control if you're taking responsibility for everything in your life. And I think that's what entrepreneurs tend to do. Entrepreneurs tend to take control, and they realize that they're making it happen. They're not going to wait for somebody to hand it to them.
Yeah, my father was always fond of saying that he just didn't want to have a gig where he had to say yes, sir, to an a-hole all day long. But that was,
well, even in the money management business, you got clients. There's always somebody to answer to. We've had money laundering audits when we were in the currency trading business, where the IRS would come in and look at us, all sorts. There's always,
you got to say yes, sir, to them, otherwise you're in trouble.
Yeah, they'll stay for another week just because they make your life miserable. But
hey, Tom, listen. I'm going to let you run, but I hope maybe we can do this again in the future, and maybe months from now, if you got some free time. And
I have a lot of free time. I'm retired now. I just have to schedule it, because as you found out when you tried to schedule me, I'm the busiest retired guy you ever saw. I just finished 4 days of tournament golf. I have a few weeks here where I'm back in the Scottsdale area, and then I'm heading up to the mountains for fishing and my summer life. So,
well, I promise it won't be for a couple months. But my idea, I was just thinking about this, is what maybe we could do is I could say to everybody out there, say, listen, I'd like to talk to Tom. You guys ask the questions. Give me a list of questions. We'll Bob wants to ask Tom this question. I think that might be fun.
That'd be fun. I'd enjoy it.
A different perspective than just having to deal with my psychological issues. Who knows what kind of issues I've got. Anyways, Tom, I appreciate you being here today, and we will hopefully get this posted right away, and I'm sure people will enjoy it.
Yeah, thanks, Michael, and keep up your great Facebook posts.
Thanks, Tom. Appreciate it. Talk to you soon.
See ya.
Bye-bye. It doesn't stop there. My second podcast with Tom Basso.
Hello, Michael.
Hey, Tom. How are you?
Doing great.
So I have a lot of questions.
I've been watching them. I've been laughing as I read all these there. Yeah.
It saved me today. I didn't have to work that hard.
Well, I think we've hit on a new formula for the Michael Covel interviews, I think, as long as the person you're interviewing is open to a wide range of whatever is going to happen.
Yeah, well, I don't necessarily have an order, but I figured, and I'm going to give an introduction earlier, so I don't think we need to keep telling them who you are. I think they're going to know by the time this is all established. But I have a quick question that I want to throw at you, Tom. You saw a video that posted on my site from a philosopher, a guy named Alan Watts, and you kind of by your comment, you connected with that. The guy that said, if money was no object, what would you do? How would you manifest your desires? How would you unfold your life? And I was wondering if maybe you, at the beginning of this, if you might kind of relate and talk to that little video.
Well, it's something I learned probably sometime in my 20s, just now getting to be a lot of years ago. And it comes down to somebody asking the question of, what if you had more money? What would that get you? And you try to answer the question. And then you say, okay, what if you got that? well, then I would be able to do this. And if you keep going long enough and the person asking the question just keeps hammering away and say, okay, so now let's give you that. And what do you have now? What it comes down to is happiness. It comes down to you can make a choice no matter what your lot in life. How many poor people have we seen that have a smile on their face and they enjoy every day? And how many wealthy people have we seen that are just miserable? And it's really a choice that each person has to make, to just be happy. So I think that if money was no object, I think it provides a lot of flexibility. It probably provides a little bit better chance at having proper nutrition or better ability to exercise and keep your body healthy. There's all those little things, but in the end, it can provide happiness as long as you allow it to.
Yeah, I think that was a good way to maybe start this off, because we have a lot of people that really want to ask questions, and I've got them all here in front of me, like 7 or 8 pages of questions about making money, essentially through a trend following system or trend following style thinking. And I just thought it was important for you to kind of put that out there at the beginning, because ultimately, you're going to have a lot of answers and give a lot of feedback to people, but I think it's important that maybe they actually know what's important at the very top.
Well, and I'll add to what I just got through saying and kind of dovetail it into what you just said, that say you want to be a good trend follower and you become a master at it. So 20, 30 years go by and you're doing very well and you're managing your own money, and you can still make your life miserable. You can take some of the money and go buy some real estate and complicate your life, or you could have 5 divorces, or you could have all sorts of extraneous things that you allow to intrude on your happiness. And so just being a good trend follower doesn't somehow make you happy. You can choose to be happy before you become a trend follower, and you can choose to be happy after you're a successful trend follower. Yeah,
I think it's a great way of saying it. Well, let me jump into some questions, because I know no one wants to hear from me. So
fire away.
So this is from Dan Montag, and it says, Tom, how do you, Mr. Serenity, manage your emotions during a loser? Any changes today since the book, The New Market Wizards?
That's a good question for Dan. He's a smart guy. What I try to do is kind of a concept in my mind I sort of labeled anchor to the wind, if that makes any sense. What I try to do is when I'm on a super fast winning streak and money is flowing in almost in record amounts, and I almost can't believe it, I keep trying to force my mind into a place where I remember back to those struggle for 4 years to get my commodity account to even break even, or the latest drawdown and how I felt during that drawdown. And what I try to do mentally is bring my enthusiasm back to neutral. And so the opposite is also true for Daniel. I try to, in losing periods, go back and remember those times when I had every market on the page turned green and making money hand over fist. And that tries to take my depression, or not my depression, but my frustration, anxiety, anything that would go during a drawdown, and you're trying to remember back to those times when you had everything on your page green and everything making a lot of money, and it sort of brings you back to neutral again the other way. And the goal is to try to go into each day just sort of dead neutral, and try to end each day about the same. It's just another piece of data in a long, long stream of thousands of days of trading over a lifetime that are all just data points. And when you step back and look at it from that distance, it sort of calms you, and it calms you on the upside and calms you on the downside, allows you to just think rationally.
Yeah. I'm going to also offer here too, Nick Rossetto had a question which is basically the same, so I'm not going to ask it, but I at least wanted to give Nick the call out that his question was basically the same as Dan's. So there's a let's see, there's this one from Bruce Stock, and it says, Tom, you conclude most of your Facebook posts with the expression "enjoy the ride," and he is asking what drove you to that conclusion. And maybe was there a period in your life where it was a challenge to enjoy the ride?
Good question. I usually put enjoy the ride to remind all those traders out there that there's no final destination to all of this. I mean, we all eventually are going to pass away, and we're not going to be trend followers anymore. We're going to be dead. I think you need to take every day and see the magical things that happen around you, and be open to new ideas and observations about the world that exists out there. And that's what it's all about. I think trying to get to some final destination and putting yourself through hell to get there, when the destination may not be quite what you think it is, or might be a little disappointing when reality sets in, and you get there and you say, well, is this all there is? Enjoying the ride is everything to me. I start each day with, I can't wait to attack it. And this morning I was hitting golf balls, playing with a new concept for about 2 hours and 10 minutes or so, and just enjoying a beautiful Scottsdale morning. And I was the only one on the range. It was very quiet. It was beautiful. And that's what enjoying the ride's all about. It's not just about trading your brains out.
It's funny. I had right before we started today, I did a yoga session with a teacher, and it was about an hour and a half, 2 hours long. And at the very end, as I'm laying on my back, eyes closed, she basically just read a passage that was almost verbatim for what you just said. Literally just almost verbatim. The moment of now, enjoy the journey, and it will all be over at some point in time. So try not to live in the future, don't live in the past, and you got right now.
Mm-hmm, exactly. What was the second part of that? There was something about enjoy the ride, but then...
Oh, hold on. Okay, let's see. As I'm looking at 7 pages. Okay, was there a period in your life where there was a challenge to enjoying the ride that really stands out?
Yes, probably. And that was probably before I understood a lot about myself, and probably in my 20s. I was working as a chemical engineer. I was trying to get an MBA. I was designing a custom home that I was about to build 4 years later out in the woods southwest of St. Louis. I was starting up Kennedy Capital, which is a stock manager investment advisory firm in St. Louis, and I was also trading commodities. That was a pretty much wake up in the morning, go hard all day, and then fall asleep exhausted and get up and do it again. Weekends, when I wasn't working as a Monsanto engineer, I would spend my time doing my research on my commodity account and try to improve what I was doing in my stock trading. And so my research projects, and this is pre-microcomputer, so you're doing a lot of stuff with a calculator, you're really running your eyes, and you're not enjoying the ride a lot, but you realize that you're trying to get through it. And I think at this stage of life, both from an energy level, my age being 60 and all, I think I pace myself a whole lot better. I do take on a lot of things and sometimes find myself rushing a little bit, but there's always that time in the day where I say, okay, time to put it away and go do something fun. So I always try to get a little bit of enjoying the ride into every day if I can do it.
I'm looking at some of these other questions. Fred Penny basically asked a psych type question, a trading psychology type question that is right in line with what you're saying. And I just want to try and call people out because some of the questions are very similar. Let me jump into, where's the one that I wanted to get to here? I'm going to go kind of to the top. So I think this was actually... might have been the first. Was this the first question? I think so, maybe. Larry Tintorelli. Larry says, can you ask Tom about his exit strategies on winning positions? Okay. A lot of traders know to use stops for losers, but exiting winners can be a bit trickier. So I'm going to jump back into some more fun psych stuff, for lack of a better term, but I thought that might be a good kind of meat and potatoes question to jump into.
Okay. Larry, he's a smart trader himself. I listened to his podcast and loved it. The answer to Larry's question is pretty simple. I don't look at a whole lot of difference between a winning trade and a losing trade. I think of it in terms of if the direction is up today, I want to be long, and I want to put a stop sell behind that position. And as long as the direction continues to be up, I'm either keeping the stop where it was or moving it in the direction of up. So I'm moving it up behind the position. When the direction shifts and goes the other way, the stop eventually gets hit and the down direction is now in place, and I wouldn't want to be in the position anymore. So I try to simplify it down to something that simple. I don't try to second guess and say, okay, well, this position's, I had 20% and therefore I should do something different in terms of trying to take the profit or whatever. I just let it run. I remember a very famous question of Ed Sikota back. I was listening to a talk he was giving probably when I was in my 30s, I'm thinking. And the person asked Ed, well, what's your objective when you get into a trade? And Ed looked at him and said, pretty much the moon. When I get into the trade, I'm hoping this thing goes long and I'm going to be in it the rest of my life and I never have to do another trade. I mean, that's a good answer. There's no reason to think it couldn't. Reality would say that I've never had that happen yet, but, let them run.
And have a plan if it doesn't run.
If it doesn't run, it's going to hit the stop and change direction then with a loss. If it runs and then falters and changes direction, you're going to hit the stop and switch to and have a profit. But it's the same exact trade as far as I'm concerned. I don't try to differentiate it. I know some people do, and I don't see any reason why you couldn't look at that as a research project, but it just never made any sense psychological to me. Psychologically, if the direction's down, I don't want to be in it. I don't care whether I have a profit or a loss. I just don't want to be in it.
So Clint Stevens and Steve Burns both have a question on hedges. And I'll read Steve's question here. He says, I would like to hear Tom's thoughts on the edge he has in his trading method by using hedges to decrease losses in downtrends instead of exiting his long positions. And Clint was essentially asking a very similar question on your use of hedges for your edge as well.
Okay. Well, takes a little time, but it's pretty simple. Say you take any kind of strategy you want, whether it be purely technical, partially fundamental. I like to screen stocks and ETFs based on a little bit of fundamentals. If I'm looking for a high dividend, yield would be a factor you could screen positions on, for instance. Valuations like PE ratios and things like that, I'd rather pay something a little bit cheaper than buy something extremely pricey. That being said, let's say I'm smart enough to put together a diversified portfolio of longs. And let's say we do that last September, just for the sake of argument here. I just happened to look, because I was closing down my market stuff just before you called, my equity in my stock portfolio, which has been hedged quite a lot of the last few months, is exactly the same as it was in mid-September. It hasn't gone up or down a nickel. But what has happened is I've put hedges on every time a down direction occurs, and I've taken them off every time an up direction occurs. All right? And what happens is time is clicking by on all those wonderful positions I put in place. So you're getting closer to long-term capital gains, which I can use for charitable contributions, or I can get a better tax rate on. Meanwhile, on my hedges, I'm short selling the SPY ETFs, which is very, very liquid. I can short anytime I wish. I can take off anytime I wish. It trades sometimes like 30 times a second. And what you're doing is buffering your portfolio with the SPYs at the same time that your long positions have the ability to, over the long run, become a long-term capital gain and to allow their alpha, if you've done your job right picking them, to sort of go through every up and down and show that they can do something for you. So that's where the edge comes in. You have the long-term gain and the taxes there against the short-term nature of the hedges.
Let me go ahead and jump we got a long list here. So
I know. I did really block off the afternoon just in case.
Oh, wow. I'm still sitting here as a sweaty mess from yoga too. This is from...
we aren't using video on this. It's just audio.
Yeah, they don't want to look at me right now, that's for sure. But once I get to the point I can do handstands, I am going to try and do some of these while I'm in a handstand. And so maybe I can ask questions. I've never really tried to read upside down, but I will try. So that'll be something new for another New Year podcast. There we go. I will be somewhere in Thailand because I'm going to Asia February 1st. I don't know for how long or whatever, but so maybe somewhere in Thailand in a really good scenic view, I can get upside down and do a Skype call with you, video sometime in the new year, Tom. That'd be really fun.
That'd be fun.
So anyways, this is from Brandon Bruckman, and Andreas Sis also asked a very similar question about, says, Tom, during the strategy development and testing process, what metrics gave you confidence in your system? And what process did you follow in taking a developed system from testing to live trading? I think it's probably
wow. Okay.
It's not a short answer, I know.
No, I know. Some of these are a little bit more, they're good questions, but they require a little bit of history and kind of blocking through the process. When we came up with a concept at Trendstat in the day, we were trying to figure out whether it added value or not. There was a number of different things we did. First of all, we had a set database of cleaned up data that we went through and painstakingly made sure there was no anomalies, like, for instance, a close or an open that was outside the high-low range is an obvious one that you find in databases all the time. And that can't happen. If you got an open and a close, it's got to be within the high-low range or something's wrong. So we'd have the cleaned up data, and we would go through and take the concept and program the actual indicator that says buy here, sell there, or do whatever the indicator's trying to do. Then we would try to have some metrics. We primarily looked at largest drawdown, average drawdown, time to recoveries, and we looked a lot at return to risk ratios, and we'd measure risk by return to drawdown. We'd measure at return to volatility of the returns, those types of things. And all of that is great, but I can tell you that in reality, the thing that helped me the most feel comfortable with any kind of new indicator was when I would go into my office, tell my secretary, Lisa, I'm shutting the door, and I'm going to be going down this research result, and unless it's an emergency, don't bother me. And I would take a ruler, and I would start with page 1, put the ruler on there, and I would read what the market did that day, and I would read what the results from the strategy were that day. And I would ask myself this one question: did that strategy perform that day like you would have expected it, given the type of market that you had that day? And it's very important to understand it to that level, I think, because in the end, that's what causes trend followers, or any traders for that matter, systems traders primarily, to let go of their system and abandon it when it's having a rough 2 weeks or a month or 6 months or a year. I know one of the questions was, what do you do when your strategy is not working? Well, to me, as long as, if you looked at the data of the last couple months of the market, let's say, and you said, based on the strategy and the way I set my strategy up, I would have expected my strategy to have a difficult period in the last couple months. Well, then it's not broken. Don't fix it. Just let it keep going. Wait for the good times. Good times are somewhere in the future, probably. I think a lot of people take a drawdown as it's not working anymore. None of my strategies, maybe there's ways of doing this, none of my strategies, including when I had all of them together and add them together, ever got to the point where I never had a losing day. They're always going to have losing days. So when I looked at it, I said, geez, as long as, if I'm having a choppy sideways market and I've got a trend following model that's getting chopped up a little bit in the sideways market, well, that's what I would expect. Let's wait until the next trending market and I'll be fine. And I think that's really, I got that level of knowledge by going through day after day after day. And I would just sit there with, I'm talking thick pieces of computer paper, and just take a ruler and go down the page and look at every day's data. It would take me hours. But when I got to that level and I thought, I understand it, it's working, I understand exactly how it's going to react to a lot of different things, and the metrics look okay, let's go turn it on and put some real money with it.
Well, let me throw in as a follow-up here, Jim Byers, and you were just mentioning drawdown and how it really can't be avoided. And so Jim asked the prescient question. He says he wants to know if you can describe what you learned from your earliest large drawdown.
Yeah, that was an easy one to remember. It was a silver trade. I think it was documented maybe in the Market Wizards interview. I can't remember now. But I was merrily going along my way, and I put on a couple of, I think my portfolio had gotten up, and my futures portfolio was about a couple 100,000 or something like that, 100,000 maybe. And I got into a couple different silver contracts, and this was the time when hunts were trying to corner silver. I didn't know it at the time, but it turned out to be that time. So silver went through the roof, and it exceeded any expectation I would ever have. But being the good trend follower I was at that point, I was going to hold on for dear life and just go up and down, and whichever way the market went, I was just going to keep moving my stops as the stops could be justified. My stops got pretty far away because the market was going so fast upward. And at one point, I noticed that my equity in this little $100,000 futures account had gotten to something like 600,000 or 500,000, something like ridiculous. I had made 400 or 500%. I'm still hanging on to the same exact positions. That's when the major drawdown occurred. I got out of the position, and my portfolio ended up probably about $250,000 or 300,000 or something. I had lost 300,000 just in a matter of weeks when they broke apart the corner and increased the margins, and the whole thing just fell apart and went limit down, day after day after day. And what I learned from that was that volatility as a percent of the equity in my portfolio need not change. What I mean by that is I had several different silver contracts. There was no reason why I couldn't stay with that silver trade and be a good trend follower and ride it to the bitter end. But I didn't need to hold the same number of contracts at the end as I had when I started out. I could peel off contracts as I went so that it reduces the volatility to the portfolio, but still gave me a significant silver position. That way, the portfolio acts more like a portfolio instead of 15 things in a silver position, where the silver position drives the whole portfolio up or down every day, and the rest of them doesn't make a difference at all. By volatility adjusting my positions on an ongoing basis, and I did it with the computers at TrendStat every day, we could take 80 different commodity markets traded by multiple different systems, and the computers could just tell us where the volatility of equity, per equity of every single position should be, so that all of the portfolios acted like portfolios and no one market could really dominate too much what was going on that day. And that's what I learned from it. It was a very valuable lesson that sort of expanded into risk controls as a percent of equity, margin as a percent of equity. And by the end of TrendStat, we had lots of different ways of trying to control position sizing and make that position sizing, the bottom line of the position sizing was that every position had a meaningful impact on the portfolio, not a small amount, not a large amount, a meaningful amount. And when you get to that level, then you're truly, managing a portfolio.
I was going to ask him, and I'll come back to it. Clint Stevens has a question where he was talking about returns plus serenity versus just going only for returns. I'm going to jump back to that, but I want to Eric Spineman and Rudy Widjaja both have questions that revolve around your use of money management the types of money management, how you approach risk control, and whether you pyramid at all. And so both of those guys had a similar question there.
All right. Well, I viewed money management, easy calculation, take the risk to your stop loss of where you are at any point in time, multiply it times the number of contracts. That's your dollar of risk in that position. Divide it by the equity in your portfolio, and that's the percent of your portfolio that's at risk at that point due to that one position. You could do the same thing with volatility. You take the volatility of any one position times the number of contracts. Volatility for me was the average true range of over the last 20 days. Divide it by the equity, you get a margin or a volatility as a percent of equity. Margin, you can do the same thing. How much margin per position times the number of contracts, divided by the equity, you have margin per equity. You can set fixed levels for every one of those three things. And by doing so, you can do a calculation where the computer says, if I exceed the limits on any of these, I'm going to sell off enough positions to get me back down underneath all of those limits. And I even went to the point where I had initial position limits and I had ongoing existing position limits, because when a position becomes profitable and starts running, it's by its very nature going to take on a little extra volatility, a little extra risk, but you've got a winning position now and it's going your way. You want to let it run. So we found that we came up with a level for initial position risk and initial volatility risk as a percent of equity and sized our portfolios. Then as the markets would run our way, we would allow it a little more room. As it got above those levels, we would just start stripping off contracts until we got back to the point where it was in the limits. And yet we would always let our positions run, as Ed Sequoia would say, to the moon.
Well, I'm going to keep jumping here. We got lots of stuff to cover when everyone wants their questions answered. So,
that's okay.
So Ross Hendricks and Matthew Fry both have questions about system testing. And Ross, it looks like from a beginning standpoint, is really saying, what kind of advice could you give to the first-time programmer looking to perhaps backtest for the first time? And Matthew's taking it a step further, and he's saying, do you believe in walking a system forward? If not, what metrics are best used to monitor the health of your edge, and how do you know when you might make a change? So Ross is really asking, how do I get started as a beginner and perhaps programming my system? And Matthew's saying, wants some comment on walking a system forward, and how do you know when a change might be needed?
Good questions all. Starting out, I had, I guess, the good fortune in my case to be a chemical engineer. So I took Fortran programming and basic programming and understood what a program was all about. I was not born with a knowledge of programming, I would point out. And I don't think any of the people on the Facebook page were born with a knowledge of programming. But these are learned skills. You can buy books on it. You can take classes in it. I would recommend when you're starting out, take a good look at something as simple as an Excel spreadsheet. For a lot of things that I do anymore, since I don't have full-time programming staff at Trendstead being in retirement and all, a lot of the stuff I do nowadays, I just do on the Excel spreadsheets. They've gotten so powerful and so capable. I mean, with the gigabytes of hard drive that we have on our computers and on the high processing speeds that we have, you can do an awfully a lot of stuff on an Excel spreadsheet today that I could not even program in BASIC back on my IBM PC back in the old days, or my Trash 80 back in, 1980 probably. The computers are pretty powerful on a small basis, so consider the Excel spreadsheet. Maybe start there. You can see what's going on a little easier. If you want to try to get a little fancy, inside of Excel spreadsheets, they allow a little Visual Basic type of modules that you can install in there to do fancier things. There's lots of courses and books available on that type of stuff. That's probably where I'd start. A lot of the canned strategy programs can give you sort of some tools to look at some things. My worry is that a lot of those tend to not be geared to exactly the way you're going to end up trading. So it's giving you a little bit of not a realistic view of what it is that you're about to embark on. And what I mean by that is sometimes these CAN programs don't have the same position sizing that you're going to have. So they might be based on one contract, and the one contract is always one contract. And so you get the results of one contract, but you don't get the effective money management in there and all that. So you get a sort of a weird look at history, and you might become tainted good or bad by that. And when you're looking at history, you want to become comfortable with your strategy versus various types of markets. You do not want to get to the point where you just fall in love with some strategy based on some simulation that was not even done in a rigorous fashion, and then all of a sudden it's falling apart in the future and you don't have that comfort level that you need to stick it out. That's how I would start out. And on the walking forward question, walking forward to me is a term that describes, for those who haven't run into the term before, sort of taking a section of time, running a strategy, and then coming out with the results of that strategy and using that particular database to re-optimize somehow your parameters. And then you're going to go attack the next part of the database and see what its results are, and then use that second section of data to optimize the parameters. And then you're going to walk that forward to the third chunk of data, and so on. I thought that seemed a bit clunky in that that's not the way real world works. I don't, to me, every day was another day, and I wanted to just continue to have things. If things need to change, for instance, example, true range, average true range over 20-day changes every day. So if you want to think about it, if you have average true range as one of your parameters, it's walking forward every day, and day after day, you're getting a new 20-day period, a new average true range, and things are changing each day. So you're walking it forward based on that. And that's more close to what you actually do in trading every day. So I like that type of strategy better than blocking off large sections of data and optimizing that section and then using it on the next chunk of data. So I would encourage people, if you want to think of it as walking forward every day, that's fine with me. You can certainly do that with your historical databases by calculating the average true range of every 20-day period, and then you just start going through the database and make your decisions and make your money management calls and let the databases keep track of it all, and you're in good shape.
So I got a question here from Andrew Derbyshire, and essentially what he's asking is, you started to excel in the world of trend following, and of course, the vast majority of market participants are still in an orientation that's more maybe value or fundamentals or buy and hold. Is that if you would get the skeptics, and he references something that I did on a podcast where I combined 4 interviews that David Harding gave on CNBC, and I offered some comments. And during those interviews, they really didn't seem to really get what Harding did, even though you would think they might have done a little homework before they had him on, but on 4 separate occasions. But one of the occasions, and I'm not saying this to kind of like say anything negative about somebody, but on one of the occasions, Joe Kernan of CNBC was essentially implying or making reference that that trend following, or what David Harding did, was very analogous to long-term capital management. And so I guess what Andrew is asking about is skeptics, and how you might have handled skeptics in the past, and perhaps even skepticism towards trend following, that, for example, how Harding was having to handle that on CNBC.
That's a good question, too. And we certainly had our skeptics, and they still exist out there. And probably that's one of the reasons why it still works so well. If everybody believed in it, it probably wouldn't work so well. Yeah, I think what I ended up having to do in the later stages of my career, I did some studies that looked at where did trend followers make money and where did they lose it. I came up with the concept of taking the monthly returns on an assorted portfolio of 20 or 30 different commodities. And I measured the amount of absolute change in direction in any one market. And then I put that against the profits that CTAs got during those periods. And I did this first with our own Trendstat portfolios because I had the detail of market by market by market. I did it later on a macro basis by saying what were the average prices of a whole portfolio of things, high or low, and what were the profits from CTA industry, high or low. And we found a definite correlation that when markets move, CTAs make money or trend followers make money. I think that that should be very logical. I don't see why anybody could disagree with it. I don't see why anybody would think that wouldn't work. So then the question becomes, are you going to have market movement, or are markets just going to sit in one place for the next 20 years? If you knew that markets were not going to go anywhere for 20 years, I don't think you probably want to be a trend follower. You probably don't want to be a trader. You can't make much money if the market isn't going to move anything, because you got to buy one price and sell at a higher price, or sell at a higher price and buy at a lower price. But if the market doesn't move at all, you aren't going to get a higher or a lower price. You're going to get the same price. It seems to me markets have to move. And it seems to me also over my lifetime, thanks to computers and lots more participation in the markets and so on, all the forces that come together, there's been more volatility rather than less. So there's more potential for things to explode to ridiculously high levels. You've got now the currency being somewhat devaluated with all this QE nonsense, I think, that I'm dead against. If the dollar keeps getting more and more worthless and things like crude oil are based on dollar, then, people in the Middle East or wherever are going to want more dollars for the same amount of oil that they're selling us. And it seems to me we're going to end up paying it sooner or later. Therefore, you've got this bias for things to go outside the range that they've ever been in before. Just because the currency that it's based on is kind of going outside of where it's been before as well. Given all that, it seems to me that that's where trend followers like David Harding are going to just, over time, continue to make money, and why people like CNBC and some of the people on the interview shows who spend their whole day, you got to realize, in front of the cameras talking about what is happening up on this ticker board that's behind them or in front of them. And they can't see the forest for the trees. They're looking at the noise all day long, and then trying to ask David Harding, a guy who's thinking in terms of lifetimes, a question which he answers very eloquently, and they don't get it because they can't see beside, they're looking at the last 5 minutes of what the Dow did or whatever. I think that's where the disconnect becomes. And in terms of where I see the edge for trend followers is just simply my bias that I think there will be more volatility in the future rather than less. And I think there's going to be a lot more big moves in the future than less. And you have to put up with the nonsense in between.
As you were talking about some of the talking heads in the news shows, I've had I've had a lot of interesting experiences, but one interesting experience comes to mind was being invited to CNBC to speak with producers, to have them, unbeknownst to me at the time, they wanted me to pitch them a show on the spot. And I remember walking through that studio, and it was so interesting because there's this big bullpen area of all these reporters. The people that you see on TV, they go back to their computers and they start typing away, doing whatever. And then over off to the side is the set. So, as a viewer, you're sitting there and you see this nice little TV window of what's going on. But as when you're inside the studio and you look at it, you realize, wow, this is all to steal from your background a little bit. This is all very engineered. This is all very fake. This isn't real. And if you stand there and you see it in live, in living color, it's much different than flipping on the TV and seeing what they want you to see within the confines of the borders of your screen. Mm-hmm. It's quite interesting.
And a lot of it's just geared to talking about noise.
Yeah.
why would anybody tuning in want to hear something from David Harding on a strategy that would require a tremendous amount of work to put together, cover the next, decade or something, instead of, I want to know why the Dow's down 50 points today.
Right.
When are they going to get to that? That's what I want to know.
Right.
So that's kind of the average Joe just doesn't get it. And, I wouldn't think CNBC would be a place where professional traders would go for ideas, except maybe what to do the opposite of or something.
Well, I guess maybe if they see an interview with David Harding and they've never heard those types of answers and that type of thought process, maybe they'd be like, well, maybe I better find out who this guy is and what he does, and maybe I can learn something.
Yeah, but it would require you having enough knowledge to separate the good pieces of information, David, from the bad pieces of information, which would be, the announcers that are asking him the questions.
Yeah. Touche.
And if you knew that, you probably didn't need to go
right.
talk to David Harding.
Exactly. There you go. That's catch-22, huh?
Yeah.
So I have a question here from Clint Stevens, and Clint says, in Jack Schwager's book and the Market Wizard's book, it suggests that you were not included in the book on a return basis alone, but for this combination of, quote, serenity, a nice way of life, plus returns. So Clint wants to know your development of your trading approach and how you run your life from the ground up was the notion of serenity and not being a crazed, overweight, overworked trader sitting there nonstop, no life. Was that thought of from the very beginning? Yes. As you were going to lay out a life in front of you?
Yes, it was to a large extent. It's slightly different than you would expect, though, in that my view, I think we might have even covered this in the last interview briefly. My view of my job as a money manager was to manage client assets. It wasn't to manage my assets. So when I talk to clients and I ask them what they like and what they don't like, and I listen to client complaints over the years about, I'm firing you because of this, why, 1, 2, 3, 4, 5, whatever. You learn as a money manager that really the average client out there, sadly, does not allow their money manager that they hired to do what that money manager is capable of. Because if you do, and you go up and down too much, it makes the clients nervous, they fire you. And they always want to chase after the returns and give you the money when it's high on your equity curve. And when your equity curve's gone through a drawdown, they want to pull it out. So it's very self-defeating from the standpoint of performance fees. It's very self-defeating from the standpoint of clients making actual returns on investments. It comes down to something I determined very early on in the process, that it was my job to try to make the clients as good a client as I could so that they would allow me to be the best money manager I could be. When you do that, you start designing your strategies around the client, not around you. Now, because clients had a lot less risk tolerance than I did, it indirectly fed into my quality of life because I created strategies that were a lot tamer, that had a lot less variation. I attempted to try to stick to return to risk ratios that were good and sort of boring. And the reason Jack, when he looked at my stuff, he kept having people say, you should really interview Tom. He's a very interesting guy. And Jack, being the caffeinated New Yorker, at the time working for Prudential Base Futures, and director of research, I believe, he, you got to picture yourself in his position. He's looking for the sizzle that'll sell the Market Wizards books and trying to find all these guys that have created, quadruple, hundreds, thousands % returns and are legends on the street that sells books. And my story isn't that compelling. It's an engineer that turns into a money manager who's got some kind of tame returns and just kind of cruises along. So from a surface outside, Jack didn't see much there of interest. But when people kept telling him over and over again he needed to interview me, he kept getting kind of puzzled over what the heck does everybody think that's so, interesting about Tom. And when he got done interviewing me and found out how I designed everything to have a life and that I had a really fun life, And he realized sort of wistfully, I think, that he hadn't figured out how to do that for himself yet. I think he sort of indicated to me that out of all of the 2 books that he wrote on the market wizards up to that point, my style of trading probably in the end would be something he would be most interested in following versus all the others, because it led to sort of a peacefulness and a control of the trading process to the point where there wasn't a lot of angst. And I think Jack originally came to trading thinking there has to be stress, there has to be, it's a macho type of endeavor, and you got to go for big returns, and you got to suck it up, and you got to, ride the equity curve, do all these things you got to do. And it was all nonsense, really. It just, his own biases led to that. And I kind of opened up his eyes to another world.
I'm going to add completely unrelated, but I think it's kind of a lifestyle choice that I saw someone in my family make. And this would be my father. And my father is a dentist. And he decided, even in his 20s, before he had any practice to speak of, before he had any real grand revenue coming in the door or anything, he decided as a very young man that he was going to work a 4-day work week. And he's taken off Friday every week, and that he built that into his system, so to speak, as a young man. So I think there are ways, techniques and ideas that we can think about doing things differently. And I get back to the Alan Watts video that I discussed at the very beginning, the guy that was bringing a lot of Eastern thoughts to the Western world, which is, how can you structure your life differently? And think about it early on. Don't just get stuck on the treadmill.
Mm-hmm, exactly. And to finish the answer to the question, let's say, he continued on and said, how has that evolved? Well, now I'm in retirement. Now, Trendstat's no longer there. I don't have a staff of 10. I don't have 40 computers. I have one PC that I pretty much do most of my work on, and we're talking on another PC right now. I have to think to myself, all right, let's see now. I don't have the staff. I don't have the backups, but I need to create good trading strategy. So I morphed into a different style of trading in different markets that I trade now, some of which are due to, like, I never traded orange juice at Trendstat because we were too big, but now I can trade orange juice, so I trade orange juice. Now I only have one contract on. It's not a big deal. And so you adjust with the conditions that exist at the time. And what do I want out of retirement? Well, I want to be able to go hit golf balls today for 2 hours plus. I don't want to be tied to sitting here in front of the computer all day and, looking at charts and ruining my eyes. I'd rather go out and prune trees in the backyard and plant some flowers and go work out and go for a hike and go play golf and all these other things that I like to do. So why, if I'm going to create a trading strategy and I know the amount of money I'm going to try to deal with, I know my skill level, I know my resources of what kind of computers I have and what kind of software I have, and I know what kind of market data I'm getting in, why don't I design something that works for my lifestyle so that my lifestyle is exactly what I want it to be, and yet I can still apply good trading strategy and principles to my trading? And I think that's simple to do if you just start from the question, how do I want my trading strategy to operate and fit with my lifestyle? I've often said, if you're a traveling salesman, you're on the road 5 days a week, and you're home on weekends, why not do a Saturday morning trading style where you take once a week data, you look at it Saturday morning, you make your decisions, you send them in electronically, and then you go on the road Sunday night again.
Yeah. I mean, I think it's surprising. It's actually been surprising me in the last couple of years how many large trend following funds use weekly bar systems.
Absolutely. It gives you a different angle. And, when you're a very large CTA, I think one of the reasons why some of them are struggling is the dollars that they're managing are just so huge. They affect the market when they go in and out. So they have to start getting in or out over 2-3 days and going to weekly charts and doing all sorts of things. And as long as you do the rest of the work on risk control and portfolio diversification and other things, there's no reason to think you can't be successful. It might change your return stream or your return to risk profile a little bit, but that's what these big guys have to do because they just cannot afford to make any trade that is not an essential trade because they just can't. They got too much money, and it's hard as a CTA when you got a lot of different forces trying to shove money at you, and your employees trying to, make a career of being in the business, and you're trying to expand and go into new markets and all those things. It's really hard to turn down money coming in. You have to really set some of your own personal levels and say, no, this is going to be 100 million and we're going to shut it down at 100 million. And if it gets above 100 million, we're going to start sending money back to you all. A lot of CTAs have done that, but it really does give an indication that you're kind of choking on the amount of money that you're managing. And so, allocators that are giving you the money are starting to think, geez, this guy's sending money back. That means he's really struggling to try to get the money invested. Or maybe they say he's being true to us and not diluting our returns by trading once a week and something. So it has two sides of the story, but it's something that brings up a sort of a spotlight on that trader, and he has to be able to withstand the scrutiny and explain why he's sending money back. But some people just don't, and then the returns sort of get diluted over time.
Yeah, you bring up a good point, maybe not necessarily where you were going, but it made me think about the idea that the idea of the trading strategy and then the money management business. And one of the things that I've done in my books, to some degree, there's a positive to this and then there's a negative, but it's great to show the validity of a trading strategy by looking at all these different traders that have these historical track records. And you can say, well, look at how this is performed over many, many decades. And that's fantastic. But your point also, when you start to talk about the money under management and assets and the money management business, frankly, I don't think most, not that you were doing this you weren't doing this on purpose, but I think most people they really want to know about the trading strategy. I think sometimes what happens is the money management gets blended into the two of them. And like here you describe your life today. Your life today is one man, no staff, and a nice life. And I think sometimes, when I receive questions from people, they want to talk about, well, did you see this? I mean, for example, John W. Henry recently closing down his shop. For me, it's hard to criticize a man who was in this space for 30 years, very successful, had
survived.
Yeah, survived. Huge assets under management. And, then he decides he wants to go to another business, completely unrelated, makes a fortune in that. And then is it surprising necessarily that he maybe doesn't have every ball in the world bouncing up in multiple Fortune 500 businesses? So I think it's sometimes you just need to step back a little bit for perspective on this kind of thing. Yeah,
you do. You really do. And I think John Henry is a good example. I mean, he ran a little bit more leverage than I would have run. So he had a little bit more up and down, but, he was able to continue to attract attention and had enough marketing capability or sales capability that he was able to keep the business running for a long, long time. Hats off to him for doing it. And
yeah.
I think in the end, everybody should consider what does John Henry want to do with his day? Does he want to, manage a futures trading firm that he doesn't have a whole lot of interest in? It's just a big liability, and he's got a very deep pocket. So why put yourself through that liability?
Yeah, I mean, and I think it's if people think about it, it's not necessarily surprising. If just like you've made this transition, and it's almost, I knew this years ago. When the moment John bought the team, you say, well, he's obviously he's interested in other stuff too, and it's kind of hard to be interested in two very big things like that in one lifetime. So Larry,
and who knows? He may be looking at something else completely different that we don't even know about.
And you have to salute that. You just have to, and once again, the moment of now, and you adjust to the situation. And I just think it's a fantastic story. Look, you and I both know that there's a lot of armchair quarterbacks that sit out there on the sidelines, drinking a Budweiser, 50 pounds overweight, watching the football game, throwing out criticism. But you got to give props to the guy who's in the game and he's sweating away and he's making it happen. I have to salute that 100%.
Sure.
So Larry has another question that I thought was great too. And so you've got a coin flip entry method experiment that you've done. And Larry wanted you to kind of reiterate that because he thought it really, the concept behind it, because what it does is it focuses people less on entries, which is the favorite thing for most traders when they're getting started, like, where do I get in? And it puts more emphasis on the exit and proper money management.
Right. Usually when novice traders start out, their biggest thing is to read a book on trading. Or, they read trend following manifesto or something, they find out a lot about what is a moving average and what is an exponential moving average and what is a range breakout system and what is point and figure charting and on and on. And they get sucked into this buying and selling, and a lot of times with one contract, because that keeps the math simple, and you can put it on a spreadsheet and off you go, and you try different things and you find something that you think works, and off you magically go and hope that you're successful. Along the way, of course, I had my lessons that I'd learned on money management started driving home the point in spades that money management was far more important than the buying and selling stuff. But everybody that would want to interview me as a potential money manager would want to know about my trading strategy, not about my money management. They always wanted, the clients want to know more about what you're doing. And I thought, what I need to do is to once and for all shut up people about this nonsense of it's all about the trading strategy and it's not about the money management. So I developed a strategy where I took our cleaned up databases, and I think at the time I did it with, I think 5 or 6 markets, maybe 7 markets, something like that. I can't remember now, it's been so long. But it was replicated by some guys in Austria with about 30 markets. Same conclusion. In my study, I just said, okay, let's flip a coin, random number generator. At the end of the day, if we don't have a position, if it's heads, you buy. If it's tails, you sell. As soon as that position's put in place, you take a simple range breakout strategy, and if it's a sell, I put in a buy stop. If it's a buy, I put in a sell stop. I move it in the same direction as the trade goes. So you're truly just letting the trade run as long as you can until it hits the stop, and then you flip the coin again. What I found when I did that was over any run that I did, because it's random numbers generator creating, so your buy and sell decisions are completely random and completely different every time you run it through. So we ran it 100 times and got different results every time. But the propensity over time, over lots and lots of runs, was that it slightly made money. Not a lot, but it made money. And the key to it was balance in the portfolio was perfect. Each one of the 7 positions had a meaningful impact on the portfolio. There wasn't one that was dominating or one that was dominating good or one dominating bad. They were meaningful. And all of the risk control was there with volatility control. We had the risk as a percent of equity limits, so we had all the number of contracts were perfectly balanced. That's what creates the profits. The buying and selling don't make that money. You can use a coin flip and still make money. The guys in Austria, by the way, that ran it on 20 or 30 markets, I forget now, they actually made more money per year than I did with my coin flip because I only had 7 markets. They might have been running a little bit more portfolio heat in the end, but they had made money too.
Well, Tom, we're on the second half at least here. There's only so many more in front of us, so I will only keep you from the links for so much longer.
Oh, I'm all done with the links for today.
Okay. So this is a question from Guru Prasad. Guru Prasad, I am not going to pronounce your last name because I will only butcher it. But he's got a real simple question here within a larger question. He really wants to know about percent betting. He's talking about he feels comfortable at 1%, and I think he would really like to hear your view on percent of capital bet on each trade and maybe how you view that choice of percent bet.
Yeah, this is where I think it'd be very important for each trader to do his own simulations on percents. And we had limits, as I already said, on things like margin to equity, volatility to equity, risk to equity. And we had those specific numbers that we had come to based on simulating how various leverages feed back into return streams and how much can the portfolio go up and down in a particular day, week, month, year. What kind of maximum drawdowns do you tend to get out of different portfolio heat levels and how much leverage? And so he's very perceptive. 1% is an area where probably we ran Trendstat quite a bit. In some cases, some markets, we were down in the less than 1%, very rarely where we were above it. And we pretty much, on ongoing trade risks, were up in the more like 2% ranges and stuff like that, because you had a position that was now moving your direction, your stops are now been moved, and you're starting to get to the point where you're going to start letting it run as far as you can, and a little more risk is fine. Excessive risk then is not fine. I think that's a question that each trader needs to handle for himself. And an important thing to note is, now that I'm in retirement and I have my wife and myself as our sole two clients, and she's happy with what I'm doing, I can run the portfolio, especially my futures portfolio, a little bit higher than 1% and feel very comfortable with it. Because I know what I'm doing. I know it's going to go up and down a little bit more, but I know I've controlled the amount of risk that I've got, and that makes trading it a little bit faster. Not a big deal to me.
You want people to see what the range of possibilities are.
Correct. Each trader should really try to simulate some trading ideas at different levels and try to dial it in, if anything, a little lower than you think you can tolerate. Because when in the heat of the battle and you're in that big major drawdown that you've never had before, having less of a drawdown will be better than having more of a drawdown. You want to kind of err on the conservative side on the numbers. So if you can do your simulations and it comes out, well, I think I can do 2%, well, maybe do 1.5% just for a while at least, and see if you think that's okay. You don't need to be rushing out and trading 10% of your equity on a position.
Giuseppe Luizzo, I hope I pronounced that right on the back end there, has a very straightforward and basic question, which has got a lot of weight behind it. How do you diversify your portfolio, Tom?
That's a tough one, more and more in today's world, because globally we've gotten into so much electronic data, so many computers trading so many different markets. It was very easy for Trendstat to manage something like 30 currency Forex markets, something like 80 futures markets, and about 25 mutual funds that we traded, and to do it with 10 people. 4 of those people were doing development work. They weren't managing it. Only 2 were involved in the actual production of orders and running of the trades. So 2 people are handling hundreds of clients across hundreds of different positions by scores of different strategies. And it's easy to do every day. And I think the afternoon runs would take maybe 10 minutes in the case of currencies, and then we'd run the rest of it in maybe 15 minutes. It wouldn't take that long at all. And I think diversification is harder and harder to come by, because in any one day, let's say you take a soybean contract and you take a gold contract. Well, theoretically, those two shouldn't have a whole lot to do with each other. So gold could go up and soybeans could go up. Gold could go up, soybeans could go down, on and on. All different possibilities. So you would hope that by having a soybean and a gold in your portfolio, you would have some diversification. But what's happened historically more and more, and it's always during times of major news announcements, wars breaking out, collapse of this or a bubble bursting or whatever, you get these what I call lockstep periods where every market moves in a direction that's either 100% correlated with another market or 100% inversely correlated with another market, and nothing in between. They are no longer independent. You look at your portfolio on a day when this major thing happens, and all of a sudden you've got your entire screen is green. Every position in your portfolio is green. You're making money across the board. Well, the very next day, a shift happens and everything is red. You're at 100% lockstep. You've got no diversification. You think you do, but you don't. The other situation I see a lot in novice portfolios, they'll come in and say, well, I want to look at my portfolio. Okay, fine. It's some relative, it's a friend, whatever. And I'm looking at their portfolio, and they've been sold by their broker or financial planner numerous different growth stock mutual funds. I remember my sister had a portfolio she showed me, and they had 5 different mutual funds in their portfolio, 3 of which were just big old growth stock mutual funds. I said, well, you don't have any diversification, and they're all going to go up when the market goes up. They're all going to go down when the market goes down. You're going to buy and hold them. That's not diversification. Well, I have 3 different ones. Well, that does not give me a diversification. The answer to it is a difficult one. You're trying to grind through all the different markets and how they trade against other markets over a time period. But in the back of your mind, you're also trying to say to yourself, when times of crisis exist and lockstep sets in on these markets, I better have my risk control schemes in place to limit my exposure, both good and bad, unfortunately, because I don't want the bad part of it to reside in my portfolio. But when I know that no matter what I do, I'm going to get zero diversification in the world because markets are just so intercorrelated these days.
So Chris May asks the sarcastic, where is gold going in the next 6 months?
I thought that was cute.
I think I'm down to 3, the final 3, and then I appreciate all your time today, and I'll let you run. But I've got 3 left here. As I've been doing this, if everyone's wondering, I've had literally 15 pieces of paper in front of me trying to eliminate redundancies, combine people, and so there's a couple questions that just aren't going to get asked. I'm sorry. A couple of you guys did not really think through a couple of these, and they're not getting asked.
Okay.
So this is from Fred Penny, and this is a good question. He says, what would cause you to stop trading a particular system, and then what might cause you to start trading that same system again?
All right. What would cause me to stop trading a strategy would be the day that I realized that in market conditions that existed in the recent history, the results I got from that trading strategy were different than I would have expected given the way that strategy had gone through those markets. Something happened that I did not expect. That's why I am so big on going through those day by day with the ruler concept in the simulations. I needed to understand everything that happened and how that strategy worked and how it reacted to various types of movements, so that as I'm going through life and I'm looking at the last 2 weeks or 3 weeks or 4 weeks, and I'm seeing let's say a market that's going one direction, and I'm a trend follower, and I'm looking at this thing and it's not making any money. Why is it not making money? Something's wrong. That's what would cause me to stop trading a strategy and take a good look at it. If I could find why it was doing that and where I was wrong on my construction of the strategy somehow, and feel comfortable making some change to it that would solve that problem, then I would be immediately willing to start it up again if, went through the simulations and went through the line-by-line look on it and said, this is ready for prime time, let's get back into it. If I couldn't find why it was doing what it was, what was creating that anomaly between what I pictured to be the way it would act and the way it really acted, then I would just dismiss it. It would go to the junk heap, and I'd move on with something new.
So this is as you mentioned that, I'm kind of curious though, because your background, the engineering background, very analytical. Was there ever a side of you that, or did you just naturally adapt to it because of your upbringing, training, whatnot, where the uncertainty that is always inherent in a strategy, especially these types of strategies, the uncertainty that you were comfortable with that range of possibilities, comfortable with that uncertainty, whereas so many people just want this. They want to believe that when they line up with their system to trade, they're going to get 1% a month every month. And so the fact that you really, I think anybody that starts to understand this world, this way of thinking, has to really find peace with uncertainty.
Yeah, I think the way to do it is to look at daily returns or some large amounts of data. I had, 20 or 30 years of cleaned up data back in the day. And so we had huge databases that we could go through. And you start looking at daily data or even weekly or monthly data, you're talking about so many data points. If you throw them on like a bell curve or something, you're going to see a wide variety of different types of conditions. And so I viewed my job as a money manager more as managing all this random data coming in and just making good money management decisions and dealing with all the data and not getting too emotionally involved in, what did the gold market do today? I don't really care. It's just another piece of data I had to process. And I think that was maybe the good fortune of being a more of a data processing mentality, a statistician mentality, an engineer mentality.
It's kind of a puzzle for you to figure out.
Yeah, I have always treated the whole money management concept and trading to me is just a puzzle. It's just no different than trying to work a Sudoku or a crossword puzzle or solve something, a brain teaser. It's a mental effort. It's like golf. You'll never achieve a perfect round of golf. Every time you get done, you say, if I could have just made that putt on 17, I could have done this. And there's always a way to look ahead and say, I can do better than this. And I think trading's the same way. You never arrive at the final destination. You only sort of get better at it over your lifetime, and then somewhere along the way you die and you can't get any better. But you never achieve the final destination. You never become the perfect trader.
Yeah. So Howard Fraser has a question, and kind of a quickie, but he really wants your views on initial capital at risk versus unrealized gains. And I guess he's just kind of looking to hear your wide view on that.
My wide view is when we did studies of return to risk at every point in a trend following trade, it's a very interesting study that you would do, and you could do it yourself if you wanted, Michael. You could take every buy signal you've got and say, okay, that is day 0. I am in the position now at this price. My stop is wherever it is. And then you go ahead and you let the trade continue on, and you measure the risk per contract and the return. You calculate ahead and use your historical database to figure out what the final result of that trade ultimately is. But then you go back and you go through every day of the trade and figure out what was the potential future return for the rest of that trade versus the risk at that point in time. So on day 5, let's say the trade's going to be at 30 days long, and you're going to make 10%. On day 5, it's only going to be 25 days to go till you're out of it, and it's only going to have a certain amount of return. It might not be 10%, it might be 7.5%. And then what is the risk at that point? And so we'd measure return to risk every single day throughout the entire trend following trade, and we did this over hundreds and hundreds of trades. And we realized that and concluded without a doubt that the day you get into a trend following trade is the day when your return to risk ratio is the best. The farther you go into the trade, a la the question on pyramiding that someone asked, pyramiding means you're getting in later in the trade and expecting it to continue to go your way. The return to risk ratio is not as good with that pyramid trade. So we pyramided or added positions, but we did them in very diminished quantity and under very stringent, low-risk conditions where like we'd have a pullback or something and we could move our stop up tight to the market, and we felt comfortable doing that in putting on a very small additional position. That's a very tricky proposition to try to keep your return to risk ratios high enough to justify doing that. Your initial return to risk ratio is the highest the day you get into the trend following trade. Now, on the ongoing risk, to answer Howard's question there, I always felt because of that nature, that trend following, a market that has gone in one direction and it favors your position, you're trying to let those profits run. At some point, you have, let's say 5 days into this trade I just described, 10% trade, we're up 3% already. And so it's looking pretty good that this is going to be a profitable trade. It's not, you're already moved ahead nicely and it's going your way and you don't know it's going to be 10%, but it's moving along good so far. So the odds are now greater, it turns out, of having a profitable trade than not having a profitable trade if it moves in your direction. We did that study too. given that, what we did was we loosened our risk and volatility controls a little bit for an existing trade, and we called that existing controls. And then we had initial limits for the initial position. And the existing trade levels were always a little higher than the initial risk levels and volatility levels. So let's say, use the 1% as an example. Say you have 1% risk of your portfolio, and then maybe existing trades, it's 2% risk of your portfolio. So you're giving it some room to grow.
And I think you'd also make the point there here. Once again, this is something where people need to not just trust Tom, but
Exactly.
to test this, to see how
Absolutely.
the range of possibilities unfold.
Exactly. Because in the end, each trader has to live with his or her own decision. I'm not going to be there to console them. So they've got to come up with whatever level feels comfortable. For somebody like my mother who couldn't stand to see her account go up or down a penny, she would have to trade at like a tenth of 1% risk to keep it so boring. But I think everybody's got their own level of comfort, and I think you need to understand what that is. Let's say you're, Warren Buffett, to cite an example, and he's going to go into trading 20 commodity markets, and he's only going to put up $1 million to do that. Well, that's going to be such chump change of his total net worth. He might feel comfortable holding a different risk level because it's immaterial to him, even if he loses it all. So his comfort level could be a lot different because of his situation. Comfort level also come from expertise.
His utility of money, for sure. It's going to be different there at that stage of the game.
Exactly. And his also expertise levels. If somebody's very, very into their systems and understands exactly what they're doing and is comfortable with drawdowns generated by those strategies because they're so knowledgeable in systems, well, then you could run your risk levels a little higher, perhaps, because there's that technical expertise that you have over the novice. But the pure novice with no experience, no nothing, keep it low. The lower you go, just putting a trade on and taking it off, even at a very low level, may not be material to making a lot of money, but it's very material to your experience and your growth as a trader.
Yeah. I have one last question, Tom, but I want to make a comment overall for people because we were kind of getting into it there a second ago, which is the idea of kind of a guru status. I think, Tom, if I read you, Tom, you love giving insights about what you've experienced. And then the idea is that people can extrapolate from that, and maybe they can get a little bit of a head start, or they can learn from your experience. They can see something. But I don't think Tom is looking to hold himself out as a guru. I think he's looking to be a man who's sharing his wisdom, sharing his insight, saying, here's my past experiences. And I think the group of questions were pretty good that I think most people kind of get that about you, Tom. But there's some questions where you could kind of tell people, they want like the magic answer. And if you give them the magic answer, then they're validated. And that's really not what you're trying to get across to people. Is that a fair assessment?
It's a fair assessment. The only reason I put the direction that I have on my indicators and my hedges every day on my Facebook page is because I have a brother-in-law and I have a stepson who are trying to muddle through early stages of trading. And I find it convenient to communicate with them in that manner because they do have Facebook pages and they can actually find out which way I'm leaning to then ask me questions, which they usually do, and become more knowledgeable. I'm trying to help my stepson learn how to become a trader and manage his 401k and all that. And so I started doing it just for basically relatives and friends that were asking me the questions. It's dovetailed into this like 300 friends all over the world thing that I wasn't quite expecting at the time, but I don't mind carrying on the tradition.
Well, I hopefully I'm responsible for eliminating some of your free time in your life.
It seems to me a lot of the new friend requests usually have a Michael Covel as a mutual friend. Yeah.
Okay, here's the last question I have for the day. So this is Jeremy Clifford, and he's talking about this. I mentioned David Harding being on CNBC recently, and I guess Harding gave a story about getting long at crude oil at like $30 a barrel. And he said I guess he must have said in the interview, he was a little nervous. But his system said, get long, you got long. It turned out to be a great trade. And so Jeremy's saying, do you have anything that you can think back of where, the signal said, get long or get short, and your gut was just like, no way, this is insane, but it's your system and you stuck with it, you did it, and it turned out to be a great winner?
Man,
that's on the spot question.
No, I've had those. I'm trying to remember a specific example. One of them, I believe, was the market timing signal that I got to buy mutual funds off of the bottom action after the 87 crash. The world was coming to an end. Everybody, they were flooding liquidity in with the Fed, and we'd lost 23% on the Dow in one day, something like that. And mutual funds, fortunately, were in cash about a week or two before the signal went. Well, when the signal went off, it was already a week before the crash actually hit. So I preserved all the assets, and now we're getting a buy signal, and I'm thinking to myself, boy, is this artificial? We got the Fed coming in, we got super volatility, that's gone off the map, but it's a buy signal, and if this thing runs up, we're going to be caught without a position, and it's not what we do. So I said, it doesn't feel comfortable, but it turns out if you bought in right after that crash, it did nothing but go up for a year or so. It was a good period, and you just have to shake your head and go, oh boy, this would be interesting. But you got to follow the strategy. The people at Trendstead had a rule with me. I said, as long as you do exactly what these computers tell you to do, I'll take the responsibility for the computers to be doing it correctly, and I'll also take the responsibility for having the strategy produce losses during any period. But you're going to take the responsibility of actually executing it flawlessly. And by separating that out, I relieved them of any stress of being wrong on the market direction or anything, and they could execute. But yeah, I had a few times over my life that I've had that happen, and it's been surprising how many times when you're most uncomfortable, so are almost everybody else out there, and by the time everybody gets comfortable, the market's already moved significantly in that direction. You gotta just turn your brain off a little bit and do the trade.
So Tom, do you have? I know if you want to say, Mike, I'm fried, I'm done. But do you have anything that? Those are the end of the questions. So if there's any other thought or wrap up that you might want to go, or we can just pause until the new year and hopefully find you again on the podcast in the new year.
Well, it'd be fine, but I think the only thing I think we can encourage people to do out of this is what I try to encourage everybody to do. Really, is to find their own way. List down what your resources are, what your skill levels are, what your mental capabilities are, how many dollars are you going to put into the thing, what markets are you trying to trade, and figure it out and design what works for you. Because what works for you is not going to work for me, and what works for me is not going to work for you. So I get a lot of questions on things, and I'm happy to have the questions. I'm happy to help when people have issues. But I would encourage that sort of introspective look at oneself to decide, how do I want to trade? Because I've seen so many successful traders and do it so many different ways. I think the key is when you look at what they're doing, it matches what they are. And they didn't go out and just follow somebody else.
You're probably most happiest when someone who's been asking you questions disappears and finally stops asking you questions.
No, I
you know what I mean, though, philosophically.
Yeah. Well, philosophically, I think they finally either get it or give up. I'm not sure which, but if I don't hear from them again, it's hard to say which one it is.
Well, that's fair point.
No, guys, a lot of times when they're starting out, they'll ask me a lot of questions, or they become a friend on Facebook and they'll ask me some questions, and I try to give them concise answers on and get them pointed in the right direction. But invariably, some of those answers are going to lead them off into maybe months of work. And
right.
So if they're going to go off and do that work, great. It's going to take months. I probably don't hear from them for a while. But there's a lot of guys you've interviewed, and I listened to some of the podcasts myself. It's phenomenal how much effort they've put into thinking through their own strategies. And they aren't doing what I do. They're doing something different. And yet, they are successful in their own right. And it matches who they are, what their dollar sizes are. Some of them are working full time. Larry, I remember, just started up his new car dealership there and has a phenomenal life plan and a great trading strategy. And it's not the same as mine, but he's got a lot of things going for him. Just lots of other guys. Steve Burns, listened to his podcast, and I thought it was great. I can't even remember all the names and all the ones I've listened to anymore, but there's a lot of smart people out there, and they all have different talents than I have. I mean, there's a lot of people that know a lot more about economics than I know about economics, let's say. So maybe that's useful. Or they may know a lot more about computer programming than I do. I'm an engineer, but I wouldn't call myself a programmer. I can program, but, I keep it simple.
Tom, I have to fess up. So I think this is like 93, 94 podcast or something. You're not the only person that's having a memory problem with all these podcasts. So I can't really admit that, but there is an issue going on here.
Congratulations on that, by the way, because I think you've hit a wonderful niche where I think you're exceptional at interviewing. And this little game that we've had where we've had everybody ask the questions, it's just been a blast for me. I hope it's been fun for you too.
Yeah, I think we're great.
And as long as the person is willing to jump around on topics, because you get kind of far afield sometimes on the next question.
Yeah,
I don't mind it. If it's useful for someone, all the better. But I think it's a fun way to lay down some recording. And in the digital world, it doesn't cost you that much to put it up there, and it's digitally free to download. And you're helping a lot of people out there, and you obviously have a big fan base. So
I'm telling you, it's amazing. These podcasts, this month will probably end up being the largest month, even on a short month, even with Thanksgiving. And I mean, we're just talking hundreds and hundreds of thousands of listens. And a lot of these individual episodes are it's just thousands and thousands of listens. So it's really fun to watch. And I think it's somewhere, like 147 countries and territories. I mean, Tom, we're never going to get to that many in our life. So
no, I've traveled the world, but I haven't traveled every country, and I don't want to.
Well, listen, I'm going to let you run. I appreciate your time today, and we'll get this up later today.
Well, it's my pleasure, and good luck to everybody out there.
Thanks, Tom.
And enjoy the ride.
Let me keep that party going. Here is my third podcast episode with Tom Basso. Here's the first question I had for you today, and a bunch of folks on the internet also had some questions too. But I think one of the things that's interesting about you, and I think this is somewhat what you're known for, at least by reputation, but you're very good natured. And there are a lot of people in the industry, so to speak, and maybe traders where sometimes they lose sight of the happy part of life. They just lose sight of life. In fact, they get so fixated with the screen and the idea of making the millions and what they think will come with all the millions. And they get caught up in that. And you're so good natured. So I guess my first question is, when is there a reason why Tom Basso is so good natured? I mean, you sign a lot of your posts, enjoy the ride, my friends. I mean, it's very good natured. That stands out as unusual in today's society.
Yeah, I suppose. I guess when I was going through high school, I ended up sort of observing my own behavior quite a bit. It was a weird thing where I almost have this second part of my brain that would watch what Tom Basso did every day. I don't know. It was a weird thing, but it kind of gave me the ability to sort of analyze how did I react to the world around me day after day. And I used to do it pretty much once a day, sort of think through the day and kind of say, did I react well to that situation? Was I overly nervous? Was I overly excited, overly depressed, overly scared, or whatever? And I think as time went on through college and I played a lot of basketball, I started noticing, being able to be sort of out of my own body. I could almost look at our defense and call out where everybody was supposed to be and could see guys behind me, because I could, in my mind, keep track of the other five guys, and there's one missing, so he's got to be behind my vision. And, just stuff like that. And as I expanded and I got into the real world, I realized that I sort of took that attitude with life in general. It's sort of like a movie, and I'm just flowing with it. And, trading is one part of my life, but so is hitting golf balls, and so is cooking dinner, and so is eating dinner, and so is watching television, and, being a husband to my wife, and all the other things that go on with life. And I don't know, to make trading your whole world seems a bit shallow to me. There's so much more to life, and it is so short. You get reminded of that as you get older, and I'm 61 now. You start seeing some of your friends pass away, and you start realizing, it's nice to take some time to go to Tahiti, like I was telling you I was making arrangements for this morning. Just to enjoy some things that you've never done before, and help other people. To me, I only have a finite time on this earth, but trading will go on, hopefully, way past my lifetime. And it's nice to pass along the simple things that I've learned that aren't rocket science really, as you know from your knowledge of trend following. It's not that difficult. People make it difficult, I think. And I think if you can help people understand how simple it is and how there's more to life than just trading, I think that's a good thing. More balance in the world.
I'm going to give a shout out to a young guy who I believe you were on his podcast, Andrew Selby. Yeah. And I caught a line that as I was preparing to talk to you today, I caught a line where you talked about the idea of imagining, and I'm paraphrasing, so I'll let you tell it incomplete, but imagining the horror, even if it doesn't happen, imagine feeling it. And when I saw you say that, or I saw the comment, I thought to myself, stoicism. Was I on the right path?
Yeah, I think what was this a reference to how to prepare for things? Right.
You kind of got to go through like mental exercises and whatnot. Yeah. And you were talking about the imagining. And my first thought when I saw it, because I always think of stoicism is like, think through the worst case scenarios, live them in your mind. And then when some of these bad things happen, you're not so surprised.
Well, that's exactly right. But I'd also argue that you should also live through the good times as well in your mind. So when you're getting into a position, if you could say, if this went insane, like if tomorrow or something, this stock I just bought gets an offer for twice the value that I just put into it, what does that mean? How do I react? Am I overly excited, adrenalized? Do I want to take the profit? Do I want to, or am I just going to follow my strategy and just do what I do? And I think you got to prepare yourself for all sides of it, and not just the bad ones, but the good ones too. I think you have to think ahead, go through a lot of different scenarios, and be prepared mentally to deal with them.
That's kind of the trend following in the emotional arena as well.
Yeah, it really is. It really is.
Tell me about since we kind of started going down the psych side of things, so to speak, the mental side, tell me some about your mental exercises, so to speak. And I'm assuming the mental exercises that whether you're driving in the car or whatnot, that these are for far more than just trading.
Yeah, I played all sorts of games on myself over my lifetime with my brain, and I think that it reaped some good rewards. I've already mentioned the sort of observer self that I had in high school and in through college. As I observed myself doing things, I think eventually somewhere probably after college, I would say, this observer part of my brain, that just I kind of had a certain part of my brain dedicated to kind of keeping track of what Tom was doing every day. That sort of meshed right into my brain, sort of. It became such a natural thing for it to be there. I don't even think about it. I don't see it as a separate entity or part of my brain that would dedicate itself to watching Tom do his day. I think all sorts of exercises you can play games with minds. For instance, I remember Van Tharp saying that young children that were about ready to, young boys mostly, that would go out and fight their first tiger or try to hunt their first lion would be taught to defocus their eye state and see what it does to your brain. And because it sort of takes away a lot of your fear. And I've tried doing that on the golf course to some success, where you, walking down a fairway, you look at a distant object, but then after you're focusing your eye on the distant object, like the pin, you try to see your peripheral vision clearly as well, so that the whole thing becomes just, this monster view going into your brain, and you're not focused on any one thing, like that lake over to the right that your ball could go into if you hit it poorly. It's just this one big vision, and fear goes away. Lots of different things. Breathing, noticing that you're breathing heavy, or you're talking faster, or you're moving faster, or those types of things. All just being an observant, I think, is a lot of it. Driving, I've played games with just wondering how these guys get off the drag race, when the light goes green. So I'll be sitting there and I'm watching everybody else who's playing with their texting and listening to the radio and doing everything. And I'm sitting there in the first position at an intersection, of course, being careful to look both ways, making sure nobody's coming at me, trying to see what would be the quickest possible reaction time that my body can take my foot off the brake and put it on the gas. Not to go fast, but just to be the first car moving into the intersection, leaving the rest of them still wondering what's going on. Just little things like that. I think it's all been fascinating, learning how the human body works and how the brain works.
And I think even though we can't get into the minutia of all these different types of things in this conversation, if anything, you can inspire people in the audience that are younger, maybe they're starting out, or maybe they've gone the wrong directions. You can inspire people to start to think more about this mental aspect of success. Because
if you don't have mental capability and good psychology and trading, the rest of everything you'll do will be destroyed. You can have the most fantastic. I could automate a program, put it in a black box, hand it to somebody who is a basket case mentally, and they will screw it up because they have the ultimate ability to. The person that doesn't have good control of their mind is going to have a problem even executing a well-constructed black box because they will screw it up. They will override it. They will not do a trade that they should have done. They'll take profits too quick because they finally feel like they've got all this profit built up and they won't wait for their stop signal to get hit. They'll never do it. I think as soon as people realize that the mental side of trading is the first and foremost, and then next up probably is going to be your position sizing, control of your risk, volatility, all those issues on the portfolio. And last and least important is going to be what you buy and sell, or where do you buy and sell, basically.
On the emotional side, as you're bringing that up, you're not just necessarily pointing out to, let's say, new traders or inexperienced traders. There are plenty of super successful, not necessarily sure how they got there, but plenty of super successful, maybe they had a little luck, very wealthy people that make those mental errors that you're talking about, and a life's fortune can go down very fast.
It certainly has. And if you look at, say, the first Market Wizards book and even the second one, you'll see certain people in there that are no longer around because they might have done well up to then, but they were pushing the envelope and maybe they didn't have their mental processes screwed on as straight as they would have liked, and went awry along the way. I survived 28 to 30 years roughly trading. If you want to count now, it's another 10 years trading currencies with no issues blowing up, or I'm still doing it. I mean, it's a long run, and you got a lot of traders don't make it that long. And I think a lot of it's due to how they think through the process and how much risk they want to take on and how much they can stay with something day after day after day after day. I've always been pretty calm towards the whole thing, and I think that's reflected in some people have accused me of being a little bit on the boring side in terms of trading. I never went for the fancy profits or anything, the big profits. But I like to try to avoid the losses and continue to plug along. And I think that serves you well over the long run. A lot of people could take a good lesson from that.
You're one of my most popular guests, if not the most popular. So your boring must be pretty exciting to a lot of people. So that's my impression.
Yeah, so every time we do one of these interviews, I get about 15 emails or Facebook letters.
Well, let me jump into some trading issues. I had a couple points that people brought up and a couple things of my own. I saw a line. I just want to read it to you and tell me what you think about it. So the quote was this: if you're not afraid of losing small amounts of money, you're almost invincible.
Yeah,
how does that strike you?
It strikes me pretty well because that would allow you to realize on things like trend following, where if you do the statistics on what we did at TrendSet back over the years, various buy-sell programs that we would have would range from perhaps 28% reliable all the way up to maybe the top I would ever get would be 40, but more realistically 36, 37% reliable. So it's averaging around 33% or 1/3, let's say. That means every single trade I get into, I've got a 2/3 chance of losing money. So if I take that on mentally and say, okay, I want to make those 2 losses that I statistically know I'm going to get, I've got thousands of data points that tell me that I'm going to get 2 losses for every 1 gain. I might as well take the attitude that I got to limit those 2 losses and be okay with it, because that's just 2 out of 3 that I got to look for. For every 3 trades I do, I'll get a profit. Profit will be bigger than the losses. I make money over the long run. That's what we're doing here, so why would I be concerned over those small losses? And I think once you realize that and accept it and understand why you got to have those 2 losses, then I think you're well on the way to making some good money. I heard one person say one time, a long time ago, trading is sort of like breathing. You gotta, everybody wants to breathe in because you get oxygen, but you have to breathe out also. And that's kind of like the losses. They're both part of the breathing process. You got to have in and out.
Yeah, I tell you, as I continue my yoga practice, the breathing it's the core of it all. Well, let me shift it here to another one. So I did an interview today and someone asked me a question. I'm going to give it back to you. Okay. And they wanted to know why trend following does so well when the black swans hit. And so I was curious as to if somebody asked you that, well, Tom, why does trend following why does it do so well when the black swan events happen, these surprises happen?
Well, trend following by its very math is saying let your profits run as far as they want to run and cut your losses short when they don't go your way. The black swan happens, which is a outlier event of major consequence probably that has never happened before, and it's gone like way beyond the realms of anything anybody's ever seen. Trend following at some point is going to pick up the move in that direction. It may be a big gap to get into it. It may have started out months ago as nothing, and then all of a sudden has become a speculative bubble at this point. Everyone will happen a different way, and I've probably seen them all in my lifetime. But no matter where you do get in, you will get in, and you will ride part of that black swan. And that one trade, and maybe a couple of others, might be the difference between making money that year and losing money that year when you take everything else and add it together, because your small gains are going to offset some of your small losses. But to really make money, you need those kind of real outlier events that really drive, a Japanese yen position, and you're in it for the whole year or year and a half, and the thing has gone up 100% on the face value of the currency, and you're leveraged, and you end up making, hundreds or thousands of percent. That really pays the freight for a whole lot of losses. And that's why trend following makes money.
Let's talk about your daily routine. And going back a long time, and I caught a post the other day on your Facebook where you were talking about the total amount of time that it took to execute your daily routine. And I want you to actually talk about routine some, because I have a feeling routine is very important in your life, and there's a reason why routine is very important. But I want you to explain the time that it takes for you, but then to also interject, of course, you have to develop the system, and there's a lot of time behind that. But then once you have your system and your daily execution, why don't I let you run with that and explain what you had posted the other day?
Okay, let's talk about the 2 things. First, the thing on time. The other day I posted something, and I think it took me 12 minutes after the markets closed to go through my entire process. And I forget exactly the numbers, but I want to say I moved like 4 stops in in the stock area times 4 accounts. I think I moved 1 or 2 futures trades. I can't remember how many. I also checked and moved some stops on my hedge trades, and it all took me 12 minutes. And I did that because I was getting some posts and questions from traders on Well, on how much they need to do and how often do they need to look at the market. And, I was getting the reaction that some of these people were spending their entire day looking at the screen. And I'm thinking to myself, what could I possibly do to waste that much time? And so I thought I was going to try to just go ahead and time myself just to make the point to everybody out there that, sure, if you want to argue about it, I've got 28 years at Trendstat, another 10 years retired, honing my skills. And
hold on, that's not even 40 years yet. That's only like 38 years.
It's only 38 years. I'm still only 61. But, when you get that much experience behind your belt, you know what you got to do every day. You just have to kind of execute it. And I think if you're trying to design a new way of trading every single day and every single moment, looking at the screen and looking at the price going up and down and trying to say, well, what does this tell me? Should I change my strategy? Should I do some research on this new idea that I just heard in a podcast or a newsletter or wherever I got it from, a friend? You're going through all this gyration in your mind. That is going to just gobble up time, and it's so non-productive. In my case, I know exactly what I've got to do to execute my trend following models, and I pull up my screens, and I start at the top, and I start going click, 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 and then my mouse is, of course, I'm faster and faster over the years with my mouse and my computers, and I know exactly what I got to do next, and I just keep going. I try to tell my wife I'm going to be closing the market down, I tell her, and she knows to just kind of stay away from the office for a little bit. And 12 minutes later, I was done, stopped the clock, and I went and did the Facebook post. So that's kind of where the time thing came from. But routine, you mentioned, and I would say routine is important. And I guess I kind of, I guess I got kind of the routine side of things from the standpoint of the markets will wait for no one, is one of the things I've always told my staff at Trendstat back in the day. And that's why we had so many backups and somebody's taking a vacation, somebody else has to fill their spot. The markets won't shut down because you're having a 4th of July, because guess what? London does not respect the U.S.'s 4th of July. We've revolted from them. So the currency markets are open on the 4th of July. We got to be there. We got to still do our thing. Who's going to take a vacation day? Who's going to work? Routine becomes something that is driven sort of by the way the markets and really almost life work. You probably get up, you'd probably be good to have breakfast in the morning because it fuels your body for the rest of the day. It's probably good to exercise. I see you upside down, sideways on your yoga positions, and you're obviously in good shape. I could not do that, wouldn't even try. I do work out. I am in good shape for a 61-year-old, I think, and still hitting the ball pretty well. And I'm enjoying all these things, but I think that routine of exercising, routine of eating, routine of hydrating your body with water, routine of making sure you're there for the markets. I've got to put my stops in and move my stops or check things once a day. So on this cruise to Tahiti, for instance, that we were talking about earlier, I'm now up to a level with this cruise line where they give me unlimited internet on the concierge level, which is where I'm going to be. So I'm bringing along the computer, and sometime each day after the markets close in Tahiti, I will be on my computer for my 12 minutes. Then I will go back to having fun. But there's a certain routine that has to be done there. And I think that's kind of the way, some people think that's too rigid, but I mean, I can spare 12 minutes on a vacation. I don't think of that as too burdensome.
No, and especially the life freedom that you get from making the choices that you've made. Some people think, oh, I'm going to go on vacation. I don't want any distraction. But those are the same people that go back and work a 9-to-5, grind working for the boss man their entire life. So I agree with you completely.
Or they go back home and they find that they've missed all sorts of signals that they should have missed or should have gotten. I'm remembering the story I told Schwager back when he was doing New Market Wizards interview with me about the silver trade, that my parents were visiting me and I had missed the silver trade, and it turns out it was worth like $100,000, and this was when my account was $10,000. And I had missed it. And when I missed it, because I wasn't paying attention to my stuff, I was playing tour guide to my parents. I'm not blaming my parents. It's my responsibility. I should have been doing that. Shouldn't have been taking my 12 minutes or whatever it was that back then to do my work. And I got sloppy, missed the trade, missed that profit. That would have been, put me way ahead of where I ended up being now. I would have been that much farther ahead at an earlier stage. and been profitable more early in my trading. So it's all, you have to really look at how you go through every day and ask yourself, where's the time slip away? And because you wake up in the morning and go to sleep at night, and there's a lot of minutes in between. And if you really think about what you spend them on, it's kind of amazing how many you can waste.
And in this day and age, we waste a lot more with all these electronic gadgets, for sure.
Absolutely. Yes.
Yeah. Well, this is a question from Fred Penny, and Fred I thought it was a good question. He said, if you were a 20-something guy or gal today and not much money, and you're just getting new knowledge, if you were looking back and with your experience and saying today, and you were approaching the kind of the trading world today, would you approach things the same way? Would you go about it the same way?
I don't think so. I ended up, of course, as most people know, a money manager and a futures trader and a currency trader, and Trendstat Capital was my firm before we shut it down back in 2003. Back in the day when I started, which would be back in, I was starting to trade in the 70s, really got our first firm off the ground in 1980. I formed Trendstat in 84, broke away from the previous firm, Kennedy Capital, and ended up at Trendstat. When I did all these things, track record, if you could just establish that you were trading even $100,000 and doing it successfully over a period of, say, 1, 2, 3 years, and maybe showed growth in assets from 100,000 maybe to $500,000, maybe you got $1 million now under management, people would take a serious look at you and say, this guy's making progress, his track record looks solid, I like his approach, he seems sensible, he seems like a smart businessman, he's hiring people to back him up, he's got computer equipment, yeah, we'll give him a chance, here's another $5 million, and all of a sudden you got $10 million under management, and all of a sudden somebody will give you another $10 million, and pretty soon you're at 20, and then you're off to the races, and you can build your business that way. Nowadays, I get the perception, and I'm a little bit removed from the industry these days, being retired, but I've heard stories where some asset allocators would want you to have 20 or 50 million under management and have a staff of 10 people and computer equipment and backup locations and marketing staff and everything else. And I don't know how I would have ever gotten into the business back in the day. So I think in today's world, with all the automation and with all the, basically, I use Schwab and Interactive Brokers for the two sides of my trading in a lot of my stuff. And I use them all around the world. I'm in Italy or Tahiti or any place. I get an internet connection and I'm in. No big deal. A lot of the charting software and all that stuff, we had to build that at Trendstat in the old days. Nowadays, it's free with your account, and it just keeps getting more and more sophisticated. I'd be inclined to go ahead and work as you said before, a 9-to-5 job of some sort, and perhaps one that had a little bit of flexibility to it so that I could do some trading as I was working the job. When I was an engineer, a chemical engineer, I could easily go home at 4:30 from designing chemical plants and spend a half an hour working on my commodity account and transmit my orders and then go have dinner. It wasn't a big deal.
So your real issue is, if I'm hearing you, is more it's the money management versus the trading, and they're not one and the same.
No, they are not. And for those people who think they're going to get in the money management industry, let me tell you that the year before I shut Trendstat down, I spent $100,000 on regulatory, CPA, and legal fees at no benefit to my client that I could see. And I spent probably 60% of my time either with personnel, accounting, or legal issues. Less than 10% of my time probably actually doing meaningful research or trading that most people would think is the fun thing that they like to do. You spend very little time trading, more time running a business if you want to be successful at it. And I think for most people, if they love trading, I would suggest staying a little longer. If it was me right now, I probably would have stayed an engineer or moved into the business side of my company that I was at. I probably would have done a little more strategic planning and business things and tried to get, I was highly rated at this company I was at, and I was promoted a month before I quit. They seemed to like what I was giving them and doing. I would just get more raises there, get into stock options, get into whatever you can get into, and keep saving a lot of that money, put it into your trading accounts, hone your skills at smaller amounts of money, and then get your portfolio to the point where it was supplying an extra source of income for you. And when that extra source of income got to the point where it was equal to your current source of income, you probably could safely retire at that point. And I probably would guess that rather than retiring at 51, if had I done that, I might have been able to retire even before. Because the things that I did at Trendstat kind of, by their nature, had to be very regulatory. So, for instance, I couldn't front run or do anything. You know, I had to be careful with what positions I have versus the clients and all these things. And so basically I had to kind of keep everything pretty plain vanilla with my own trading, sort of match my clients, or actually put my money in the same fund that my clients are in so that I'm getting exactly the same trades in essence, so that there would be no favoritism to me over the clients, because that's illegal. And I think without those restrictions, what I'm finding after 10 years in retirement is I can do things that I could never do for clients. I trade orange juice futures. Geez, I only need one of them or two of them for my portfolio. If I had Trendstat with $600 million under management, how am I going to buy orange juice futures? I might be able to buy 10 or 20 of them, but that's not going to mean anything to my clients. So it's a whole different world when you're trading for yourself.
You know, you mentioned the regulatory environment, and I think it's worth pointing out that, and I'm not purporting to be a regulatory expert, and I'm also not taking a shot at our home country, but it probably is worth investigating for those folks listening, that not all regulatory climates are the same and not all home countries are the same. So there might be some situations that are a little less strident than others. And I'm not saying that in a way that they're less strident that means it's, you know, cowboy and no regulation. I'm just saying that there are some places where it's gotten a little tougher than others.
Yeah, and there's some places that are easier, some places that are actually worse than the U.S. probably,
Sure.
in some ways. Very, very ancient thinking on certain things, and some states in the U.S. that are worse than other states. Wisconsin comes to mind as a state that seems to have extremely stringent restrictions on mutual funds and things like that. They seem to always have had a tough time getting people to blue sky their stuff.
Worth investigating, though, for those folks listening. Don't make assumptions that everything in all climates are the same and all countries are the same.
And sadly, some of the friends I have on Facebook that are foreign based, they're in Australia or they're in other, Vietnam or someplace, they realize, as I did, that a lot of the assets that you can obtain to manage seem to be in the U.S. We are a very wealthy country, and there are a lot of assets, a lot of pension plans and things that need to be managed here. When I got into the currency business, it got a little bit better because there was less regulation on currency trading. And there was banks like Royal Bank of Canada, Bank of Montreal, Soc Gen over in France, other places that I had as clients that were, where I didn't have the regulation and they weren't in the U.S. and having to deal with U.S. stuff either. So I had some U.S. banks as clients. I had some foreign banks as clients. It was kind of an interesting mix, and different environments are definitely need to be explored, because how you run a business is all going to be about what you're allowed to do, because between the government and your clients restricting the money manager and what he or she is able to do day to day managing the portfolio, that's going to dictate some of your success. If your clients and regulation don't let you buy orange juice futures, then you can't buy out. It can't be part of your portfolio.
Yeah.
It's just a simple fact. So that does affect your returns. You have to think about that.
Let me shift gears on you. I love shifting gears on you. Just it's why not, right?
Why not? I love it. That's why I like your interviews. I never know where they're going.
My brain's not a straight line. So Clint Stevens, I think you know Clint.
I know Clint.
Clint, it's kind of a combination question here, but he kind of wanted to know: do you tinker with your current systems? And kind of adding into that, how do you know when you're dealing with a normal drawdown versus like, this system is shot? So, do you still tinker, and how do you know when something has really gone the wrong way?
Okay. First one, do I tinker? I'm currently in my futures trading using the same buy and sell triggers that I think I created and probably were using back in about 1984.
How ancient, how archaic.
And
They can't be useful. They can't be good anymore, Tom. They've got to be, they've got to be, retire those.
No, they're virtually identical. I used to sit down, and the only difference is I used to do it all on graph paper, and now I have computers that are sitting there, and I'm looking at fancy colors and all sorts of data that I didn't have available. So it's a little easier.
So the graph paper would take you from 12 minutes to 30 minutes?
Yeah. I used to take about an hour doing my futures portfolio. But my goal over my lifetime was actually to put myself out of work, so that I could have more time to golf and do other things. So
you don't tinker. Okay, that one's off. What about
much? No. But that being said, let's say I come up with. For a good example, ETFs never were around. Back in the day, I traded mutual funds. So we'd look for no-load mutual funds, and we'd have to do end-of-day buy and sell because that's the nature of a mutual fund. When ETFs, exchange-traded funds, that is, came into being and started trading continuously throughout the day, then you could start thinking about stuff like stop orders, and you could do things that might get executed intraday, even if you were not executing them. The stops would be executed intraday, and it to me it minimized the risk of the overnight gap type of situation a little bit more, and therefore was a good thing to start looking to add to my portfolio. So I wouldn't call that necessarily tweaking as much as looking at various new products that might come into the portfolio, and I might have to do something a little different to actually try to physically trade those. But the ones that I've had in the past, I don't tweak too much now. And on the other question you had on
if the drawdown starts to be a little steep, how do you know when things?
I tell you what I do there, and this is the scenario analysis we were talking about earlier a little bit. If you know you've got a strategy and you've thought through, okay, if this thing goes well, and I have these types of market conditions, this is what's going to happen good. This is what's going to happen if it goes really to crap. And this is what's going to happen if we just kind of have an expected, month or 6 months. If you've really thought and done a good job of that, then you should ask yourself on a drawdown, look at the markets you're trading, look at your portfolio, look at the market action that has been provided to you by the market. You had nothing to do with that. That was just the universe sending you ups and downs and all over the places. And ask yourself, given those conditions, would you have expected anything different than what you're seeing? If the answer is yes, then I would say then something's wrong with your strategy and you need to do some tweaking and need to do some homework and work and research and whatever to find out what's the difference between what you would have expected versus what actually happened. But if you answer that same question, this is an extraordinarily choppy period, and there's been some violent disruptions that, I would get caught in with this strategy, and I would expect to have a drawdown. Then it's not broken, don't fix it.
Straightforward.
That's kind of how I look at it.
Jim Byers has a question, and Jim was curious if you are a one system guy or multiple systems.
Multiple. When we were at Trendstat and running our flagship fund, the Market Math last years before I closed everything down, we had 6 different portfolios within the fund that ranged from trading commodity options to 2 different approaches in currencies, 2 different approaches in futures, and 1 approach to mutual fund timing. And I think within the mutual fund timing even, there was 2 different sub-pieces to that. And in one of the futures areas, there's probably a couple sub-pieces there. So there was a lot of interesting stuff going on there. And all those maths were trend following in a way, but they were all very different in how they took on what they took on.
So they all got to trend following, but you had thought through different ways of getting there.
Mm-hmm. Based on the markets, based on what I was trying to accomplish, based on how much risk that particular portfolio was trying to take on. Some of the strategies we had, particularly the ones that were more 28% reliable, because they're 28% reliable, the math would say you got to have a bigger gain when you have a gain. The losses could be bigger as well, but you got more losses that you're going to take as a percentage of the total. So you got to have a real big one hit. And so that was one where we slightly added to positions in a conservative way and when risk would allow. And we would try to really maximize those particular trades each year that came along that were really, really paid the way. Other strategies were more, just catch every intermediate move up and down and don't worry about the big one. We'll be there for it. If we get whipsawed along the way, so what? The big guy next door will pick up the big gain and not get whipsawed. And so we'd have different kind of personalities to these trading strategies. And some clients would pick and choose and say, I like that, I don't like that. If you got in market math, then it was my decision as to how it was all allocated. And we did a lot of research on that and how much exposure we wanted to each of the strategies. And then we rebalanced that monthly back to the set point, so that kind of the Robin Hood approach of taking from the wealthy strategy and giving it to the poor strategy. So whatever was in a drawdown was being fed, and whatever was on a explosive up move and equity was coming in like crazy, we're taking money off of the table. And that stabilized everything and kind of kept us with a nice steady performance.
I think you've got some great wisdom and you've got some great perspective, and you've had a very long business career starting as a young man. And so we're in an interesting climate, so to speak, an interesting economic climate. And everybody can hear the political debates, regardless of the side of the fence you're on. The debates are out there. Some folks want more government. Some folks want less government. I know where you fall on the spectrum. We probably have very, very similar views. Mm-hmm. I'm not really looking to kind of go down the blame game or the names game, but I would really just like for you maybe to paint a picture from your perspective, watching markets evolve, watching governments evolve, and especially watching the Fed's involvement. Maybe paint a case for people that don't have your lens, your time horizon lens. Paint a picture for people about how you see what's going on today in terms of, let's just keep it very narrow, Fed action. It seems like to me we're in brave new territory. Are we, or is it just some of the same that we've seen over the decades?
Well, I might back up from just the Fed thing to even a little bit something just slightly bigger than that, in that society in general these days seems to be gravitating down, and certainly Fed is doing the same thing along this line of not taking responsibility for themselves. It's really, you've taken the responsibility, for instance, to go to Vietnam, to go to Asia, and to do your speaking, to bootstrap a business out of your podcasts and to be successful. I think that took a lot of work and a lot of courage and a lot of things. And I think the average person, when they're in front of the television every night and they can get a government stipend of some sort, or maybe can get an unemployment benefit and not have to go out and look for a job tomorrow, or if it's kind of cold tomorrow, I think I'll stay in. I think they're subtly, second by second, minute by minute, and with respect to the Fed, the same thing. There's this tendency to think that government, the Fed, and the big entities are going to take care of all these little individuals. And the individuals kind of allow them to do that, strangely, because it's the easy way to go rather than the difficult way that you've gone or that I've gone. It's easy to not take responsibility. It's easy to say somebody else is to fault for the way that my little life is today. I think the Fed is sitting there saying, okay, well, we got an economy that's being overburdened by a government that's spending more than it takes in. We got, $17 trillion in actual debt. We got $100 trillion in unfunded liabilities. That adds up to about $117 trillion. The GDP of the country is only about 16 trillion a year. So that's multiple years of total 100% GDP to ever get close to this huge number of liability that we have. That's not a good recipe for success. I don't care. I can't imagine any economist could put a good spin on that, although the Keynesians seem to try. But the reality of it is Fed is just saying, what other choice do we have, kind of? If the stock market were to crash, if commodities start skyrocketing, if we have unabated inflation, or if we have a depression or whatever, it's going to spill over to the entire world. It could get really rough, and then there's going to be riots in the streets, and there's going to be all sorts of problems. And I hate to be negative, so you try to look at the positive side of that, and they try to say, okay, well, let's see if we can keep, funding enough money into this thing to keep it, muddling along somehow. Over time, maybe somebody brilliantly figures out a way out of the mess. It's looking pretty dismal, I think, over the long run, in that I don't think the Fed has used so many different tools so far, and I think they're sort of running out of quivers in their arrows in the quiver, so to speak. They've kind of used them, and I don't know what they're going to be able to do going forward if things get tough. So I would remain very cautious towards your trading, and I would also look at, like you have, at other countries and diversify internationally if you can, and do what you can to protect yourself. So, because I think times could get a little interesting going forward.
Well, I think what's interesting about what you say too is, and I saved that question for last because I wanted to establish in our conversation that you're a price-based trend follower, and that your trading is going to respond to whatever activity is happening in the markets, either up or down. To place the view that you just had, the public policy view that you just put out there, that's just your learned view about the proper way society should go. But your trading is going to, you're going to do well whichever way the markets go. And I think sometimes people get a little lost in that. They might say, well, why does Tom Basso have this opinion? Or why does Mike Covel have this opinion about the markets? Who cares? And my report is, it's gotten so unusual. If you don't have a public policy view, regardless of what your trading is, I start to wonder what's wrong with you. Not you, Tom, but if this has gotten so unusual out there that if you don't have a view, it kind of scares me.
Well, and it goes back to what I think I did in the Andrew interview that you probably listened to, about one of the most profound things that happened to me along the way was this ability to listen to someone talking and separate fact from opinion and flag them in my brain. So when you're reading a Wall Street Journal article that some analyst is saying, I think this, and the market's going to be here, and that's my prediction, and you just kind of flag it and say, okay, that's interesting, but it's just an opinion. And when Tom says something or Michael says something, same thing. However, if I say the market closed at 183.76 today, or whatever it is, whatever number it is, that is an actual data point. That's a fact. That's not my opinion. It is just a number. I think once you start separating facts and data from people's opinions, the whole world of trading gets a whole lot clearer, because in my mind, I could think the world's going to come to hell in the next year, and I could still be long the market. I really don't have any other choice. I mean, where else are you going to put your money, and where else are you going to try to hold on to some value? With the Fed sort of devaluating the dollar by pumping so much money into the system, you're probably going to end up having to make 10s and 20% returns just to try to even hold yourself even in terms of purchasing power. That's a pretty daunting task.
Yeah, it is. Strange days indeed. But I think I love hearing your wisdom, and I know the audience says too. And I appreciate you taking the time today from Arizona.
Lovely Arizona, sunny and 68 today.
Well, I'm jealous. It was like 5 degrees here the other day. Hey, Tom, listen, for people, if they want to catch up with you, they'll have to find you on Facebook. You're not trying to advertise anything or promote anything. I know that. No,
I'm retired happily. Yeah. And,
so if
not advertising anything.
if they can find you, that's the challenge. If you want to find Tom, you have to find him. I'm not telling you where he is.
So, I think it's spelled TOM, I think.
They'll find you.
Yeah.
Hey, listen, Tom, I appreciate it. And hopefully we can talk again in the new year once I'm in other continents.
No problem, Michael. I enjoyed it. You're welcome as usual.
Thank you, sir. And finally, my most recent podcast episode with trend following trader Tom Basso. I hope you enjoy. How are you?
I'm doing fantastic. Just got back from 2 weeks in French Polynesia and very relaxed. I'm taking a break from moving 5 tons of gravel in my yard right now to talk to you, and then I'll go back to that when we're done.
The 5 tons of gravel sounds like good exercise, to say the least.
That's the way I view it.
Yeah. So French Polynesia, I've not been there, even though I've been in roughly that same part of the world. But that's probably, I'm guessing, if I looked at a map, that's probably another 10 hours from where I've been in Southeast Asia.
About, yes. It's in the southern hemisphere, just off kind of down by New Zealand area. It's pretty far south, and although very, in their summertime right now, so 80s, humid, probably a lot like Vietnam and some other places in the summer.
Could you live in a place like that?
Not if I had my choices, but yeah, I could live there if I had to. But I really enjoy Arizona a lot. It has the best of, it seems to me, the mountains and some of the peace and quiet and the beautiful trees. And then it's got the desert down in the valley with Phoenix area where there's a lot of action, lots of concerts and plays and restaurants and things to do. They're only 90 minutes away from each other. So I sort of have the best of both worlds.
I have to give you and Jack Schwager and Charles Faulkner all a big shout out because my podcast keeps evolving and changing, and I've had a lot of non-trading guests on and some fairly noteworthy, but I think the three of you guys coming on really early and kind of giving me some credibility has really helped to expand things out. So I'm most appreciative for you sticking with me, Tom.
I always have fun talking to you. I spend zero time preparing for it, and it's just a hole in my schedule, and it's always fun.
Listen, here's where I want to go. I thought there's something fairly topical we could talk about. I don't know how you want to set it up or how we should play with it, but I've seen in the headlines there's been some hedge funds that have had not the greatest returns this year, and a lot of people are bemoaning the price of oil, which is kind of funny. You would think oil drops, everyone should be happy, but apparently there's so many budgets and programs and social programs tied to high oil around the world, and so a lot of people aren't happy. But hey, this is a zero-sum game, so quite a few people that in our little world are happy that oil has dropped. But I think what's so interesting is how many people, and I haven't tried to Google this, but how many people 5, 6, 7 months ago, we're talking about a 50% crater in oil. Nobody was predicting this at all. But then there's one trading strategy that seemed to do exceptionally well during this unpredictable run, huh?
Yeah, trend following. All you have to do is short it someplace up around 100 or 90 and enjoy the ride.
Yeah, but you make it sound so simple. I mean, there's some I saw the head of OPEC and he said, well, the speculators are doing this. And hold on. At what price are the speculators not involved in oil?
They're involved at every single price. The reason the speculators are in there helps to create a price. Without the speculators there and the constant buying and selling, you wouldn't know where the price of oil is from second to second. You might know where it was from maybe day to day or maybe even hour to hour as large companies and large hedgers and things made a transaction, but the market would be very inefficient. It would jump all over the place. With speculators there, you have every second trades going off, and you know exactly where the price of oil is second by second.
And Tom, I know you personally don't ponder these things so much because you've been there, done that. You understand it deep in your gut. But when you hear a headline where the head of OPEC is saying that the price is where it should not be, the fundamentals do not support this price, and casts blame at speculators for this particular point of price, explain to the audience just how disingenuous that is.
Well, it's disingenuous because the price of anything is where someone will buy and sell it to each other at. If a speculator would be selling it and driving the price down, someone else has to be buying it to make that transaction happen. And for that person to be buying it, that could also be a speculator. So, well, wait a second, how can speculators be driving it down if speculators are on both sides of that trade? Or it could have been a hedger, like let's say Southwest Airlines in the past has come in and bought gas when they thought it was cheap, and maybe they're thinking that now, so maybe the speculator is selling it to Southwest Air, and they're hedging their future fuel costs. All right, fine. Well, then it goes down cheaper. Well, Southwest can buy some more future cheap oil. I don't see, nobody ever complains like OPEC when the prices go skyrocketing up to 100 and something, but the same speculators are there at that point in time as they are right now. It doesn't speculators don't just short the market; they go both ways, and so it's just very. It's for public relations. It's trying to place blame. It's trying to placate their people because Saudi Arabia depends so much, as does Norway and Norway, I think it is. Some of the socialistic type of programs out there in the countries that depend on oil. I think Brazil, to some extent, Venezuela, all countries that are leaning towards liberal socialist types of things and using oil revenues to try to help pay for them. Well, now they don't have those revenues anymore to the level that they used to. So they try to place blame, try to not point the finger at themselves for setting up a budget that was based on the house of cards. But that's the way the world works these days, it seems.
Yeah. So I just was in Dubai Thursday, Friday, Saturday. And so when you talk about when the price of oil is high, no one complains. Well, I know why they're not complaining, because I just saw what they've been building with that oil money over there. And frankly, it's fabulous. They've done a fabulous job building out a city. I don't know if it's where I'd want to live, but they've done a hell of a job.
I've seen the photos on your Facebook page. They're very impressive.
Yeah, they've done a hell of a job. Hey, let me jump into something really basic. And since we've talked a bunch of times, the real challenge in speaking with you is because to try not let you get the feeling of being bored. So how do I make sure that I'm giving you something somewhat fresh? Very difficult to do. But listen, let's talk about your stomach lining for a second and just go back and I think this is a good reminder for whether it's the professional out there, the new trader, the new investor, and talk about Tom Basso's stomach lining. And if you don't mind, also the rush and the devastation. We can have this emotional rush. Oh my gosh, I'm making so much money and I'm losing money, the devastation. But talk about your own stomach lining, Tom. Let's just talk about that lining.
Well, first of all, my stomach lining seems to be doing just fine as far as I can tell. I have never had any ulcers or anything else. Knock on wood, I guess. In my early trading years, which was well reported in Schwager's New Market Wizards chapter on me, there were some silver trades that went all over the place. That really was catching my attention almost hour by hour. It was during the hunt, cornering the silver market type episode there, and that was more excitement than I really needed. And I tried to analyze why was I so uncomfortable, and how do I stay true to trend following while at the same time dealing with the issue that I've got a position that I want to let my profits run, cut my losses short. But the position that I have now is moving all over the place by tens of thousands a day on an account that just a few months ago was maybe 50,000 or 100,000 or something like that. Now it's worth 400,000 or 500,000, and it's moving up and down tens of thousands a day. That kind of opens your eye a lot, and I realized out of that there's no reason you can't stay true to trend following and stay with the position. You just need to manage the position size. So all I did was figure out ways to volatility adjust and to risk adjust my positions ongoing throughout the trade so that things would become fairly tame and the stomach lining would be kept very intact. There was nothing to get excited about because one day was roughly the same as every other day. And that's what I learned out of the early trading mistakes and situations where it really would have gotten to my stomach lining over my lifetime. And once we got to TrendStat days, we just automated a lot of that to the point where it just happened automatically, and the only thing that would affect my stomach lining at that point would be a power outage, or the internet lines go down, or the program's not working properly, or something like that. But certainly wasn't the markets anymore.
I've seen in many interviews that you've had, and going back to our conversations, you've talked about how you would mentally rehearse catastrophic events, and I guess if you've got a position on and it's the wrong kind of position, if you're long and you don't adjust and oil drops 50%, that's a catastrophic event. And I saw a great comment from Van Tharp, and he talked about that he got a phone call from you once, and you said that you had a disaster the prior day and you couldn't answer the phone. You couldn't talk to Van, but basically you said it was a planned disaster. So you've been thinking about, even a young man, is like, how do I plan for catastrophic events? How do I plan for the unexpected? Because it's going to happen.
Right, exactly. And I was amazed at how many CTAs, professional traders, did not plan for disasters. We would, once a year at least, have what I would call a disaster day. And I would tell everybody ahead of time, so everybody in the company knew what to expect. And I asked a little bit extra out of everybody. And we moved
a section of the company to our off-site location to operate in an alternative mode and try to run the company from the secondary location, while a certain number of people stayed in the primary location to answer phone calls from clients and things that would come in that would be normal routine business, and we didn't want to have our disaster day exercise affecting, the clients being able to get to us and schedule appointments or talk to us or something. With Van's call, for instance, that wasn't a hugely necessary, I got to do this right today call. So I put him off because I was trying to make sure we did this exercise. And it required a whole lot of attention, because when you're operating on backup equipment, it's a little bit more clunky than it would be with your mainstream stuff. So, but what we did all day was we started and we offloaded data to the backup facility. We put orders in from the backup facility. We tried to call our trading desk from the backup facility. We tried to, look at procedures and things and modify things. So we have all the Word files and Excel spreadsheets and different things that we needed to operate. And invariably, what you get out of those exercises is a good list of things that you missed or that have changed since last time you did a disaster backup, and you can improve and tighten your operations. I find it amazing to me that some CTAs just have a single operation and they don't have a clue what would happen if, say, the mobile phones went down, or if, the internet goes down, you lose electricity, one of your trading desks is no longer available for some reason. There's so many different scenarios, but if you've actually gone through some of them and actually tried to tell your trading partners what you're doing, I always found that they were very, very, very excited in working with me to generate ways of operating in an emergency, because they have the same problem on their side. They want to know that I'm going to be able to deal with what happens to me. And in some of these cases, they were giving us money to trade. So we were trying to, be good partners. And I think that's something that you can do in a lot of aspects of life. It's amazing how many people just kind of let life put it to them. And then there's the stress of dealing with it, as opposed to trying to say, well, I could go this way, and those following 2 or 3 things could happen, or it might not happen, and it might be this. And if it is, do I go to plan B, or do I try to solve that problem? There's a lot of things you can do if you think ahead a little bit, do a little planning, do a little exercising, and then it's not so stressful when it happens.
Those catastrophic events, though, it's not necessarily only what you've just described. Thinking in terms of catastrophic events, it's also about your portfolio, your trading strategy.
Sure, it is. And so to some extent, probably the most catastrophic move that I ever saw was when we invaded Iraq during HW, when we went from Kuwait into Iraq. Those years, when I was, closing down the markets, I think the oil was at $32 a barrel. We were long. By 8 o'clock that night, we had a bit of a computer issue at the Trendstat, and I was staying late that night. I left having solved the problem at about 8 p.m., which would have been 6 hours or more after the close. And oil was up to $40 a barrel, and we were rolling into Iraq. So I thought, this ought to be pretty nice. And I go to sleep, and I come in the next day, and oil is at $22 a barrel. And we're stopped out and take a chunk of a loss. I think we lost in all the portfolios about 5 or 6% of the whole portfolio that day, which was to that day and to this day the largest single day loss that I saw in trading the futures markets. So and we made it back, and we were at new highs a month or two later, 3 months later. It wasn't a big deal, but it was wow, 6% in one day. That's interesting. It wasn't something that was unusual, because we saw what the markets did. It was a bad day, but you can recover from a 6% loss. It's not going to hurt you. And we had managed that position properly. It had gotten very volatile, so we were down to minimum size positions. When it got down to 22, a lot of accounts couldn't even own a position because the volatility was too great. So we would keep them out of the position altogether. Life was good, and we, like I said, came back to new highs shortly thereafter.
It sounds so simple, But I think for most people, that simple story can go right over their head. And the big picture point there is that you're saying, hey, look, we've got to have chips to play the game. Our egos are not so big that we know what's going to happen next. So if the market's not going our way, let's take our losses, get out, and come back to play another day.
Exactly right. That's all it is. It's how do you get to your next 1,000 or 2,000 or 10,000 trades? It's all a matter of statistics. Any one trade can either win or lose. Over time, I usually figured that we were around 33% profitable and about 67% of the time unprofitable on trades. And of course, the winners were worth a lot more than the losers were, so it worked out. But yeah, you got to come back and do those next 2,000 so that you can get the 33% that are profitable and have to deal with the 67 that aren't.
And every piece of media, and of course, media is not relevant to trend following trading, but if you look at media, all media, whether it's print, radio, online, TV, is all about the trade for that day, And there you just calmly and coolly say, hey, hold on. I don't care about one trade. I care about 1,000 trades into the future. That's what I want to be focused on.
Something that Van Tharp had said a long time ago, and I remember it so well, is a good day for a trader is following your strategy. In other words, trying to get to those next 1,000 trades and just doing what you do over and over again. It's not whether you made money or lost money today. It's whether you followed your strategy today and put on that next set of trades that you're supposed to have put on according to your strategy. And when you get into that mode, then trading gets a little less exciting, your stomach lining feels a lot better, and you'll have more success.
You've spent a lot of time in the last couple of years. I think anyone that's been online has seen this, is that you quite enjoy interacting with people, and you're on Twitter and you're on Facebook, and you weren't doing this a couple of years ago, but now you do. And I know you've given a lot of interviews and you've stayed connected with people and you clearly really enjoy it. Mm-hmm. I do think, though, what's interesting is that you have a definite political opinion. And I'm not necessarily curious about the political opinion. I know what it is, and I share a lot of those beliefs. But I think for some people, they could see the political opinions and get confused. They could say, well, Tom's got this strong opinion, and they could somehow or another think your trading is living and breathing with your political opinion, and it's not.
Oh, not at all. My political opinion is that, I think just like trading, where traders have to take self-responsibility to be successful. If you're blaming the guys on the floor for screwing you on the trade, or if you're blaming your broker for giving you the wrong advice or whatever, you're going to fail. You got to take self-responsibility. You have to be responsible for you pulling the trigger on something. And I think that's what I fail to see a lot throughout political life as well. There's a lot of finger pointing all the time. Something happens and so-and-so is blaming Congress, and so Congress is blaming the president, and everybody's blaming everybody else. And I think they're not looking to themselves and saying, what could they have done, each of these parties involved, to make that not happen or happen better or whatever. And I think trading's the same way. And so I view a lot of my political views come from that same bent, but it's certainly not. It doesn't have anything to do with my trading. My trading is just purely mathematical, and if the direction's up, I want to be long. If it's down, I want to be short. It's not any more complicated than that.
I've had some traders on here this fall, current CTAs, running multi-billion-dollar funds, really interesting people to talk to, mm-hmm. And I'll get feedback. And they'll come on the show and they'll say, hey, we're price driven. We're 100% systematic. This is what we do. And I'll get these emails from people that they're like, no, you don't get it, Covel. There's a secret fundamental overlay. There's discretion going on in the back room. And it still strikes me as funny as that so many trend following traders just like you will come out and say, this is exactly what we do. Yeah. There is no fundamental input, and people still think, no, there's a secret sauce of human discretion that you don't know about, Mike, and you're missing the point, and you don't realize that Basso's really got a huge fundamental staff in the back room.
I don't have time. I got to move the 5 tons of gravel this afternoon. No, I think it comes down to people love to have complicated things. A lot of traders, when they start out, what do? They go get Covel's book. You get Schwager's stuff. You get all sorts. You read. You get a lot of opinions about all sorts of different ways of trading, fundamental and technical, and there's a pattern in the universe type stuff like Elliott wave and Fibonacci and all that stuff. And you just, the poor trader starting out just looks at all this and just can't figure out what to do next. And the human mind wants to make something as important as making money in the markets a very complicated thing. Like, Tom's been around for a lot of years, so that's why he's so experienced and that's why he's successful. But the reality of it is, simple things work the best. Schwager had a way of saying it, there's degrees of freedom. In other words, the more things you add to a strategy, you start out with a simple moving average, then you say, I'll only do the buy signal in the moving average if the moon is in the right phase. And then you add on that you got to have it only on the open and not any other time during the day, and it's got to meet those criteria. And you start adding filter after filter after filter, and pretty soon you won't do a trade. You'll sit there and look at all this stuff, and you'll first of all be confused because you won't be able to process all that information in your poor brain, and then you'll miss out on trades because you just can't function. There's so much complicated nature. So you sit there and watch the markets and wish that you could trade, and make some money. And really, simple things are very robust. There's very little about them that can fail because it's so simple. There's not anything but price. Price feeds your profits and it feeds your losses. So if you stay to price with all your strategies, you are strategizing on that variable that feeds directly, one-to-one, your profits and losses. So you never get out of sync. If you're over there looking at interest rates and trying to predict stock market indices, you've got two different variables going on there. The interest rates may agree with the stock market. They may not agree with the stock market. You could get caught sideways someplace. But if you're looking at stock indexes prices and you're buying and selling stock indices, it's one-to-one. You're going to make money or lose money on what stock indices do, and therefore you never get out of whack. You're always in sync with the market, and you don't have to stress out of it.
Tom, you mentioned traders and overwhelming amounts of information and confusion and different strategies. And you mentioned like Elliott wave and whatnot. One of the things that I found really useful in wrapping my arms around strategies when I was just a new guy trying to understand as well was not to necessarily just trust what Tom Basso has to say, but I would look at the performance data, and I could not, for all the strategies out there in the quote technical space, I couldn't find any strategy that had this massive number of participants openly putting their performance data out each month, where you could compare those performance data and see that there was often some correlation, maybe not exact, but there was some correlation, and you could wrap your arms around and say, wow, trend following has all these participants. They seem to be doing something similar. I feel comfortable about this. This is a useful piece of information for me. Whereas I've never been able to find that kind of overwhelming amount of data for any other technical strategy. It's only trend following.
That's correct. And you'll find that the trend followers also tend to lose money at the same time. And I did studies on if you took the average volatility, high-low range of various commodity markets over a month time, and then looked at the performance of CTAs in general over that same month, you would find a direct correlation to highly volatile months led to larger CTA profits, and lower volatility months led to smaller CTA profits or even losses. And so it made a lot of sense to me that if people are really trend following, you want the market to go a long way. If it's sitting there in one place, you can't make any money if the prices aren't moving. So it's a simple study and a simple result, and it fed exactly the way, it leaned exactly the way that I thought it would lean. That was published someplace a long time ago. Makes sense, doesn't it? I mean, if the prices move, then trend followers can make some money.
I'm just amazed that so many traders will believe in some type of a strategy and they can't find other market participants actually using this. So they decide on their lonesome, I have this one novel strategy, and they must think in their own mind, well, it's worth more to me because I'm the only one doing it. Whereas I'm like, hold on, I want to see that some other smart people before me have done this.
Well, that'd be nice, but I can't say that trend following is the only way that you could possibly make money in the markets, but it certainly is one that has been tried and tested by a lot of different minds over the years. You got to say that it's certainly a sound way to approach things and to keep yourself from getting in harm's way too awfully much.
Hey, I'm gonna have a couple more questions on you. I'll let you go move some gravel around. No, I mean, I'm off to yoga after. While you're doing gravel, I'm gonna do yoga. So
okay.
We'll see who sweats more. Hey, years ago, your firm did a study, and people can still find it online. And I think there's some big picture points to it that still are relevant to this day, which is the hot hand type issue, and specifically for people that put money with trading managers. And they often want to put the money with the manager, and specifically, let's talk about trend following traders, but they want to put the money with the manager when they've had this great run. And it's the human condition, behavioral economics, behavioral finance. Now I want to give the money. Whereas I think in your study, why don't you explain what you found out? It's a little bit different than what people think.
Well, what I found out was that the two studies together, the prices move, therefore trend followers make money. So trend followers making money means their equity curve gets better and better. So the trends persist for maybe several months. Maybe the trend followers are now knocking it out of the park. So then all the money in the world starts rushing in and floods in there. And then the markets start stalling out of those trends. Trend followers go into a sideways or a drawdown. Then at the bottom of the drawdown, at the pit of the trough of the equity curve, at the low of the drawdown, the markets are now going sideways and are about to break out up or down or whatever, but they're just building pressure, waiting for it to explode, and that's when people are pulling money out, just before the next big surge. And so what I found is that when you took the dollar-weighted return, which is the actual returns that the CTAs would have provided had you just put your money with them and left it alone, versus the time-weighted return. I got that wrong. The time-weighted return was what the CTAs would do if you just left it alone. The dollar-weighted return takes into account clients giving the CTAs money at certain times and taking it out at other times. The time-weighted return, which is the CTA's actual returns by their strategy, were always better than the dollar-weighted returns of what the clients did in terms of coming in and going out. So clients were actually hurting their performance across the entire industry. And I forget whether it was 100% of the cases or some very high percent. It was at least 75%. I can't remember the exact study results now, but it was a huge, overwhelming preponderance, and certainly averaged over the whole industry. It was definitely hurting to have clients put their money in or take money out. They were hurting themselves.
And I find so interesting, and we might have even spoken about this before, is that so many aspects of successful trend following trading have the understanding of behavioral economics, behavioral finance, and how to deal with biases and using heuristics to trade. Long before it was a popular subject, long before the Nobel Prizes were handed out, there's this group of traders that were essentially, while not promoting the idea that, hey, we understand behavioral economics, were effectively trading in a way where clearly they understood what all the academic research that was to follow in the decades to come.
Mm-hmm. The turtles.
Many of your peers. Yeah. I mean, it was just is fascinating, you know?
All I'm doing is saying, if the crude oil market's going down, it's not up to Tom to figure out how or why it's going down. It's simply going down. It is. And what would you want to be positioned today if you had your choice? Would you rather be positioned in enjoying the downslide, or would you be trying to jump in and saying low is low and maybe it's going up from here? To me, if the trend is down, I just want to be short. And when it turns around and goes the other way, I want to be long. I don't really want to think too much about it. I've got other things I'd rather think about. And I think that that's reacting to the behavior of a whole market full of traders that may or may not be using fundamentals or hedge techniques or whatever they're using to make their decisions. But the aggregate all feeds into that price. Makes it go up, makes it go down. So it's the dependent variable of all that behavior decision making of all of those rest of the market, and I'm just reading it in the price and going with it and not thinking too much more than that about it.
You know what I love that you just said is and we can kind of go this direction with the rest of our conversation. I think it's some of the most important stuff. It's very personal. I got other things I would rather think about. And I think what that really says is to people that are paying close attention, hey, my name's Tom. I have this system. I've done the homework. I've done the research. I know why it works. I'm comfortable with it. And then once it's in place and I put my machine in place, I'm not running around like a chicken with his head cut off, all nervous and antsy all day long. And as you said, I got other things I'd want to do. And I think what that really says, though, too, is that life is short and you've got to find ways to enjoy your time and have fun. But the idea of sitting around and staring at a screen and talking trading all the time, trading is it's a useful byproduct of a process of a machine. But I could tell you don't really care. It's not what you are. It's something you know how to do, but it doesn't define you.
Yeah, I mean, I know how to golf, but I don't consider myself necessarily a one-dimensional golfer, and I don't live and die, but whether I can get to the golf course. I haven't touched my golf clubs thanks to the cruise to Tahiti. I haven't touched them in about 3.5 weeks now, and I'm still enjoying life. It's not like I need to get over there and hit balls right after we get off the phone. I think a lot of people get into trading and they get addicted to almost the gambling nature of it all. To me, it's just managing my portfolio. The less time I can take to do it, the more time I have to move gravel or talk to you or prune my backyard or, go hit golf balls. There's lots of things, or take a cruise to Tahiti. A lot of people won't take vacations because they're afraid they're going to miss something in the markets. I just take along my computer and I go do about 10, 20 minutes a day on the ship's satellite internet, and I'm done. That's not too burdensome.
What you just said there, I think, is so terribly important. So many people run their lives afraid they will miss something. And I think that is what's happened in modern society, is especially with the media coverage, it's all built around a really intense fear.
Mm-hmm. Yeah. And I think they're going to miss something. So if they're making decisions based on what did the Fed decide today, then they're glued to the screens trying to, wait till what the Fed decision is coming out. I've got to stop sitting there. If the Fed decision causes the market to go through my stop, then I get executed. I find out about it when I close the markets down in the afternoon, which I'll probably do after our call. It's not something I'm going to sit here and want to, wait until the Fed decides to publish their darn report. That means I'm sitting here all day long in front of a computer. That's not quality of life.
But Tom, can't you listen to the Fed and use some extra discretion to improve your trend following performance?
No, I cannot. I cannot. So I just don't. I did enough studies that in the early years that talked about what value did my discretionary decision making make, overlaying it on trend following or anything. And I became clearly convinced that I was not adding any value. So then, therefore, I just fired myself, basically.
I love it. I love it. I mean, I think it's so fun talking to you is because you just you're so clean, meticulous, and precise about your thinking, about your process, your system, your machine. And I just know some people will listen and they're just going to go, oh, Tom doesn't know that we can improve what he's doing. It can get better. Almost like the $6 Million Man. We get better, faster, stronger.
Well, that might be, but you got to remember I'm 62 and retired and enjoying life, so I don't want to, create a job out of this. Certainly there's things I could do to try to improve what I'm doing. I'm sure if I had a team of computer programs like I did back in the old days at Trendstat, I probably have a couple ideas I could work on, but, it's just not worth spending that kind of money and effort and then trying to pick up a few extra percent here and there. It's just not what I do today. So I keep it simple and I keep it low fixed overhead, and I have zero regulation fees at this point. I have very little to no chance of somebody suing me like I did in the old days. You end up with a low liability, easy to run, retirement type of investment strategy, and that fits my situation and my dollars and my expertise level, and that's what every trader should always get to, is examine themselves and their capital and their expertise. Design the strategy around those things, not around what Tom Bassa does or Michael Covel does or anybody else. Everybody out there needs to do what they need to do for themselves. That's what creates the success, because then they can do it over and over again with ease. If you're trying to copy somebody else, you're not going to ever be at ease with that. You're always going to be trying to compare yourself to that person, or try to do things that are not in your expertise levels, or maybe you don't have enough capital for, or who knows. But if you design what you're doing for yourself, then that's where success lies.
We kind of talked about this last time a little. I get emails from young people all the time, and they want advice on where can I go to get hired in the CTA space, the trend following space? Who will hire me? What insight can you give me? And I think stories like the turtle story, for example, has really created, and now that since the story is so well known, people think, well, this is going to be, I can recreate this. I can replicate this. If I can just get my toe in the door. Whereas I think you have some different perspectives about the managed money space today. Why don't you talk about that and maybe offer some advice to a young person today that wants to trade, and maybe give an alternate view on ways to go about it versus the ways that people have seen in the last 20, 30, 40 years. Maybe you might have a point that things have changed from your perspective, and maybe there's another way to go about it.
Because clearly, if you took today's world and you took Tom, personally me, I could not do today what I ended up doing back in the 70s and 80s, starting up Trendstat and becoming successful doing all that. I don't think that would be a reasonable path to success in today's world. There's too many billion-dollar money managers with extensive staffs. I have no idea what their criteria is to hire somebody, but I would dare say it'd be hard to get on with a lot of those folks, I imagine. And I think because of the regulation increasing, the cost of doing business increasing in the CTA space, an easier approach to learning how to trade is to probably become your own trader and continue to work very hard at whatever it is that you did before trading, your main job, so to speak. I was a chemical engineer in the old days, so work hard at chemical engineering, let's say. Save as much money as you can. Keep building your portfolio bigger and bigger, and keep building your expertise in trading bigger and bigger. At some point, you'll be making enough money to look at your trading success and say, I'm making as much money off of trading as I am being a chemical engineer. Maybe I don't need to be a chemical engineer anymore. And then you transition, and then you're where I am right now, trading full time. I think the CTA space has gotten to be very difficult to break into, and I'm really at a loss at this point, partly because I've been out of the business for 11 years, but also just because I can't quite see my way clear of how would you go about doing that. You definitely would need capital infusions or partners that would be able to bring in sizable amounts of assets to trade, be able to finance a staff of 5 or 10 at least, lots of the phone systems, the computers, the regulatory environment, all the prospectuses, and some of those prospectuses you can blow $100,000 really quickly with legal expense. So audits and CPA fees, it's getting to be a pretty tough game to just break into for a little guy operating out of the garage.
But that doesn't take away from the fact that if you want to trade your money or friends and family or something to that effect, that opportunity is wide open. You're not saying trading is tougher to break into. You're saying what we've all read about, the managed money is tougher.
The managed money is very tough today, and the business of being a CTA is tough. Trading your own money is free of regulation. It's very low overhead. The commissions now, where in the old days, being a manager, you could negotiate your commissions, and the retail public had to pay a higher brokerage fee. Now everybody pays low brokerage fees. So there's almost no cost to trading these days. And you really can, as a small operator, do things that the big guys almost can't do. I never used to trade orange juice a whole lot when I was at Trendstat, but I trade it now because I can. I'm small. I'm a small dollar size compared to what I used to be, so I don't have to worry about it. I can go into markets that I didn't go into before very much. And so I think you have to examine as an individual trader, do you want to go and work at a CTA because you're trying to pick up expertise? Well, what if their expertise is bad? Maybe, I remember in the day, John Henry was one of the big guys. Say you got a job at John Henry. Well, he was going up and down with 40% drawdowns. Yeah, he traded billions of dollars. I don't think what he was doing made a super amount of sense to me. I thought it was probably always going to lead to very large drawdowns and run-ups because he was more leveraged. And maybe if you go work for somebody like that, he's teaching you that type of stuff. You're learning bad habits, maybe. So it's not a panacea to go to work for somebody else and learn what they're doing. I think it's better for you to learn how to do it on your own and trade your own stuff successfully, and then you're right where you need to be. You just need to try to find ways of getting more capital to trade, and that means working harder, taking a second job, getting maybe a degree to get a promotion, getting that next rung up on the ladder in the corporate world so that you can have more money to put away.
Tom, great wisdom, great wisdom. I really like the way how you just laid that out, the lack of a panacea. I think a lot of people, they dream and they fantasize about the panacea, but there isn't one. No,
there isn't. Becoming a trader to get to where I am right now, where I'm trading my own account, living off of it, that is something that is difficult to get to no matter where you're starting from. Unless you're starting from like a major inheritance, you've got all the money in the world, that would be an easier time transitioning. But if you're starting from where I started as a guy out of college with a $4,000 student loan and a chemical engineering job and zero net worth, or negative net worth actually, I think you have to realize that it's a tough road no matter which way you go.
Tom, I'm thinking the best place to send people to check you out, to maybe connect with you, Basso_Tom, which is your Twitter handle. Is that the best place?
Probably Facebook I look at more. I put stuff out on Twitter because then it's attached to Facebook and it goes to both places. But those are usually my market directional calls. I try to do that to just keep my friends and family informed of which way I'm leaning. And it is what it is. I noticed I was, 2-3 days late when I was down in Tahiti on the cruise because of the bad bandwidth. So I had gotten a cell come in, and then I got whipsawed on it because it made new highs again. Apologize for people who are trying to follow that, but I recommend you don't follow it. Use it for what it's worth, but it's free and possibly worth about that much. And I think that you have to do your own thing and create your own indicators. But find me on Facebook is probably the easiest way. I'm going to see that probably quicker. I also, tom@trendstat.com. My email address is fine. Send me an email. I just had one today from someone who had some questions, and I answered them inside of about 6 hours. So,
yeah, I do know a lot of people have responded to me and said, hey, Tom's given some great feedback. However, I want to tell my audience out there, for those of you that are crazy, it would make me look bad. If you are crazy, please don't contact Tom. If you really are, if you're not connected to reality and you're going to ask really, really weird questions, please don't go there because it'll make me look bad and Tom won't come talk to me anymore.
No. I love talking to you, Michael. No, it's okay. And if somebody's crazy, I can figure that out pretty quickly myself.
Well, hopefully we can catch up again in 2015.
Life's good. Take care of yourself, Michael. It was good talking to you.
On to my next compilation, Charles Faulkner. And by the way, I did not mention this at the top of this mega episode. I promised to reach out and have onto the show in 2018 these three guys again. But let's jump right in to Charles Faulkner. Today I have a guest who I've known for a few years, and I was thinking back to the first time that I met Charles Faulkner, and I was in an event with Charles Faulkner and Ed Sakota, and I believe it was early 2001, and somehow or another today it's 2012. I'm not sure what I've done for the last 11 years, but I don't know where time has gone, Charles. Thank you for being here.
You're welcome. I got a couple of books on my shelf as some evidence that you've been doing some stuff.
Yeah, I guess that's where it all went.
There's something missing. Well, listen, let me just kind of give a broad overview for folks. You know, Charles was originally in Jack Schwager's Market Wizards series. I believe it's the New Market Wizards, right, Charles?
Yes.
Both of those first two Market Wizards books, I think people consider classics. And I think that's where Charles was first introduced. I'm going to let him go into a lot of the details, but is this broad overview. Charles has had an expertise in something called neuro-linguistic programming, and that would be one of his expertises. But I think, from my perspective, Charles has probably affected me more than anyone else in the sense of how he looks at human behavior, how he looks at the mind. And he does this from just an everyday approach, but he also has this unique niche where he approaches the trading world from the human perspective. And he's got some great insights. And like myself, Charles has had a chance to interact with some of the great traders over the years, and has just been exposed to a lot of different thoughts, and has developed his own way at looking at the mind and behavior and all these different subjects we're going to talk about today. And I think one of the first things I wanted to talk about, because I just thought it was an interesting, maybe kind of broad overview, Charles, would be the idea of maps. You know, it's such a simple thing. You know, as kids, we all, I remember trying to draw the map of the 50 states, and I used to be able to draw the map of the 50 states in like fifth grade or something by memory. And you just a little tiny, vignette. But talk to me about maps and how you see maps, and feel free to be as detailed as you want, and maybe start people off gingerly and then kind of move through the progression of how you use maps and think about maps.
Well, yeah, you call them maps, or Charlie Munger calls them mental models. Different people have different words for this idea that when we think about something, we make some sort of a picture of it, if you will, and we now know enough about connectivist psychology that part of it's a picture and part of it is our number of associations. So if you think of a dog, for example, then you get some kind of an image of a dog, and maybe it's your dog, and maybe it's just the dog's head, and then you think about how soft and friendly the dog is, or maybe some other memories and so forth. And these show up in our experience, and not only visual, but in all sorts of ways, for anything that we think about, and particularly anything we want to make sense of. You think about the United States, and you, as a kid, could quickly draw the map of the continental United States, and you probably knew Alaska was up a certain way and Hawaii is over a certain way, the same way that people are thinking of that right now as I'm explaining it. Well, okay, fine. What difference does that make? It all depends. It's like we have a mental map, if you will, of how a car works. The parts of it that we directly, most of us anyway, connect with, putting the key in the ignition and which pedals and how many and how you steer. We have a very vivid map of that, and it corresponds to actually our car and so forth. But as you get under the hood, unless you're a mechanic or, a weekend car guy or something, it gets a bit fuzzier, if you will. We have like, okay, there's little explosions going on and there's things whirling around, and we have a sense of that. And some people have more or less detailed maps of that. When we're understanding something, whether it's how a car works or how the electricity comes into our home and we flick a light switch, all we care about is flicking the light switch. But as you get into more and more complicated situations, this really curious thing happens. And this, I'm going to mention him right at the beginning. And Daniel Kahneman and his colleague Amos Tversky came up with this idea about what they call System 1 and System 2. And System 1 is our quick, intuitive thinking that utilizes these images and utilizes our feelings and makes sense of things so we can react. And biologically, hugely advantageous. We're glad our ancestors had this skill so we could be here today. And then over those millennia, another system developed, the System 2, the second more thoughtful, deliberative, let's think things through system developed. Here's the thing, is the map making starts with that intuitive, quick understanding picture of the world that we get. And very often, you read their work, you find out we don't get much beyond that. And a lot of life, that's just fine. You go into a restaurant and you say, I'm going to order a steak. And you haven't ever been in the restaurant before, but you know what a steak is. And you order it and it comes back and it's not exactly how you pictured it, but close enough, And if it's not close enough, we send it back, so we have these ways of dealing with this. You get into something like trading, the person's map, their mental picture, the model they're applying to what's happening out there as they're making a trade. Now it begins to make a pretty big difference, and a lot of people are really unclear what it is that's going on out there. But as these two scientist researchers pointed out, the less information we have, the quicker we'll make up an image and a story that makes sense to us, and we'll believe it.
Well, that can be, I guess I could look at that immediately as being good and bad.
Exactly. And it's great because when things are close to us in time and space and physicality, then this system works really well, like driving a car, for example. We're responding to the world. We have ideas what other cars will do and so forth, and even then, of course, we know there's a good deal of slippage given how much accidents there are, but it does work. But as you go more into, what's the person's trading approach? What map do they have of what's happening out there in the markets? And therefore, how does that inform their trading decisions? Well, then, because of either the shortness of time, which is just subhuman in how fast it is, or more like the trend follower, the extended length of time, which is something that a lot of people have a hard time holding on to, then those kinds of natural systems fall apart. That is, they're not as effective unless the person has been careful in how they built their map. Or model, if you will.
Charles, as I think about right now today, we've got the Dow is hovering around 13,000, crossing back and forward. And, I've noticed a lot of headlines in the last couple of days. I think Time Magazine, is this rally for real? And you're seeing a lot of desire to attach feelings of well-being and good times are around the corner. And it's kind of where you're going with where you're building a map. I mean, maybe people are building a map about what it means for the Dow to be going back above 13,000, but that doesn't, I think that gets back to your second part. It doesn't necessarily translate to trading success.
Well, and take the point that even as it's going over 13 again, there's another whole emergent group of people who are saying, but the Dow is now disconnected from the economy. That in the old map that people had, the two would grow together. And they're saying, well, now they're not, and so it's like, how does one revise the mental map? Now, to back up a moment, if this seems, too space age for people, is that you can't not do this. That's what all the research is coming out now. And this, I don't know if your listeners have heard about the book about the invisible gorilla, where these college kids are playing basketball and people watch a video and they're supposed to count the number of times that the balls pass between the players in the white shirts. And in the middle of this video, out walks a person in a gorilla suit, beats their chest a couple times, and then walks off. And it's about 7 seconds in the middle of the video. People who are concentrating on the passing of the basketball from one team to remember, 50% of them will not see the gorilla. Vision is selective and vision is active. And the vision that we're using in the real world, if you will, is based on what map we're projecting. So it does make a difference about which maps you're using and do you have systems to update them.
It quickly becomes, I think when people hear you, I hope they immediately get those aha moments where it's like, if I'm going to put my money on the line,
yeah,
it's not just about rolling the dice. It's not just about how you felt that morning eating the cereal. That you can have those thoughts, you can have those quick, immediate, intuitive thoughts, but they might lead you astray if you've not taking it, as you say, getting under the hood and really seeing how the pieces interconnect. You can have big problems if you don't take it the extra step.
Well, and again, this all depends on, what's your level of interaction. It's like, I don't need to know very much about electricity to run a light switch. But then again, I'm not concerned about that. But then if I do get concerned about the flow and all that and how the flow might make a difference in my trade, like liquidity flow, then suddenly it does make a difference. And so it isn't about having to learn everything, but it is about realizing that your natural tendency, especially with little bits of information, is to build a picture and a story and go, And the thing is, you feel congruent, as we say. It feels good. It feels familiar. It could also be, as you say, completely misleading. It's like the intuitions of a very experienced musician about what's in there are really different than the intuitions of an inexperienced one. Or we have this show called Car Talk here on Saturday mornings. And these guys hear people describe, their car making a certain noise when it goes up or down a hill or something. And they can infer what that means because they do have a rich map of lots of different cars and what sounds do what and so on and so on. And then they ask questions and tests. They go, well, does it do it when you stop? Does it do it before, right after you turn off the car? Is it still doing it? And these other ways that they're testing the limits of their knowledge, knowing that they have an incomplete map, picture, or model.
Charles he's actually wrote the foreword for my trend following book, and he was in my most recent book, The Little Book of Trading. And I believe the chapter title is called In the Moment of Now. I don't want to say this because I don't want to sound trite because I'm not that studied, but it's a Zen-like expression to be in the moment of now. And Charles, whatever you could define being in the moment of now, and then maybe bring it back and circle it and connect it to being in the moment of now when it comes to being, for example, an Ed Seykota or a David Harding or a Salem Abraham or a Bruce Kovner. And so you could have defined the moment of now and then maybe bring it back to how it applies in the world of some of these traders that you and I know.
Yeah, and first I'm going to start by misquoting or attempting to quote Nassim Taleb from The Black Swan. And there's a phrase in there that I love that goes something like, the more people understand the past, the more they think they can predict the future.
Which is, the past is the past. It's gone, and we don't know the future. All we have is right now.
But here's the point, is that we have within us, again, the new neurobiology coming out. The work is that we can't help if we put two ideas next to each other to think they're somehow connected, to think they're somehow causal, to think that this leads to that, leads to the next thing. And so that the line from Taleb is the idea that we have the past is prologue to the present. So the present must be leading to some particular future. This in behavioral finance is known as the hindsight bias, meaning that I think that I saw how this happened, and therefore I know what's going to happen next. So being in the moment of now, in the simplest non-Zen way of thinking about it, is not to reference the past or the future.
That's tough. You've seen that in people.
Well, yeah, no, it's against our nature. This is years ago that when I heard the line, and I heard it from Larry Hite, so he may be the original author, I don't know. It's cut your losses, let your profits run, and it's the hardest thing to do. And I began to think about that line, given my own background, and I went, you're going against biology. That's where I tell guys, I says, you earn your money. People who say, oh, you're speculators, traders, it's not that hard. I says, oh, no, you have to go against human nature and not do the, oh, I know what's going on story. You're going, there's a probability of this, and it's a good enough probability, and I have enough evidence of the pattern that I'm willing to put a measured bet on. But you're not doing, the more of the past I can explain, the more of the future I know is going to happen. Yeah,
but you just really, we could go on for hours when you say, well, examine the probabilities and put a measured bet on. If there's a secret sauce, it might be right there in that simple phrase, That's heavy duty lifting for most people when they haven't been exposed to these worlds.
But the first thing about it is to get that your brain is designed to fool you. And the thing is that in the past of our creature, in our history, is that the idea of something was coming towards you at great speed, whether it was an ox cart or what, your ancestors, that predicting that was going to run you down and getting out of the way was a really good idea. In fact, one definition of intelligence in humans is that we have these prediction engines in us. And they're always predicting what's going to happen next. We can make this clear image, going back to the map, and because our image of this idea is so clear, it seems true, and we believe it. And as I say, when things are close in time and space, this makes good sense. But when you get into the ether of trading something that's little movements on a screen, if you will, and other things, then we get deceived.
Because hold on, Charles, are you telling me that looking at a diversified futures portfolio in 2012 is different than the ox cart barreling down on you 1,000 years ago? You're saying there's a slight difference and we can't go back to all those visceral human ways that we used to handle the ox cart?
Well, I'm saying we can't not utilize those human ways we used to handle the ox cart, and so you need to find a way to frame them and contain them. When you talk about Ed Seykota and people who talk about, being in the now, that it's to treat the stories more lightly. I mean, Ed, first time he said this, I just scratched my head, and he said the following: is somebody was asking him about, I don't know what it was at the time, it might have been copper or something, and he said, this commodity has the property of going up. And they asked him again, and I now realize that they all wanted Ed to tell them the story of why this was going to happen, why it was happening, why it would happen. And Ed again repeated himself and says, this commodity has the property of going up. In other words, he freely confined his language to the moment of now.
It's just tough for people to accept when they're not exposed to it. I think it's when, the hard thing too is that sometimes when you've been exposed to it for a long time, it becomes second nature. I just don't even think or worry about some of these things that you might have when you were first exposed to it. And then the tricky part becomes, how do you reach back and explain it to folks that maybe have not had the chance to experience that same aha moment that you've had?
I agree, and another of the strategies, one that I've picked up recently, is the idea that full and complete picture you have of that future, if you've got a way to poke a hole in it. I think of that the fellow that we met at a conference. I believe his name was Samuel Abraham. Is that right?
Salem Abraham.
Salem, yeah. Is that he was saying, then I think, what could kill me? What could get me? And what he's trying to do is he's throwing into that image that he knows his brain can't not make, and going, how could this not be so? Throw another picture up on the screen, throw another map up on the screen.
Well, he's also looking at the probabilities too. He's saying, what could kill me? What are the odds of this happening? What are the odds of that happening? And trying to affix a number to it. And that kind of leads me into one of the things I know you've been talking to your students and clients about in the not too recent past here is what is risk? And I'd love for you to maybe just kind of jump into that from your perspective, because, people, you hear this word risk and, different people use it for different reasons. You'll see magazines, newspaper articles, TV, but risk is something that I think the great traders put some definition to, and they attempt to put numbers to it. Even if they're inexact, there's an attempt to measure risk, and not simply by saying risk is volatility or just a standard deviation, that it's something more than that. And you mentioned Larry Hite, and I think Larry Hite's great explanation of risk was, what can you control? Well, the only thing you can control is how much you can lose, and that's real risk. So I just let you run with it. I know you've got some different views on risk and what you've been teaching people.
I'll start out with a reference to authority, which is to say that I was looking over a talk by one of the senior risk people for one of the largest firms in the world giving a presentation internally. I was given a pass to look at this, and he admitted in the talk that they don't know what risk is anymore. This is like trying to figure out what is it. So first of all, the fact that you can put a label on something, that's again that magic of the mind. It creates a certainty. Well, risk must be a thing. And this fellow went on and he says, well, no, risk is a process. And right there, of course, we're going to lose a number of our listeners. So let me pull it back and start with where I come from, is that risk is a feeling, an estimate, and a reality. And these are not the same thing. So if you make in your mind a triangle, this is a model, a map, by the way, and one point of the triangle is the feeling that you have of what's risky and not risky, and another point of the triangle is the estimate, and the other point of the triangle is the reality, then we can begin to sort out the following, is that it turns out the feeling, if you like something, you'll systematically rate it as less risky just because you like to do it. And if you don't like something, you'll systematically rate it as more risky because you don't like to do it. This is how we're built. This is how people take on, they say, well, why is this person engaging in that risky activity? Because they like it, So we have this emotional measurement of risk. Also, risk declines with familiarity. That as one becomes used to trading every day and putting on positions and taking positions off and so forth, it begins to seem ho-hum and it feels less risky, which has nothing to do with the estimate of the risk. And then there's various ways, of course, that you can estimate risk, whether it was the VAR or some other measure. You just mentioned one in terms of going to more investor orientation is what Charlie Munger would say, that risk is risk of loss and anything else is just pretending. And looking for a margin of safety, which is an old Benjamin Graham term people are bringing back. It's like, not what's the number, because here again goes into the work that I do in the nature of the brain, is that if you put a number on something, people think numbers are more real because most people are uncomfortable with math. So they go, oh, it has a number, it must be authentic. That must be the real risk. It's even worse, by the way, if the number has a number of digits, especially odd ones. So if the number is like 0.67394, they go, oh, that really must be the number. Because the more numbers they are, instead of like it being 0.9 or 0.2 or something, well, that's slipperier. So the very mental model we make of it is influencing our feeling about it, instead of us looking at the idea that even that estimate, as much effort may have gone into it to make it as accurate as possible, is actually not the reality. What one is trying to do is bring together a smaller and smaller triangle so that the experienced trader's feelings are closer to estimates that actually are closer to the reality. But of course, you never find that out until the risk has happened.
I was going to say until after.
Yeah, and that goes to the idea of the importance of reviewing one's trades, not from the standpoints of winners or losers, but from like the standpoint I just mentioned, which is, how well did my risk measure operate in this situation? Is it actually trustworthy or not? And, there's any number of cliche examples we can take from 2008 onward where people believed the numbers were the reality and then got the big wake up.
I did an interview with a trader named Bob Pardo the other day. We were talking about risk, and one of my favorite things to tell people just is a simple little guide. Maybe it's a simple map that I think works well. Maybe it's not perfect, but I think it at least gets people thinking. And I said, well, if you ever see a trader that produces positive performance every month. And once again, this is in a world where you've just accurately mapped out that, getting our feelings and our estimates and the reality all to be one is very, very difficult and impossible. I say to people, if you ever see a trader who has a track record, who makes, and you're probably going to tell me you know some, so they don't blow my whole theory up. But if you ever see a trader that has a track record where they make 1 or 2% every month, month after month after month, never a down month, and this goes on for decades, I say you've either got long-term capital management on your hands, which was the case in their case before they blew up, or you have Bernie Madoff, who constructed fake constructed 1 or 2% a month. Literally, it's just that when you're dealing with risk and you're dealing with all this uncertainty, I think the natural human reaction is, oh, wow, that track record's 1 to 2% a month. That's great. I think a lot of people would see like a long-term capital management track record before they blew up, and they'd be like, oh my, and clearly this worked because that's why they raised all the money.
Oh, and it gets funnier than that because, and I've been reading a lot in a lot of the literature in behavioral finance, and it's about the time that these guys are on a new high, like the third year in of these great results, is all the people will pour into the fund at that point, and that's where it has reversion to the mean.
Yeah. When you see it, I think the natural reaction for folks would be like, if somebody, it's going to be a very bright person, it could be, super high SATs, doctor, attorney, whatever, and they could see, wow, look at that track record. They've got all the requisite PhDs, they all Stanford, Harvard, and look, they've produced a 10-year record of 1 or 2% each month. And your reaction is, well, my gosh, I want to give them my money. My first reaction would be, I'm not giving them 1 cent of my money because there's something funny going on here.
You've got the contrarian mindset. Yeah, I mean, the doctor or the attorney, whoever they are, what you just described is someone who is making the story. They have a very few data points, to go back to my original idea of how easily people build these maps and stories, is they have a few points about, oh, it went up this year, it went up that month, oh, they got this PhD. And then they, in their own mind, make this rich picture. of how wonderful it all must be there. Recently, I was looking stuff in terms of hedge funds. It was the article I was looking at pointed out that there was a 90% correlation across all hedge funds, which means even though there are, at least a half a dozen, if not a dozen different kinds of hedge fund strategies, apparently they're all doing momentum strategies now. What the name on the door says, what they say they're doing, this goes back to the idea of the car, that it doesn't matter if all you want to do is drive it, but it does matter, if you expect it to take a long trip or whatever. I'm going to try to stretch my analogy here a little bit, that at what point does it matter that you know what's going on underneath? And that's the big flip here, is that especially people who have a full-time job like an attorney or a doctor or whatever, is that they don't have time to become an expert at investing. And in fact, being an investor, a good trader, both those to me have a lot of similar skills at a basic level. This whole idea of not following the crowd and being able to estimate risk and all these things. This is an unusual talent, or as Charlie Munger said, is as only 1/5 of the people are in the top 20%. Not everybody can be an outperformer.
Well, you just mentioned also the doctor or attorney who maybe doesn't have the time. And it's almost like, well, if you don't have the time, then you don't want to play because you're up against people that have put more time in. And I think that raises another thing that I know you've worked with is the socialization of risk. Everyone thinks, the street says, it's only just, it's always been this way. And I think that gets more back to the stories and, bringing the stories into risk. And I think you find a lot of inexperienced folks. And look, I've been there. I've done that. I had to kind of learn. I had to come learn from the Charles Fauchters and the Ed Sekotas of the world to find out what I didn't know. But I knew there was something I didn't know, so that's why I kept searching. But why don't you speak to that too, the socialization of risk?
I don't know if your listeners know about mirror neurons, but it's worth Googling. Mirror neurons are when we see somebody else do something, we have an unconscious connection to that. Now, not everybody and not in every situation, but it is our biological heritage. We actually have to turn it off as opposed to turn it on. It's a baseline. You see somebody trip and you yourself move forward a little bit. You begin to get into a good conversation with a friend and you're beginning to gesture at the same rate of speed and you're finishing each other's sentences and you're in sync. I mean, that's what it really is. Thing is that being this deeply, that's why I use the mirror neurons, deeply biologically in our neurons as well as our muscles, herd creatures. One, it's really hard for us not to stay with the herd. Which is, when you just said earlier, when you saw the fantastic history in this particular fund, you'd go, well, I'm staying away, whereas everybody else is going, I want some, because that's the herd mentality. Also, it's, again, going back to our biology, it really made good sense. I mean, somebody would try to eat something, they didn't die. You go, oh, I'll eat that too. So the idea being that we would, if most of the people are doing it, it's probably pretty safe. I mean, that is the basis of the herd idea, that the herd will survive. In the socialization of risk, we are unconsciously, and I mean unconsciously, outside of awareness, is in a trading room that a guy has a successful system, other people will begin to trade closer to that system. In the banking area, what happened there was that the banks were all trading the same algorithms. They even have a word for this in quantitative finance. It's called convergence. Is that the traders were trading the same trades, the banks were using the same algorithms, they were all trading the same instruments. They could have diversified, and of course we know some places some people did. But everybody kind of gets in there because it feels more comfortable to be with the group, to be with the herd. And then it doesn't feel risky. It makes perfect sense of why people that were tremendously risk averse in 2006 decided they had to get me piled at the last minute because at that last minute it seemed least risky. In fact, it seemed like it was a bigger risk that you'd lose out by not doing it than by doing it.
When I think of the herd, I was looking at some videotape from this film that I did a few years back that you were
That's
in.
Wonderful, yeah.
And I went back and I was looking at the tapes of being on this sheep farm, because we were on the sheep farm for 2 days, to watch the hours and hours of outtakes were much more interesting than probably what we had a chance to put it in the film for a few minutes, because to watch that behavior and just so desirous, to watch their eyes, if you watch a herd animal and get down at ground level and look at their eyes, and they don't look at you. They are looking at their neighbor, worried about what their neighbor is doing at all moments. And you are just something to get around till they can get back to looking at their neighbor and feel comfortable seeing their neighbor. And you're just an object that they need to get away from.
Well, and that, I'm not saying we are sheep, but there are some similarities, is that we now know, again, the biology, that the most important creatures to humans are other humans. We are looking at each other, sometimes in fear, sometimes in lust, sometimes in envy. There's a whole range of emotions. The thing is that we're comparing ourselves to them. It's a typical strategy for well-being. We're looking to them for signals of what to do. Every creature on this planet with a backbone has a pecking order, a hierarchy. And in fact, some of my work that I do consulting in business is, how do you create a situation where the leading people in a firm can actually get their ideas out before the leader says something? As soon as the leader says something, then you get herd behavior. So it's not only are we looking at each other, we're also looking at the leader. It's, and as I say, people act like, oh, you could choose differently, ask yourself this other question. And it's like, it's not that easy. In fact, you said it early in a way, getting at my newer work, is that one has to actually learn, be so voracious in their learning that you pop to another level. That you were saying you used to be like that, and now you're contrarian. Now you're questioning this. To me, the whole thing is, it comes from building up enough worthwhile experiences, not just mindless repetition. But
a simple heuristic to what we're talking about today, at least one that I use, is I want to sleep like a baby every night. And if I sleep like a baby, every night, then I'm doing something right. Because that, if you're not sleeping right, this is like just a really basic type thing, but I think it's important, because if you're not sleeping right, there's probably something wrong. I mean, that's a simple heuristic I use on just how to manage day-to-day life.
Well, and I would add to that to say that, if you're not sleeping like a baby, then it's being serious about going, so what's keeping me up, instead of taking a sleeping pill or a bottle of Jack or something like that, right? It's about taking that feedback seriously and going, okay, so how do I need to change what I'm doing so that I can get a good night's sleep? In the morning,
well, that was fun. Nice little glitch there. The only thing I could think of when I see that glitch is the classic line from Cool Hand Luke.
What we've got here is failure to communicate.
We've got things fixed now too, so I think we're right back into the interview. You back?
And we're back.
Yeah, I'm gonna. Yeah, we're recording. We'll just edit this all in, but I should make the note to listeners. So we're doing this Skype interview, and as my tech engineer Steve just said, something with Skype digital artifacting. So I'm not sure what that exactly means, but for whatever reason, we'll complain to the free Skype people that they interfered with our nice transmission here. Well, listen, I've kept you on the line here for a while, but I do have one last thing that I want to kind of go over with you, because I know I saw it on one of your presentations, and I thought there was a lot of little details that you could make with it. My work appeals to stock traders, ETF traders, futures traders, but I saw something on your site that was comparing motorcycle riding to futures trading. And there was, I just, maybe you might run through some of that, and without me giving away anything, and kind of let us know your thinking on how you were making those comparisons and intertwining them.
Well, this goes right back to when you opened about maps and models and so forth, is that because the nuts and bolts, to use a metaphor, of trading are often invisible to somebody getting into the business, and sometimes even somebody who's been in the business a while, by taking a physical object and utilizing that as an analogy, then people could begin to go, okay, well, these are the kinds of things that I need to look for. So it was a heuristic, to use the word used earlier. It was a way of helping build a strategy for them to start paying attention to things. So I explained that in motorcycle riding, there's, your holiday or weekend rider, your weekend warrior. There's your motorcyclist that does it pretty regularly. There's racing cycles. Then there's motocross and so forth. So there's a lot of different kinds of motorcycling. And of course, you could make that analogy to trading, make that analogy to investing. And then it goes, well, then, which kind are you interested in? Do you have the right kind of cycle for that? Do you have the right kind of experience for that? And this is just to get people to begin to think about that in terms of the trading, that trading is not just trading. And for them to get more critical, and I mean that in the sense of more detailed and more thoughtful about, well, what am I doing that I'm actually going to put my money in this? Because the systems that are out there, you can click and be online in 5 minutes trading now. Those people who will remain nameless are not that interested in your being good at doing this before you start doing it. So it's on you. And then I went from there to the idea that, well, now, when you have a system, it's like a cycle, and it can be over-optimized. And I had a picture of a very tricked-out bike, which would have been great as long as the ground was perfectly flat, right? And there weren't any bumps in the road or things like that. But, when trading, there are bumps in the road and sometimes potholes to go around and so on and so forth. Again, extending this metaphor, this analogy. And then I explain and give credit where credit's due, is Ed Sakota, who is a systems dynamics guy at heart, a real brilliant man, pointed out that most people think their trading system is on their screen, just like most cyclists think that their cycling is in their bike. And the idea, no, it's not. The bike is part of it, just like your software and screen are part of it, but you begin to increase the picture, take a bigger picture, and you see that you're there as well. That it matters what you have and what you bring to the table, what you know, and the mechanic there to maintain it, or the person who's maintaining it. So getting the person to realize that they are a significant, if not the most significant element in their trading system, that it's not merely on the screen, that it's them and who their broker is and what kind of quotes they get and what kind of execution they get and what do they know and so on, and their information sources. All of that matters. And moreover, to take Ed's point here, each of those can be optimized, and none of them should be optimized all the way. If you're going to optimize a system effectively, you optimize a little of this one and then a little of the next one. So you keep bringing things up all the way around every element, because if you over-optimize one element, like the cycle, I don't know about where you are, but in Chicago a few years back, they released I think it was Suzuki Katana, a really fast bike. And it had a life expectancy of like 3 months. And I mean the rider, not the bike. Is that guys were buying this bike who had no business being on it. They had over-optimized their ride. They got themselves into permanent trouble. And in trading the same way, people think, well, I need faster quotes. And I would go, maybe you need a better sense of how to utilize your emotions in the situation. Maybe you need a better sense of what happens when your trade is executed, or maybe you need a better sense of what the options are to take advantage of the opportunity you saw. Does it really have to be in gold? Are there other ways that you could optimize that opportunity? So you're developing a richer and richer picture, and you optimize all the way around the circle.
Maybe they shouldn't be trying to get the motorcycle racing experience on the Katana in futures trading.
Exactly that. And then the idea I made in this presentation of the two wheels, and the front wheel I just described, or the back wheel, doesn't matter. One of the wheels is optimizing each element of your system, which is to say yourself, your indicator, your information, and so forth, your money management strategies, your execution. Then in the other wheel is to go further inside you as part of the trading system, which is, what are your mental maps you have to draw on? And I know I've used Charlie Munger's name probably way too many times, but every guy I know, and a few gals who've really succeeded at this, they've really developed their mental maps of what the markets do, whether it's Linda Bradford Rashke or a George Soros or Jim Rogers or Ed Sakota or so on and so on and so on, is they have a very rich understanding, and they don't take the information as given. They tear it apart and put it together in their own way. And people go, well, that sounds like a lot of work. And I'm going, well, that's what expertise is. Expertise is doing those hard things because you find it fascinating. For some people, it's chess. For some people, it's motorcycle riding. For some people, it's the markets and many other things as well. So inside oneself, there's the metaphor of what you're using. And we could spend another couple hours on this one. The idea here is that language and thoughts are fundamentally metaphoric. So they talk about markets climb a wall of fear and then markets fall. I'll use that example. Why do markets fall? Markets climb? And here's another thing. Markets fall 4 times faster than they rise. But if they're just a number moving from one to another number, why would going down go down faster than going up? And the sort of Twilight Zone answer to that is that the markets fall at the same rate the human body falls. Yeah, the markets are an expression of us. How you think about the markets is an expression of human ideas. For some guys, it's a game. For some guys, it's a puzzle, and so on, these different ways. And then they delve deeply into that. Paul Tudor Jones would say that the markets are a game and money is how we keep score. But, he's no Thursday night poker player. This guy seriously and deeply understands the many, many aspects of the game. Who are you as the trader? That'd be part of it. What do you believe? What are your emotions? Ed Seykota famously saying that, the emotions you're not willing to experience are your trading system, because you'll get frustrated, you'll get afraid, you'll get greedy, and you won't follow your system. So there's that whole circle of self-knowledge as well. And it's only when all of those are, as we would say, firing on as many cylinders as your cycle has, that you really go down the road knowing that you're in for the journey as opposed to, just to the next block.
As you're talking about the individual and you're talking about self, and I know I said that was going to be my last question, but I want to relate this back to something because I think you have an interesting perspective. And I want to bring this back to where we are in 2012. I started my online consulting business in 1996. So I've had people grow up with me, but then I've had new people become exposed to what I do now. But a lot has happened since 1996 in terms of how people acquire information. In my humble opinion, we've got to a situation where most people think, well, if I go to Google and I type it in, I'll find it. Okay. The reality is, I could have never, for me to put the books together that I put together, for me to make the context that I made, Google was a side show to some degree. And the point that I'm ultimately getting to is how we acquire information, that we are inundated with what we think is real. And the TV and the Facebook and, all these things, these become our lives. This becomes what we see. We think this is real, but it's not necessarily real. And before I let you respond, I'll give a great example of something I was dealing with today. I had this thought in my head. It's like this man and his wife who I met in the late 1990s, very influential in the trading sphere. And I had gone and met with them at their house. And I'm not going to name them, but they were very accomplished, and they were right there at the beginnings of the trend following space with a publication, and they knew everybody. And I remember, it's like, oh my gosh, I met this guy. It's like, I wonder what he's doing today, because I wanted to reach out to him, because I knew by reaching out to this particular individual, he might have information, resources in forms of either performance data or audio tapes, things that aren't going to exist on Google, things that I know would be as timeless as when they were probably recorded or put together in 1978, 79, 80, 81, as they are today. But I also knew from my experience, there was no way this is going to find I couldn't even find this man's name in a Google search. It does not exist. I had to go through like a couple degrees of separation, and then I got his email address after 10 or 12, 13 years. But my point being is I didn't just wake up and say to myself, hey, I want to find some information that I might not have heard from some of the legends from nearly 30, 40 years ago, and I'm just going to find it through a Google search. Now, if I woke up today and I was 21 years of age, I'm going to do the Google search and I'm going to stop, and that's it. It doesn't go any further. So in some ways, I guess, and like I said, you make this point very eloquently in an interesting way, but we've reached this point where we don't ask why anymore. We don't dig deeper, because we don't even know to dig deeper, because what we see is what we become, and we're just kind of, a lot of people are just lost. Speak to that a little bit. I mean, you've talked about this before with me.
I think what I've talked about, there's several aspects of it.
It was a nice, easy one question, right?
Yeah, exactly. First, it goes back to the mind tendency, is that what we see is all there is, to quote Kahneman, is that, we go to Google, and if you haven't been pre-Google like we are, then, there's more. I think that like the readers that people have, I see carrying the airports and so forth, they're wonderful things, except that a number of the books that I have aren't on the readers. They're out of print, or nobody thought it was important enough to put in a reader. Not to speak ill of them, but it is like people think that they have complete access to information when they don't. And also we have this thing is it ought to be newer. Maybe I'm just getting antiquarian, but it's like I've been lately going further and further back, reading Jesse Livermore just this last week, and reading old 1930s books on cycles and stuff. And actually the math is harder than the newer stuff. But more to the point is that the ideas are there. I mean, you read Livermore's book and he lays it out. It's there if people are interested. And yet it's not the new thing. It's not the hot thing. Obviously, what I need is more information. Now, here's a funny thing about information, but not in a ha-ha way, is that, for example, you take market data coming in. That market data coming in, if the market data that you're looking at is at a higher rate than the rate of change of what you're trading, you are likely to become more volatile in your trading.
You got to read that one over for people so they really grasp where you're going with that.
Okay, yeah, I know. It's a curious thing that I worked out on my own, and so I bring it up again, is people who weigh themselves every day are more likely to yo-yo in their weight than people who weigh themselves once a week, because it takes about a week to lose an appreciable amount of weight relative to you ingest, you release, and so forth. Weighing yourself every day just encourages the people to be more crazy about their health habits.
But Charles, I have this. I'm not talking about myself, but I have the scale, Mr. Faulkner. It's in my bathroom. I have to step on it every day. Every day. And what would happen if you didn't? I might die.
Yeah, I know. Well,
I might
let's try
stop.
that one out.
I might go to another parallel universe. Who knows? If I don't watch Basketball Wives or Jersey Shore or something, if I don't know what's going on, if I'm not TMZ'd all day long.
Yeah. Oh, and this, because of the rate of change, of difference, at the end of the day, it will feel like you've really absorbed a lot. But the thing, we go back to that original thing I was talking about, the system 1, which is intuitive and quick and emotional, and system 2, which is thoughtful and creates new patterns and thinks things through. You really need uninterrupted time to develop that mental muscle, to use an analogy that I think your listeners can relate to. Vic Spirandio is somebody that I thought was interesting, is that he went into his study for I don't know how many years and figured out, thinking about it and looking at lots of charts, that here's a real shocker, it really matters what you're in. As far as trading, it not only does the way that you trade matters, but most of the money gets made by being in the right things. So for whatever time period it is. So he began to look at that in terms of wealth building, rather than looking at what method he was using. And that's that ability to think that through and back up a step and go, okay, I need to add another layer of thinking to what I'm doing. You got to unplug and give your brain time to actually walk those steps. And yeah, there's so much discouragement to do that the people who can and do it, they'll have an advantage. They'll have leverage.
I think one of the most interesting apps that I've seen in the last couple of years, and who could have ever thought we would get to this point, I think it's called Freedom, and it goes onto your Mac, and you type in how many minutes you want to be able to not be able to access the internet.
Yeah. It does exist, yeah.
And so it blocks you, which, it's amazing that we've got to the point where we need tools like that to stop the addiction. Because I guess what you're really ultimately telling us is that being a master of random, trivial pursuit will not, having every last table scrap of information that's coming at you nonstop with a fire hose all day long is not going to be a solution to where you might want to go in your life, that it is going to be that deep, thoughtful thinking by yourself and really the self-examination. I mean, that's where it's at. Because, someone said this to me yesterday. We're talking about helping people to get from any point. And he said, ultimately, people over on the A side of the ledger, and they want to get to the B side of the ledger. And maybe if they're overweight, they say to themselves, well, I want to be George Clooney, in shape now. And the reality is they really don't want to be George Clooney. They want the benefit of the benefit. They want the benefit of being George Clooney. They want that striking.
A lot of guys want the benefit of being George Clooney.
Right. But it's not necessarily they want to be George Clooney. So, but I think that it's really interesting where we're at today. And I think you make that, and I should let you go, but I think the point that you make that's really important for people to be aware of is that deep thought side of the thing, is to kind of try and, we can't stop being smacked every day with the barrage of information, but it's finding the time to put the deep thought in.
Well, I'll go further than that. I will agree with that, certainly, yes. And I'll go further and say that as much time as any of our listeners are putting into their profession, they should know there are other professionals putting time in to try and find more ways to make the internet and YouTube and all the rest of that irresistible. And they're preying upon our physiological, perceptual weaknesses.
We're all a superstar on Facebook, Charles. We all have our own pages now. We all have our pictures, and we can put our favorite picture up, and we can look spectacular now.
And if somebody wants to do that, you could do that in a few minutes a day.
Well, but there's like 800 million people on Facebook looking to do it every day. Everyone's a star now.
That's what Andy Warhol said was going to happen.
Being a star doesn't necessarily get you to the benefit of being George Clooney, or it doesn't necessarily get your trading account to where maybe it's higher enough to give you some real freedom in your life to go experience whatever you might want to experience.
Yeah, just recently, I do remember his name. Cuban was interviewed, and the last line of the interview he said, should people follow their dreams or something like that? And he says, no. He says, don't follow your dreams, follow your effort. Then he explained that what he meant by that is look where you're actually willing to do the work. A line that I like from Tom Baldwin is everybody wants the money, but who's willing to do the work? Nothing wrong with having a lot of dreams, but then look at what you actually are willing to actually go in and do. That can tell you more about where your edge might be, what kind of trading or investing or engagement with the world is really going to make a difference for you.
By the way, that first episode you just heard, that was episode 3 on my podcast series. Now what follows is episode 51. Let me get you to talk about, because you're using the phrase here in our email conversation, System 1 and System 2. Why don't you just define that from your perspective for listeners?
Okay, well, back up ever so slightly. System 1, System 2 is a dual process theory of how the brain works. And, it's not a full model, but it's compelling. It's the people in behavioral finance and economics are very interested in it because it makes sense of Ehrlich's book entitled Predictably Irrational. It's what Kahneman in his book Thinking Fast and Slow is referring to, that one of the systems is very fast. It's intuitive. It's automatic. It's largely unconscious. It's how we look at somebody and we know, or we have an idea what they're thinking. We see a situation and we know immediately what to do. This intuitive, instant insight, instant reaction kind of thinking they call System 1. That's number 1. Now, what I've done in my book is pointed out that this as well is an early system in children, that it grows up and showing up in particular around 3 to 7 with things like magical thinking, where children feel like the sun is following them, or they have the idea their toys can talk, and that they slip across categories and they make mistakes. And what I show in my book is that these mistakes actually explain what are called the heuristics and biases, or most of them anyway, in the area of behavioral economics. The idea of the availability bias, that if something comes easily to mind, which is System 1, that we believe it's more true. Or if we can tell a story about something, then we think it has to be right because the story is short and clear and doesn't have very many things in it, which actually makes the story easier for us to see, and therefore we think it's truer. That our brains have these properties, if you will, that were really good when our ancestors lived life up close and personal, where you were reacting to people around you, where you were reacting to your world around you. And so this kind of thinking is very adapted to that. But then as things get further away in time and space, another kind of thinking becomes more useful. And this kind of thinking showed up later on in terms of human evolution, and that's called System 2. Now, System 1 recognizes things and associates things, puts things together. System 2 separates things and compares things. Somebody's looking at whether to do certain trades or not, and they might be thinking, well, what are the advantages, disadvantages of these trades? That would be a System 2 type of thing. System 2 compares. System 2 can sequence and resequence things. And so System 2 is what traders are utilizing when they design a system to trade. One of the insights that I'm bringing in the book is that System 2 sits on top of System 1. In other words, all the basic ideas come from when we were younger, under stress and under emotions, good or bad, positive or negative. And this isn't from me. This is the research has already been done. People go from System 2 back to System 1 and don't realize they did it. So let me give you an example. It would be that the Facebook IPO is going to happen, and people go, Facebook is like Google. In other words, they put those two together. They go, Google came out and just kept going up and up and up. And so they have a really clean, easy story, and they've combined these two ideas, and they think they've been doing some logical thinking and some System 2 hard thinking about it, but in fact they hadn't. It feels like the right decision, which is very much a System 1 kind of thing, and they go for it.
You know what's interesting about your view? First off, I should say, just to make a note here for the audience, my toys do talk to me. That hasn't stopped.
Well, let me jump in and say that's one of the big discoveries. It's something that I was seeing anecdotally, and then I went and looked for the neuroscience on it. It turns out that people like to think that we're all System 2 now. We're all logical and rational. But in fact, most of the time in most situations, we're utilizing this more intuitive, instant decision process. Moreover, we're making category mistakes, just like the children made, only now as adults they have a different kind of phrasing to them, like, it was destiny that we met, or everything happens for a reason.
You know what's interesting about these connections or the contrast between 1 and 2 is that I think it makes, as I listen to you explain it, and I feel like I'm in the front row of your class listening to you explain it, it makes me realize sometimes in my world, when I'm attempting to explain or contrast or put a parable out there, the numbers of people that interpret my actions in a System 1 way, as opposed to realizing I'm presenting it, if you're paying attention, in a System 2 way. They reach for what they think they're seeing, some visceral gut level where perhaps they think I'm being angry or I'm fighting or I'm dueling for no reason, and they immediately go to the 1, and then they want to come back at me with more of this kind of visceral level thinking, whereas I'm really trying to have the discussion at level 2, and frankly I think that's why I enjoy always talking with you, is because you get me to think about ways to where I can present the 2 discussion, for lack of a better phrasing, in a more coherent way.
Keep in mind, System 2 thinking is deliberate, or deliberative, as they say, and it's mostly conscious, and it's effortful. It's hard work. People don't like to do it. Kahneman tells the story of the fund manager who was thinking of buying Ford stock, and he goes, "Oh, Ford, they make great cars," and decided to buy the stock, instead of going and doing the System 2 hard work to look at, was the price of Ford stock at that time, did that represent some sort of value that was likely to increase?
Yeah.
So there's the slippage here is of tremendous importance to traders, because they think they might be making one decision when they're making another. Now, my addition to this is that from the person's behavior and language and the kind of beliefs they give, you can begin to calibrate whether they're coming out of System 1 or System 2 and which one's more appropriate for the moment.
Well, help me to understand where you're going with, I think people can follow along and they can see this clear description that you give of 1, this clear description of 2. Where are you taking it for the reader and for the student out there?
I'm using developmental psychology. Again, I'm using it because the research has been done. It used to be believed that as children grew up, that they would go through these childish ideas, and then they start to think logically, and then they start to think in formal symbols, as they say in the academia. What's been more recently discovered is no, not everybody gets up through, say, Piaget's 4 levels. That, in fact, they say less than 35% of the population gets to the top level. There's a lot more people that are utilizing the lower levels, the system 1.
Charles, do you want to define those real quick, just so people can follow along?
The Piaget has the most basic level he calls the sensory motor. This is the infant, the child, and how they relate to the world. And then it goes from there to what are called the pre-concrete, the pre-operational. These are magical thinking, where the child sees the world as being ruled by intention, that people are doing things, that the sun, they draw pictures with a smile with the sun, there's a man in the moon. Now, how this gets expressed later on in adults, which they didn't think was there, but the evidence is there now, is that traders will talk about how the markets are out to get them. Or they'll start to imagine that there's some other person on the other side of the trade, and they'll try and figure out who this other person is, because the idea that it's just statistical is too hard for our brain. They go for these simpler explanations, which can be, lead you down the rabbit hole, because you're looking where what you need to develop yourself isn't. So then the third level is called the concrete. And this very much is about the world and moving in the world and beginning to think about the world in terms of causality, in terms of this causes that, for example. And this shows up again in traders when they begin to work on systems. They want a system that's going to make money. They're looking at the result, and they go from system to trying to find a system that makes money, right? The thing is, they're looking often for a single variable system. Because we say, and the language here is important in my work, there's got to be a cause for this. So there's a fallback position that we adults, who are supposed to be more rational, who would obviously realize that many things in life have multiple causes and multiple effects, and that there's chance. But no, in our simpler mind, we say, well, what's the cause? And we look for one. While we might think that, we've got these adults managing money and Wall Street and all that, is that, the average mind in terms of it might be 5 years old in the images and ideas used, or maybe even as advanced as 11, which is pretty advanced. But what I'm getting at here is that development of a trader, of an investor, turns out to need to be much more deliberate than people thought. To become mature in your thinking ability, you actually have to work on it. And if you look at the top market wizards, you see that they did. And this goes over into the literature on expertise, where it takes between 6 and 10 years, practicing hours a day, challenging oneself, having a mentor, thinking things through over and over again, that these build people out of their system 1 into their system 2 and perhaps beyond.
Before we get too much into system 2, I think there's a lot of ground we can cover in the system 1 area. And I think specifically, I don't view these as negative. I think it's just observations. Issues, for example, like the herding, bubbles, panics. Why don't you talk about the notion of those types of behaviors inside system 1? So just kind of clearly define that and talk that through, the notion of herding and bubbles and panics. Frankly, they're all a very similar word for a similar type human behavior, but walk with that on some.
Okay. I'm going to have to go a little bit to the side of System 1, because while they talk about it, sometimes the academics don't strictly include it. But it is part of our natural and unconscious thinking system. So in that sense, I think it is System 1. And the natural unconscious thinking part that I'm thinking of now is called the mirror neurons, like looking in a mirror. And exactly that, the mirror neurons, they were discovered in the 90s, is that people tend to unconsciously copy each other. I don't know if you ever, years ago, there was a book by Desmond Morris called People Watching, and he showed pictures of couples that look like each other. He had pictures of people and their pets that look like each other. But the idea is, if you go to a cocktail party or anywhere and you see people, and if they're getting along, they start to have the same body posture, they have the same rhythm, they might use the same volume, they might use the same words. And it turns out that this ability of us to group together and to get into sync with each other had huge evolutionary advantages. Hooray for our team. The thing is that It also has the property of groupthink. That is that, yes, it's good to be able to all get on the same page and think the same things and do this without having to think about it. But on the other hand, you're in a trading environment, and I know this having been in these places in London, and there'll be some guy that's making money, and pretty soon, whether they mean to or not, other traders are starting to trade like him. So pretty soon the whole floor is into the same trade. And then suddenly it's not the great idea that it was.
Because in that context, it's not having a system. It's just, what's my neighbor doing? He's doing something that might be successful or is successful. I'm just going to copy him, and I don't even have a plan. It's literally, I have to jump and follow him immediately just because he's making money, and I have to do that right now, and I haven't even thought it through.
Exactly. It's the not thinking it through that's one of the signature signs of System 1, is that System 1 is largely unconscious. People don't even notice that they're doing this. Even, somebody like Taleb Nassim said that the day he made a bunch of money in Chicago and he went in the next day and he had the person drive around to the same exit, although it was a different taxi driver, and he looked down and he realized he was wearing the same clothes. Well, the thing is that, again, the neuroscience is in situations of high luck, where luck, the odds, multiple outcomes are possible. Human beings get more superstitious because we don't know what to do. I mean, back in the jungle or, back on the plains or wherever it was, our ancestors, if they did something, the results were pretty clear pretty fast. Not all the time, which I could go into, but often enough that became a preferred way of thinking. So now you spread out that time, or you make it much more probabilistic. Then the person starts to build false positive and false negatives. They start believing in systems that don't work. They start avoiding certain things. They believe in certain ideas. All of this coming out of System 1, including the herding.
I think the brilliant part that you're discussing, that I hope people are paying attention to this, is the notion that people think they're outside of System 1 in their thinking, that they actually think they're over in 2. The reality is if you really, and I'm sure I'm guilty of this in aspects of my life too. I mean, I try to work at it, but the reality is we are us, the blood and mass that we are, the human that we are, we're still preferential to be in 1, right? I mean, that's where we want to be naturally, right?
1 is where the action is. A Woody Allen line, it's the only place you can get a great steak, But what you make is a good point, is that System 2, because it's more deliberate and conscious, and we know we're doing it, and we talk to ourselves. Yes, we talk to ourselves, and we rearrange things in our head, or we scribble on a piece of paper, or so forth, that feels like us. So
Charles, when you talk to yourself, what do you say? I that's what I want to know right now. No, I'm being dead serious. You've now told us, so I'm putting you on the spot. I want to know a conversation.
Well, one of the things I'll typically say is when I made a statement, I'll say at the end of it, so far. In other words, because when you talk to yourself, and this is also in the book, the idea is if somebody says, I can't believe I was so stupid, for example. Not that I say it to myself that often, but take that line. At that moment, your brain doesn't know that when you say that, you just applied it to all time and all space. You might have started out with one idea, but you've just said, I can't believe I was so stupid. Now, if you go, I can't believe I was so stupid in that trade, suddenly you've limited your stupidity down to that one trade, and you can be smart everywhere else. And this isn't an idea from me. This is an idea from the fellow that did Learned Optimism. That optimistic people are not people who are necessarily happier, although that's part of it, but they're people who know how to limit the effects of their less than useful thinking by limiting it in time or space. Like, I can't believe I did that last night. Limits it in time. I can't believe that I did this in this trade, limits it in space to that trade. And so one can then free themselves up from making overgeneralizations about who they are and what they can do.
Well, I guess a great example could be, I guess to some degree I am too, even though I don't have all the products, but Apple fanboys, so to speak, the people that just love Apple products. And not only do they love Apple products, but they love the stock price going up. And that's fine, but just limit it on the downside, meaning don't allow your love of the stock price and your love of the product to obscure the fact that there could be a point in time where if you do love that stock price and you do own Apple stock, that you might want to have an exit.
Yeah. Yeah, and that kind of separation activity is system 2. And as I say, system 2 is effortful. It takes sucrose, it takes focus. It takes the ability to inhibit one's attention and ignore other things. And system 1 is meanwhile attracted to, bright, shiny, happy, exciting, the people on television shout, "Oh, I can't believe the stock is so high," and we're much more responsive to that until we begin to realize that. And then we've got some choices about how to manage that. One of the interesting things I found about that is that people forget that Warren Buffett, who I know is not a trader, but good example, he was at Columbia in New York City. He worked for Graham's firm in New York City. And then he decided New York City was too distracting. So he went back to Omaha. I mean, there's a guy who understood that he needed to manage input. Now, I'm not saying you need to move your location, but that's the kind of thinking about trading and investing that I'm hoping to encourage my readers to take on. That there are things you can do to improve your abilities when you understand how you work and how to make it work for you.
I love New York City, but the idea that you have to be there to make it is so utterly false and misleading and misguiding and whatever you want to call it. It's just not a relevant thought. The thought is, how do you get ahead? How do you be successful? The thought is not assuming that if you're in New York City, it equals success. That's just nuts.
Well, and you bring up something else about System 1 is the idea that the availability of an image, an idea to us speaks to it being true or it being common. So people have ideas of what a trader or investor ought to look like, ought to act like. And these are very often quite sketchy and underdeveloped, which unfortunately, again, if it has a few facts in it, it actually feels more true than if it has all the messy truth. Because our brains like, if it's a clean, clear picture, we go, I understand. If it's got a blotches and is messy and, smudges in part, we go, oh, it doesn't look so good. So we apply that basic principle to our understanding. So people get the idea in their head of what an investor ought to be like, or a trader, and where they ought to live and how they ought to dress and so forth, instead of actually finding out what people who really succeed in the business are like. And my experience anyway is pretty big distance between the image and the actuality.
Yeah, I was very fortunate early on to have experiences and mentors that showed me that lesson almost out of the gate. One thing I want to jump back to here, though, was herding. And I want to kind of just give a brief experience that I had, and I'm sure I've shared it with you before, maybe I've shared it with an audience before. But when, years back when I did some filming and I was at a sheep farm, the day was a long day and we really weren't getting great footage or whatever story we were trying to tell. Like anything, sometimes I find it's the experimentation is where you find something, where some real nugget happens. So I spent a day on a sheep farm with a film crew filming sheep. And yes, I'm learning stuff about the sheepdogs and how all that behavior. And however, it wasn't until the end of the day when I kind of felt like we really weren't getting anything, where I told the director, I was like, okay, turn the camera on, follow me. And I just waded down into a pack of sheep, herd of sheep, whatever you want to call them, flock, I don't know. And anyways, and so I got eye to eye with them, okay? And they were on both sides of me, and I was in the middle. And sheep eyes are very human-like, okay? And expressive. I mean, I don't know how many people have actually put their face to face with, dozens and dozens of sheep as they're all looking at you. It's very weirdly expressive. But the thing that I could immediately realize just on my own intuition was their desire to not necessarily run from me, but their desire to reform the pack. They were panicked and upset that I had interfered with the herd. I had interfered with the group. And their desire was not necessarily, if I would have been, for example, they had no way of knowing this, if I would have been a man with a gun who was going to start shooting them, they seemingly wouldn't have cared because they were so concerned about, their eyes were saying, let me get back to the group. I don't care who this guy is. Maybe he's got a gun. He's going to kill us all. I don't know. I'm more concerned with being with the group. And it was an extremely interesting experience for me. I know you can relate to it, but I don't know if you can connect that to some of your work and maybe even to trading.
Well, the famous line from John Maynard Keynes is better to fail conventionally than to succeed unconventionally. What they call in fund management reputational risk. That these people that claim to be going for alpha, not all of them, mind you, but a goodly number, and especially in larger institutions, claim to be going for alpha will often have their portfolios adjusted by their superiors so they're more beta, so that they will match the market better. Because it's better to match the market than actually be the person that takes the risk and goes outside the herd. So yeah, we have a lot of that. And in fact, coming back to the point about the trading floors in the UK that I was at, is that they would all get onto a certain kind of trading. And it was interesting that every once in a while you'd meet someone, usually it would be the head trader, and he'd fade the group. And it would just, it was like, the eyes, just popped out of their head. But he understood he needed to break the trance. He needed to break up that group need and get people thinking again, because we slip into it without thought.
Yeah, I think it's a great example. I think and for people out there paying attention, this is why I think so far, and the podcast is doing really well this year, is because I can tell a crazy story about sheep and sheep eyes and being in the middle of sheep, which probably has nothing to do. It sounds slightly, off the rails. And then you bring a wise guest on who then says, he makes a good cogent connection in the world of finance and Wall Street that makes perfect sense. And it's true. It's the reputational risk, which is they would rather take the risk to potentially blow their accounts up. And that means, audience out there, that means if you've just got random mutual funds, these people don't really care about whether they're doing the right thing for your money. They care about whether or not their peers approve of them. And should be frightening for anyone. I think that's why it's so important what Charles is talking about, because ultimately this is about setting in motion your own path and taking control and personal responsibility. I mean, that's what all these tools and this thinking that Charles is going into is great for. It's about you. It's not just leaving it up to some unknown, faceless bureaucrat out there who may or may not be managing your money in an optimal way.
Or even some well-known person.
Yeah. Is there anything else you would want to talk about for System 1? I think we're kind of laying the case for,
Well, I would, for a couple of reasons. And one of them is that System 1 is how we make sense of the world. So you can't avoid it. There's a lot of encouragement for traders to be objective. Don't be ruled by your emotions. Be objective. It's well-meaning but misplaced advice. Being objective would be System 2. But System 2 utilizes System 1. So you really need to be well-versed in that in order to do the higher level thinking. And I want to give you an example that you're not going to hear anywhere else. And that is the idea that we make sense of the world with our bodies. We talk about looking forward to something, about looking back on something. We talk about things being over our head or beneath us. In each of those, the phrase looking forward to a goal, looking back at a memory, something's over our head, it's above us, something beneath us is some moral judgment. So we're utilizing our bodies to literally make sense. And the linguistics and the neuroscience is in on this now. What does this mean for the investor, the trader? The markets are rising. The markets are falling. Markets actually don't rise or fall. The price can increase, the price can decrease. But these are all metaphors. We metaphorize this, the idea of going up. Now, going up is a good thing. Going up in the world, stepping up in the world, being on top of things. We really like that feeling. We don't want to be down in the dumps. We don't want to be going down. Now, it doesn't stop there. There's even something deeper here about the way our bodies think, is that when we use words like fall. Have you ever seen a small child when his parent calls out to him, "Don't fall," and plop, the kid goes right over? That's because in order to understand the word, he had to mentally imagine and enact it. Now, we get older, we get better at doing this more subtly. But if I ask you to think about a trade position was slipping away from you, I wonder how many of our listeners would realize they also had a sinking feeling inside. which goes right along with the word fall. This makes it real. So when you hear on the markets, you hear on the news that things are crashing or something like that, we can't help but activate those images and ideas unless we've made arrangements to do something else.
Yeah, crashing. If you think about crashing, it's like a waterfall or Niagara Falls, something, heavy and volume and, but it's really just, it's price decline. If you're just objective about it, you have to say it's a price decline, and what's my plan for dealing with the price decline?
Yeah, but this is where the neurolinguistics I do, the relationship between the neurology of our brain and the language that we use. Just I used the example earlier about how we talk to ourselves. Well, these other words, they give us images and ideas, which if we're not careful, because of the way we're built, we'll react to in a heartbeat. The people I've met, the market wizards I know, they're quite careful about their language. Ed Secoda, a fine example where he got asked why, I think it was lumber at the time was going up, and people were asking, he said, this market has the property of going up. He wouldn't tell a story. He knew that telling a story would be telling this little lie to himself, and once it's in there, you can't get it out. Just like you were, the way you explained it with yours is you took out the emotion, you took out the vivid imagery so that it became something that you could think about more objectively.
I think you make a great point. I think if we think back some of the literature of the last 20 years, and for those I think it's funny, sometimes people, if they're coming into trading for the first time today, they might not see the benefit of looking back 20 years because they want to imagine what's new today supersedes anything that might have taken place years ago. But clearly, like for example, the work that Jack Schwager put in his books, I think some of the interviews and stuff that I was able to assemble in my books, if you look at the wisdom of the folks that have come before us, there is generally very clean and clear thinking. It's very logical. It's plain. It's crystallized. And as somebody out there who's new to this, you have to develop an affinity for that. You really don't want a story unless the story is teaching you how to think clearly. That's
an incredibly important point. Is the System 1, again, is a natural storyteller. The story can have like 2 steps in it, but it's a natural storyteller. And the stories you want to tell are about yourself, being capable of learning this craft and doing it. You said a story about the learning or how to hold certain ideas in mind, but that's not what most people do. Most people tell stories about the stock, the investment, the bond. In fact, on Wall Street, they talk about when they have a new product is like, what's the story? Because they know people will fall for the story.
I was thinking one you mentioned, Ed, and I was thinking, and I'm paraphrasing here, but I think it was a conversation between like a young guy and a fundamentalist, and the knife dropped off the table or something, and the guy put his hand out to catch it, and the fundamentalist is like, well, it's going to go back up, but so he wasn't worried about whether he's catching a falling knife, because it's going to go back up, but the point of that story, if you think about it, wasn't in the typical Yahoo Finance, CNBC, Bloomberg explaining the story of what's happening. It was explaining behavior. Mm-hmm. And there is a huge difference. I mean, I had a really interesting phone call with Larry Hite over the weekend. And every time I talk with Larry, Larry is a character, but his stories are always, they're not about wasting time. They are parable-esque. They are the learned wisdom. Anyways, you could probably explain even more about that.
I don't think I need to. What we're getting at here is System 1's a natural storyteller. You're not going to be able to not do it. Any book, novel, film, stories are all around us. If you look at them for more than a minute or two, you realize they're pretty simple stories, which is fine. Our brain likes that kind of thing. But in your business, in your craft, in your profession, you want to be more careful about where you use them and where you don't and how you use them. And I know I'm opening a whole possibility here, but just if people start thinking about that, they may find it useful. They might find surprising what they'll find out on their own.
Let me pivot. So we kind of lay in this foundation for getting people to come into, and obviously your book's going to go into this a lot more detail, and I think people will really enjoy that. But we're kind of laying this foundation for System 1. So what was in your mind? Where did the pivots where are the pivots and whose work did it begin to pivot from, where we kind of, and it's probably even a non-trading question because it wasn't until trading applications came after, but the pivot from 1 to 2, where do you see that really starting to gain speed and traction?
Well, again, going back to developmental psychology and Piaget from the 1920s onward, but there continue to be researchers, and it's around the age of 7, which I think is curious, since there's a phrase that, according to what I've heard, the Catholic Church says, give me a child till the age of 7. So there was some intuitive understanding that we went from a very unconscious and automated kind of process to beginning to be able to think about our experience. It's an emergent property, to use the lingo. It appears to be natural, but as years of schooling will show us, it needs to be trained. I would say, regrettably, in my case, I've had to do most of the training later in life. That I don't think our school system really understands what it takes for us to begin to think about our experience.
Well, I think, if you look at and I'm not trying to be some massive political statement or anything.
No, I realize that either, because the point I want to make is that it needs to be encouraged, and it's what schooling is supposed to be about. Almost all schooling is dedicated to developing system 2, to think logically, to think methodically, to compare and contrast, to evaluate, to develop your working memory. One of the things I looked at is you can almost figure out what level a person is at by how many things they can hold in mind. And system 1, it's one thing, and system 2, it becomes 2 or 3 or 4. The story of George Miller's research back from the 50s about 7 plus or minus 2 chunks of information is what we can hold in mind. What he was talking about is what system 2 can hold in mind, which isn't very many. There's a fellow who I like that does research in this area, and his line is, if we're so stupid, how did we get to the moon? The answer to that is there were lots and lots of people using system 2 and checking each other's work, because it is hard work to utilize your rational cognitive abilities.
Let me throw it to you this way. So I was just thinking about this example as you were talking. So I have a young guy email me last night, I think it was, or the last couple days. And I think he was from the UK, and he was talking about, he might have been 21, and he was asking about going to where he should go to school for trading. And he was mapping out for me the university courses he should take and whether he should get his MBA too. I'm not asking you, Charles, to go ahead and brag. It's not your style. However, let's be frank, the kind of things that we're talking about right now, I'm sure a good bit of the material in your book, and specifically how you tie a lot of these psychological issues in with trading and how you blend it, this is not part of university curriculum. So when I made the statement a second ago, and I said the thing about political schooling, the point that I wanted to make, the larger point is, I don't know what kind of school system we have anymore, but if one is looking for the truth and one is looking for the higher level of analysis, I think most of the school system, you have to look back at the sheep behavior and the herding behavior. They're not going to give you the original thought. They're not going to give you the higher level thought. If you want something that's truly unique, if you want to be at the edge of understanding, if you really want to know what's going on, you have to find mentors that are outside the system, because those are the folks. It's the guy on the corner who's not part of the system, who hasn't been tenured, who's not just repeating the same stuff year after year after year. It's the person that's finding this engaging new material, as you mentioned early on in this conversation, the solitary work where you can think. Your work, this is not in university programs. So the young guy that writes me at 21 and says he wants to go into a university program, well, he's not going to find your material there.
I disagree with you, of course, because I also agree with you. But there are some really lovely counterexamples to that these days, especially in this new area called behavioral economics or behavioral finance. There's a number of very bright people. And the brightest ones are the ones who are out there, and this is a new thing. They're doing what they call physical experiments. They're doing actual experiments with people and setting up little markets and things like that to find out this material. I draw very much from that well of information. If I were to go back to your question about this fellow, is that in one sense, I think you could take up any rigorous discipline. Because the whole point is to think rigorously, and once you've mastered that in one area, then if needs be, you can transfer it to another. And this is not well understood, but it is possible to do that. I don't know who I'm quoting right now, but I saw this a while back about a fellow who said the montage has ruined America. And what the fellow went on to say was that he says, whenever anybody has to master a skill in a movie, they do a pop song montage of 2.5 minutes or shorter. And by the end of it, they've got the business plan, or they've got the product prototype, or they've finished the degree, or whatever it is that makes light of that learning to think for yourself is hard work. If that interests you, if you want to be your own person and in charge of your own life, that you're going to want to do that. And the best or easiest way to do that is pick something you're really interested in mastering and then go do the hard work.
I'm not really sure where we're disagreeing there, but I want to clarify. My larger point was you, Charles Faulkner, many of your peers that we're talking about, Dan Ariely, Michael Mauboussin, Nassim Taleb, Daniel Kahneman, Vernon Smith, these are outliers. This is not mainstream. I know there's been greater acceptance and there's been greater press coverage, but by and large, these are topics that are outside the mainstream. Because let's face it, Charles, if we were to accept you, your work, the other mentors, the other peers that you have, their work, if we were to accept that this has really penetrated society as a whole, it kind of savagely takes a stake to the heart of modern portfolio theory, the efficient market hypothesis, to a stake to Bloomberg, CNBC, the mutual fund industry. I don't think we're there yet. I think we're still outside the realm.
Okay, point taken.
But no, I guess my larger point with the young guy is that I think you really have to be aware that the big system, the big school system, might not be where you can get your real insight. I really look forward to your book, and I'm sure other people do too, because I know it's the unique thinkers that are perhaps outside of the system that are bringing novel ways, new ways to explore these topics.
Well, no, I was chuckling to myself that it just may be my availability bias at work, because of course I'm looking at these guys' work almost every day, and so I think they're real popular. Well,
I think you make a great point. It's great self-analysis too. I'm sure it is. It's we in your world, you're seeing it all the time. You've surrounded yourself with this open way of thinking, and it has to affect, to some degree, I'm sure you think about this, it has to affect your ability to even want to pay attention to the old way anymore.
And bringing it back to our listeners, is this like Buffett moving from New York back to the cornfields? These are the kind of deliberate choices that people who become successful at this work do. I was writing a piece earlier about different people and their leanings, and I actually said that if you want to get an idea of the different kinds of ways people dive into the world and really become an expert at it, that the interviews in Jack Schwager's Many Market Wizard books is a really good place to start, as are your books. That one can begin to get a sense that one gets to mastery through doing something and engaging with it and questioning it and learning as much as they can about it. And this is where people who want to go into trading just to make money, an understandable leaning choice, but not one that's going to take you the distance, I don't think. Because it's not like being a Saturday golfer or something. To actually get good at this takes some effort, takes some real effort. It can be done. I find it, again, you talk about efficient market hypothesis, I find it humorous that they're still fighting that battle, whereas, the market's already efficient. They're occasionally efficient, except when they're not, and how much more evidence of that do we need? Even somebody like Nassim Taleb, who talks about how most or all fund managers are lucky, he's a fund manager. He's found a way, he's found an edge, as have many of the people that you've written about. They have found a place in the market where the statistics favor the prepared.
As you're mentioning some of the well-known inspirations, I caught a quote the other day, and I'm working on some different projects, and it's a quote from David Blaine, the magician. And I don't have it in front of me, but it's essentially, he was motivated by, if I can see that someone else can do it, I can do it. I think that you've got to have that positive optimism in life. That doesn't mean, because let's be perfectly frank about this. I met a gentleman in London in 2005 for the first time, who his hedge fund at that time, I believe, was less than $1 billion under management. Still a significant amount of money, had tremendous amount of success. And right now today, his hedge fund is about 30 billion. Now, if somebody does the typical hedge fund fee structure thing, and you say 2 and 20 over 30 billion, and let's say he makes 12 to 15, 20% a year, you can't sit back in your house and imagine that, okay? You can imagine, I think, making your first million. You can work and imagine that. But some of this stuff becomes, you can't control it. Bill Gates was at the right time, at the right place, wide awake to the opportunity, and he put an operating system on every IBM computer that was shipped. You can't wake up and say, I'm going to repeat the exact same success. You could be motivated, you can be inspired, but you've got to be grounded. I think you would probably agree with me on that.
Oh, yeah, on all points. It is interesting that people will make those kind of comparisons. My own line like that comes from Bruce Springsteen, that all he wanted to be able to do was to be able to make a living playing music. He was shocked at what happened in terms of his financial success. Who knew that somebody would have billions of dollars under management? But, that's the world we live in. But one doesn't start out that way. There's all of the learning curves that go on in there, whether it's finding opportunities or ways to execute, or the money, the risk management, the management of oneself, the management of increasing numbers of people, the management of increasing amounts of money, all these effects. People who find that fascinating, are the people that are more likely to succeed.
The trader that I was mentioning, which was David Harding out of London, if you go back and you do any homework and find out about his early process, he's very frank. He was at a task with a trader or a fund broker, I can't recall, and he talked about that he was spending all of his time with daily charts and looking at charts and drawing charts. And this went on for years. It was literally just this kind of particular process of looking at charts and being in love with the process. He could have never predicted the outcome. And he would say that. I mean, he could predict in his own mind that he would have tremendous success. And I'm sure that was a huge part of his success, is that eternal optimism. But he would have never said, when he was drawing all those charts and going through this process, that most people would probably, even today, most people would probably be like, I don't want to do that. I just want to start making money. Right?
Well, this goes to what I was saying earlier, as System 1 becomes System 2, and people are still focused on the results, whereas you can really tell that somebody's beginning to get trading when they focus on building better processes, as Mubazin in 2 books now has written about. That it's got to be on developing a better system, and you only develop a better system by having more distinctions. I'm using that word instead of just information, because it isn't just information, it's about differences in the world. And so you talk about Harding looking at all his charts and becoming deeply knowledgeable about the nature of price movements, so that later on, when he began to get ideas, he had some basis for doing so. It's building expertise. They say of expertise, there's a certain school that says it's merely pattern recognition. In other words, what you're doing is educating your System 1. Well, there's a lot to that. The idea that a master chess player can look at a board and realize they know the configuration and all the possible next moves for it. Very, very different from somebody who's sitting there, their first week, month, or year into chess. And you only get there by building experience. It's get out there and get experience. And this, by the way, going back to our harangue about school, is that schools very often now are more about the experience than they are about building the experience. Again, there are some lovely counterexamples to this, but if someone is pursuing some kind of higher level mastery in their life, I would put that into their thinking, that you want to be sure you can do something at the end of it and not just be able to talk about it.
See, I thought school today had become a sideshow for consuming large quantities of beer preparing for the reality show that you will soon star on. I thought that's what school was. School had become.
I never felt that lucky.
Well, I think we might be pretty close to that today. Well, listen, we've only got a little more time, and I want to kind of let's let this last kind of thought from you be where you are right now, and kind of let you check in, because I'm sure you have daily conversations. There's daily things that are interesting to you, but I don't know if there's anything that you might have in mind that as we leave out today that you might want to share, something that's near and dear to you, close to you, that's exciting to you, interesting to you right now. We've been talking about parts of your book and whatnot, but I don't know if there's anything just topical or something that's enchanting to Mr. Faulkner right now.
I just the other day saw a piece of research that pointed out that it's people who have an experience bias, that is, that they use their money to buy experiences, will tend to be better traders and happier people than people who have a materialistic bias, that is, they want to acquire things. I thought about that, and I thought, yeah, because getting things is a very early childhood kind of experience. It's where the things represent some sort of object, some sort of power or something. And you collect these things. But what it does is it makes you more thing-oriented. What difference does that make? Well, for example, if I was to say to you, name some different currencies, you mentioned the euro and the dollar and the yen and stuff like that. But then again, what about, is gold a currency? Bonds? Could bonds be a form of currency? What about emotional currency? Was reading, I believe it was Howard Marks was talking about that one had to take account not only of what it cost to be in a non-performing trade in terms of money, but also what it cost in terms of mind share, like mind share as a currency. To do that kind of flexible thinking, you won't do it if you think that things are just things. But if you go into the world of experience and you have more experiences, then your thinking's more fluid. So I thought it was interesting that this is all starting to come together or come out now. So for your readers would be, listeners would be to think about utilizing their capital, some of it anyway, to get them more experience in the world, because that will pay much huger dividends, both in the moment and in memories and in future abilities.
Let me add to that. That's a brilliant thought. I just love the way you phrase that, because I'm instantly scanning my own life and just looking at my own life and saying, what do I do with my money? And the vast majority of it is experiences. Right now I have a yoga instructor. I work with a trainer as well. And it's the experience. It's not, I'm not buying anything other than the experience. And if I was thinking to other people, if I think back about my own life and some of the experiences I purchased that were invaluable, get on a plane. And I know most of the world doesn't have to worry about this issue, but I think for Americans, it's like 70% don't have a passport. Please. It's
higher than that. 8% of Americans have passports.
8%. Okay, it's terrible. So listen. So as Charles gives this wisdom about using your money to buy an experience, okay, the first object you have to acquire is go buy the passport. Put yourself on a plane. I don't care what city it is, either go east or west. Just get there and get on the ground. Because if you have not done that, if you have not had a chance to end up in a city like Tokyo or Singapore or Lisbon, if you've not had a chance to set foot on the ground in a foreign location that you've never, you don't have that something that just hits you where you realize, and you don't get that with an object. You get that with an experience.
Well said, Michael.
You inspired me. You inspired me. So now for episode 117. Hey, Charles, how you doing?
I'm good. How about yourself?
Well, I'm in Malaysia, and I'm trying to do all this technology wizardry from 8,000 or so miles away.
Don't they build all that stuff over there anyway?
Yeah, but you know what? The bandwidth thing is still an issue. We just don't have that figured out. After all these years, you would think we would have got good bandwidth. I don't necessarily know that it's a Malaysian issue. It's just overall.
Well, I think it's a human issue that we could speak to if we wanted. That as soon as people had more bandwidth, they went YouTube.
Right. So how you doing? What's going on? I should tell the audience that, gosh, I think the first time we met was in 2001. That would be, if my math is correctly, that's more than a few years ago.
Yes.
Wow. Time flies.
Whether we're having fun or not, that's what some people forget sometimes. That relentless sculptor time continues to move on.
Yeah. Well, I'm trying to have fun. I don't know if I'm doing it yet. I'm at least I'm in the mix. The mix of something. I'm not sure what it is, but I'm out there mixing it.
You've certainly leaned opportunities in your direction by doing so.
But Charles, right now, I'm really curious to your opinion. So you're a man who's got a keen sense of the human psyche, investor psychology, decision making, analyzing people, looking at people, watching behavior. And before we jump into your new title that's coming out, your new book, and perhaps it's going to lead to this, how are you feeling about just human behavior today, decision making? Are you seeing anything today that is different than you've seen throughout your whole career? Or is it still just the subject of the human mind, the human being? Is it still the same stuff?
The question itself is misleading, and I don't mean you should not respond to an interviewer that way. But it's that curious effect that in human beings, we are, in a sense, changing the world by not only how we think about it. I'm not somebody that believes you create your own reality, at least not completely, but also the way we act in that world, what we do in that world. And what I was thinking about when we started this call, and you asked me this question, was that a couple things are clearly evident. And one is that the world is getting more complex. There are more people, more interconnectivity, things moving faster, more items, and all of that in number has changed, if you will, the ecosystem to where things that used to be more causal have now slipped into more feedback-oriented systems and have become less understandable to the mental mental hardware and software that we have inherited. For example, simple example would be that if you advertise some musical band for their off-color lyrics or their terrible attitude or something, to warn people against them, of course, this creates more sales. That is, that things begin having the opposite of the intended effect would be an example of that, although it doesn't have to be opposite. That kind of thing is happening a lot more. Another thing I've noticed and wondered about is that with all these new devices and with so much information, things are becoming, if you will, more opaque instead of transparent. There's a lot more of the world that's very complicated and completely up and running that we don't know about it. And in the area of trading and so forth, mention things like black pools or what was going on with JP Morgan and their whale trade and things like that. Whole worlds are operating that people aren't aware of. And the way the human psyche responds to that, responds to the invisible and the opaque and the complex, is with magical thinking. And so what I see is that there's actually less critical thinking going on about what's going on, at least in my opinion, than when the world was so-called simpler. Although in one sense it was never simpler, but the human systems of trading or the human systems of commerce were simpler. And now that they're actually more complicated, people can and do have crazier ideas about them.
Well, I have to say, for a pretty bad question, I got a pretty good answer at least. I felt like I was a freshman in college and I raised the hand and the professor just is like, it was like something from Roger Waters in The Wall. Covel, sit down.
Well, not that it was a bad question, but here's the thing. Implicit in your question was the idea, well, is it the same thing that it's always been? And the thing is, well, yes, it is, except that the same thing changes in its relationship to the world as the world changes and as the same thing changes. So, yes, it's the same thing in the markets when there's irrational exuberance as there is when there's utter panic, except, of course, they're entirely different and are motivated by different aspects of our psyche. But fundamentally, yes, it's because it involves us.
No, I had no ego about that at all. I enjoy the whole process of this. You know this.
Yeah, I do.
I like being transparent too. But let me ask though. So I know, because we've been talking about you writing this book for a while, and you know you've got deadlines now, and I know this process. I know what you're going through, but I'm almost hearing it in your voice a little bit right now too. I imagine the excitement of pen to paper and constructing how you want to put this all down is starting to be quite exciting right now. Why don't you let the audience know how you even came to say, hey, I'm ready to do this work. I'm ready to put pen to paper. I'm ready to lay this all out. How did that process even start?
The truth is, as well as I can tell it, and you'll understand more about that preface later, is I wasn't ready. I had noticed some things in the marketplace, and you and I had talked about them, and you kindly introduced me to one of your editors. He and I discussed I had 3 ideas, and of course they and a possible agent liked the one that was least developed. And so I went back and started working on that and thinking more about that, and with horror realized how unprepared I was, but also realized that I could become prepared. I could wrap my head around these ideas and dove into it. That quality, if I were speaking to your listeners, is that's one of the things that distinguishes the so-called market wizards. It isn't that they already know it, and it isn't that they're even sure that they can know it, but they're sure they can find out. And they're sure that they can do the work. Of that, they're sure about themselves, rather than they're sure they're winners, or rather than they're sure they've got the Midas touch or whatever. To quote Tom Baldwin's line, is everybody wants the money, but who's willing to do the work? And of course, you know about diving in and doing the work.
That is the trick. And I posted something on Facebook a little while, basically said the same thing, which is, are you going to come up with excuses and rationalize why you can't get past the fear, or are you just going to jump?
And I think part of that is also to be informed. So you have the professional athlete, especially the extreme athletes, they aren't just jumping. They're jumping with the knowledge behind them, if you will, that they have prepared themselves. They have done all the work. They have, whether it's learning to do a new trick or learning a new move or ultimately performing in an official game, they have been doing the work all along to be there. And so all that preparation, it's not one insight into, and this goes again to the magical thinking idea. It isn't, I have a secret that will carry me through in my trading in or investing, but rather that it's all the efforts that I've been doing are preparing me for doing this.
Yeah, I should clarify that jumping aspect. I'll give you an example for me. I started doing yoga about a year ago. And so here I now in my early 40s, and I'm doing handstands for the first time in my life. And I mean, at some point in time, there was that kind of, yes, you go through the preparation motions, and yes, you're building up your shoulder strength. But then there's a moment in time where it's like, you got to kick up and you got to do something, and you might fall, but you got to get back up. But there's that moment in time. There's a lot of process that you have to get built up to before you kick up for the first time. But when you kick up, you're still jumping, there is a point in time when you do that first thing, even the extreme guys, you're still jumping.
Oh, yeah. But it's like, is it an informed jumping? Is it a supported jumping? Or is it, and this is something I've been looking at and wondering about how, for example, the trading, the financial industry encourages people to think it's so simple. For example, in one ad, a baby could do it, right? And they're very cute ads. But, the suggestion being that, and then the babies, they're trading, and buying this and doing that. It also gives a sense of activity. The idea then, you see the ads on the pages with the, get, so much money to play with, plus this many free trades for the next month or 3 months or whatever it is. And these encourage jumping because it is a leap for people to go into something new. It's a false sense of preparation, in the sense that the kinds of behaviors that system is encouraging, like just jump in, a baby could do this, do not reflect the actual world into which one is jumping. That is that I'm guessing you've had a yoga instructor or two, and you've had lessons, and you have seen this done, the headstand, for example, and other things. And so when you went to do it, it was, yes, you were doing something new you hadn't done before. On the other hand, you'd seen people actually do it, not the rumor of people doing it. You'd prepared your muscle groups under some kind of a supervision or at least occasional check-in to do it. And then you had done it.
Yeah, that's 100% correct. Yes.
And I'm encouraging that kind of thinking for traders and investors and there's yet another book out in addition to the Indomitable Trader. There's Pound Foolish and other ones that show that the industry by and large either isn't interested in that because that's not a real revenue stream for them, or actually doesn't want the trader or investor to do that because that also isn't useful in terms of a revenue stream for them. And I know that's damning about the industry, but this is becoming pretty well known, is that work such as yours, and yes, I do give a shout out to it, work in your website and your work of actually getting people at least some of the skills, if not most of the skills they need to do and have mastered to learn to take a proper jump is sorely lacking out there.
You know, you bring up the industry as a whole, and I'll give a little piece of feedback, and I've said this in a couple other podcasts, but you know, traveling around Asia, and I've been speaking on behalf of a brokerage firm, not on behalf of them, but they've been introducing me to clients. I can say whatever I want to say, but most of their clients I've been speaking to are fundamental value-based guys who have restrictions that primarily keep them long only, no leverage, and country-specific assets or securities in their home country. I'm starting to see more and more that, I mean, the fee business is a great business if you can get trillions of dollars of assets and you don't really have to do much. There's not a real incentive for change.
No, and we don't need any kind of evil vampire squid metaphors to explain this. Is that people are self-interested. People want to develop what's good for them, and they notice that our society likes experts.
Well, unfortunately, we had some technical difficulties there. And by the magic of editing, our first part of the interview with Charles was while I was in Kuala Lumpur, Malaysia. I am now in Ho Chi Minh City in Vietnam, and our conversation continues. So listen, you know, we ended this conversation last time, Charles. We were just starting to get into a conversation about the motivations and the thinking behind a new book that you have coming out. And we'll talk more about it in the fall when it comes out. But you've got a new title coming out called Higher Level Trading, the 5 Stages to Trader and Investor Mastery. I know it's your first official trading book per se, but maybe you could let the audience know some of what went into your thinking, how this project has even come to be.
Yeah, I was graciously introduced to your editor by yourself, and he said, well, what do you got? And I started out with an idea concerning personal development. And he went, yeah, pass on that. And I went, well, I have a idea in terms of explaining behavioral finance, behavioral economics, which of course are a number of popular and both well-written and well-received books by professors in that field. And he went, yeah, there's enough of those. And then I said, well, the thing is, if you roll those together, you end up in this position where actually it's that people have to develop through stages of thinking and interacting both with their personal lives and in their trading lives, that it makes sense of why most people don't make it. Most people don't get to become anybody that anybody's heard about because it's work. And it takes a certain kind of effort and a certain kind of development. And he went, well, I'm interested in that one. And I went, well, that one I'm still thinking about. I went ahead and continued to think about it and put my notes and research and contacts and all that together to make sense of what is the developmental path that succeeds.
Well, let me ask you, because you were a little generic there, and there's a book that I love from many years ago by a woman named Brenda Ullin, and she wrote it, I think, in the early 20th century, and it was called If You Want to Write. And the way she wrote it, you could basically remove the word writing and insert anything that you might want to do, and it would work. So I'm curious, if you were a little generic there at the beginning, does this title, well, I know it's specifically aimed at investing, trading, does it have a crossover appeal for any type of success somebody might want to pursue?
I think it does. In my own thinking, that this is a specific application of what I know at this point. I'm not the only person that might know something, but I think I may have found out a few things. And so I'm putting that forth.
Well, I'm not going to let you get away with being that short and sweet. That's not going to work. Well, listen, so you've been, for the audience that might have not known or had forgot, you were in the book, The New Market Wizards, and Jack Schwager profiled you. So, and that was a while ago. So you've had a chance to really observe and be around a lot of very bright and successful traders over the years. So what now beyond, I mean, look, I can take credit for an introduction to Jim Boyd, but that's about it because I know nothing of the content. I haven't seen the book. So get into some of the more, what was really spurring you? I mean, this is something different. I mean, you know full well when you start to put pen to paper and you're saying, hey, I'm going to put 80,000 words out in a book, it becomes a whole different beast.
It is a different beast. It shouldn't surprise. This is what I was just writing to a colleague who lives in Paris yesterday. And it shouldn't surprise people that it's complicated because life is complicated. Yet it's deeply in our nature that we want things to be simple. This fulcrum, if you will, this kind of, walking that line, that tightrope, if you will, is very curious because our minds want to think, it's really easy to become a trader. I read Michael's book on trend following and I just follow it, and in fact, if they could, it would work. And yet, as some more famous comic than myself would say, and then life intercedes, then life comes into it. And the life part of it is also well known in trading, but people act like it isn't, which is that how to make money and things to do that work are pretty straightforward. I mean, depending on the time frame, depending on your capital, depending on your goals, yes, they're quite different, but they're pretty straightforward. But what is it people don't do? They don't follow them. And so, okay, well, they don't follow them. So what? Well, how is it that people are so dedicated to whatever it is and then they don't follow it? They don't do it. And this, of course, has created entire fields, the most recent of which is called behavioral economics, which is giving us example after example after example of how we're not rational decision makers. We're not thoughtful, careful individuals, that we like to think whatever we do is best, that we like to think that we're better drivers and better lovers and better decision makers than anybody else. And, that if we get an idea or insight, it must be true and all this. What's going on here? And how is it, though, that there are people who actually do they do it? The conclusion I came to is a conclusion that's emerging in neurosciences and developmental sciences and so forth. Not that surprising, but so hard for us to absorb, which is that there are people thinking on different levels. That it's not a difference of how much information, it's a qualitative difference in terms of how people are envisioning and thinking about what they're doing. And like any form of expertise, any form of achievement, it takes time to develop it. As I say, it's so odd that on the one hand, it's so obvious and simple, yet it's so hard for people to take it on board. As I said, I was joking with my colleague that, we're not surprised that, that it's tough to become an honor student or an athlete, a world-class athlete, or even an exotic dancer. I mean, every one of these things takes efforts. And yet when you get to this straight...
We might have to explore that exotic dancing part again. Continue.
It takes a certain natural gift, gifts, if you will. It takes, a certain kind of mindset. And then it takes dedication. And I'm joking, but I'm not joking, because all sorts of things in life take that. And yet, because of our brains, because of our society, because of our need to be right, we somehow didn't think that trading and investing would take that. And of course it does. And it's like there is a path. It is hard work. And it is something that can, at least in its workman fashion, be achieved by many people. But not if you continue to think of it as this kind of magical, well, I met a guy, or I had a flash in the middle of the night, or, all the other things that people do instead of doing the work.
As you bring this idea up of the qualitative differences, and I'll give you an example that you can run with and play with. And so I caught on Ed Sekota's Trading Tribe recently. He made a comment about day trading, and he said that traders use it medicinally as distraction from deeper issues. And I took that statement and I put it into a podcast, and I simply made the challenge. I said, the root of my books, the only reason I've had any success is I was lucky enough to see all these insane track records going back decades, all audited and on file with the CFTC for all these trend following traders. And that was the foundation for my work. If I didn't have those, then it's just my opinion. And so I took the idea of where are the day trading track records? I know we can always find one or two guys here or there, whatever. And so I thought about Ed's comment, and to take it a step further, what I was really thinking about was the feedback that I got. I mean, you would have thought that I had just, injured somebody. And instead of even being direct about it or confronting the idea of no track record or confronting what Ed said about using it as a distraction, they would say well, your interview style's not very good. You're not very prepared. All these other things. And they just didn't like the idea that somebody was making them think about something and really challenging them on it. Once again, starting with Ed's comment, and they just want to fight on that. And all I was saying was, hey, hold on, just do yourself a favor and just find the proof before you latch onto it and assume it's something you can do.
Well, and this, again, the behavioral finance people and researchers in human cognition, they've begun to discover this. There's an effect that goes like this, is the less you know about something, the more convinced you're right about what you know.
That's a great statement. Say it again. That was great.
The less you know about something, because it allows your brain to make really clear and vivid pictures, the more convinced, because of those clear, vivid pictures seeming true, the more you think it's true. So,
I love that.
It's a deep fallacy in human thinking to begin with, that we like simple things, which of course turn out not to be true because life is messy. I mean, to put it in the simplest of terms.
The less you know, the more dangerous you are.
Yeah, there's a corollary to that. It's not quite the less you know, the more dangerous you are. No, if you know a little bit, then you're tremendously dangerous because you think you know something. So the research is in, and people who want to look it up can find it, that traders, investors who have researched a little bit into the markets, who actually are somewhat self-educated, and I mean, have taken it seriously and done, read a few books and websites and been diligent, but are only a little bit or partway there, they become convinced that they know something, and then they're even more dangerous to themselves.
I'll add that as an interesting example of my conversation with Jerry Parker the other day, who was one of Richard Dennis's Turtle students, who's had a fantastic hedge fund career. And he led off the beginning of the conversation by saying that he is trend following plus nothing. So it was just the brilliance there is that he knows exactly what he knows, and he knows it well. And he sticks to his guns, and he doesn't try to be something that he's not. Yeah,
and that's a wonderful example, because that's really hard for us to do. I mean, as I was saying earlier, and again, anyone can easily find the research on this about how we're optimistic. We think we're better drivers, and we're better lovers, and we're better investors, and all this and the other. In terms of evolution as a species, that makes perfect sense. It does. Everyone thinks it's gonna happen for them. So of course they do something instead of nothing, which is, motivating and action oriented. And then the ones who do badly, are culled from the herd. And the ones who succeeded, whether they succeeded by luck or skill, are left. So it is, over time, it's a strategy that works for the species. But on the individual level, it's delusional. on the species level, it's survival oriented. And it was you years ago. He got me an introduction to our friend in New York, Larry Height, who said if you could take the shoulda, coulda, and woulda out of your thinking, you'd actually see something other people don't, and you would have an advantage. Well, all of this neuroscience research into human biases and heuristics, as they're technically known, it's all about that. It's all about the coulda, shoulda, woulda, and all of that is like the very rose-colored glasses that influence our decision-making. And for the few people that can, take them off. And what my work is about is to say it's not biological, although I think people can get a head start. I mean, there are biological differences. We know, people who taller athletes more likely to go into basketball, or wide guys going into football and so forth. There's a starting advantage, if you will. There, Ed Sakota, Larry Height, so forth. They may have had some sort of mental makeup that allowed them to think a little more in that direction. But when you get beyond that, a lot of it is you got to do the work. And that the work is not so much learning another trading system. It's not so much, trying to find the secret sauce or something, or being able to do Fourier equations. The work is being able to question your own assumptions. The work is being able to move beyond the conventional thinking that's all around you. And it is work.
Finding out a way to think. I've learned that from you. I've seen that from Ed, and it's observing how someone puts words together, observing how somebody constructs sentences, and then you realize, wow, they do that a little bit better than I do. And why are they doing it that way? And what can I learn from that? And then seeing, why do they put the sentence together like that? Oh, I see what they're doing. And I think it's that curious nature one has to have.
Well, that's what I say, that there can be some biological advantage to someone who's more innately curious than the other guy. But that's just the starting line. After that, how do you apply that? And do you understand that it's never done? That, you keep going and developing and developing. And this is where, this is their books, the latest one by Robert Greene last year called Mastery, a very nice title, where you find that it is just in our nature. It is so easy to get at one trick, and go, okay, I know how to use auto-tune, so I don't need to sing or develop myself anymore. I'm done with that. Or I found this one thing in the market, so I'm going to run with that. In contrast to somebody goes, okay, I found that one thing. What else? And what else? And here's your Parker you were just talking about. And in the face of all that, if you do all the what else's and you find out that the one thing is the thing that still you, okay, I'll do that. It's seeing, as Larry Height was saying, it's seeing things as they are. And in fact, that is one of the toughest things for us humans to do.
Hey, by the way, I had Robert Greene on my podcast last year for that book.
Very cool. And I recommend people go and listen to it because
he's a good guy.
The guy takes the time to know his stuff.
Yeah. So I got an example for you. Let me kind of piece this together. And I want your analysis where somebody that thinks like this, where they are in the stage, and I want you to maybe describe it. I often have people write me and they're all worried about their initial trading signal. And they'll say, well, the breakout happened in January and the market's still going up today. What do I do? Do I wait for a retracement? So that's a kind of common refrain. And to kind of an adjunct to that, the other night, I ended up, don't ask how exactly, but I ended up at a room full of would-be Vietnamese entrepreneurs, like 50, 60 folks, and having a 3-hour conversation, kind of leading it. And at the end, I had been using some notes from Seth Godin on one thing. And Seth Godin always has this issue of like, look, you're never going to have the perfect product. You just have to ship at some point in time, because when you ship, you will get feedback, you will fail, you will learn, you will improve. And this guy stood up and he said, well, I can't just ship. It's got to be perfect. What if it's not perfect? And I said, well, gosh, how many versions of the iPhone has there been? What did the first Macintosh look like? And so I connect that with the idea of missing the breakout and waiting and waiting while the market goes straight up. So if you hear that description of the person that's looking for the perfection, what do you think when you hear that description?
I think of somebody who's trying to predict the future. And this is part of my work, what I've been involved in these last couple of years. I'm going to back up a moment and go sideways, but it'll make sense. There is a movement afoot in physics, which has been motivated by biology, to stop trying to make the model so elegant. Because there's been this idea that it underlines all of physics, which is that an elegant model, a beautiful model, will be more the true model. When they finally, due to all of the variation in biology, if you know the stories, and Darwin, he and his fellows had figured out there were like 40,000 kinds of beetles, and their remark was, well, God must have loved beetles. He'd made so many different kinds of them. There was only a few kinds of humans, but there were lots of kinds of beetles. And that goes back to that seeing things as they are. To see things as they are is to give up this really beautiful and pristine and wonderful image in the mind of how things might be, and that perfection that people put in the future, that perfection is a natural tendency in our brain, and yet it can be, as you were just noting with the entrepreneurs where you were, it can be, the stone that stumbles you completely, that people go, well, I'm waiting for that perfection. Whereas the world is full of variation. Our brains can't take that in, so we look and we see a beetle and we go, oh, it's a beetle. And I'm using that as a dumb example, but you could also look, it's a breakout. You could use an example like it's a momentum trade. Use an example like, it's a commodity trade, whatever. People use those same kinds of categories to perfect in their mind what they think is true about the world, but it's not the world. Meanwhile, the world goes on.
Yeah, I was thinking about Stephen Jay Gould's book, Full House, and the whole idea of variation. And there's just so much variation out there that if you allow yourself to get caught up in it, you might not ever get anything accomplished. I mean, you really just have to imagine it. It's just one crazy, chaotic stew of, as I said in Vietnam, I just had a huge dish of pho tonight, and that's all it is. That's the world, is one big dish of pho.
So you go back to your trader. Well, what's the guy to do? And here's where I do have a solution, is that people think the solution is, let's start where they go. People typically think, well, if I get more information, or if I find the perfect system, or something like that, that will resolve, it will solve, it'll dissolve my problem. And while it's contrary to their thinking, their experience in the meantime is getting more examples and more variation and being able to get a larger sense of what's going on. And that's where to put the effort. We talked about this the last time we had a conversation about the fellow who was looking at the price charts for years and years as a young trader. Not that he was trying to find the perfect trade, but he may have been trying to find the perfect trade. But that practice of seeing the same or other kinds of behavior in the markets over years and years and many, many, many kinds of markets built up, if you will, a database, a foundation, like having seen tens of thousands of chess games where he could then be able to see patterns that other people couldn't see. And that's where I can say there is no substitute for experience. And people don't want to hear that. They want a technique. They want a quick leg up. I talk about this in my book. They want to know a guy who's going to give them the secret sauce, And the thing is, even if the guy has the secret sauce, it's not yours. You don't have the experience yet to actually know what that is and how it applies and when it doesn't apply and so forth. And that comes from being deeply involved with what it is you want to be involved with, in this case, trading.
Yeah, I was just smiling to myself when you said the guy. I was thinking of it was almost a description straight out of every Scorsese film. There's always the guy, and he's usually played by De Niro. But how did you, getting back to the book, so if we were to lay the foundation, and we're going to talk again in the fall when it comes out, and I won't quote, give away the secret sauce just yet. But if we lay the foundation, was there a moment? Is there something that crystallized for you that was kind of the launch of this title, this particular book, or was it just a combination of many, many factors that you've been looking at in research over the years? Because I could think back with some of my books, there was something that crystallized. It was almost like one thing. I almost could imagine each book came from one experience, and then it just all branched from there. Did you have something similar happen in your world?
No. It emerged out of watching and listening and being around people, being around different traders, being around actual market wizards, that it just became over time, not immediately, over time, more and more obvious that these people were not living in the same world as me. That was my initial thinking. But I went, well, but of course they're living in the same world I am. Well, they're not seeing it the same way. Well, that's not getting at it either. And by step, I got to the point where I began to think they're conceiving of it differently. To put it in a vernacular metaphor, they're slicing and dicing it differently than me. And it feels natural to them what they're doing, and it feels natural to me what I'm doing. And we can have kind of a conversation when we talk, but they're in a different world than me. And when that idea began to sink in is when this idea of these levels began to become not just a conceptualization, but real for me. And I went, okay, well, what are the ways people do this? And of course, I started out with the idea, well, everybody's different. Everybody's got their own take on things, which is true. Yet it also, after a while, began to emerge that there were, in fact, very detectable levels, if you will, conceptualizations widely held. And I'm not saying any of the things people immediately go, well, I want to be the top one. I spent an evening at the top of the Hancock building with some of the winners of a trading game, or if you will, contest that happens each year. And the winners all came to Chicago, and we were around a table, and, the bright lights of the city in one direction and the Great Lake in the other. And they were all going, okay, what level am I? And I began to explain the levels. And someone, I'm a level 3. Well, how can I be successful when there are 5 levels and I'm just a 3? And I'm a 4, and they joust each other, But what came out of it was, how well can you utilize what you know? This is where your work is a huge example, is trend following. And excuse me for saying this about a number of very thoughtful and important books. Trend following is pretty straightforward.
It's extremely straightforward.
But the actual doing of it, and again, this is what I started out with, that slippage between, okay, here's something very straightforward to do that'll make you money. Now, can you get yourself to do it? Not so straightforward.
Well, what's funny, though, when you say it's straightforward, I think conceptually, if you read some of the titles I put out and you look at the words in print, it's very straightforward and objective. I think the hard part, though, that I've seen over the years is for people to imagine that they are going to trade off the movement of the price of the market, and that's it alone. One of the things that I've been doing in Asia is I've had a chance to make, 23 presentations across Japan, Hong Kong, Singapore, and Malaysia, in front of sovereign wealth funds, hedge fund managers, mutual fund managers, the vast majority of which are value guys, all the nice education from the Ivies and all that stuff. They just listen and they hear this idea of following price movement and this momentum thinking, and these are the bright guys. These are the ones with all the experience, and they just don't wrap their arms around it. So I agree with you. Conceptually, it's very easy. But for a lot of people, there's this huge blind spot with using price as a decision-making cue.
Well, and this goes to the point of my work. And this is something, again, you were asking me earlier, did it come to me in a flash? If there was a flash much earlier in life, my flash was, how do people know what to want? That might seem really obvious because people go, well, I know what I want. I'm going, no, not what you want. How do you know to want that? And out of that came a whole body of work that people can still find that I did. on metaphor. That is, if you think life is a game, then you want to be a winner, not a loser. You'll work on your strategy and so forth. If you think life is a journey, you'll be sure you've got the right equipment, and you'll have maps and how to get there. And if you think, life is a book, what chapter are we on and so forth, where the research has caught up with, not my insight, but the people I drew on, is that these turn out to be much more real than people thought. Now, what's an example for your listeners? Efficient market theory. That this idea, like life is a journey, or that like life is, that trading is a game, or whatever that is, that efficient market theory is that humans are rational decision makers. Again, a fiction like the other ideas, but a fiction that influenced what people pay attention to, what they value, what they notice, what they respond to, what they get advanced degrees in, and what they go out and do for a living. So you're talking to these sovereign wealth funds and these individuals, very bright people, I'm sure, in this different area. They are operating out of a mindset that is causing them to notice things about the world. The world is complex because they had to get an advanced degree to do this. The world is made up of these rational and irrational components. So they have to be able to quantify them in some way and qualify them and so forth. And these very elaborate ways of thinking develop, which feel true to the people, which go, well, I've spent years studying this. I have an advanced degree in this. And then you come in and say, what if you looked at it this way? And the way that you want to propose is certainly no more challenging than the ways they're already doing, except it isn't supported by all these other ideas and images and metaphors and so forth that they already have in place and they already can't not help but use. Now we're deep in the middle of my book and my work. Is a few people can notice that they've done that and then move on. This is what one author called the lattice theory when he was trying to figure out what Charlie Munger, Warren Buffett's junior partner, was doing. And Munger says, I have like 100 models, he calls them. He's like, I have 100 models. And the thing is to draw on the model that you need in the situation when you need it. Which is to say that Munger could step back from his thinking and go, okay, does this way of thinking about this work here or not? That's a big step. That's a step up. That's a higher level trading ability to be able to step back and go, okay, when would I use momentum? And when would I use trend following? And just that idea right there means that people could begin to evaluate different methodologies as ways of seeing the world, not as trading strategies. And if that sounds a little exotic, well, that's actually the mental world most people live in and don't realize. These are real until they're real until you develop enough to go, oh, wait, that's just a way of thinking. I could do it differently.
To give an example of the rarity of perhaps having this mental dexterity to adjust and be flexible. So I make all these presentations. Usually it was a large group in a room, maybe 3 or 4 people. So it was a lot of people over 23 presentations. And I did this in 8 days, wow. About 75 minutes for each presentation. But the very last presentation I did in Singapore was with a family office, basically one guy who happened to be an extremely wealthy, net worth somewhere close to $3 billion, Kiwi. They were the only people that wanted to have a follow-up conversation. Because when I was telling him, I was like, well, it's interesting. I've talked to all these value guys and they just don't know how they can do it. And he's like, well, we basically have one client here and we go for absolute returns. And so it was like they just wanted to hear, they heard something different. They saw some viability to it and they're like, oh, we can take this in. We can absorb this. We know what to do with new information that might help us to do well. They didn't worry about whether or not they had made their money in some other way. They were going to take this in and use it in some way. At least nice to have that one experience of getting through to perhaps the most successful person that I met in that whole 8-day event.
Yeah. And for your listeners, that's it's an outlier. Are you the outlier? And the chances are you're not. But here's the very interesting thing, and this is why I'm bothering to write the book, to do the work, to talk to you, and so forth. It is possible at every moment to become that outlier, because it's a change of thinking. It doesn't require $3 billion. It doesn't require, inside market information. If you can make the change of thinking from you are a certain kind of skillful person to you do a certain kind of skillful thing, for example, that's one way to think about the change. That you could add other skills to what you do. If you can make that shift, which many people can't find themselves able to do, you can become that outlier. You can become that person who now has an edge because you can see more of what's actually there than what you think coulda, woulda, shoulda been there.
It's some really powerful thinking. I wanted to add something. I want to see where you wanted to go with this too. You were talking about the idea of efficient markets, and I'm going to let you run with that a little bit more, because even people that maybe have heard that might need a better explanation. And I know you can give one to really explain the idea of efficient markets and inefficient markets. One example I want to give you that I saw the other day, I was watching a presentation. It was an interview with Vernon Smith, who won the Nobel Prize the same year that Kahneman won it for experimental economics. And so Smith, who was kind enough to appear in my film that you were kind enough to appear in as well. But Smith made the comment, he was talking about the housing bubble. He basically said, we learned this stuff in the laboratory years ago. And this is the reason he got his Nobel Prize. He goes, we, basically created these artificial markets in the laboratory with students, and we started putting these markets together. And all of a sudden, we didn't really expect it, but we started having bubbles would get created. They had no explanation for where they were coming from. They couldn't predict them, but they would just appear. And so the bottom line is that Vernon Smith really got his Nobel Prize for basically proving that all of this econ that had come about the efficient markets really just was inaccurate. And I'll let you run with that and maybe let you explain to the audience a little bit more about the idea of efficient versus inefficient.
Well, but this goes back to where sideways a while back, and I said I'm going to talk about physics a moment. Because there was a point in the development of physics where a really elegant theory, gravitation, just a few equations, electricity, Maxwell's 4 equations that explain electromagnetic theory. I mean, the brain is just like, oh my God, there it is, And as Einstein said, it's like, I want to know God's thoughts. And they assumed, it's a human tendency of this elegance, this being able to see deeply into the world. And at a certain level, if you will, at a certain resolution, with a certain kind of instrument, it all does have that orderliness to it. And with human beings, that orderliness in economics is about 30,000 feet, maybe 25,000 feet, which is to say, if you pull back and you see human beings not as individually motivated, that you want to go to one restaurant and your friend wants to go to another, and so forth. You pull back enough that you're like little dots moving around, and you go to restaurants and you go to clothing stores and you get on airplanes and you're in hotels, Skyping and so forth. Then at that point, you can begin to describe some kind of physics of human interaction. But of course, when you've pulled back that far that humans are just dots, you can't take in the individual into account. So you tell a story about it. And you go, well, each one is trying to maximize their utility, which is to say well-being, goodness, whatever. We could have used goodness, but they came with utility. And in that, you were able to see things in a way and derive some equations that, in fact, had this insight into masses of people. And that was if you will, the framework that resulted in the efficient market theory. And it does have insights, and it also has seductions. One of the big seductions is it is so orderly. It has numbers. It has equations, and you go, well, it must be true. And so our brain, as I remember I said earlier, who wants the simple story with the really clean lines, and the less you know, the more you believe it, also came into play with this story. You have Fama, who's famous, actually is one of the principal authors of efficient market theory, coming up with these elaborate explanations of why there are bubbles. It's entirely rational, of course, but it's explanations after the fact, or what we call in everyday life excuses.
Yeah, and the idea of predicting is just that's where the problem starts for so many people, and you discussed that in the beginning of this podcast.
Well, and the thing is, it's in our nature to want to predict. And again, taking this idea of, whether it's 5 feet or 25,000 feet, at 5 feet, we're trying to predict what's going to happen next. Is this person friendly? Am I going to eat today? And so on and so on. And we have a whole history as a species of predicting the next moment. And at that level, it works pretty well. Someone looks at you and smiles, you go, oh, they're friendly. They look at you with another look, you go, oh, I better back up. So we instantly, this is the system one idea, we instantly derive assumptions that obviously have worked because we're still here. In fact, we're the most successful species in history. Yay for our team. As one pulls back to 25,000 feet, the brain still is using those patterns. So now we have, whether it was in history like Hegel and philosophy, predicting the movements of history, or whether it's one of those Washington think tanks, which, tells you what Iran is definitely going to do next year and charges huge amounts of money to find out that secret. It's the same pattern.
Look at North Korea right now. I mean, I'm sitting over in Asia right now, just reading some of the international news, and it's like this kind of cherubic, dopey-looking kid basically has got the entire world transfixed as to whether or not he's going to launch a scud off into outer space that may or may not hit something. I mean, it's absolutely amazing how much everyone is trying to figure out whether or not he's going to send one missile off into Looney Tunes land.
Yes, exactly. And why is that? Again, this comes back to my work in the sense that it's not about thoughtful international analysis. It's not about careful military intelligence and spying on their technology. It's not about understanding the deep psychological motivations he might have. No, it's about the fact that humans are really distracted by vivid imagery. And the idea of this missile flying into the sky with a fire coming out of the other end and then landing somewhere with a tremendous boom, that image is so big and so compelling to people. As you say, it's one missile. Transfixes most of these brilliant brains, and you're right, there's hundreds of thousands of brilliant brains in the State Department and in the military and in private industry and so forth, are all transfixed on this very simple, vivid image that they can't get out of their head. And going back to the point of why you would ask me to speak with you is the person who can look at that and go, it's just one image, who can step back mentally and say, I am not my thought processes. I have certain thought processes. And this is not the only technique, but it's the one I'll emphasize today. Someone who can do that and begin to put out in their brain multiple scenarios, which, by the way, is almost the definition of being an advanced thinker, is you can, instead of like Kahneman, the Nobel Prize winner, along with Smith, who said that what you see is all there is. This is one of his insights he brings forth in his book, Thinking Fast and Slow. Most people, most of the time, is what they see in their mind is all they think there is, and they can't not respond to that. And the person who can hold 2 or 3 thoughts in their head, like you were just doing, this is a Looney Tunes situation. It's one missile. The U.S. could easily deal with it, as could most of the countries in the area, and so on and so on. Suddenly you've got room to think about things. And suddenly you're not the guy who dedicated years and years and years to being the value investor or the momentum investor or whatever. You go, okay, how does this work and when does it apply? Now you've got a chance.
I mean, let me take this missile example a little bit step further and let you run with it. So my thinking would be, if I was in this world, I'd say, okay, look, this is not a great situation, because let's say he can launch a missile that has a 2,500 kilometer range, and let's say he puts a nuke on top, and let's say he makes a miscalculation, and let's say it hits Tokyo. Nobody wants that to happen. However, you have to start to look at it from a standpoint of odds and say, what are the odds? And then you say, what's the response? And I think what's interesting about what's going on in the media, as opposed to reducing this to a discussion of odds, it's almost like the media is gearing this up where it's almost like a kind of a sadistic, like, let's watch the car accident. It's almost like people want something bad to happen because they're bored.
Well, in honor of the fact that we're in the middle of April, I'll say that it's been my back of the mind thought for some time that we're hoping that something disastrous will happen or the aliens will come so we don't have to file our income taxes. So here's the thing. If I was to put it in a word or a few words, is that in order to tie things together in our minds, to keep track of them, to do what we do as humans, outside of the moment when we're eating or drinking or doing something else, we tell stories. We tell stories to tie things together, and to do that, we use vivid imagery because we respond to that. Our news media is an expression of that. We'd like to think it's news and it's serious and it's helping us make decisions. No, its fundamental purpose is to appeal to the part of us that loves stories. Of course, the other part is they want to make profit. So they're going to tell the most vivid and the most emotionally exciting, even if it's fear, stories they possibly can. So as you and I've talked on other occasions, there's any number of very smart guys, the market wizards say, you got to unplug your television. You have to control the flow of information to yourself because those inputs do not exist to inform you. They exist to make a profit for themselves. Now, not a bad thing. I'm not against that, but I am saying, therefore, they are going to try and excite you and put up the most vivid stories they can, rather than the messy mishigas that is human life.
Here's a way, and this kind of builds on something you said earlier when you were talking about some of the market wizards and how they kind of operate on a different plane. And a lot of people are fond of always saying, well, that thing that Ed Seykota learned 30 years ago, that's not relevant today. Well, clearly they'd be mistaken, but I see the brilliance in someone like what Ed does is he says, okay, we've got all these sources of information flowing at us, right? So I can either be the guy that decides I'm going to try and take in more information each day. If I go to Drudge Report every day, if I go to Zero Hedge every day, if I have Bloomberg on in the background and CNBC on the background, if I get more and more and more and more and more stimulation, I will make better decisions. Or I would say somebody like Ed looked at it and said, let's operate at a higher plane here. The information flow is never going to stop. It's going to get more intense. Where is a better place to make decisions? And clearly somebody like Ed Seykota and Richard Dennis and the Turtles and other trend following traders, David Harding, they said less is more. Less information, and we can make better decisions and then ignore the distractions. And I was just thinking as you're talking, and the whole idea of how some of these guys operate at a different plane.
Well, yeah, that is, and there is where I didn't want to, and I didn't want to take up the idea that people operate on different levels. It's anti-democratic. It suggests certain things about, well, I know better than you. But in fact, I ultimately had to take out the woulda, coulda, shoulda, and say, this is what is that getting to the point where you ask this question, at least among traders, what do I need to know in order to make my trading decisions? Some people are listening going, well, I don't know what I need to know. And I go, exactly. These guys have gotten to a point where they've gone, okay, I know what I need to know to make the decision, and anything else is a distraction. So I'm actually going to reduce my inputs to the inputs I know make a difference, because I've taken the time to vet my inputs to find out which ones are important and which ones aren't. Well, there's the work. I mean, this is where where people say, well, Charles, there's a lot of words you're saying, what can I do? And I said, well, this is the thing. At each stage of the trading process, the people who get good at this, they do the work. Part of the work would be what inputs make a difference, what inputs don't. And they're going, well, how would I figure that out? Somebody says. I said, well, that's the first thing you need to figure out. In your trend following process, to give a real example, you point out, the only input is price, or price over time, if they want to get, fancy about it. Then how do I utilize that input and that input alone? And then how do I study that input to find out how that could be useful? Well, there's work there. And you're feeling free to restrict yourself. And in a sense, if you'll allow me the analogy, this is, like the athlete who, the basketball player who goes and does dribbles every day and does, shots every day. And you got to go do the practice to actually find that out. Now, in your case, you've done a lot of the legwork for people in the sense that you can show them all the data you've already gathered on this. Back before that happened, people like Ed had done the research and they were keeping it to themselves, about how this worked. And therein, I can say that your listeners are in a better position than traders, investors, speculators of even a generation ago, because a lot of the legwork's been done. But the really important thing to do still has to be done by every individual, him or herself, which is that you've got to be able to go in and get the experience and then be able to say, okay, this is one example. What would be another? What would be another? How do these compare? How do I evaluate them? What am I using to evaluate them? I know this sounds boring, but this is the going in and beginning to do that kind of sorting out of all of these opportunities instead of jumping from one trading system to another, or one guru to another, or one advisor to another, until your money's gone.
Yeah, but as you say this, Charles, and this is, it's going to come off as a compliment, but I think you're going to see where I'm going with this, is that when I have listened to you over the years, when I've listened to Ed Sakut over the years, or Richard Dennis, or a lot of other well thought out folks in these subjects, people might not understand that most of the words that come from certain types of people that think through things, they're not extraneous words. Meaning, if someone really sits back and kind of analyzes what you've said over the course of this podcast today, it wasn't extraneous stuff that you wanted to say because you liked the way your voice sounded. And I think that's a real interesting thing that's hard for sometimes for people to grasp, is what's important in what Charles Faulkner is saying, and what's important in what somebody else might be saying. Now, somebody can come back and they can say, okay, Covel, you're redundant. But that's different than being extraneous. You know what I mean?
I would go on to say, and you're redundant because most people can't hear it the first time, not because they don't have ears, but because of their preconceived notions, their ideas of how things should be or could be, and they don't get it. Like you said, you did all these presentations in Southeast Asia. I'm sure had some wonderful times as well. You had a few people went, let's talk a little more about this. Most of them went, yeah, and went on to the next thing. And this is the unfortunate fact in my work, is I've had to conclude that but again, and I'm interrupting myself here, very few people become professional athletes or chess masters or even exotic dancers. It's a lot of people drop out for whatever reason along the way. Your listeners would do well to, as much as they can, let go of their ideas of their own brilliance and the fact that they're better drivers and lovers and traders and all the rest, and get a sense of what it is they're willing to do. Because ultimately, I have good news, which is that if you're willing to acknowledge what level you're at and what efforts you're willing to make, you can probably find a strategy that'll work. Now, it may be at the lower levels, investing in passive index funds, distributed over a number of countries and so forth. And this is a well-known strategy. You can find it in, most, big brokerage houses' websites. And that may actually be the best thing for that person to do at that level. If you're willing to do the work to go on to learn to think for yourself and to develop your own strategies and to think them through and to find out, as I was talking earlier, sorting out all the different approaches and what works when and when it doesn't and so forth, then you may have a trader in you. And your work in trend following is definitely one they should look at. Not the only one, but definitely one they should look at. And a few, just like in professional athletes and chess masters and everything else, a few will have a natural gift and will take it forward and do something tremendous. And God bless. I mean, I will love to meet you someday. Most of us are somewhere in the middle. You know, we're not the tallest, we're not the most handsome, we're not the smartest, but we do have what it takes if we figure out what it is we really want to do and we're willing to do it.
So I have one last final question based on everything you've said today, and I'm sure the audience is out there, they're thinking the same thing that I'm thinking of. I think we're up to 3 times that you've mentioned exotic dancers in this conversation.
It provokes an image. I'm doing it on purpose. I'm showing that is how your brain works. You can't help doing this. Now, for some people, it might be dancer. For some people, it might be value. For some people, it might be momentum. For some people, it might be breakout. And the point is, those are all things with shiny, what do they call that stuff on the costumes, you know, the tinsel and the rest. And it's only one option. There are others. And to get beyond that in one's brain, to allow oneself to go, ooh, shiny, which, by the way, every mammal on the planet is attracted to shiny. Rats will take shiny stuff back to their nests. It's part of our biological makeup. And a few of us humans can go, ooh, shiny. Okay, now what's important? So thank you for the question.
Do you want to hear a PG related rejoinder on this subject?
Go ahead.
So I have an assistant named Michelle, who you met a few years ago in Chicago. Michelle is a sweet girl, and she is a goody two shoes, is the best way I can describe her. Married goody two shoes. So she knew that I liked this author, Seth Godin, and she heard about another book, and she picked up this book for me called Fascinate by a woman named Sally Hogshead, I believe. And so I start reading this book, in the very first, I think the first chapter was talking about rooms full of exotic dancers, and the girls that ended up making the most money were the women that were not taking birth control, and that was just a fascinating thought. And so I remember calling Michelle. I was like, Michelle, have you read this book? Do you realize what I've just learned in this book that you've given me? I've just learned that the most successful exotic dancers do not take birth control. And she's completely embarrassed. But it was fascinating.
That brings us back to where we started with this conversation. It brings actually back to my work. I mean, not to burst the bubble on exotic dancing, but that we are most influenced by parts of our environment that we are unaware of. This then proposes, well, oh my God, well, what does that mean? And it's like, well, first of all, people think of like CNBC maybe as part of the environment, or Barron's, or their broker calling, or something or other, or, you know, that there are all these environments that are influencing you, the listener here, in ways that you don't realize. And the people that I've met, the people that became market wizards, are people who at some point began to realize that was going on and began to manage it. He's not a trader, but he's a good example. A lot of people don't realize that, or don't remember that Warren Buffett went to Columbia University in New York City, and he worked for Benjamin Graham in New York City. So he was there, and he left because he found it was distracting in terms of what he really wanted to do. And I'd leave your listeners with that idea is sometimes it's not taking on more that makes a difference. It's being able to let go of something that, you know, it's New York, hey, it's a wonderful town. And if you can make it there, you can make it anywhere and all that. And he went, no, it's too distracting for what I want to do. I've figured out what I want to do, and here's how I need to rearrange my life. That's a leverage point, by the way. That's a higher level trading strategy, is you begin to organize your inputs because you realize that you will be distracted by things you're not even aware of if you don't take charge of them.
You thought it was over? It's just getting started. Here is episode 187. Where are you at?
I'm in Belgrade, and it's snowing. It's just started to be winter here, a little bit late this year.
Share with me, how have you meandered to Belgrade in late November?
Well, I've meandered here via Budapest, giving programs in this NLP work that I've done before, neurolinguistics, and how language affects our thinking and our behavior and our beliefs and attitudes. And then more specifically on money, how the metaphors and ideas and images of money in our mind affect our actions and our results in the world. And even more recently, how all of this then relates to decision making and how we're a lot less in control of our decision making than we think we are. And
well, hold on. Before I let you go, though, I can't let you, because I've not been to Belgrade yet. You have to tell me.
Yeah,
so when you come into a city like Belgrade and you experience it, you've been there before?
yes.
What are some of the first things that you feel when you come into this city that I've not yet experienced?
Well, you come in from the airport, and that in itself can be very interesting because it's how much nature or what is in or around that area. Where is it? Is it far away or is it close? As you know, in European cities, very often there's a lot of green around the airport, unlike in the United States, for example. And so you get a sense of are you in the countryside or what? And then at least in my case, I move into the city, and so then you begin to find out about what's their idea of suburbs. And unfortunately, in Belgrade's case, it's very post-Stalin, it's post-communist. And so there's these big blocks of buildings that are out and with very little around them in terms of trees or whatever. And so you get a sense of the starkness of people's lives. And then as you get closer into the center of the city, you look I look at architecture and stuff like that very often, at least in Belgrade more, the buildings are more Eastern European, where there's this like concrete facade on the outside, which it's not inviting. And there's a very sense of an outside and an inside. And this sometimes lets me know how it is that people are as well, because people respond to their environments and they create their environments, and these get mixed up with each other. And I find the people in Belgrade very warm and very inviting. And yet from the outside of their system, you wouldn't have guessed that at all.
Interesting. Well, I leave Asia in early December, and I will be taking a pit stop in Zurich for 4 days. So I'm looking. I've never been there. I'm looking forward to that brief experience.
Zurich, the airport is like it's in a park or something. Or you arrive in Zurich. I was there just a couple of days ago as I came through, and I've been to Zurich as well. And so you're out in this pastoral place, very nature oriented. I mean, you even count cows as the plane is coming in if you're so inclined. And then you go into the city, and as you're going in, is this high tech feeling emerges with all with the new buildings and the glass and so forth. And so it's its own incredible journey.
Very cool. I was thinking about your description of or comparison to maybe American airports, and I was thinking it's something in some instances, not all, but in some instances, maybe like JFK, it's like landing at a black ops site for your waterboarding.
Well, I wouldn't use that phrase.
I know, okay, that's a little over the ledge. So, listen, I want to get you warmed up, though, because we want to go right into what you've been working on. But I wanted to kind of lead in. We've kind of exchanged some emails about where we wanted to go today. But I wanted to lead in with something that's been in the news, and I thought it was a great way to start. Because if we're going to talk about money today, and we're going to talk about the confusions, the emotions, how people interpret it, how they use it, how they think about it, the emotions surrounding it. I look at the Nobel Prize that was just given out recently, and almost in a helter-skelter, schizophrenic way, they gave the prize out to two theories that seemingly don't even mesh. And I can only imagine, like, if you give one to Fama, you give one to Schiller, and you have the standard issue finance on one side, you have more the behavioral world that you and I relate more to on the other side with Schiller. I can only imagine how the average person must feel trying to walk into this subject of money when the famed Nobel Committee is seemingly schizophrenic about how they give out the awards.
That's a wonderful thing and a wonderful place to start, because it parallels, if you will, Dickens' novel, Mr. Dombey and Son. And at one point in the novel, the young son, Paul, who's 5 years old, turns to his father and says, "What is money?" And his father, who's a business person and wants to be a more successful business person, says, "What is money, Paul?" And his child's going, "Yes." Dickens tells us that Mr. Dombey in his mind thinks he wants to talk in terms of circulating medium, depreciation of currency, bullion, rates of exchange, value of precious metals, and so forth. And he looks down at his son and realizes that this is not probably going to be an appropriate way of answering. And so he turns to his gold and silver and copper, guineas, shillings, and halfpence. And then he goes on to tell his son that money can make you honored or feared and respected and courted and admired, and that money makes you powerful and glorious in the eyes of men. And then, to his amazement, Paul looks up at him and says, "Well, if money can do all that, how come money couldn't save his mother's life? Why is he himself such a weak and fragile child?" And he says, "Money isn't cruel, is it?" And I bring that up because there also is this, you call it schizophrenic, I would call it a duality, complementarity, as I've said in our previous discussions about System 2 and System 1, that System 2 is our logical and deliberative and thoughtful and conscious decision process.
Give an example of that, System 2, because you got System 1, System 2, and it pertains to money. I want to let you outline that for the audience, for those that might have not heard our prior conversation.
Okay. System 2, as I say, is conscious, thoughtful, and conscientious. We're told that money is objective. After all, it's got numbers on it, and we're adding and subtracting and multiplying, dividing it. And that's that conscious, abstract idea. That's System 2. When we think about things consciously and deliberately and step by step, then we're thinking in terms of System 2. Whereas the System 1, as this theory in behavioral finance, behavioral economics has come out, is that that's our unconscious, automatic, and wildly associative part of us. It's the part of us that lets us be able to read people's emotions when they smile or when they grimace or when they look confused or such. It's the part of us that lets us have an intuition, an idea. And we develop associations. To this part of us, money is very physical. To this part of us, money has many associations, many emotions. Now, here's the situation, is that our System 1 is both older in our came first in our species, is much older. It's what we call our gut feeling, when we go with our heart, all those ideas of utilizing our body to think, which even 2 decades ago was not considered how it's done, but now the science is in and we know we do it that way, and we do it all the time. Meanwhile, our System 2, this thoughtful, deliberate, conscious, putting things together, whether it's, the emergence of the Renaissance or whether it was the emergence of the industrial age or now with, iPhones and Androids and all the rest, this very successful part of us requires deliberate energy and attention and is easily exhausted. And what the research has found is that, and again, the most famous book in this is Daniel Kahneman's Thinking Fast and Slow, a wonderful place to start, and not the only one. There's popularizations, Malcolm Gladwell's Blink I've mentioned before. Different people have begun to get these ideas out there. These two processes are going on all the time, and we don't outgrow them. Rather, System 2 consciously suppresses System 1. That is, that our Roadrunner Wile E. Coyote physics is still running in the back of our head. And we consciously go, no, that's not how it works, and we have to think more Newtonian or whatever, but that's a conscious effort. In the same way, our earlier images, associations, idea, impulses, emotions about money, the ones that we got as a child, we grew up with, the ones that are in the background of our society, they're running all the time. And meanwhile, we're told that, of course, money is abstract and it's logical and it's objective. We can do that process. But again, that process can be overwhelmed by strong emotion, by stress, by being tired, by being intoxicated in some way, either with chemicals that come from the outside world or generated internally. And oh my, isn't that what happens when people are trading or investing? That they get emotional. And so what Kahneman notes in his book is that we often substitute the thinking of System 1 for System 2, and then afterwards tell ourselves how rational our decision was to get out of that stock when it went down, but now it's back up a bit again, but we didn't get back in. the idea that we can think objectively about money because it has numbers on it and because there's economic theories like Fama's is paradoxical to our actual situation, that we're making these so-called irrational, but I wouldn't say they're irrational. I'd say they're associative decisions about money that Schiller talks about and that Schiller has pointed out in his research.
That's a good point about associative versus irrational, because I think the quick and dirty way, even someone like myself, I'm sure I'm guilty of it, is to immediately say irrational, but there is a rational process going on with System 1. It might not be the best thing at all times, but it's rational deep in our fiber and deep in our gut.
Well, I wouldn't say I would give, the problem with rational, irrational is the same problem with conscious, unconscious. The very word gives precedence to the rational, gives precedence or more importance to the conscious. And it's like, no, there are two sets of processes. And the actual fact of the matter is the so-called unconscious process, or the automatic System 1 process, is running much, much more of our lives than the conscious and so-called rational. So I think to call them, as I said, associative in contrast to logical, for example, or automatic in contrast to conscious or deliberate, are better used, because then they draw people to notice what are the properties of it, rather than giving preference to one or the other.
So let me throw some color out there for a second and let you run with it. And this is going to be base level, really not even thinking about the markets or trading anything yet. But in my travels in the last year, I've seen a lot of different cities in one particular part of the world, Asia. This, however, is going to apply to everywhere. And you see what's going on is many malls that look identical. And in these malls, many empty shops. You have your Versace's, your Ferragamos, they go on and on and on. By and large, they're empty, but they stand like monuments, influencing the masses as they walk by every day to see, to maybe even feel, to think this is the highest thing you can shoot for. And it's really an amazing thing that's happening across society. I'm sure some people realize what's going on, but I'm thinking a lot of people don't. They don't know that even their unconscious mind are seeing these images of extreme wealth, of extreme materialism and consumerism. And I'm not saying those are necessarily bad things, but it's really interesting. These stores are empty and they're just pushing this message. And I think this is, in a roundabout way, right in the territory of where you're working.
I think so, and to give a historical perspective to it, as this didn't happen recently, this consumerism, or you want to call it, is that H.G. Wells, who more than generations ago, more 100 years ago, wrote, "Money means in 1,000 minds, 1,000 subtle, different, roughly similar systems of images, associations, suggestions, and impulses." And you make the very good point is that, well, how do those get in there? These images, associations, suggestions, impulses. Well, from our family we grow up with, but moreover now, since we grow up so much in public, so much in the media, those images, ideas, and impulses. So people who think they're thinking originally about money or about their life or about the choices they're making, if they step back in their mind's eye, that is to say, if they were to repress those for a moment and use their system they'd find out they're pretty much wanting what everybody else wants, because that's what's out there to want. And to become the contrarian investor, the independent thinker, the trader who discovers something new is, in fact, quite a challenge and takes deliberate effort.
So let me ask, I know you're in the middle of a research project, and I have a feeling in 2014 it will come to a completion. Where are the examples, the research? What are you coming across in your current process that are either light bulb moments for you, those aha moments, things that you think the audience might really resonate with, that's coming across your desk recently?
Well, I was going to say, just last night, there's a new paper out, and I'm in front of my computers. We're stalking, of course, and I could look up the paper, but basically it's called The Basic Bias. I believe it's called The Basic Bias. It's that they're discovering, much to the dismay and this way, again, the reason I brought H.G. Wells up is the idea that these things are being rediscovered and rediscovered. The neurosciences have found a way to think about it that it's staying in the brain this time. Kahneman, decades ago, had noticed that the smarter people were the more they fell for these so-called heuristics and biases. That is, the more they thought that these foibles and problems of decision making didn't apply to them. They applied to those other dumb people who were falling for it. And it turns out that the smarter you are, the more you fall for them. I spoke about this in a previous podcast where I was noting that if you know nothing about trading and investing, then you know nothing. And in a sense, you're better off than somebody who's read a few books, gone to a seminar or two, because then you think you know something. And you're even more dangerous if you're like in the middle of the process, because at that point you go, well, I got a handle on this, at which point you're no longer self-critical. You're no longer questioning what you're doing. You're going, well, I understand technical analysis, or I understand the amount to put on a position, or so forth and so on. And then that's when performance slippages you can really hurt yourself, so to speak.
There's an interesting example. I've not saying this in a critical way, and I've spoken fondly of his attitude and his trading acumen on my prior podcast. But there's a fund manager out of Ireland, I believe, named Hugh Hendry. He's a famous bear, and in the last couple days, he basically said, I've thrown in the towel. I'm no longer bearish. I was only staying bearish so I could feel the sense of being right when everything was going to crash. However, now that many equity markets seemingly are going parabolic, the momentum trend style is clearly working. I have to shift gears now. And it was a really interesting, I give him credit for putting it out there. I don't necessarily think it's great for a career, but for him to say to the audience, to his clients, I was trading with the hope that the markets would go down with your money just so I could be right.
Well, it shows a great deal of honesty and in that sense, self-disclosure. And I think that if you will, is the Fama and Schiller thing, going back to the Nobel Prize, is that they're beginning to have to do that. The fund guys, people are beginning to ask these questions. There's enough books out about this now going, well, which of the blind spots of trading and investing are you falling into? And, one way to regain credibility, to regain reputation, is to admit your mistakes and move on. To not admit them is to actually, people now are saying, oh, he really is caught in he's believing his own marketing,
Here's my other example that I saw this recently, and I just want your feedback. So I was in Singapore. I went to dinner with a group of Singaporean folks that all worked for this one company. And we got to talking about something called kiasu, which I was not familiar with. And essentially it means afraid to lose. It's an afraid to lose to others, and everything must be number one. So Singaporeans are famous for this kiasu. For example, they'll queue up overnight for condos. If there's going to be a big shopping fiesta at the mall, they'll wait all night. They just don't want to lose. They have to be number one. I guess if you're in the pure consumer world and you're looking to just buy something, I can't necessarily tell someone it's an incorrect way to think. However, I think if you were to take that kiasu type concept, this afraid to lose and must be number one to the markets, that could be terribly dangerous, especially in the research that you're working with right now when it comes to money.
Yeah, it's well known. And this goes to the idea that the attitudes and emotions, especially when one is in those emotions, they run the decision process. So when one is in system one, if you will, and emotional, and, I can't lose here, then you will be restricted to the decision processes you have in your automatic, unconscious system one. And if your trading strategy or approach, requires a longer time frame, requires more conscious or thoughtful application of a system, well, you'll tell yourself later that you did it, or you'll tell yourself why you didn't do it later, but you won't have done it. And in fact, this goes back to our friend Ed Sakota, and his thing was that the emotions that you're unwilling to feel are your trading system. And when you put the behavioral finance stuff together with Ed's thought there, you understand why. If the person is afraid of losing and can't go, okay, take your loss and go on to your next trade, then of course you stay in the position until it goes to zero, or you scramble in and out of it and you try to chase the market, and all the other behaviors we know so well come out.
The reason I partially bring that example up is to have a concept, this concept of Kiasu, K-I-A-S-U, to have this concept in a place like Singapore, which is capitalism on fire, which is success on fire. I think it's the highest percentage of millionaires per capita. I think they've passed Switzerland. And so to have, how does that reinforce when you have such a successful country, a successful population of people, and they have a concept like that built into the culture? In many ways, it just seems like such an incorrect way to think about things. However, they would say, well, hey, look at our success.
Well, that's right there. And now we're going more into the decision-making side of my work than the ideas about money. But to take up your question, you're looking for, or they're claiming, a cause or a primary cause. And that's a very conscious mind system 2 thing to do. What's the reason this is happening? Whereas in most of life experience, in most of decision-making, in most of the effects in the world, there are multiple causes and multiple effects. Is it the high degree of education that they have? Is it the homogeneity of their people? Is it the fact that they're building their technology infrastructure now? We know that as countries come later to the technology revolution, they actually have an advantage over countries that have older infrastructures. So right there, I just named 3, as well as this idea that maybe their fear of losing is getting them to save more or do other things or be more diligent or something like that. Now we have 4 possible sources of success. And in what way are equal amounts, and and in what way do they synergize and affect each other, and what are 5 and 6 and 7 and so forth? We do this as humans, and it's almost always retrospective. We look back and go, we became great because, but we're very often making it up. I love Talib Nassim's phrase, which is that the more we can explain the past, the more we can predict the future. Or rather, the more we think we can explain the past, the more we think we can predict the future.
So the reality is, if you really wanted to start to break something down, like this example that I bring with you, Kiasu could just be a slight concept to the overall culture. And that if we really broke down the success of this culture, the success of this country, as you said, it could be 5, 6, 7, 8, on to 20, 30, 40, 50 different ways. And I think it's your thought process that you're giving the audience right now to be introspective, to think, to look, to observe, to take notes, to be awake.
The idea, any model is a simplification of reality. And models, analogies, systems, whatever it is it's a way of trying to make sense of experience, because experience is complex and ambiguous and subject to, as they fancily say, stochastic processes, which is say randomness, and it's not determined in many cases what's going to happen. And our system 1 is very much see and respond, because up close and personal, both in time and space, it works really well to, how is Michael feeling this morning? I can hear you're interested and excited and, going into this podcast and so forth. We're really good at that. But as we get into bigger scale stuff like the Singapore economy, or as we get into longer timeframes like what's going to happen in the markets next year, we use this same near and dear process with less and less reliability. We do what we know how to do, and we don't often know where the limits of it are. And this is where, when you your own research into trend following, was to find that the simplicity of that approach, the kind of ease with which one can take a class of information, price in the case that you're studying it, and then, make a measured bet about the future. And people go, well, that's too simple because, I like a complicated model because the world is complicated. Well, that's a mistake of thinking. It's like, well, because the world is complicated, you need a complicated model. Maybe. But also to think that one thing will be the answer. Maybe,
We've got to find the fit.
I often get the question from people that are maybe new to my world, and I want your big meta view of this. So they'll come at me and they essentially want, I assume they've done a little bit of Googling, and I've assumed they kind of say, well, this guy Mike has got 5 books and a film on this subject. And they come at me and they ask one question and they want one answer, and they expect the answer to be 1 word long. And seemingly they will then have everything they need to know on this subject. Whereas I've always looked at any subject where it's like, you're not going to get there in a straight line. You're going to have to dig around the edges. You're going to have to fall down some. You're going to have to get wet. You're going to get dirty. It's not going to be necessarily logical or in a linear fashion. And I find it really amazing that there is a certain portion of the population that truly believes in I guess I almost want to call it the McDonald's way of thinking. Give me the fast food answer right now. 1 word, please. Thank you. That's all I want. And then they actually get mad if you don't give it to them.
Yes, I mean, that's well known. I was thinking of the H.L. Mencken quote, just again to show that this goes across generations. Those of you who don't know Mencken, he was one of the characters that was in the movie Quiz Show. When the fellow from the family that was Charles Dorn, and one of his friends was this great pundit and writer back in that period of time, early television. And if I'm going to misquote it, but it was basically, to any question or problem, there's a solution that's clear and easy to understand, and it's wrong. It's basically what the quote is. And this goes back again to the kind of work that I'm drawing on, which is that we now know that the less you know about something, the clearer the image, the more certain you are that it's real and true. So when they come to you and they want that 1 word answer, they want you to help make their pictures really clear so they can feel settled in their decision and feel they did the right thing, making the decision that they did. And of course, we know there are all sorts of different offers in the marketplace which will do that for you, picks all highs, picks all lows, our foolproof system, and so on, appealing to people's need for certainty.
That need for certainty, how extensive do you see that in the population?
Oh, it's basic to our biology, I think. I think that it's fundamental to our thinking processes. And in fact, part of the work I've got is that there's almost literally a 1-to-1 correspondence between the number of ideas you can hold in mind and how developed your mind is. And we start out with 1 picture in mind, and then if you can hold 2 pictures in mind, then you move to a different kind of thinking. If you hold 3 pictures in mind, you might even be able to build a strategy, for doing something in life. But that doesn't kick in till 12, 13 years old, and even after that, most people still go back to 1 picture.
And we were talking in email about this. So we're talking system 1. Anyway, I've taken you off on some tangents, but I always love taking you off on tangents. So on system 1, system 2. Do you have any other examples that you could lead people into? And what are you, as you dig into this research on 1 and 2, what kind of conclusions are you drawing? Where are you looking to ultimately take people in understanding 1 and 2?
Well, thank you for a really, really big question.
I love it. Of course, it's a big question. That's why they tune in, because they realize I get smart people like you on here, and then I ask really hard questions. That's the magic of it. And then I just sit back and hopefully try and be quiet.
The first part of it is, and going back to the Fama Schiller, is that it's not schizophrenic. Those are 2 ways of thinking about things. And both of them are profoundly useful. So whether they meant to or not, I think the Nobel Prize Committee did a really good thing. It's 2 pictures, right? Remember I said about 1 picture, 2 picture, 3, like 1 fish, 2 fish, 3 fish. So it's actually saying, look, there's both of these exist, both of these sets of ideas, efficient market theory and behavioral finance, to give them big abstract names. Both are ways in which human beings approach the world, or at least approach the financial aspects of the world. And they represent the expression of those. System 1, the behavioral finance, the automatic, emotional, intuitive, pattern recognizing skills. And the other side, the efficient market theory, the deliberate, thoughtful, abstract, step-by-step logical way of thinking, and that these are two aspects of us, and that one does not replace the other, and moreover, that the system one, is pervasive and running all the time, and that the system two we have takes effort. I know I'm repeating myself, but the thing is that...
But that was a critical distinction there, I think. The one's running all the time, and two takes effort.
Yes, absolutely. And as I say, it takes so much effort that very often people slip back into one and then after the fact will claim they did two, because we tend to associate ourselves with system two. We tend to associate ourselves with the conscious mind and not with all these unconscious automatic processes, which if you look at in people's lives are also their habits. So when people have a habit they don't like, they say, I can't stop myself, would be a phrase someone will use, is they have an automatic process going on already, which in that case they don't see as serving them. We have the Freudian idea of the unconscious as adversarial. It's this thing set apart from us that's somehow bad and not, or it needs to be controlled or whatever. And the point is, no, these are both processes that have different operating systems, to use a computer metaphor. And in my work, I'm pointing out you need to learn how each operating system works and work it accordingly.
Okay, let's give an example of working in it accordingly. And I can go in my world, but if you've got another one, run with it too. I'm thinking from a pure, let's say, a trading strategy standpoint. If one was to look at the markets and not really have a lot of experience, maybe they turn on CNBC, they get all excited, they hear a guy throws a buy signal out, they run to Schwab, they buy something. It's very emotional, it's very immediate, almost just wild and crazy in some ways. Where on the other hand, I think the trend traders have said to themselves, hold on, we need a way to kind of handcuff, so to speak, our system one personality and put some rigidity on our trading world, on our money-making world, and that gives us better odds of success as opposed to relying on one. System one, that is.
Mm-hmm.
Am I barking up the right tree?
Well, I would use another analogy to add to what you said, is that well, I don't know if they're still around, but there was called the 3000 Club years ago.
Yeah, I remember.
And then the 3000 Club, you couldn't be a member of it until you'd spent $3,000 on trading systems that didn't work, or rather on trading systems, and, and then you went, and then people would get thoughtful about it. And that was the idea of the 3000 Club, where people said, let's get thoughtful about this process. And this goes back to, we haven't talked much about money, but this goes back to the duality of money, if you will, or the paradoxical nature of money, is that it's objective and it's out in the world and there's these ideas about it and it's got numbers on it and all that. And so people feel like it's, real and objective. And then there's all the emotional attachments and all the ideas and images and impulses that come with it. Those are so mixed up that, yes, the person's watching TV, they get an idea, they run with it. These are things that, they wouldn't, I would hope they wouldn't do in their profession, that in other parts of their lives, whether they're, a mechanic or a manager or an MD, that they realize it takes time and energy and thoughtfulness and experience and consultation to develop an expertise. Yet in the trading and investing, famously, people are impulse buyers of stocks and bonds and commodities and ETFs and the rest. And that makes sense when you think about the emotions involved and the fact that money is this magical substance that can turn anything into anything else. And I've got quotes going back hundreds of years that are like the German one, is that money not only makes you more handsome, but you can sing better.
That reminds me of the old ads from the 50s about smoking, and they would literally put ads in the magazine that smoking would help your health.
Yeah. And so they thought, and so going back to, we've been spending time again here on system 1 and 2, is for people to embrace the idea they really do have this automatic system, and that it will run and it will run away with them, if they don't make decisions to do something about that. Then there's how do you educate system 1, but I don't want to get ahead of myself here.
Well, and this might be off on a tangent again, but as I listen to you and someone asked me about this the other day, but I think what's great about these long form podcasts is it allows the audience to listen to how someone thinks. In this case, you, Charles Faulkner. But if I think about it and I make the comparison to listening to you educate me and the audience right now, I can look over at this flat screen TV where I'm sitting and I could flip it on and there'd be some financial channel. I start to make the comparison. Well, here's Charles, very down to earth, explaining in long form, getting into detail. Or I can look at the TV and it's like there's a male model and a female model. Everything that comes out of their mouth is perfect. There's a set in a studio that looks like millions of dollars. There is stuff flashing across the screen that makes you feel like something important is happening right now. But then if they, to make the comparison, they come back, well, hold on. Charles is trying to get me to think. That's hard. Look at the flashy TV. That's good. It's true.
Well, we've been down this road before. It's like, Kramer's Mad Money show. It's got, noise and lights and excitement and emotion and answers, instant answers, and these all, of course, appeal to our creaturely nature, to our system one. And that's a good thing. We want to have that. People go to clubs for that. People go to concerts for that. There's all sorts of things people do to satisfy their senses. This is a wonderful thing to be able to do. Is that the appropriate strategy when it comes to their trading and investing? That's the question.
When we were communicating earlier, you mentioned something about thought experiments. I did not know where you were going, but I thought I should bring it up with you and let you run with it.
If we were to actually, enter into this idea of money, and we've really set it up now with a system one, system two, that economists have three definitions of money. And these are very abstract, objective system two ideas. That is that money is a medium of exchange. Money is a measure of value, and money is a store of value. These are the accepted ideas. They seem very, of course, it's very intellectual. Whereas in system one, the idea that something's a medium of exchange, that money, you can take money, you can exchange it for almost anything. And some people would claim you can exchange it for anything. Money can turn into any other thing. Money has this property of being able to become anything you want. First of all, what is that in our history? What is that? Well, that's magic, that you can turn something into something else. That's out of a fairy tale. And in terms of our thinking processes, the turning something into something else is metaphor. My love is a rose. The markets are a game. Things are looking up. It's time to take a plunge and jump back into the markets. All those are very metaphoric at their base. So in a sense, money is the most basic metaphor. Money is the most pervasive metaphor we have. And it's not a metaphor just in language. It's real. It's a child quickly figures out that you can take this paper or these coins or whatever and you can turn them into other objects, or you can take the objects and turn them into money, and back and forth and so forth. And if you think money isn't different than other things, here's the thought experiment, or the real experiment you go do, which is when you go to work next or somewhere, pull $10 out of your wallet and just give it to somebody. And say, here, have this. Not a family member, mind you, but somebody that you know them, they know you. Now, the thing is, if you bought that person a drink in a bar, if you picked up something or picked up lunch for them, there wouldn't be a second thought about it. But if you take that magical substance and you give it to them directly, I think you'll find there's a different set of feelings that emerge. That is, we like to think this is an example of we like to think we're objective about money. But if you actually start to notice stuff like that, you'll find, well, no, it's actually be really weird for me to take, or 20. If you've got so much money, 10's not enough. Take a 20 out and just, give it to somebody you know and go, here. And then you'll both be standing around being uncomfortable for a while.
I can think of the many times this year that I've been at a very nice dinner somewhere. Maybe the very nice lady who's accompanying me, there's absolutely nothing wrong with being the man and picking up the tab. But I think you're right. I think if you were just to give a friend money for no desire for anything in return, just to give money, people are going to look at you. They're going to think something. They're going to feel something that they might not like.
Well, you could do it a different way. Be like, people wear very nice watches, very nice clothes, things like that. I'm sure you've seen that in Singapore. Having a Rolex or something on your wrist would be really different than if you just walked around with a large bill in your hand.
That is a great example, right? If you just walked around with like $100 bills, kind of like long way in your hand, so people could see that you've got a big watch. And look, a Rolex is going to clearly go a lot more than that. So let's even just.
That's my point.
Right? Yeah. So if you just. Well, they do say in Saigon, though, they do say that you shouldn't walk around with those things on. So in Singapore, I don't think you have any trouble. But there's some look, even in America, I don't think it'd be such a smart thing to walk around. I mean, there's some elements of society that realize that you are walking around with money on your wrist.
Yes, that's true. But my point being is that it gets treated differently when it's the money itself, when it is this substance that can turn into anything else.
Yeah, it's a really interesting example to just imagine, instead of walking down the street with the Rolex on, just walk down the street with the wad of C notes. What's the reaction? We have to try this one. Can we film this one? Can I come meet you in Eastern Europe? We could film this one. I'll just walk down the street with like $100 bills in my hand.
I used to do stuff like this when I would give a talk, and I would put like a 50 and might have a white shirt on, and at a certain point I take my jacket off and I had a 50 folded in my pocket when I had a pocket on my shirt, and people could see it, and you could watch their eyes, tracking the 50. They weren't looking at me anymore, even though what I was offering there was of considerably more value, than to their work if they took it on, than the amount of money in my pocket.
What is it doing to us at a biological level?
Well, that's what I'm getting at, is that it's like cocaine in the brain is what they're finding. Again, you want to know what the research is. It's like money lights up the dopamine areas like nobody's business. It is the reward that goes across all the different types of things in our brain, because it is all the different types of things in our brain. Money represents the physical object we talked about. Money represents certain kinds of accesses and opportunity. Money means people will treat you in certain ways. Money means that you could be thought of as a different person than you are. And again, we didn't invent this. I've got quotes going back hundreds of years that have this in them.
So if I'm reading you right, if I'm seeing where all your research is ultimately going, you're really making the case to investors, traders, entrepreneurs, the average person, hey, before you even make the step of going down the path of building a business, putting a trade on, it might be worth your time to take a step back and think about system one, system two. Think about what's going on, the interplay here, because you don't want to get to the trading success, the entrepreneurial success, and then have not thought about those issues and have them rear their ugly heads, so to speak, at the most inopportune time.
Well, it's the linchpin. What I've come to in this work is that money is a linchpin issue. That, of course, how a person thinks about and treats money can be a great motive for them to become a successful trader and entrepreneur, but it can also be their ruin at the same time. And you and I both know guys that have gone in the business and made a lot and then lost a lot. That can be due to the movements of the market, because there is the stochastic processes, as they call them, or randomness and so forth. But moreover, more often, it's that there are certain ideas, images, and impulses and so forth that the person has about this substance, which they hadn't noticed, but are running the show.
It's a terribly interesting subject. So let me ask, so when will your baby, so to speak, be available for people to read? We're talking a long time away. We'll have you on again when it comes out, but I'm just curious where is the ETA?
Well, we're looking at next fall, because I had an experience in the middle where I needed to move my entire household. That just blew out a few months. I hadn't moved in some 20 years, and I never thought of myself as a thing person, but it's surprising what you can accumulate in a large place over a couple decades.
Yeah, it's so funny. I went through that process coming to Asia this year, and I gave away a lot of things. Because you look around and you say, well, if I haven't touched this for a year. What am I doing with it still? And so I remember one guy in San Diego, I think he got 8 suits.
Very, very similar thing. Except we utilize the local charity shops, and yeah, they got suits and jackets and jeans and just piles of stuff that it's. And again, this stuff also represents as like, well, I bought this stuff with money. I mean, if I just give it away, I'll waste my money. I mean, again, all these associations are going on. Just like then this goes to the behavioral economics idea that if you own something, it's more valuable than if somebody else owns it. And so, it's like, well, I don't want to give this away. It's valuable. It's mine.
That example you just gave, though, too, I always love the definition of a sunk cost. When I first heard that described in an economics class, finance class, one of the few things I got out of an MBA program, the definition of it's paid for, emotionally let go. It's paid for. It's gone. You don't get it back. I think the definition, the understanding of a sunk cost flies right into the middle of your work too, because if you can let go of some of that and not hold on to it, I think you're a step ahead.
Well, listen to the metaphor.
Yeah.
Hold on, let go. See, that's what I say. It's like you've got money is sunk cost, very objective, abstract term, system 2. And then it's like, well, if you can let go, well, that's very basic and sensory and personal, and that's system 1. These two thoughts occur in the same moment, and people think, well, I ought to be able to think this through, and they're trying to do with system 2 what they need to do with system 1. And that probably goes to the heart of what I'm up to in my book, is that once I've got these ideas laid out as we have, then how do you utilize the system 1 operating system the way it is? And I'll give the answer right now to the one that we're talking about, is you need to have what are called reference experiences. You need to give away stuff, little giveaways. In other words, practice the behavior so that your neurology, because system 1, remember, is automatic and unconscious. It's running off of put it this way. You do what you do because you've done it before. That's what a habit is. Why do you do what you do? Here's the deep reason. You've done it before. If you want to do something new, then do it. And you can do it in the smallest, simplest way. And once you begin to do it, then you're beginning to do something new. So, take something to the secondhand store, the charity shop, or the junior league, or whatever it is. Just do that with some things. Then you have done that behavior in one area of your life. You get that practice. Then you can do it in another area of your life. Like you're trading and investing.
I was going to say, even though trading and investing might not seem anything similar to taking some used clothing down to the thrift shop, you're kind of making the case that biologically it's triggering the same aspects in us.
Well, I'm saying that in order to trigger the same aspects in you, you want to first of all get the behavior into your neurology, into your system 1. And that's where system 1 is based on experience, whereas system 2 is based on logic. So the secret to running system 1 is to get yourself the kinds of experiences that will make a difference. Whereas your system 2 goes, well, I just want a strategy. Just tell me what to do. Yes or no, bright picture. It's like, it's not about a bright picture. It's about doing things.
I think you make a great point with this, the idea of experience. I think so many people want to walk through life imagining, because now you have the internet, you can be there, you can see it. You and I both know that's not true. There is no experience that I can find in a book, a magazine, online, nothing that will give me the same experience about Belgrade that you're having right now on the ground there. It's a sad aspect to me. All this technology is trying to make us think that we're having an experience, but in many instances, we're just not. I think it's a lot of it's very fake, and it's not. I don't think it's the real types of experiences that you're talking about.
Well, I would put it differently, and I agree with the following caveat, is that when people are having experiences through their technology, they're having an experience of their technology. You can look at places, and I do this. I've looked at places on Google that I might be going, and I'll, can pull up the map and then pull up the street view and so forth and look at it. But I know that all I'm doing is orienting myself for when I get there. It's not the experience of being there. It's just a way of kind of going, okay, there'll be this and there'll be that and there'll be that. All right, good. So I have an idea. some landmarks, some still photos along the way, but that's not the experience of being there. The old thing that Jim Rogers used to say, or Tom Baldwin, another one, is there's life before the trade and there's life after the trade.
Do you think that those preparations, you're traveling a lot, I've traveled a lot, do you think those preparations we do they really help at all? It seems like once you get to that place and you look back on the preparations for the experience to try and prepare on what the experience is going to be like, it all pales to the experience.
Well, that, you're talking Clausewitz on war now. He said, he says you do all this preparation, and then when the war starts, then all bets are off, because at that point, again, randomness and ambiguity and all these things come into play. I do think that very often preparation is a ritual for focusing the mind to be prepared for what one is going to do. And again, when you know that, you can engage in that ritual in a useful way, and not in a superstitious way or a magical way that you think it really should happen that way. But you realize, okay, I've done my preparation. I'm settled in myself. Now I can turn my attention outward and be responsive to what is happening now.
So I'm thinking about the last 185 podcast episodes that I've done. And
wow,
I love the idea that I don't think anybody else has used the word ritual. And it's such a cool word. It paints such an interesting picture. I love the fact that you throw that one out there.
I go further than that. In my work on money, I point out that in the modern times, the most common and most persistent and prevalent ritual that we engage in the modern world is the exchange of this substance called money for something. It's really hard for people to take this in. So I'll spend just a moment on it, is that for most of human history, for most people, they didn't deal with money. We have this, I call it the Flintstone factor, which is that we take our current situation and then we imagine it backwards. And in fact, they now know, and I've got the references and so forth, and I'm wondering whether to include them or not, that the original uses of money were not to make barter easier, which is what the economists will tell you, is that, well, money came along and then you didn't exchange your cow for wheat or whatever it was. It's like, so we had money. Yeah. So it was very practical. No, the original uses of money were religious and ritual. Money was a way of transferring emotions from one place to another. Money was a way of transferring power from one place to another. And it still is. That's still in money, because the old so-called primitive people's ideas of money and children's ideas of money, the tooth fairy and the quarter, although it's probably $1 now under the pillow and so forth, those ideas about money are still inside us. And so that idea when the child would take the money and go and buy something with it the first time. I was just in a shop recently and this little girl is there counting out her dollars. I mean, little girl, and counting out her dollars to buy something, very methodically, that stuff's still in there. And then you engage in that ritual. Used to be religions were the rituals we engaged in. Used to be the families had rituals we engaged in. No, the ritual we engage in most often now is with strangers. And it's for the exchange of something. And what is that doing to us?
This begins the second part of my conversation with Charles. A slightly bad internet connection and the desire to just add more material to the subject. And we're talking for the second day in a row.
Hello there, Michael.
Hey, Charles.
I was looking like you look in your picture last night.
Out and about, doing the presentations.
Yeah.
Sometimes it's fun. I could not do it all the time. I can do it every now and again.
Yeah, me too.
I'd rather be in jeans than a t-shirt.
Well, it's still cold and snowing here, so I'm in cords and a turtleneck.
So I got your list here, and I was trying to think about what's the best way to approach this. Because I'm sure we touched on many of these issues.
Yeah, that's the thing we did. I know.
But not in an orderly fashion. But I don't know if an orderly fashion necessarily makes it better. It might make you more constrained. I don't know.
Well, what I'd like to get at is I don't know that your listeners can really get the idea that money is both real and practical and magical and alchemical and therefore paradoxical in our experience at the same time. That's really what I'm trying to get at in this talk is because I'm thinking most of them will go, yeah, and they'll brush it off.
Probably. So where do you think we should? I was trying to think where to start here, and I was thinking maybe it was really at the part of money as a living metaphor would be an area that comes in where we've not yet been.
Yeah, I'd agree with that.
Okay, well, why don't we jump in and talk about it, because they know money having many different meanings and different metaphors for money, for relationships with money, in different areas of life money is used as a measure. Why don't you dig into those three different areas and kind of just outline it from your perspective?
Yeah, well, first of all, this idea that money is the metaphor, that the so-called abstract and economic idea, money is a medium of exchange in the world, in our minds and in our language, that's called metaphor, when one thing can stand in for another. And we find that when people talk about money, they talk about bread, lettuce, the lifeblood of the economy, dead presidents, and so on and so on. Every language has lots and lots and lots of words for money, very often based in the profession the person is in, or related to it, or related somehow to wampum, tobacco, all these different things. The way that we think of money as having this transformational quality, that we can turn it into the object. And so very often the object is used as the name for money. And that's evidence that it's not just in the mind, it's in the world. And related to that is, of course, how we relate to money. That is, we have lots of different metaphors, words to describe our relationship to money. That people will say they have money problems. Now, on the face of it, again, and this is the elusive obvious here, on the face of it, somebody says they have money problems. You go, well, yeah, they don't have enough money, or they're spending too much money, or some combination of those. Well, yes, of course, that's the real world part of it. And in the mind, if the person is using a problem frame, a problem thinking process, a way of envisioning in their imagination, their mind, what it is, then they're trying to solve it. Now, here's the misapplication. When somebody thinks that they have money problems, they will try to solve it with a problem framework. Now, unless you're a professional mathematician, we think that we solve a problem and it's done. And you can hear this when people think, well, if they only had enough money, that they wouldn't have money problems anymore. Like, when I have enough money, I'll never have to think about it anymore.
It's the near impossibility. And even if you did get it, that's really not getting at the root issue of what your perspective on money is.
Well, and the point is that most of us in our world, when we solve a problem, we put it aside and don't think about it anymore, move to the next item in life. But the thing is, with money, the more money you have, the more you do need to think about it, or think about who's going to watch it, and then you need to think about them. So it's a misapplication of a thinking process. People say they're flush. They say they're stone cold broke. People, they're swimming in money. All these different ways we talk about our relationship to money. Money held me back. How did money do that? And it's, well, what they're trying to say is that the lack of money actually somehow prevented them from doing something. And that's the objective, if you will, the outer world way. But in our mind's eye, in our mind's ear, in our mind's body, we embody those metaphoric ideas and make them real. So if you talk to somebody, they actually feel like money is a person, and they're having this argument with money, and money is pushing them around, money's influencing their life in different ways. And I invite our listeners to, listen and look into your imagination and your everyday languaging around money, and how do you speak about it, think about it, because these ideas have implications. It's like, as they say, if you think there are money problems, then you're going to try to solve it like a problem. If you are looking for money, the assumptions, the presuppositions, you use the linguistic words for it, is that if you're looking for money, that means there's so little of it, it's hidden. So it's money as a hidden object. And people, looking here and looking there for money, as opposed to, for example, a Paul Tudor Jones, who described the economy as this large and incredible system of pipes and liquids and so forth, and he would look for a place that he could tap into this plumbing system and draw off some money.
I love where you're going with this, because it does for me, as I'm just a student listening and learning, and it really forces you to think about what we've done with these terms and the idea of money, and how we've allowed it to go in so many different directions. And it's fascinating. And once you started this process, you must have been just opened up a can of worms on the analysis.
Oh, it did. And, this is initially, and I did this a couple decades ago. Initially, I had the idea that there were what I called a living metaphor, a personal metaphor that people would have for money. And I'd been looking at what I call metaphors of identity. Life is a journey, someone's a hero, and so forth. What was the personal metaphor? And then I realized in the background of people's lives, other metaphors were running, the metaphors for their relationships, the metaphors for their job, and the metaphors for money. And as I got along, I realized the metaphors for money were pervasive because of these abstract economic ideas. Money is a medium of exchange, and so we make it a metaphor for so many areas of our life, like what it is, our relationship to it, how we use it. And on the other hand, money is a measure of value. And so we use money to figure out, well, did we spend our time wisely? Or did we waste years in that relationship? Are we living a rich life? Did that decision pay off? What are the emotional costs of this? And so we were using money to measure life, to measure time, to measure decisions, to measure emotions, to measure relationships, whether they fit well or not. And the thing is that once you've used that measure, once you've used money to make sense of that, well, then you can go, well, then how much is this relationship worth? How much money, how much do I invest in this relationship? And that measure begins to influence your behavior. It influences your actions. That's the point. The point isn't the languaging here. The point isn't the, pictures in your brain. It's the fact that, as John Locke, the philosopher, said, is the images and ideas in men's minds are the invisible powers that govern them. That's the point of it.
But first things you have to do, and I think even myself, I was trying to put my arms around the ultimate place where you're going. But then once I see what you're doing, you're like, it's like me with a Lego set when I was a kid. You take it apart so you can see where the pieces are. And then when you can see what all the pieces are, you can start to realize, okay, now I can do a little self-analysis here. I can see how I'm treating money, how I'm thinking about money, how I'm feeling about money, and then start to make some adjustments depending.
Yeah. And this is the point. You can make adjustments because we are so much more creatures of our imagination than we like to think we are. This goes back to our previous podcasts and so forth about System 1 and System 2. And System 2, logically understanding cause effects in the world. System 1, images, ideas, associations, suggestions, impulses. And the System 1, the part that so many of the researchers, really fine people in behavioral economics and finance and so forth, they basically say, well, you try to catch yourself at it, you try to change your habit, don't do it again. And because it's so largely unconscious, people find themselves doing it again. Except that this metaphor idea is a window, if you will, into the motives and the means of action that we use. So you can actually influence the metaphor. Let me give you an example of this, as it goes deeper into this idea that, well, first of all, modern money is a social trust, or if you talk to Ed Secoda, people like him, they'd say fiat currency. In other words, there's no value in the money. It's the value that everybody trusts that the money is worth something. And that's what gives it value. If people stop trusting in the money, and we know this has happened in certain places, then of course you get a run on the currency and so forth. All right. But some people, gold bugs, if you will, as they're known, those people think that there is an intrinsic value in money and that it's gold and or silver, definitely gold. Now, this goes back to that System 1, System 2, the images and associations of money as gold, as shiny, as incorruptible, as the color of the sun, as warm to the touch. And so those ideas, images, are very much very young, very primitive, if you will. And in that person's mind's eye, that glows more real. That is brighter and closer in their mind's eye. That they think that's really money and the paper stuff isn't. And now you can see where the metaphor and the image in the mind's eye actually are affecting financial decision making. Because a person has reduced the number of choices they have. Now they're going to say, well, but gold is real, you know? And I'm going, well, yes, gold is real. And the stock markets are at an all-time high now as well. I mean, that's also real in that outer world sense. But it's the inner world that we're using to respond to that outer world that makes the difference.
Let me ask you, as you've thought about all these, something that crossed my mind, you could tell me if I'm off here, but I was thinking of the Myers-Briggs instrument that measures preferences. And I'm almost wondering if this subject, how you're breaking money down, almost lends itself to a survey type procedure where one could be asked certain questions or probed in a certain way to where they could find out where they stand. Because here you are, you've outlined all these different ways to think about money. And frankly, I know I've not thought of these ways, and I'm sure many in the audience have not, but I think all of us can immediately see the benefit. But people are going to be at different points on the scale of how they view money from the way that you've broken it down. And I'm just wondering if I'm sure it'd be a fairly interesting, big, taxing, novel project, but I don't see a survey to get people to think about these issues that you've brought up.
I'm intrigued by that idea because in doing my research on this that I found initially I was just collecting them from people. That was really cool. You go to a program and get new ones. And then I began to find that there were some themes, and depending on where the person was as an investor or trader, how developed they were in their craft, they would have shifted their metaphors. And then I found that even historically, people will start out with, or at least be around the idea of money as an object will be an obvious one. I mean, money is an object, as my listeners would say, but it is an object. Well, yes, it is. And it's also an object in the mind's eye and the mind's body. And what do I mean by that? Is if you think about objects, there are properties, if you will, of objects. You acquire them, you value them, you use them, i.e. trade them or somehow, and you dispose of them. When I hear somebody saying that they have a money problem or they can't handle money, that's another way people talk about it. It slips away from them. That's a metaphor. How does the money slip away? It doesn't just slide off your, well, maybe one bill does, but, money's, so as I was saying before, language is essentially metaphorical. But if people say, well, I just can't handle money. And I say, no, wait a minute. Let's get a little more detail.
These are
here.
all excuses, though, in many ways, right? These are.
Well, now this is why I want to be careful here, because the typical modern system 2 psychology, intellectual psychology, would say, well, those are excuses. Whereas if you analyze it in terms of system 1, I'd go, these are accurate descriptions of the person's inner world. They just don't realize they're telling themselves that. Because if they tell me their money's slipping away, I already know it's a physical object and it's slipping away. And so I go, okay, so they're not very good at, remember I mentioned just these properties or qualities.
They've got a grip problem. They need like Stickum they used to use in pro football. If money is slipping away, then the first thing that you and I should do is help them with their grip.
Well, we could. That's disposing of money. In other words, their ability to effectively or to their pleasure. I actually
meant grip. I mean, when you're breaking it down this way, I'm thinking the physical grip of money's slipping away. That's what they don't mean is their grip of the money. They don't have the ability to hold on to the paper; it's falling out of their hands. So I'm literally saying to them, "Oh, hold on, let's put some sticky stuff in your hands so it doesn't actually fall out of your hand." And they would kind of look at you and go, "What are you talking about? I'm not talking about that."
Exactly. And what I do is I pop it up to a bit of a higher level, but in the same area, because I'm going, okay, so you can acquire money, you can acquire money, you can value money, you can do things with money, you can dispose of money, for example. So I'm going, so they're in the acquiring process, it's slipping away, and or they have a really bad disposing of money ability because they haven't. But my point being is there's these 4 areas, skill areas. And you could develop yourself in the skill area, but instead what most people do is they have some reaction like, I can't hang on to money. And then they stop thinking about it. Go, no, wait a minute. you just told me that you have a problem in one area. You actually might be really good in the other areas. You might actually be good at valuing money, putting it in its proper place, if you will, in your life. You might be good at doing things with money once you can hang on to it. So the point is, the person may have more skills than they realize, but the way they're talking about it is obscuring that fact. And at the same time, they're also telling me, as you just pointed out, okay, you need to work on the hanging on, the storage ability of money, that once you get money, you need to develop more skills, ideas, images in your mind, abilities to deal with that area. Let's work on that. As opposed to, oh, that's just an excuse.
What's also crossing my mind here, you're talking about this issue, is the people that win lotteries. And it's almost, I know there's been research done on it, the people that win the lotteries and millions of dollars, many times, they get all the money they think they needed, and they win the lottery, and then they blow it all, and they're right back to where they were when they started before they won the millions.
This is a wonderful example of how money in the mind influences money in the world. Let me open that up just a little bit, because it's a wonderful example. Is what they found in the research is that how you get the money, and moreover, how quickly you get the money, then in your mind is how quickly you dispose of the money. And they call this a mental container, where you're putting your money. And the point is that you want to change the container. So people get a tax rebate. They also spend those really quickly because the money showed up quickly. Therefore, the money goes out quickly. And what I suggest to clients and people I work with is that you take the money and shift where it is. So you get a tax rebate, or you win a lottery or something, is to put it in the bank or someplace safer if you have it, but to put it someplace and let it sit there just a week, just a little time, because what'll happen is it'll shift container. And in your mind, it'll become a different kind of money, and then you can utilize it differently. So the point is that these are in the mind, yes, and you can do things in the mind and in the world to shift how you respond to money, so your actions are different. That's the point in bringing this up.
Where as we get, and clearly there's going to be a lot more research and a lot more effort at this subject coming in your new work in the new year, but I think yes, our conversation right here alone will get people thinking about this topic of money in a much more constructive way. How would you direct people to take the next step? You start to break money down in these different ways, thinking, feeling about it, analyzing it, system one, system two, all the different ways we're talking about in our conversation yesterday and today. What's the next step? Where do you want to take people? The loaded, heavy answer. The loaded, heavy question.
Yeah, we're already on the way. Is that the first part is to get curious about this, and really in this particular meeting of minds that we're doing here is if they from this podcast could take these ideas seriously enough to begin to examine them, to begin to just wonder, like when words come out of their mouth about money or how they use money in their life to measure aspects of their life, or when they use a money metaphor, is if they went, I wonder, how does that idea, that image, set my beliefs about money and what I can do with it, set my actions in a certain direction. I mean, just that would be a huge shift, because that shift of awareness will lead to the next shift, which is like, oh, maybe in this area of my life, I want to stop using money as the measure. Is finding out where money does not adequately apply. You sell your car, but you don't sell your daughter, right? Well, in most countries. In other aspects of money where you're using money, it's using money as emotions. My account is overdrawn. Is that really a useful way to think about your emotional life, for example? Or would you want to measure emotions in some other way? For example, the idea is, where does it apply and where doesn't it? That's on the one side, money as a measure. And on the other side is this money as an idea that's actively influencing your life choices and actions, is getting curious about the metaphors coming out of your mouth and seeing they're also showing up in your actions and your choices and your behavior. wondering what else they could be. I mean, the idea of mentoring, the idea of success leaves clues, and Anthony Robbins has pointed out to us, is much better known than it was when I was getting into it years ago. So it's like getting curious about, well, how does that person over there think about money? And I could actually catch a little of that in the everyday conversation by the metaphors and ideas that they use. I mean, one of them that early on when I was investigating this and I was presenting this to different market wizards, as that they looked at me, and Paul Tudor Jones is an example, though I have not met him. They all looked at me and went, well, money's a liquid. Money's a fuel. And so I give away the game a little bit to your listeners, but it's finding out where you are, and then what if you were to try out this other way of thinking about money? That money is something that you are utilizing in the world, and it's always flowing, and there's always more of it somewhere, and so it's a matter of tapping into it. And that mindset redirects one's thinking, even in terms of what kind of trading and investing they do.
I'm thinking back to the example that I brought up with the idea of another type of instrument or survey like the Myers-Briggs instrument. But in your case, in the Myers-Briggs instrument case, there's 16 different types. They're not necessarily, in that situation, one type is not necessarily better than another type. They're just preferences going back a long way to many psychologists' work in the early 20th century. But they're just preferences. And so, but in your situation, when I'm thinking about, like if I'm thinking, okay, how does Charles Faulkner think about money in the many different ways you're laying it out? How does Ed Seykota think about it? How does Paul Tudor Jones think about it? And then, you have the average person that's starting out. And it'd be really interesting to see, and I think you're already pointing this out, is where does one sit on the continuum? How do those people that have done very well with money, how do they sit? Because I think the other thing that we might find too is if this takes it to the natural conclusion, there could be plenty of people at the top. Maybe they get to the top and they change their view of money. Maybe they get to the top, so to speak, the money top, and maybe their views and understandings of money are just the same as the average guy. And then you start to bring the factor of luck into play. It's a terribly complicated and interesting path to go down.
It is, and I agree with you that there aren't, so to speak, magic ways to think about money, and most people could improve theirs. And let me give you the example. We're in the holiday season here. Of course, the Christmas Carol was Scrooge, and the idea of going back to money as an object. And Scrooge was very good at acquiring it. He was very good at valuing it and putting it to work. And yet the way his disposing of it, at least if you follow the Christmas Carol as a story, he was very underdeveloped in that area of it. So in other words, is one might putting money to work or even putting money to play. It's the idea that one can be well developed in one area, the acquiring of money, and yet be not developed at all in another area, which is to say, how can I, have that money flow back into the world that makes a difference in a way that enhances my life and the people that I want it to enhance, for example.
Great point. We all know people. Maybe we've all gone through it at some point in our life. People that could just consistently bring money home, but they can also be the same people that get into debt and spend too much of it,
or just are keeping it and living, very frugal lives. There's nothing wrong with a frugal life, but are they living the life they wanted? They actually could choose, to live large or live magnanimously or live, with great connection into the world. And instead they're sitting on their money, if you will, metaphorically speaking. And I look at that and wonder about that. Like some people are very good at disposing of their money. And I mean that in the sense that they put it back out in the world in a way that makes a difference, that they're getting maximum happiness, maximum fulfillment from it, but they're not that good at acquiring it. So when one begins to look at it as a physical object, as composed of different skill sets, then your listener can go over that and go, oh, okay, so I've got this area knocked over here. It's just I don't have enough money to live the way I want. So it's not that money's the problem. It's that I need to look more at my acquiring strategies. So it allows a more detailed analysis, if you will.
Two more to go, but there is nothing boring about how Charles approaches this subject matter, the subject matter of us humans. Next, episode 303.
I haven't let you know yet. I'm going to be there in January.
Yeah, where are you going to be?
South Vietnam. We're going to do North Vietnam, South Vietnam, Laos, and Cambodia. My wife and I.
We are going to surely have to grab a dinner at least.
As soon as I've got the actual dates, I'll send them along.
I'll probably be back here the first week in January, so.
That's when we're headed out, I think, that first week, the second week. Yeah.
Okay. Well, I'll be back for sure. How goes everything? I know you've had an interesting year.
Coming face to face with aging and mortality and the American medical and insurance industries.
But you postponed the mortality thing for a little while. That's always good, right?
Yeah, well, I know I'm still into the mortality thing. Everything seems to be working fine, but that's what I thought beforehand. Uncertainty, the unknown unknowns.
No, I tell you, I'm getting up tomorrow morning to go to a track in 95-degree heat and run sprints. Now, I don't know if this is going to help me in the long run or hurt me, but at least the blood will be moving somewhere. How else is everything? So where have you been recently? You've been in Europe. You're in Chicago today, yeah?
I live in Evanston now, the home of Northwestern University, a lovely little town with tree-lined streets and beachfront and the rest. If you have to be in the Midwest, it's a very nice place to be.
I tell you, I asked you for some talking points, not because I don't know how to prepare for guests. That's not the problem. The problem is preparing for you, because we've spoken so many times, but it's never boring, and you're never boring. You always have this fresh angle. And when I was looking through some of the notes you sent me, I was like, oh my gosh. And I thought the one that, I'm going to jump around on you today. I'm sure you don't mind, right?
Not that I can mind now.
You don't have a choice. So what I love, though, is you made a point, and I'm surprised. I guess some of the things that you sent me, I thought about, I just love them because we all should think of these things, but we don't. And I thought and I don't know where you want to go with this or how you want to tie in, and I'll let you explain it. But the notion of fictional people. And even though somebody can tune into my podcast and they can listen to some really noteworthy folks giving some great wisdom, it's still a little fictional. Even if you pick up Jack Schwager's books, you still don't know these people. And so...
Well, let's back up a moment and explain how we got to this point, because we both have the back.
I don't know how I got here.
Well, my claim is, and in one of my notes, is that famous figures of finance are fictional. And then I softened and I said, most famous, but really, they all are. And here's why, is that the way we make sense of the world, and the research is in, the way we fundamentally make sense of the world is through stories, is through metaphors, through frames and so forth, these linguistic devices, if you will. But we know what they are because we have a deep, rich experience. All of us know what a well-told story is like, and we all know when we have a turn of phrase or a way of thinking about things that shows us something in a new light. We can't not use these. And given our limited exposure to a Warren Buffett or a Soros or a Rogers, or, you pick the person that you admire, that we only know them through the stories that we get that are told about them. And those stories are not neutral, starting with they cannot be complete. They aren't the person's life. They're selected snippets of their experience. And moreover, what we know now is that they're what people consciously think are important, whereas the real machinery, the real stuff going on, is very often unconscious and outside of the person's awareness. So even when somebody tries to talk about what they think were the important influences on them, they're going to use the availability bias. They're going to use hindsight bias. They're going to have the blindside bias and all the rest of them, all those biases from behavioral economics. Us, can't even tell the truth about ourselves, even if we wanted to.
I want to add, though, and I was going to add there at the beginning, which is, I think, an important point, and you say this very succinctly, which is most people have little or no direct extended contact with famous others, and so they only know them through the simplified and often, just the simplified stories. That's how they know them. You and I have been fortunate maybe not fortunate in the sense that we make our own luck, but you have spent a career reaching out, getting to know people that have achieved at certain levels. I know I've done my level-headed best, not just to get on the telephone, but to get in front of people over the last 15 years. And that is quite different than perhaps some of the idolatry that takes place in the online chatter worlds these days.
Yeah, absolutely. And as I say, even if you do know them, you still know them in limited circumstances.
Sure.
And this is a funny thing, is they know themselves that way. Is that one of the things I get into is how these people who have achieved in one area of their life will then assume they have the same kinds of great insights in another area of their life. When we do this with other people, we call it the halo effect. When we do it with ourselves, other people call it deluding ourselves. But we all are doing this, and we're doing it through stories. So yes, that idea that the famous figures of finance are fictional, to you, for the most part, to all of us, that's not a bad thing, but it does mean we want to take things with more than a grain of salt. And I actually have suggestions around that in my work about is you want to get the most down and dirty, detailed biography of other people. You really want to know how they day to day take up their lives. And of course, many people don't want to reveal that, particularly in the finance area.
In meeting these types of people, you can see quite clearly, well, they put their pants on just the same way. I always found a lot of confidence in that. And then the issue is the nitty gritty details, like you say, is can you scientifically break their process down? Because if you can't, there's no reason, there's nothing you can really learn. I mean, you get back to the stories that you're talking about. So unless you can break down the process, it's very difficult to learn from some of these real but fictional people.
So the other part of that is because, and again, the reason I'm on a horse about this is because it's become very popular in the things that I look anyway, is that narrative, which is saying stories bad, data good. And so he's like, avoid stories, don't listen to the stories. And I'm going, we are story generating creatures. We can't stop ourselves. The only choice we have is how we utilize the stories. And here's where I suggest that people begin to sort out, as you were just doing, the difference between a story and a strategy. Very often people think they have a strategy in the markets when in fact they have a story, and most often a story about the markets, and then they figured out some magic thing and they got rich. I mean, I hate to be that way, but to actually do the nitty-gritty work of figuring out, as you were just saying, scientifically, what is your system and how does it work, that actually takes effort and time and thought and development of skills and abilities. In the words of Tom Baldwin, everyone wants the money, but who's willing to do the work?
Let me quote you on something which I think dovetails right into what you're saying. This is you. Most people's experience of money markets and market participants is their imagination. And it's not even that imaginative. It's mostly the same conventional ideas, definitions, and experiences that everyone else has about them. And I see that as such a great couple sentences. I see that on the internet just day in, day out. It's this cacophony of voices that it's just noise. It's noise pollution. There's literally there's no depth to it. There's no details. There's no learning. It's literally this race to just put 140 characters out to, I don't know what, to generate followers and this and that. But the whole idea of breaking it down, which is where you're going, I just don't see it in the big picture media narratives these days. It's all about fast food information, right? Isn't it? I don't know. Am I crazy?
Well, let's slow it down for a second and say, well, what was I getting at there? And I was getting at the fact that we humans have these ways of processing information. It's called classic style in literature, just so I have something to hang it on there. But it means that when we use words, the words have one meaning, they mean what they say, and it's like we're looking on a window on the world with our words. That is, the words are accurately representing what it is we're seeing. that assumption, which is so deep and everyday, people don't notice, so they crank out the 140 characters or whatever. They think that they have an opinion about something, that opinion must be true, that idea must be true, because they can have it, because it's clear, simple, and vivid. And there's one of the key insights from the work of Kahneman and others, is that when we get a clear, vivid image in our head, and it's repeated a few times, we think that it's real and true. Now, I know that sounds crazy, but this is the other side I'm coming through. I've been through the looking glass. From the side of how the brain actually processes things, when people get a clear, vivid image of something, the markets, a market direction, particular trade, then they're going to believe it's true. And unless they've got a richer universe, a deeper idea, as you were just suggesting, that moves beyond those conventional categories of what's a stock, what's a bond, what's a moving average, and so forth. Unless they really begin to dig into what those things are, but more importantly, how they work, then they're going to be using the same kinds of information as everyone else. And of course, when you don't think there are different kinds of information, what you will do is try to get it faster, sooner. Does that make sense? See, if you think that that's the only reality, then your only edges are more, faster, better. But if you go through the looking glass, which is what I'm claiming, if you begin to see that all information is complex and ambiguous, it has what's called stochastic uncertainty, which means it has noise and false positives, false negatives, and moreover, that it's endogenous, meaning the information changes the very environment, like high frequency trading did, and finally that your view of the information is limited. Your ability to process information is limited. The information you get is limited only by the sources used. All those factors mean that you're getting a particular interpretation of the information, not the truth. Then suddenly there are other edges for you to exploit, which is what market wizards do. There are other ways to interpret, understand, and take advantage of the markets. But if you think that words are real and true in presenting facts, then you're stuck with faster, more, better.
I'd like to let you go back to something within that little passage that I read from you, which is the notion of imagination, and you making the comment, which I just love, which is, and it's not that imaginative. That's just brilliant.
People use the conventional categories to put things in the boxes, put things that everybody else uses, or in the words of Howard Marks. And if you don't know who he is, go get his book, The Most Important Thing, right now. Order it on Amazon. Then he does this thing where every chapter is the most important thing, which of course to a number of the realistic thinkers will go, well, how's that possible? Well, it's possible because Howard Marks is not in the same mental world you're in. And Marx says, if you want to succeed in the markets, you've got to do something different. You cannot be doing what all the other people are doing.
In the same space that we're at, and I guess it's related. You might interpret it or state it a little bit differently. So what truly is independent thinking?
Okay, independent. Yeah, I have quite a harangue about this because we live in a society that assumes, again, this is because of these conventional categories, that everyone is an independent thinker of their own mind with their own responsibility for what they think and what they do. Okay, there's a lot of political thinking or philosophical thing we go into, but we're interested in the markets. What it is, when people are thinking with those conventional categories, they see the world and they divide up the world the same way everybody else does. Hence, the thinking is not independent. It's herd behavior. It's conventional. It's what everybody else is thinking. In fact, it's not thinking at all. To think independently, one needs to actually have gone through and thought through what those categories are. Are they things the person actually takes on or not? Do they agree with them or not? And this means moving beyond authority. Just because somebody who authoritative says it, it means moving beyond the conventional categories. It means moving beyond herd thinking to where you're thinking what you're thinking because you've thought it through and that's what you think. or, to put it in the vernacular of trading, the contrarian.
I think a great example I've got a market example and a non-market example of herding that I'm thinking of. Number one, top of the list, are U.S. equity indices at all-time highs. Now, I don't have an opinion as to whether or not, I guess I have an opinion, but I don't have a trading view on it as to, the market's too high or it's too low fundamentally, so I'm going to do something. I don't have that. The market's up. You probably want to be long. You don't really want to be short when the market's going straight up. When you talk about thinking independently and thinking outside the box, non-conventionally, I would hazard a guess that most people out there that are in mutual funds or they're long only have not pondered the idea that at some point in time to get your profits, everyone's not going to get out at the high. And I think that's kind of an outside the box thought. That's not like a typical conversation that's coming up on CNBC or Bloomberg, where you're talking about the notion that it's great that stocks are at all time highs and everybody's wealthy on paper if they're a buy and hold or a mutual fund, etc. But everyone can't get out at the high. It doesn't work that way. The math's against you.
Now, you even take the simple idea that if people follow the recommended, and I'm not talking to traders now, I'm talking about mom and pop, how do they handle their retirement? And they say save money and invest it in the markets. And I've seen statistics depending on when you started saving and when you needed to retire, that 25, 30 years, whatever in there. Depending on the start date and the end date, the amount left, even though you contributed the same amount in every scenario, could be 6 times different. In other words, for example, it could be $500,000 that you have, or it could be $3 million that you have, all depending on your start date and your end date.
And see, there is a going against conventional thinking. That's not the typical conversation. The typical conversation is a simple heuristic of for everybody, it's the same situation and it's all going to be okay. Just trust the little heuristic of buy the mutual fund, go long, and forget about it.
Yeah. And when you dig into the details, you find stuff like I just spoke about.
Yeah. Hey, I'll give you another one I saw today. I don't know where he was from or how he got the data, but he got the purchasing habits of people on airplanes now that you can buy movies or buy extra snacks or whatever. And the herding influence, the social influence, that if you're sitting next to a guy who buys a bottle of wine, your desire to buy the next goodie or the next film goes up some 30% higher. And they've looked at all the data, and it's just literally, if the guy sitting next to you does it, you've got a much higher degree chance of doing it too.
Mm-hmm. Yeah. And this is the stuff from behavioral economics, and everybody wants to think, yeah, the other guy, he'll fall for that, but I don't. And the thing is, almost everybody falls for it. The thing is, by developing a greater detail, a much richer appreciation, understanding of whatever your area of expertise is, you cannot do it there. You still may do the movie on the plane, but at least you won't be buying the next thing just because the guy at the next desk or somebody you talked to on the internet bought an investment, and then you said, well, gee, I should get some action today too. Yeah, the idea is that people who realize there are different contexts, different situations, that they realize that there's a difference between their knowledge in the markets and the choices they make at the grocery store. People who begin to know about these context shifts, as I call them, or situation changes, that's an independent thinker. That's a sign of independent thinking. And the practice of that is independent thinking.
Another point we were talking about in advance, which I just love how you say it. It's one of those ones that I told you, I was like, wow, it just triggered me thinking, which is, why are people, it's often, they got the big ego, there's some ignorance around certain issues, and they're also oriented to authority and to experts. And this is all happening at the same time. So there's the ego, ignorance, and authority. And you just, I sometimes shake my head. I mean, it's crazy. Talk about that for a second.
To talk about that, I need to stick back to the idea that there are different kinds of minds, that we are not of one kind of mind. For ease of remembering these, because there are 5 of them, is I've named them. And there's the experiencing mind, which is what you see is what you get. These are people that reference direct experience. There's the imaginative mind, which is an imaginative mind. People think it's like fairy tales, but no, when you think about the future you want, you're imagining it. When you think about the past, people actually don't have photographs in their head. The research is in. People draw on bits of experience and create a past memory at that moment. It's at least in part, if not in large part, an act of imagination. So, and people using the categories and projecting those forward. What is the market going to do? Prediction is imagination. So the imaginative mind is quite prevalent. Then there's the reasoning mind, where everybody likes to think they live. But the reasoning mind, this is what we go to school for years and years to develop, because it is so much work and takes so much mental effort to think things through. And even then, we can get really clever at our numbers, or really clever at what we do, but we won't stop and go, is this really the best thing to do? And that's the reflective mind. The reflective mind can actually put the clutch in or put the brake on, whatever you've got. Is this what I want to respond to? Is this the situation as it really is? And these are the people that can look at it from different angles, that understand the world is ambiguous and so forth. And then last is the generative mind. Well, let's drop back again. Is properties of the imaginative mind include being egocentric. And this is from the developmental psychology. All the research is in that people will hold very much to their own point of view. They see the world from their own eyes, and yet they're only using whatever imaginative ideas they have. And because of this developmental stage, they also still are looking out in the world, and they look to authorities. So you've got somebody that is very much in their own world, but is looking out and watching authorities and just taking anything that comes along. And when they see a resemblance, they go, oh, they're the same. It's like Apple is a technology company founded by a young upstart that made a lot of money. Facebook is a technology company founded by a young upstart. I'll bet it'll make a lot of money. That's resemblance. Any kind of resemblance, and bang, the imagination kicks in and puts those together. And this is the principal way. People don't like to hear this. Mostly people hang out in this mind, this imaginative mind. As I say, reasoning takes work, and most people only develop it in their area of expertise.
Look, a lot of people listen to my podcast. There's some very bright, accomplished people listening to this podcast, but they don't want to think it's them. Whether it's the groupthink, the herding, some of the other issues you're talking about, it doesn't happen to the bright people.
No, that's one of the great illusions that we have, is we think that we're our reasoning mind. One of the notes I sent you is, why is it that people do that? And the point is, there are different ways of processing information. That the imaginative mind is very image driven. It sees things and has feelings about it instantly and unconsciously. We know when we look at somebody if they're upset or they're happy. We know when someone's thinking. All this stuff, it's perception is a form of thinking, but we don't experience it that way. We experience it as perceiving. We just know. We interpret experience immediately. And this is this imaginative mind. To think things through step by step, that we use words to hold stuff down and to get it into sequence and so forth. And so it's a different kind of reasoning process. And I don't know what it is about the way our brains are built, but we think we are that step-by-step reasoning, talking to themselves person, and we don't think that we are that person who just sees the guy at the next seat on the plane order a wine, and so we order something.
You know, Charles, you bring your own perspective. You bring some novel insights. You also are extremely good at curating and synthesizing other either known or not so well-known experts in the field of the mind. So the question I have, though, is we look at all these details, we look at these great insights, these kinds of insights don't really affect behavior in a positive way. Now, clearly, some people will listen, read a Charles Faulkner, and will walk away and have a life-changing moment. But I'm guessing It's the rarity. It's the edge of the curve. It's not everyone. Most people might hear this or hear these kinds of conversations, these thought processes that you have, and they walk away and, oh, okay, that was kind of cool. And then it's back to something that's easy and familiar, like ice cream, potato chips. And I use that as a metaphor for everything that's easy, right? And people aren't really taking this stuff in. But why is that?
Well, this has already been described by many professors and popularizers of behavioral economics. If I was to make a connection here, is that the imaginative mind is system one in the books that are out there, like Thinking Fast and Slow. And the reasoning mind, reflective mind, is system two, the thoughtful, deliberative, conscious part. The strategy that I've seen again and again and again in the literature is you use your conscious, deliberative part to repress system one, to try and hold it in check, to try and don't let it run away. The point is, right at the beginning, these very same professors and popularizers admitted that strategy doesn't work. Here it is in a phrase. Words don't change people. Experience does. Now, what do I mean by that? I mean that what one needs to do is to educate one's experience. And we talked in a previous podcast about a famous trader you knew who studied charts for years, just looked at probably millions of charts in the end. And he got an experience base to draw on. Experience changes people. The imaginative mind is that educating one's imagination rather than trying to suppress it, which means to begin to think in more unusual ways about the markets, to get out, as you would say, get outside someone's comfort zone and seriously take on ideas about how the markets work that you disagree with and see if you can understand how they work in detail. In other words, have other ways to understand the world and how it works. Since they're both stories anyway, we can't get to the truth. That's what, again, the illusion of language, the illusion we have that what you see is what you get and it's all real. No, we're getting an interpretation of a complex, ambiguous, uncertain, limited amount of information world. Your question had to do with, what is it that this washes over people? And the point is, as long as we talk about it, it does. But when one begins to change their experience about it, then it begins to change oneself. Now, this again is contrary to the usual thinking. Conventional thinking is you need a strategy. And I'm not saying you don't need a strategy. Strategy is a good thing to have. What I'm saying is that to develop oneself, you need more than a strategy. You need a greater experience base. You need to embrace, for example, one of the differences between professional traders and amateur traders is, for better or for worse, professional traders very often have more exciting lives. They go out and spend that money in ways that one saw in the movie The Wolf of Wall Street. Or they go and do exotic sports or extreme things. What that does is they have a wider emotional base than the trader who the most exciting experience they have is when the market goes against them. The professional trader with a wider range of emotions, they go, yeah, okay, I've been here before. I'm nervous, but I know what being scared is. I've been really scared. I did something really stupid once, and so I know what that experience is. So it offers them a mental context. Whereas for your mom and pop everyday person who's out there trading, unfortunately, trading is the most exciting thing they do. And hence, they go to the edge of their abilities, except they're actually beyond the edge at that point. They respond emotionally instead of responding to the trade because they don't have as wide a range of emotion.
To go back to something we were talking about earlier, the market wizards, and I'll pass something on that I've seen over the years, and it hasn't changed. I often find I'm going to generalize here, two kinds of market wizards. And I'm talking about some of the noteworthy people that have really achieved highly. Everyone knows their names, all that kind of fun stuff. One of the types will just tell you literally exactly what they do. They're so confident and so comfortable. They just put it all out there, and their performance data backs that point of view. And I'm somewhat talking in the trend following space is what I'm most familiar with, and it's easy to find the performance data and see how it matches with the words. But then there are some that will, not in a nefarious way, but maybe their words about what they do doesn't exactly match their performance data. And where I'm going with this is what's so interesting to me are the third parties. The third parties that will listen to both types of individuals and then not be able to draw a clear conclusion because they can't think outside the box, and they get hung up on a word or a phrase that a noteworthy market wizard uses, and they don't attempt to think that there could be a reason why the words they're saying are not 100% true. And so I think there's a certain segment of the audience out there that gets confused because they hear mixed messages and they're not comfortable enough in their own skin to make a judgment that perhaps the $1 billion plus fund they just listened to might have given a little bit of cloak and dagger, not necessarily false, but they just don't feel that comfort. And so again, it gets back to the issue of you have to have the imagination and be able to perceive what's really going on versus just trusting. It's not just idolatry. I say that again, but I think it's a good word. I see that so often in my world. People just want to worship. They don't want to understand.
Oh yeah, that's level 2. That's the imaginative mind. Is that but even to add to what you said is, given that there are these different kinds of minds, market wizards, the ones I've been able to speak with and be up close and personal with, as well as the ones that I've read extensively, interviews and other things that I have at least on somewhat reliable sources, and you hear me qualifying it right there because I'm careful about this, that they had the most to do with the phrasing and the language that was used, as opposed to it was written by, some staff member. It's very clear to me that these men and few women are in the upper reaches. They're operating at a higher level. They're operating with a different worldview, a different mindset, a different level of thinking. And they're not using words in the same way. For one thing, they understand that words are not reality. You get up to level 5, you get up to the generative mind. As I say, you start with experience, concrete, every day. You go to the imaginative mind, the reasoning mind, the reflective mind, the generative mind. At the reflective mind and the generative mind, the way they use language is they're very, very aware of the limits of language. They're very aware of what it does, how it influences thinking. Wonderful example from our friend Ed Sakota, when years ago he was asked what was making gold go up or some such thing, and he answered he says, it has the property of going up. Audience members said, oh, no, and they asked the question again, trying to go, well, what is making it go up? What's the reason? Why? And by the way, why and getting reasons and getting those kinds of simple cause-effect explanations, that's imaginative mind. That's a property of the imaginative mind. Ed is up there at reflective and generative, and he's not even thinking that way. He's a scientist by training. First of all, so he already broke free of why questions, and he started asking, how does the market work? And developed his own trend following approach. As I say, you know a lot about trend following. And then from there, developed the psychology of that even further. So he couldn't think in terms, I wouldn't say he couldn't, he didn't think in terms of why. He thought it has the property of going up. He wouldn't allow himself, and some friends have suggested couldn't just generate a reason anymore, that the ordinary person can come up with 1,000 reasons why gold is going up or down as it is now.
To add to the idea of words, I can think of 2 market wizards, extremely well known, very successful, at the top of the heap right now. That'd be Warren Buffett and Ray Dalio at Bridgewater. Now, if I was to compare those two to, let's say, I look at the field of trend following traders, and I can kind of, with the field of trend following traders, I can easily look at their track records and I can see some commonalities in performance. And it's like, okay, I could kind of slot them to some degree, and there's something common there. However, when I look at the words of a Warren Buffett or the words of a Ray Dalio, I mean, obviously they're tremendously successful, but I think they might be great examples of you talking about words at a higher level. I don't know for the average person what you can do with the words from a one-of-a-kind Warren Buffett or a one-of-a-kind Ray Dalio. I'm not sure how those words can be effectively used unless you understand the world exactly as those two very unique men do, unique stories in market history. I mean, the top of the heap, and no one's ever going to have their experience.
Well, I will differ with that because I think I have a fairly good understanding of both of the gentlemen. I've looked at their writings and their work pretty extensively. I know, and I'm laughing here to myself as we're talking, is that in the case of Warren Buffett, he understands the difference between stories and strategies, which is to say, imaginative mind thinking versus reflective thinking, is when he talks to audiences, he almost always uses stories. He knows that that's what he should use with people. But every once in a while, he gets in a situation where people demand strategy from him, and the guy just digs down immediately. Stories go completely away, as he describes it. It happened at his last shareholders meeting. Went on for hours without notes, explaining how the insurance business was structured through Berkshire Hathaway. The same kind of thing that with Ray Dalio is that, I mean, he clearly has a complex and mathematically thought through strategy, and yet he also produced that video about how the economy works, so that, and he told it in somewhat story form. I know it's not a Sleeping Beauty story, but somewhat story form on the internet, so that people would begin to think these things through as well. So you get to that level of thinking, and they know even the difference between when they're talking to ordinary folk and when they're talking to another professional, and their language will shift a lot. And again, that's the idea that context or situation makes a difference. But for the most investors and most traders, they want the one strategy that'll work all the time in every situation. And that's not how these guys are working.
You know, I think I make a great example of words and their meanings and trying to convey a thought. I think where I was really going with that is that those guys, so successful and so original, whereas I might compare their careers to a more common type strategy like trend following, where you can see the commonalities. There are differences, but you can see the commonalities quite clearly. And I guess I just come back to, there aren't Warren Buffett Jr., so to speak. There aren't Ray Dalio Jr., so to speak. They've got this, they occupy these unique spaces. Now maybe you're going to tell me that you see that differently too, but it just seems like it'd be much more difficult to be Ray Dalio or Warren Buffett, whereas some other strategies might have a little more chance for replication.
Well, let's not overlook the fact that, at least in Warren's case, and I know he's way too famous an example, but it fits what I want to say here, is that he's made most of his money in the last 10 years. And in that last 10 years, he's made most of his money in just the last few years. It's called compounding. And years ago, Jim Rogers was talking about, and Ed as well, talking about this was the secret, was to get a consistent kind of return over time and let compounding do its work. Time is a huge factor there, as well as luck, as well as skill. And people who look at these traders, look at these investors, and want to replicate that, forget how much luck enters into it. Now, if there wasn't a Warren Buffett, we would have had to invent one. And how much time enters into it. Being able to run a consistent strategy for a long period of time, I'd go right back to your trend followers. That's still a real skill. A lot of people can't just... You shouldn't be getting your excitement from trading, or in the words of Charlie Munger, trading should be boring. You know, to just be able to grind it out means that you've mastered that craft to the point where you're not seat of the pants every day. And here we enter into the whole motives for why people get into the markets and why they get into money. And that's, I sent you the piece about money, that money is a substance, a sign, a symbol, a cipher system, a story, a ritual, and an abstraction. You know, money is in your pocket, but the idea of money is everywhere. So we're in this symbol system, and it has multiple meanings. Money just is not comfort. Money is security. Money is, Tony Robbins recently wrote, is power. Money is freedom. So all this emotional stuff, all these acts of imagination are taking place around the issue of money. Okay? And then people are supposed to calmly and rationally go into the markets and do their thing to create their retirement. Except we're human, and people are looking for excitement, and they're looking for success, they're looking for meaning. It turns into a competition because it has win-lose, and so they begin to apply a competition frame to their thinking, and then they'd rather gain just a little money rather than lose money, so they stay in a position, but it doesn't come back, so they lose more money. That's how humans work. So being able to have developed oneself to follow a trend following system through market ups and downs, that's an accomplishment in itself.
Absolutely. I mean, unconventional to say the least. I mean, unconventional compared to what you normally learn growing up these days, which is there's still a significant part of the population that's markets are efficient and all that type of thing. So yeah, it's definitely unconventional.
Well, I'm talking about it's a skill set to be able to not respond to your emotions. It's a skill set to not have your ideas of being competitive and being successful and so forth tied up with the next moment of trading. You know, all around you in the industry, conventional thinking, they're measuring quarterly results. And in fact, you know, most people out there are measuring your quarterly results. And yet a true trend follower is not trading for the next day, the next quarter. To have that independent mindset. So that's what I was getting at in my notes to you, is that the development of that worldview, that mindset, those abilities, which are not part of any trading course or investment course that I'm aware of, is key to being able to execute the strategy. In fact, it's key to being able to develop the strategy.
Hey, let me end with something. I don't know if you've read it yet. I've not had a chance to read it. I glanced at who is in it, and look, and Tony Robbins, I have to credit for something that I read in one of his books years ago, which really influenced how I was able to reach out and really get close to, in the face of so many noteworthy people. And it was really a tip from him in his writings, which kind of inspired me. So I really don't have anything negative to say, but I do think it's interesting. He's gone into the financial space now, the RIA space, and I've not seen his new book yet, but I do know generally he's putting forth a strategy that people should follow. But my gosh, he's picked, 10, 12, 15 of the most famous billionaires to sit down with, and none of them have made their money in the same way at all. I mean, it's the most diverse group of billionaires, and I just don't know, when you bring that many diverse people together, where do you start? I mean, like maybe you get back to maybe the commonalities, the psychology, but there's definitely not strategy commonalities in the group in his new book. And they're all the big names everyone knows.
Well, you're not the first person to note that. There have been some reviews that have commented that the advice, of course, is for very low cost. Fees are bad, low cost index funds, and strategy Warren Buffett recommends. And then he interviews high fee individuals and recommends annuities and other things that are all fee based. So other people have noticed there is a contradiction in the message.
Yeah, it's going to be interesting to see how that shakes out. It's new territory for him. But like I said, he's definitely given me many inspirational moments over the years. But when you launch into that particular space, I guess, and look, I'm sure I don't know. I don't think anyone says anything bad about you, Charles. I think everyone likes you, but I know occasionally they say some rough things about me.
Well, I just haven't been out there enough yet. Yeah. It's just the nature of, you put yourself out there, people are going to disagree with you because you're challenging their reality. As I say, it's an advanced form of thinking to begin to say, well, maybe the world works differently than I thought it did. There's any number of famous people that have said phrases like, I believe it was Winston Churchill, is that most people would rather die than think, and most do.
Yeah, absolutely.
Or Russell, who said that being shown that having a choice between admitting that they are wrong or proving that they're not, most people get right to work on the proof.
Hey, I got to tell you, I've really had since we spoke last, I've had some really interesting guests on. Not only the full enchilada of trend following traders, but I mean, I've been reaching out to so many people in the psychology field, just all kinds of folks. I'm not even going to try and throw a name out. I'd miss their name. I'll have to send you the link. It's definitely been, this year has been crazy. And just really broadened out. And I feel like I'm in school half the time, getting a chance to listen to so many smart people. It's really fun.
Well, your podcasts are a place that people have a chance to broaden their experience. Yeah, it's indirectly, and yes, it is words, but words evoke experiences in us. And if people are willing to listen, it's actually not only not harmful, but pretty entertaining way to begin to get some vicarious experience to go with their real experience and widen their base. And that's how you move from one level to another, is you've got to increase your experience, increase your imagination, increase your reasoning power, which again, in the trend following area, your books are foundational for people how to think about the world in terms of trend following. And if they want to find out about Buffett publishes a lot, Dalio's publishing a lot, Soros has published a lot. I mean, there are people out there who share themselves. And if somebody decides they want to be a trader, then go learn your craft, widen your base, learn all the tools.
This last episode is from, originally, episode 402. However, it was not an interview with Charles. Episode 402 was not an interview with Charles. I went and found this really great speech he gave a long time ago and made an episode out of it. I hope you enjoy my final chapter in this mega Charles Faulkner special episode number 500. I want to read a nice email that came in. Michael, your podcasts continue to be a wealth of education, entertainment, and enlightenment, and I can't thank you enough. I don't think people really appreciate the value that you are providing. I've spent approximately $4,000 on your products, and I feel like there is more than the value in the podcast alone, and I get those for free. If you're ever in Toronto or Miami, we split our time. Let me know so I can buy you a drink. All the best, Simon. Simon, thank you for those kind words. But of course, this podcast would not be very good unless I had some fantastic guests. It makes my job extremely easy to literally, not figuratively, literally have some of the brightest people on the planet on my show. Now, some people might say, I have really smart people, I have really accomplished people on my show, but I think I've got them beat. The list of guests that have appeared on the Trend Following podcast are just, I'm lucky. I'm extremely lucky. So Simon, thank you for those kind words. And building on Simon's very kind words, it gets me thinking about reviews. And that's part of the nasty process of running a podcast. In today's 2015 world, social proof means something. It helps to land guests. If you like this podcast, do me a big favor. Go to covel.com, covel.com/iTunes. It will forward you to my iTunes page at Apple. You can write a review. It's really simple. Say something good, say something bad. Rip the hell out of me. Go write a review. Please. Look, there's the please.
for your time, for your effort. I will send you a trend-following CD of extras. Simply send me an email, michael@covel.com. I will send you the CD right away. My guest today is Charles Faulkner. Well, he's not really my guest today. He's not live today. I'm not asking him questions today. Like my recent Tom Basso episode, this is an excerpt of Charles that is really intriguing. Charles giving a seminar, and I am excerpting part of that seminar, to students that are interested in neuro-linguistic programming. I'm not here to teach about NLP today. That's not my point. But the way that Charles talks, the way that he thinks, the way that he explains is useful for all of us. If you have a goal, if you want a goal, if you want to think about how to even get to the goal, Charles is digging into that very topic in this excerpt that I'm going to play today. For those of you not familiar with Charles Faulkner, he was originally featured in Jack Schwager's The New Market Wizards. He has studied and worked with some of the best traders in the world. He's also appeared on this podcast 5 times. That would be episode 303, episode 187, episode 117, episode 51, and episode 3. I can safely say I have probably received more positive feedback about Charles Faulkner's appearances on this podcast versus any other guest. There's a soothing quality, a soothing nature to Charles, and he seemingly always comes at his world from a perspective that you don't see coming. I love that about him. I still remember meeting Charles Faulkner for the first time. I was with Ed Seykota and Charles Faulkner in the Virgin Islands a long time ago. I remember interviewing Charles Faulkner one time at Cal Ripken's minor league baseball stadium in Aberdeen, Maryland. I believe it's in Aberdeen, right up 95. Gorgeous stadium. It just so happened when I was doing my film years ago, that's where we had to meet given this crazy schedule. And I remember interviewing Charles. I mean, that's not the only time I've talked to Charles, but I remember interviewing him in some kind of crazy space overlooking the field. This excerpt I'm going to play is all about goals. There's no one listening to this podcast that does not have to think about goals, how to set the goal, how to imagine the goal, how to get to the goal. There's a reason that Charles was in Jack Schwager's New Market Wizards. There's a reason that he's been close friends with Ed Seykota for all these years. I hope you enjoy this great excerpt with Charles Faulkner.
You go to a book like Think and Grow Rich by Napoleon Hill, who claimed it's a model of successful people. Now, his idea of successful people were robber barons. Robin bearers, that too. They were robber barons. So they were Standard Oil, Rockefeller. They were Carnegie, or as we now say, Carnegie. It was Pullman and the old Pullman trains. It was Gates, that comes later. So there were these people that he modeled. When he asked them about their goals, he said they had goals that were above and beyond their everyday concerns. Now, can you hear that now? The neurolinguistics of that. And we all make goals, but if you have a goal that's above and beyond lunch, that's above and beyond put the telephone bill in the mail, that's above and beyond pick up the kids from school. You still have those goals. You still do those things, right? Just because you have big goals doesn't mean you don't, you have a life, right? Both. Okay. Now, some people have it like, I'm too important to pick my kids at school. This goes to the English. There's this thing, yes, well, I decide the important things in the family. I decide when we go to war, who will be the prime minister. My wife decides the minor things, how many children we'll have, where we'll live. Yeah, it's just, people get confused about this. I mean, you have these everyday concerns,
And then what gives your life direction? Sometimes it's called purpose. That sense of above and beyond your everyday concerns. Now, the other thing that we now realize is that when Napoleon Hill was writing this, he said they had big goals. Now, this is confusing big content with big picture. Because they would control the oil industry, control the finance markets of America, control the software on every desk. Now, the thing is, these are big goals. And it makes the world very interesting for people to have big goals. It's also, in terms of an orienting response, very possible to take a simpler goal, to take something that people don't think is as grand but could make a huge difference, about utilizing these skills, and when you greet people, when you interact with people, to make it a covenant of good communication, to bring your best to that, to realize that conflict is the nature of another model of the world and an opportunity to learn. To realize that other people are not only there for fun and reproduction, they're also there to learn other patterns from. And you can make that goal, but that goal doesn't seem as grandiose as controlling the oil industry or geopolitics. But if you were somebody, and Gandhi was somebody who had both of those, who would have the big goal of freeing a country, but he also had a goal which was a person to a person. And in that, you can make that goal big in your mind to remind you about the importance of your children to you and how you want to interact with them, especially when they turn into monsters called teenagers. Because this too shall pass, and they actually need a lot of help at that point. And you can hold that goal of two people interacting. And you can hold that large in the same way that you can hold controlling an industry large. Because the brain don't know the difference, right? If it's above and beyond your everyday concerns, it can direct your attention. Also, you want to be careful, because you make it too big, it's bigger than the both of us. Curious thing when you begin to do this modeling is that we found Bandler for a while was doing these seminars. Make your goal 40 feet across, and Technicolor and 3D. And then behind you have 400 black singers. These are these ladies. They have them in Chicago, the choirs, you've seen them, Channel 25, and they're going, you got your goal! And this can be very motivating. It was discovered, though, that some people do that, and it's tremendously motivating. Other people go, it's too big. And actually bringing it down to earth, some people found it made that goal so much easier to do. Instead of it being something that was up there, it was like, I could do that. And we hear this again in the language, bringing something down to earth. And yet whoever thought of connecting the way we talked about things with the way we represent things with the way that we can react, that we can change, that we can create our lives. As Bandler said, see what I mean? 2,000 years of psychology, nobody noticed that. Not a lot of people on the ball. What we got to realize here is that in our world, all right, I'm going to back up here. You know about mirror neurons, right? Oh, you don't?
Not yet.
Not yet. All right. There's been wondering for some time now if seeing stuff affects what you think about. In other words, does television cause violence? Does children getting bad role models? How come some kids, and they have bad role models, they turn out great, other kids, turn out, what is all this? There's been much debate about this, but the fix is in. That the neurology has now been verified. There's a set of neurons back here, not just in me. They're called mirror, like looking in a mirror. This is very bizarre because it goes directly to the idea of mirroring, something that we do in NLP. And the mirror neurons are that when you see something, a part of your brain, if it's primate, hi, friendly primate, that's us. If it's another person doing it, we do that on the inside. It's literally like there's a little person in there, and that you do those behaviors. Children make an immediate translation from these neurons, it's right near the hypothalamus, into the long muscle groups. So when kids see other kids doing stuff, there actually is a physical tendency to do it. It is monkey see, monkey do. And so when you ask your teenager, well, if everybody drove off a cliff, would you? They're going, maybe. because one of the learnings that you have through childhood is you learn to inhibit the long muscle groups. That is, you see somebody else do something, like jumping off a high dive or something, and in your brain you're jumping off the high dive, and then you go, no, but you could, and that's why in NLP again, and Erickson saw this long before, when you'd see the micro muscle movements. When people would be, you were doing the stuff and you relaxed people, you told them a story, and you watch people start to do the story a little bit. Yes, well, that's because they're inside imagining it's activating the muscles. Yeah, as I say, the fix is in. So when you're watching television, yes. The brain doesn't know that if you put a black plastic strip around it or fake mahogany, that it's not real. On the other hand, this is why couch potatoes can sit there with the beer and watch the Olympics, and watch somebody go, and they go, I could do that. Because they did in their head. They go, that was easy. Spin it around. So this actually brings up a thing about mental hygiene. In a sense, what do you want to be able to draw on? By the way, this is evidence that mental rehearsal, this is how mental rehearsal works. The idea, I'm sure you're familiar with it, the basketball example is the most famous one, where they had, now people don't realize they had 3 groups. They had one group that did free throws and did every free throw. And they had another group that sat in the bleachers and just watched. And they had another group that did free throws until they had done one really exquisitely. Then they stopped. Now this makes sense if you think about the mirror neurons. As soon as you had an event that was exquisite, then you would stop, then you'd sit down, and of course when you go to rehearse what's there, what have you got? That last exquisite, wonderful example. And so you're rehearsing that example over and over. You're replaying that example as opposed to the person who's actually out there continuing to shoot free throws. Is that they're then getting every one of those, some are on, some are off, and so forth. Whereas the person, when they did the really good performance, stops, rehearses it, they're deepening, the brain is a neural net, they're deepening the attractor circuit, the neurons that are tied together for that particular behavior. Because that's the one they have in mind, and they repeat that and repeat that. Now, the interesting thing is, the people in the stands didn't improve. The people that actually threw the free throws, they improved. And the people that did this kind of systematic practice improved the most. But wait, Charles, you said that if you do it in your head, it's just like you were there and you did it. With this difference. That when you don't engage the connection between the mirror neurons and the long muscles, then that connection is still as rough as it ever was. In other words, athletes, going to the idea of representational systems, have more connections to do a certain sport. So the person who actually makes the connection between the mirror neurons and the long muscles and then rehearses that whole circuit is going to get more result than the person who's merely watching it and seeing, well, can I connect it here? Because they didn't actually do it. And by the way, it works in the other direction. If you take up a musical instrument, and there has to be that physicality, you can't just listen to music. You can listen to music, you can develop your auditory. It'll work. If you take up a musical instrument, I'm holding violin, Steve was telling me about his kids, because his kids have gone to Waldorf schools, and the fix is in. We now know that playing physically, or guitar, whatever it is, playing a musical instrument, the connection between that muscle circuit and the brain literally builds brain cells. It goes in both directions. In other words, the imagining will influence the body, and the body, actually utilizing the body for certain things, can build up more capacity in the mind. The brain is much more plastic than they realize. Now, we knew this in NLP, but I'm sharing this with you because, well, as I was saying to the master trackers, they're going, can we use this stuff covertly? And I'm saying, look, you belong to a field. No, you too belong to a field where if you have the person who's feeling phobic, right? And they go, oh, elevators, and so they see the elevator, they're terrified or whatever it is. And you say, have them step out of the movie, watch the movie over there. So they watch themselves, right? Okay. Run it backwards. And step back in, and what happens? They're not phobic anymore. You belong to a field that if you think you're stepping into an imaginary circle, you get resourceful. Circle of excellence. If you don't tell people you're doing a technique, everything you do is covert. Because it's unbelievable. But what I'm sharing with you is some of the research that's showing not only is it believable, they're figuring out how it works. While that may not make it work better, it often supports you in the idea, yes, do this, and realize the difference things make. So the first difference I want to make this morning is to give you a launching point, a way of stepping from this program to wherever the hell you're going. One of the things we find, you also know about the research on people learning in a context. Learning is context dependent. All right. Again, studies, I don't know where they get the money for these. Somebody's got to let me know. I could use this money. A bunch of medical students, end of term exam, standard end of term, came into their classroom, take the exam. They had been asked, because of an experiment, psychological experiment, to leave an extra 3 hours after the exam. They said, fine, sure, we'll do that. We're game. We're medical We're going to be medical doctors someday. We're going to experiment on people. We understand this. So they came in and took their exam in the morning, went away, had some lunch, came back in the afternoon, and they were escorted over to that auditorium where the basketball experiments were going on. They sat them down in the bleachers and they handed them the same exam. And you know what happened? They scored between 20 and 40% less than they did in the classroom where they learned the material. This is called context dependence. And it's well verified. I'll give you one experiment of many. It's well verified. That means that this room here, given that we've done so many NLP trainings, is the place to do NLP. You just walk in this room and it will happen. The difficulty is that none of you are taking this room with you. But you could in your mind. And I do suggest that you consider that. I also consider that you suggest that you transfer those skills from here to where it is you want them to be. What we call what? Future pacing. Future pacing. It's like imagining yourself doing what you've done here in a context in the future. So what I want to start with this morning is some goal setting. That is to figure out what the hell one of you wants, or each of both of you, whichever. I want those skills to get where you want them to be. You spent all the time and effort and money here. So the idea is, what of these skills do you want where in your life? And to formulate that as a goal. All right? Now, we got some paper back there? We're going to have you do the Longman study. It actually is called the Longman study. The Longman study, often considered apocryphal, actually true, is where they had people from 3 American East Coast universities just after World War II. They got the graduates, they talked to them, they found out which graduates wrote down their goals for life and which ones had not, and they checked up with them after a decade as longitudinal study. The study included Ted Kennedy. If that influences your thinking, so be it. They had the people write down their goals. Now in this case, I'm having you one goal at a time for the purposes of the exercise. It's an interesting thing. What you're doing is you're taking an internal dialogue and you're externalizing it. How many of you, if you're not sure of the spelling of a word, will write it down to see it more clearly? Yeah, well, we're talking about the same thing here, is the idea that you're taking something, a thought, and by writing it down and putting it on the outside, you can see it more clearly. It also dissociates it from you, gives you a different perceptual position, and allows you to interact with it differently. Somewhere on that page, and I do suggest the top, the side, or the bottom, but not the middle. If you do use the middle, you'll find out why I suggested the top, the side, or the bottom in a few minutes. To write down a goal that you have coming out of this training. Now, what do we know about goal setting? We have the 5 conditions, yes? Stated in the positive, that should be the easy one at this point. I want to be able to, or I want to, or I'm going to, okay? And the second condition? Specific. Now, this gets trickier because people will often say something like, I want to utilize all my NLP skills. And I'm going, yes, this is a good idea. The thing is that if you go for all, that's such a generalization, your brain goes, all. You know, make me one with everything. Yeah, and mayo. But you want to specify. Now, there's an interesting way to specify that. Is, especially if you're talking about a state, a practice, a skill, is where do you want it to show up first? What part of the skill do you want to show up first? Remember that thing, the Erickson numbers, first, second, third, fourth? You can make a positive use of that by suggesting to yourself, okay, I'm thinking about going back to wherever it is I'm going to, and it might be my office, it might be my home, it might be my family, it might be my business, it might be my church. Context, right? What specifically of this skill do I want to show up? And here we go to sensory-based. You know, what do you want to see, hear, feel that'll let you know that you're starting to integrate those skills into your everyday life? Now, people say, but I don't want to just start. I'm going, but you do. Because if you're starting, that presupposes it'll keep going. That's the idea of the first, second, third, fourth. So you want to think about something that could be fairly easy for you to do. Something you'd expect yourself to do, but you might not if you don't take this step. You'd expect that you'd build rapport with people when you see them. You'd expect you'd listen for their language, try to find out something about their model of the world. You might expect you'd notice their accessing cues or their voice tone or how they mark out certain words. But then again, if you don't actually do the future pace, you get back there and go, God, what happened that summer? Meanwhile, this room is filled with NLP resources. You know, people walk in the room with their change, you know. So we want to get that to where you're going to be. So writing down now, what is one of your goals? You probably had it since before the course. We're visiting it now because now you've got the skills in yourself. Let's take them to where you want them. So that's the idea, a goal of this course that will be evidence for you that you're beginning to integrate those skills into a specific context of your choosing, which is coming up next week maybe. So, make a note, your words. All right, you got a few words there. Now, if you're writing a lot, and I have no objection to that, what you want to do is pick off a couple of words or a phrase or an image in that whole bit of writing that means that to you. In other words, you want to make it easier for your mind to keep in mind. You know, it's like trying to quote some politicians these days. It's gone. We want a soundbite in this case, but it's your soundbite. You pick it, not somebody else picks it. All right. As you finish that up, and it's just finishing up, making that thought of what it is, this goal, I want to remind you, gentlemen, that the women are smarter than the men in this respect, is that the language part, the broca region, the language generating part of the brain is on one side in guys and a little bit on both sides for the women. This is why they hear tonality, they hear everything. Yeah. Just so you're not too paranoid, okay? Good. It's just an encouragement to develop your acuity, because they have already. What I'm getting at here is that when you write down a goal, you are externalizing an internal dialogue, you're seeing it in a new way, you're interacting with it, you're reading it, and you're only using half your brain. It's a half-brain goal. The other side of the brain, which we take to be the creative part and all, well, really, it's about color, and it's about imagery, and about shape. And so in order to get a full brain engagement, I mean, why not? If you're going to have goals in your life, if you're going to want to future pace this, you want it to be there, you want to have both sides of your brain working, is for you to draw a picture that will in some way represent that goal for you. Now, before you do, let me offer you 2 comments. First, I come from Chicago. We have a museum there. They got these pictures from the Impressionists and Expressionists. This guy Picasso, it's like 3 eyes, 2 noses, They're great pictures to get you over any kind of feeling that you can't draw. I think this was one of his big points. It's like, I can draw, So the idea here is not the accuracy of the image, but that it evokes in you your goal, right? So you could make it an actual picture. In other words, you could see yourself doing something, for example. On the other hand, you could also do something symbolic. You could draw a heart, or you could draw a sun, a tree, or something. In other words, for you, and I'm just those are just my ideas, it's your ideas. When you read your goal, what idea or image comes to mind that if you drew that, which I'm going to suggest you render some kind of an image. Again, you externalize that internal idea to some extent. And even though it won't be exactly like your internal pictures, or maybe if you're a trained artist and you have the eye-hand coordination, it will. That's possible too. But the idea is it doesn't need to be. All it needs to be is enough for you to get that feeling. You go, yeah, this represents my desire in this case. And by means of encouragement, for those of you that aren't quite with the program yet, the wealthiest trader in the world, dollar for dollar, that is to say that he's made more money for people than anyone else. He couldn't draw that well, so instead of drawing his goals, he would cut them out of magazines. He'd go through magazines and cut out pictures and make collages. He's only made maybe 5,000–6,000% on his money, but you can live on it. And again, it's understanding this above and beyond your everyday concerns. The idea of putting stuff out there for your brain to respond to. So that's what you're doing. You're creating something that you want to respond to. Not the media, not some company, not a relative, not even an old tape loop in your head. You can put all that aside and go, what would you like to be responding to more? How would you like these skills called NLP to show up in your life when you really return to it fully and completely? What we want to do is review the outcome well-formedness conditions. You can really tell this field's got jargon, well-formedness conditions. This is from linguistics. It simply means like a well-formed sentence, because a well-formed sentence is going to make sense. So for this sentence, which is directing your attention into the future, of course stated in the positive, initiated and maintained by self. Another way to put that in more ordinary language is you can do something about it. And it's not even that you can do all of it, but that you can, as we would say, keep the ball rolling. That you in some way. Now, this is problematic for some people. They say, well, what if it's about building rapport with somebody? A relationship. Very often we have goals in a relationship, outcomes in a relationship, and they go, well, what if they don't want to build rapport with me? Well, what can I do? No. I'll tell you what. What's this? Well, no, I'll tell you a story about one of my teachers. She, anthropology major, university. She's assigned to work for a professor whom, of course, she has to take. To put it in the simplest language, he hates women. Yeah. And women shouldn't be in universities. They should be back in the home, back in the kitchen. Yeah, right. Her eyes were rolling too. But there she was. Young graduate student. What's she going to do? What she did is the following, is that she was in this office with this guy, and she would just breathe with the same breathing rate he did. While she did her other work, she was secretarial, and he's the important professor, When he spoke to her, she would speak back in the same rhythm, in the same tones of voice. Not in the sense of copying, but if somebody speaks fast, you speak faster. If somebody's slower, you speak slower. Measured words, professorial words, she would do the same. She did this, and a couple of weeks passed. And he turned to her and said, I generally don't like women in the academic professions, but I think it's good that we made an exception in your case. Yes, we are glad about that, aren't we? The idea is that even if that hadn't worked for her, but I share it because that kind of persistence does pay off, is that she was still learning more about building rapport and practicing it, even though the other person wasn't responding. So in other words, her goal of creating rapport was initiated and maintained by her. So she kept that for herself in that instead of going, oh, well, what can you do, It's like Erickson is like, well, what can you do? I wonder what we could do. Of course, this goal then needs to be sensory-based for two reasons. One, as Woody Allen says, you might not think a lot about the world, but it's the only place you can get a good steak. And everything else that we would want. It's also the way that you get feedback loops going. In other words, if something is sensory-based, you can actually notice, am I getting closer or farther away from my outcome? If you don't have ways of sensorily measuring that, you can make up anything you want. But that's not actually going to get you to real goals, real differences in the world. Context specific goes again to the idea of where would you like this to show up first? Where specifically in your life would you like to begin to be practicing these skills, to be appreciating all the time and effort you've spent and noticing the changes in yourself and the people around you? Now, when I came into NLP long ago when dinosaurs roamed the earth, these were the outcome conditions. Now, this was a heyday for NLP. We were flying first class, we were staying in fancy hotels, we were calling our friends and spouses back home, and we were getting divorces and relationships breaking up, and it was realized in all that something was missing. That is that we, being good Americans, had focused on our outcomes, what we wanted, and had neglected, not all of us, but enough that it was noticed, the larger context. We were doing this for a relationship, but honey, now I know I'm on the road 250 days a year, but I'm doing it for you. Yeah, it's really nice here in Hawaii. So the idea of ecology came into the picture. Now, to this day, some people, they like the word ecology or they don't like the word ecology, but they really think of ecology as some sort of constraint on your goals. I have this wonderful goal and now I have to keep other people, I would suggest instead that what you're doing is you're increasing the scope of your situation. You go, okay, if I get this happening in my life, I know the effects, or I believe I know the effects around me, with me. You increase the scope, that is, you increase your picture, and you go, so how's this going to affect my friends, my coworker, my family? And if you need to, you utilize that information to refine your outcome. This is not the case of having to put it aside because of ecology, but with ecology it gets richer. I'm reminded of my colleague Gary Schmidt that what he decided is that certain times of the year his family would travel with him. And he would go and stay longer and make it a vacation, and he'd work for a few days in the city, and then his family, he and his teenagers, they'd go, and his wife, and they'd go out and see the city and do things like that. Well, was this more expensive? Yes. Did it make a better quality of life? Certainly. Because then they got a sense of what he was doing. They joined him in his life. They got to see new places. It's a very simple example, but it's the idea he discovered by that he actually had better outcomes than he had before. And there's also the willingness not only to look at the upsides, but to look at the downsides. That is, what happens when you get so busy and you're so in demand that you don't have time to eat or do your laundry or anything else? People do this in life without thinking about it. This is one of these strange things about our society, is that people choose careers without ever having stepped into the picture. A colleague of mine is a lawyer, and she says, I love the law, but I didn't realize that being a lawyer meant people yelling at you on the phone 70% of the time. People are always calling, because that's what you're supposed to do with lawyers, I guess, So there's that. There's about stepping into the picture. There's life before the goal, and there's life when you get the goal. So one of the ways I'm suggesting here of testing for ecology is that you step into that future. And as much as possible, take a moment or two or three and live it like the lawyer. And if you don't have rich enough representations, what do?
Change your goals.
No, you don't change your goals. You go out and get them. In other words, if you want to know about being a lawyer, if you want to know about setting up a consulting business, if you want to know about what it means to go back to college as an adult, if you want to know about married life, go buy these people a drink, take them for coffee, get a permission to show up at their office, and build a richer representation of what that will be like. Because you may find that you love the law, but you don't want to practice that kind of law. You want to do something else. You may find that you really like consulting, and you don't want to be the marketing person. These are good things to find out. There are many, many people in the world that want to do these other jobs. Let them. You go for the ones that you want to. And so in that sense, the ecology, both the idea of the expanding the scope, so there's yourself and you expand the scope in terms of the people, you can also expand the scope in terms of time. And you're looking at the positives, and you also look at the negatives so that you can come back and enrich that possibility. I'll give you an example from my experience, because I know it better than other people's, is that at the point that I went into consulting in the trading business, apparently it got the attention of some people, because some people that previously took little ads, they took little ads. After that, when I showed up, they were taking full-page ads. I realized the cost of those ads. I decided at that point that I was not going to advertise. I went in a complete direction. I said it's completely word of mouth. I did conferences, and I did word of mouth. And my income went up. And I wasn't marketing. Now, that seems contrary, but I had already decided that what did I want to do? Did I want to spend my time marketing myself, or did I want to spend my time doing the work? Now, you make your own choices, but my point in the example is that when I checked the ecology of that, and I found out that most consultants spent 75% of their time marketing themselves, I went, no, that's not what I want to do. If I want to be a marketing person, I want to go into marketing. I decided I wanted to do it differently, and that caused me to revise how I went for my outcome, how I went for my goal, which turned out, and I did not know this at the time, I knew my experience would be better, but it actually turned out to be more beneficial than I thought it was going to be. This is the Joseph Campbell thing about following your bliss. You got to figure out what your bliss is and how you want it to show up, and realize that this is just one step. And when you realize that, it becomes a process you can keep revising as you discover more. All right? The first exercise this morning is that I want you to, each of you, with two others, get together and test for this, because you're still learning to do it. See, we do this really easily in everyday life. You go to lunch, you go, yes, I want lunch. I'm ordering lunch, or I'm telling somebody what to order and they're bringing it back. I will know whether it's fresh or, what I wanted or not, and I'm going to eat it in this reality. There's these considerations. Ecology, you go, well, if I have a big mass of French fried potatoes, I might not be awake this afternoon for this really cool exercise. Maybe I won't do that. When it's already in experience, people do this very easily, do it naturally. Where it gets screwy, and why we can actually get away with teaching it, is because when you step off of the everyday, when you start talking about things like success or career or rich, fulfilling relationships, those nominalizations begin to float. And people say, well, I really want a relationship, or I really want to make a difference. Well, how do you want to make a difference? I don't know. But they want to make a difference, and so the person's going around, am I making a difference? Am I making a difference? Example. In Chicago, and again, example because it works, we had a study group where we got together after we finished our practitioner training every Saturday at this psychiatrist's house. Didn't have to be a psychiatrist, but he was. We would practice different skills. Practitioner in the master track. And one of the people there, professor at a local university, and she was feeling very, very good about being a grandmother. This little daughter, her daughter was learning Spanish, her granddaughter was learning Spanish, English, and every time the little granddaughter learned a new word, she was thrilled. Sensory based. On the other hand, she felt badly about how her NLP training had not turned into a book. She had this idea that she wanted to make a difference with the NLP. The way to do that, she thought, was to write a book, but she was too busy with the family, too busy with the classes. If you know anything about universities, lots of meetings, and so she didn't feel any fulfillment there. Well, my colleague Klaus and I, we look at her and we go, how's that possible? We said, how many students do you teach in a term? It was hundreds. And how many of the students do you teach NLP to? It was a little under 100. So each quarter of the year, you have all these people whose lives you've touched, who are now thinking about their lives differently, are setting goals differently, are approaching relationships differently. How can you think you're not having an effect in the world? Well, at that point, she realized she did have an effect in the world. And I bring up that example because she had a goal, and she thought she was maintaining it herself, but she forgot to have it context-specific and sensory-based. And when she saw those examples, then she could feel, and does feel now, fulfilled about those very positive and very important efforts she makes every term with those students. So that's really what we're up to here. It's not that people don't have big goals, it's how to make sure they make their way into the world. That's why that's so important. And that's why the ecology is so important as well. Into groups of 3, this is going to take maybe 15 minutes, not very long. What you're going to do is a show and tell. You're going to show the person your picture and you're going to describe your goal. What are you going to do in the group? The first thing you do is appreciate. So, if we had the good picture, I may borrow a picture. We go picture, and you look and you go, ooh. All right? And then the person tells you about it, and you go, ah. Yeah. With sincerity.
Of course.
All right. Then you're going to, with rapport, and we will be watching, you are going to ask the person, you're going to listen to the goal, listen, is it stated in the positive? You might ask them, so what can you do about achieving this goal? Again, voice tone counts. What can you do about achieving this goal? No. What are you going to be doing to achieve this goal? When you're listening, do they have stuff? You'll ask about, is it sensory based? Or maybe you use real language and go, so what will you see, what will you hear, what you feel when you achieve this goal, or when you achieve this first step? And ask about, and where will you be, and who will be there? And help enrich their images, right? Because that's the other thing you're doing, submodalities. You're helping them to vivify that picture because that's going to make it more directional for them. And then you're going to do what? You're going to say, wow, that sounds wonderful. Are there any downsides? No downsides. Well, wait a minute here. What will this do about your time? Will you have the same free time? What about your friends? What about your family? How will this change your life over the next year or so? In other words, ask about ecology. And if they begin to go, then you can go, well, how could you make that goal even better by incorporating that? Yeah? Okay. Look around, find yourself a couple of partners, and let's do it. I would suggest that the more important the goal, the more important the outcome, the more you check the well-formedness conditions. And the reasoning, again, is that the more important it is, the more likely it is to be abstract. The more likely it is that you're going to want it to pertain to a large amount of time. And therefore, the less likely it is that you're going to be thinking about specifically where it might show up, or specifically about the consequences. You know, those of you that have done, whether psychotherapy or coaching or just wanted to help a friend, know that very often people will take whatever it is and they'll take their negative and phrase it in the positive. They'll go, well, you know, I don't want to be alone anymore. And they go, okay, what do you want? Well, I want to be in a relationship. And so it's a sense of opposite as opposed to what it is they would really like. You go on to Master Practitioner, you're going to discover something called meta programs. You're going to realize that it's deeply rehearsed in the person's experience to state what they don't want. And if it is, that's what they'll do. They're a lot of fun. You say, well, what do you want? Well, I don't want this, and I don't want that, and I don't want that, and I don't want that. And I don't want this, and I don't want this, and I don't want this. What do you want? And they'll actually say, well, I know I don't want. John Grinder's strategy. Hey, Didu, what do you want? What if it came up and bit you on the ass? You kind of do like that, just to get them going. But an alternative to that is to pace and lead. So you don't want this, and you don't want this, and you don't want this, and you don't want that, and you don't want that. And if you didn't get all those, what would you want to be getting? Sometimes you need to do a little of that. Again, people are going to go global, and this is where you can do that magic thing. You can say, okay, well, what would be the first step? What would let you know you were on the path, that you were on your way? Because, of course, that's a feedback loop. You can get that to be sensory-based in terms of a well-formed outcome. This also can be taught to have huge life-changing, society-changing goals. And still, what's going to show up in the world that's going to be steps on the way to that? Having done that, we have a very simple model in NLP, which is about that gap. The gap between where we are now and where we want to be. And of course, being a field with jargon, we have to have words for it called present state, desired state. It's in that gap that we get curious. You ask the person in question. Now, the way it's taught in the book is to ask, most of the books as a matter of fact, what stops you? You're at a point in your training that I want you to hear that if I ask you, what elephant? What do? Momentarily, you've got to think of it if you understand it. If you don't understand it, if it's from some other language, wakarimasu ka? Hai, wakarimasu. Osh.
Sure.
Well, now the thing is, if you didn't understand what I said, you'd grab the tonality, da-da-da-da-da, and it's probably a question. And you'd grab the context. In other words, we're always trying to make meaning. So if I ask you, you've got this goal, you're here, you've got this goal, what stops you? What are you going to momentarily imagine? Yeah, even if there's nothing stopping you, you can come up with something.
Right.
This could be called you're creating difficulties for the client. You don't need to. So I have a couple other proposals here, because we're getting to the integration. One of those proposals goes to the idea, do you know how you got here? The answer is yes, by the way. Do you know how you got here specifically this morning? Do you know how you happen to be in this training this summer of your life? And you could describe, relative to the amount of time and detail requested, what that is. You'd say, well, I heard about this NLP stuff, and, I read a book, I saw a tape, people said this is the training to go to. You can tell me that path you took. Right up to the present. And then it gets a little spotty for some people. And then there's going home, and then there's going back to work, and then there's and so forth. But if you look back, it's a very complete path. So one of the ways to fill in this gap is to go back out to that future. And instead of trying it on, well, you are trying it on, and you're feeling it, and you get into it, and go, yeah, that's where I'm going to be. And when you're in that state, look back and see how you got here. Because the brain is a tricky thing. It will fill in those steps for you. Or a number of them anyway. Because we're very good at looking back on things and seeing how we got somewhere. It's that looking forward thing that throws us off from time to time. And then what you can do is step out, and you can re-walk those steps back to where you are now, and step back in, and turn and see those steps leading to that future. And you can see what would be the first step now that would let you know you're on that path of those steps. Now, for those of you interested in language patterns and so forth, there's a number of behavioral presuppositions here as well. By going out and looking back as if it's already happened, because you do the same thing, you look back on your past, it's happened, you're in a sense saying to your brain, it's happened. But then you come over here and go, it hasn't happened. Well, it's happened, but it hasn't happened. Yeah, like a lot of experience, right? Like a number of you are going to go to DIA, the airport, and you've been there before, and now you're going to go back. And even if last time was the first time, this time it's more familiar. So it's easier to navigate. Just like when you first were learning to drive a car, at least for most of you, it was complicated and other things to do. Now you get in a different vehicle, and you go, oh yeah, that's familiar. So the idea is by doing this, you're making this future already familiar, which makes it easier to do. Yeah. How about that? So, can you guess what the next exercise is? Now, why are we chunking it this way? Because you want to make sure the outcome's well formed before you start laying these kind of tracks. If the person goes, do you want, what do you want to change? I want to change everything! And they go out there and I've changed everything! And they look back and they go, but I didn't, this is whereas if you say, well, what I want to do is go in and really apply this anchoring stuff. Because that, I know if I do that, the other stuff will come. And so I've got this place in my future, and I'm utilizing the anchors. People are responding, and I'm noticing the feedback, and you go out and you go, yeah, I'm doing that. And how did I get there? Oh yeah, I took that course, and and at the airport, actually, I saw this, but I built rapport, and I matched their anchor, and other things begin to fill in. Oh, and I told people about it, and I showed them, and when I showed them things, whatever fills in for you. And there'll be some gaps, but now there's smaller gaps, all right? And you step out, and you walk back, step back in the present moment, and then see, okay, what's going to let me know that I'm on the way? Whichever foot you like to go, okay? Yeah. Getting off on the right foot, yeah? Okay. So, you set this up with your partner, you got the present state, have them look to where the goal is. All right, so now I have to tell the NASA story, going to the moon. Oh, so long ago.
I'll remember that.
Yeah, just after dinosaurs roamed the earth, we went to the moon. Yeah. Well, the deal about going to the moon that we want to focus on is this, is they were where they were supposed to be. We're talking about they're leaving the earth. And they're going to this object going at high speed called the moon. You want to get there, right? And they are where they're supposed to be how much of the time?
They are where they're supposed to be.
They are where they are supposed to be.
70%. Every month.
They are where they're supposed to be 3% of the time. 97% of the time, they're a little off or a lot off from where they're supposed to be. There's a lesson in this. The idea of going for a goal is the idea that you've got a direction, not that you're exactly where you're supposed to be. The idea is, do you have direction? Do you have trajectory? In other words, you're on the way to the goal and you get a little off track, and you get a little, and the point is that you bring yourself back on track. At least that's the point I'm taking from that story at this point. Is that we humans do this funny thing where we think if we're not right where we're supposed to be, then we're in the wrong place. Now, pulling a souffle out of the oven, yes, you better be there on the moment. But there's a whole lot of other things in life where there's a lot more play. And in fact, being off course can let you know to be on course. You ever been driving down a road and you just kind of get tired and you daydream and then you hit a speed bump? Wakes you right up. In a sense, when we get off course, when the world catches it, in some sense, for a few of us, it reminds us to pay attention. So you want to be careful about how you're evaluating your journey on the way. Remember, you can get to the moon and back and not be in the right place at the right time as long as you're going in the right direction and you're making course corrections. Yeah, it's a pretty significant learning, and I don't know that the metaphor does it, but it's a beginning. I'll also tell you this, that most of you will not get the goal that you made the picture of. Well, I probably shouldn't have told you that.
3% probably will get.
No, not about that, Amal. What I'm talking about is that what happens is on the way to the goal, you have additional learnings. You have additional experiences. You don't think about it, but you start to revise that goal. Maybe it gets better. You know, it's the idea that the goals are a way of directing your attention. Keep in mind that if some of these people in Silicon Valley had gotten exactly what they wanted, they'd be running a $100 million company. If you know what the public offering for Google is, then you get the idea how much bigger it can be. That's only a monetary example. It's the same kind of thing. It's like you're going along in life and you think you're developing this skill, and then you realize, wow, this applies to interacting with my family. Or, wow, I'm thinking in a new way that I didn't even know to anticipate. And so your goals revise and they get richer. And that's the way it ought to be, because it's dynamic. The other thing I want to point out about these steps along the way comes again from my experience in the finance area, is that I worked with guys and gal. That's what we say, ladies. We'd say gentlemen and lady. Typical finance seminar. And the colleague and I had a plan. What we were going to do is do a seminar on how to make lots of money. Only then we were going to covertly teach relationship strategies. And then we were going to do a relationship seminar and then covertly teach finance strategies. We thought this is... Because people tend to want to go for what they know to develop, rather than developing something completely different. We'll be getting to that. The thing about that I noticed about the people who were in the finance, who were young traders, going for the gold, going for the $1 million, is they would make that the measure. By that, they would end up whipping themselves and forcing themselves and very often burning themselves out because they didn't see that some of those places along the path could be rewards. Those could be milestones, if you will. Markers. We have, for those not from this country, we have markers that let you know the mile you pass, a kilometer, perhaps in your country. There's things along the way. So in the trading business, learning to run the computer, learning the process of placing orders, mastering your technique. I mean, there's ways you can go, yeah, I did that. And in the same way, on the way to your goal, that first thing you're doing today, yeah, you're doing something. Feel good about that. And there are other places where you can go, yeah, I've got this piece of it, or I've got a handle on this. And so you reward yourself, and it becomes easier. The idea when we set goals is not to set one big goal. You want to set near-term goals, because this encourages a person to continue to set goals. You want to set some medium-term goals, because then there's different levels of reward. It keeps you going.
Like you have a long-term goal, very big, chunk it smaller, and get the...
Find some natural milestones or some natural, I hate the word mini goal. It's not a word. But find some places along the way where you've actually got a bit of it. You're like, I got that part. So what we've done here is we set up a present state and desired state space. The explorer went into the desired state, experienced it fully, looked back either in the mind's eye or physically in the mind's eye, because of course there's nothing there, it's all in the mind's eye, found how they'd gotten from the desired state to the present state. The explorer then dissociated, that is, became an observer on the experience, and viewed that path, saw those steps. Explorer steps into the first step, what's going to make a difference, get them on the path, determines that first step to be completed today. You could also see this as an elaborate form of future pacing. Future pacing is you see yourself doing something. You see yourself doing a lot of some things here. So the next thing, in terms of Diltz's idea that we have a present state, we have a desired state, and to get from one to the other, you want resources. Now, I haven't written the word in there till now because most people think of resources as states. That you want a state of go for it, a state of curiosity, a state of confidence, a state of excitement. You want to be in a state of competence in your skill and bring all that skill to it. That is correct. And I would suggest that the ability to look back and have those steps appear is also a resource. It just doesn't have the flair of the resource state, but it is part of programming your brain, organizing yourself to get where you want to go in life. So now we do want to go to that more traditional meaning of resources. That is, and here's the question I would suggest you ask, what's between your present state and your desired state? As in, not what stops you. What's between? Now, right now, what's between is all these steps, yeah? Now, some of those steps you might not know something about, you might want more resources in those steps, and some of those steps might actually be something that stops you, yeah? We're not going to that yet. Is this another easy thing to do? What are we doing? Doing a variation on a circle of excellence, on placing an anchor. Bless you, and you too. Because we are people, creatures, with all the resources we need. But I'm unhappy with the word need. We're with all the resources we could need or want, and very often more than we can imagine. Because you think back on certain moments when something incredible happened and you had some feeling or some insight or ability, and it's still there. And we know from the mirror neuron ideas now, we know from our experience in NLP, if you go back to that moment and vivify it, then your neurology has it, and then you can take that around and bring that into the moment or moments where you want it to be there. Now, what are you doing? You're taking the V and the A, the visual and auditory of this steps, and you're bringing this new K in, and you're making new experiences that you're going to be having. But you already had them. So it's going to be easier to have them. Aren't we clever creatures? All right. So this exercise, you've just seen it, is with your partners again, is that you set it up. Now they've got steps from here to there. And then you can say, well, what's between here and there? And they might say, well, a lot of steps. They're going to, in other words, going to have some reaction. And then you're going to say, so what resource, what emotional state, what idea, what kind of skills, if you had them present here, would make this so much easier, so much more enjoyable? And if they pick something like discipline, then you want to go, okay, discipline. Well, let me ask you, is what will this, the discipline, being able, what will that do for you? Right? You want to get to, remember the idea of chunking up. What's important about discipline? What will discipline do for you? You were looking for something bigger. Because they're going to want to do it the way they've done it. And you're there to offer something new and different. That's the whole idea of this interaction, the explorer and the guide. So if they want, I want confidence. And well, what's confidence going to do? It's going to make me feel it's possible. He says, when was a time in your life? Because if you got yourself here, you've had experiences in your life where nothing could stop you. It's like you saw something and you just went for it. What if that experience were present here? Or what if it were, as you were saying, humor, pixiness, playfulness? It's a different way of understanding a resource. Instead of like, well, I need more discipline. And I'm thinking, yeah, that would probably work. And what's going to make it easier? What's going to make it more enjoyable? What's going to make it a delight to interact with this? And you talk and you have the voice tone, right? Because the voice tone carries. So you're talking to the person too, and you look at them and you go, "Oh, I bet you know how to make good trouble." Yeah. And he goes, "Yeah, I do. I had a few of those experiences." Okay, be a little ecological, What would be appropriate? That playfulness, because you can always take the state, the curiosity. What's around the next corner? When you've got that, have the person go back, get the state. Of course, you're calibrating, two in your group. They glow a little bit. You go, good. You go, now take that with you. Step off, come around, and put that right into the moment on that path, on those steps where you want it. And if they look at you like, "Hey, wouldn't have more steps?" Then you say, okay, now that it's there fully and completely, go ahead and carry it forward, noticing how it makes your journey so much easier, more delightful, and worthwhile. Or words to that effect. The question there is about how a specific kind of goal can actually get you in trouble. Right? And this is where, what is the purpose of that goal? This goes to the other dimension, if you will. The idea that we've been talking about the future out here, we indicating the past. We've had people step out into an observer position. The thing is that people do this kind of thing all the time anyway, right? Well, think about it. I mean, people, they'll project, "Oh, I wonder what I'll have for lunch," go into the future. People will go, "Oh, yeah, that restaurant like that was really good." Even for lunch, they're flipping around in time. They're in the experience, or they're watching the experience from the outside, going, "Oh, and then stepping back in, or somebody trips, and they get that person's feelings. And people don't realize they're doing all these changes so quickly, and that they add up to what we call strategies. One of the ways I've seen, by physicalizing it, getting a person to experience those differences. The mat, we have the Trimurti mat here, is another effort at creating a physicalization. The idea that when you've done this, the person goes, "Okay, well, here's where you're in your own body, and here's where you go back to the past, and here's where you're planning for that future, and you go into that future." For many people, it's very useful to sort that out. If the person has a kinesthetic leaning, then doing the timeline work, doing the walking we were doing this morning is very useful. And I'm sure a number of you noted that Judy did less walking, although she certainly looks capable. She did it in her mind's eye, her mind's ear, her mind's body. You can do that as well. In fact, it used to be with NLP that we taught it all by sitting down. That people would do these things. It's just when we physicalized them and brought them out like this, it became easier for people to understand and appreciate. We've got the dimension of time. We got the dimension of other people and observer. You're talking about the next dimension here. And the next dimension up is about importance. What's important about making $1 million? The idea that people can become too attached to a particular outcome and forget that those outcomes are only there because they represent the fulfillment of certain criteria. What's important about $1 million? I'll have you be him for a moment. We'll just play a
Well, from what
role
I
play.
know of him, I think it's just something little.
What's his name? Give me a name. Doesn't matter.
All right. Kieran. His name's Kieran.
Kieran, what's important about being a millionaire?
I think for him it was just he just made a thing in his mind of having $1 million, period. I mean, that was success to him, I think.
All right. And what is it that makes $1 million success?
From what I know of this guy?
Sure.
I think he can retire or something, I think is what he thinks.
Okay, and what's important about retiring? Being able to retire when you want?
Maybe doing what you want.
So what's important is being able to do what you want. Is this familiar? Mm-hmm. Yeah, is it the Virginia Satir example? Mm-hmm. You know that one where the young daughter is being brought in to Virginia? The father is dragging her in. The daughter is got the earrings and the clothes, and you kind of wonder if there's a tattoo under the shirt kind of thing. And it's, it says, well, what's going on here? And it says, I want her to mind. And of course, you can see this daughter, she's not going to mind. And so Satir, building rapport, goes, well, what's important about her minding? Well, she'll know the right thing to do. The daughter's going, Satir continues, what's important about knowing the right things to do? Well, you'll get on in the world better. Oh, so you want her to get on in the world better? Well, yeah, I'm her dad. And what's important about her getting on in the world better? Well, I want her to have a good life. Daughter's starting to look now, Goes the next one, and why would you care if she has a good life or not? Dad tears up. Because I love her. This is about this is a very important skill set here. That's the other side of the goal setting. Because goal setting is being very specific and getting sensory based and getting into behavior. You also want the flexibility to go, well, why bother to go for that desired state? Because it has attached to it, stated or not, certain values that this person you're talking about holds dear, that other people hold dear. It's the fulfillment of those criteria, those values, we use those words interchangeably, that the person experiences when they get the goal. And also, they don't experience if they don't get the goal.
Yeah, because he seems always disappointed that he never, he didn't take in all the other things into consideration when he was 16, but he still has that, and every time he thinks about it, he gets disappointed.
Mm-hmm. And yeah, I understand. And I, this is a rumor. This is secondhand information I'm getting. So it would be, it's certainly, long distance, coaching here if I were to suggest anything. I would say, though, that it's about what I said earlier about goals help us set directions. They get us moving in life in a certain direction. And with that direction, we encounter experience. And then, if we're awake and alive, we can revise our goals based on new information. Or as I've often noted, that what were your goals when you were 5 years old? And did they change by the time you were 15? We'd imagine a few of them changed, and even more of them changed by the time you were 25. Those changes are personal or social. At 15, it was like the opposite sex, which was either ew or huh. At 25, a different relationship. At 35, you might be concerned about raising your own children and how they're going to deal with that transition. And so we are presented with all these opportunities to apply ourselves and make a difference and experience incredible things. And that, to me, is what goals help us to do, closer to our heart's desire. For some people, it's a fast boat. For some people, it's a ticker tape and having a lot of other people ask them their opinions. For other people, it's being able to go for a walk in the woods when they want. Having said that kind of thing, the next step is to get the person to appreciate that all these efforts that you just made, that you set up the spaces again, you ask what's between you and your desired state, and that answer you utilize to select a resource state, had the person go back and get that resource state, bring it around to that future and put it where they want it, and then spread it to other future moments as desired, that all of that effort is actually in service of these criteria.
And finally, the man himself, one of the most interesting and inspirational people that I have ever met. Please enjoy, on this show, many times, repeated many times, Ed Secoda. I was trying to think of an example just as we were getting on the call here, and I was thinking, and I'm not trying to pick on a particular bank or anything necessarily, but a few years ago, I read something that JP Morgan had made money every day in the first quarter of the year. And I was thinking, wow, is that a great example of the Gavopoly system in action? Would be one question to you. The second part of that question, though, would be, is that if there doesn't seem to be much outrage right now, and I'm wondering if the outrage, the lack of outrage, is reflected in the fact that so many average everyday people via mutual funds and perhaps pensions actually have investments in these many Gavopoly type companies. It just seems like it's a precarious situation.
Yeah, I don't want to comment on any particular banks, and I'm not sure exactly in what section you're talking about. But it's everywhere you look, everywhere there's a regulation, and there's a Gavopoly system at work, and the outrage, as you say, the outrage doesn't really occur because as the system grows, more and more people have an investment in it, and as you stop competition within a economy, the whole economy itself becomes less competitive. And we're certainly seeing that show up in our relationships with other countries, where particularly China and other countries, India and so forth, we're not competitive. The whole economy, our economy is not competitive because we don't allow ourselves to compete with one another anymore. And so we're not competitive with other countries.
I think to add to that point on the other countries, I see it being in Asia right now. It seems like that in Asia, you can build an 80-story office tower faster than sometimes perhaps you can install a fence in America.
Yeah. Yeah, that's right. Trying to do anything in the United States requires enormous amount of regulatory effort, and the companies have to maintain whole staffs just to comply with regulations, and all of that has got to get paid for somewhere. So they've got to eventually get to raise prices, and we're not competitive. So it's and I'm not saying any of this is bad or wrong or should be changed. In my book, I don't say that there's anything wrong. I'm just looking at how does the engine work. How does this work, and how do we explain what we've got? And I'm not trying to change anything. I'm just saying, well, this is how it works, and I need to know how it works because, as your audience does, and so do I, we try to trade, and we want to understand as best we can what's going on. So my point is not to change anything. I'm not a politician, and I'm not running for office or anything. I'm not promising any changes, or I don't have any formula for change. I'm saying this is what's happening, and you might as well take this into your personal calculus when you're playing the markets.
Well, you make a great point because you're talking to a guy that unfortunately grew up in the Washington D.C. area, so I had to listen to too much politics. And I think there's a great video on the internet with Ray Dalio talking about the economic machine. And I think you're doing something similar, but it's your take, your research, and you're saying, hey, look, this is the machine that I see. This is the economy as I see it. And I'm not trying to give you a value judgment on it, but by all known facts and my research, the evidence lays out, this is what's happening.
Yeah, and Dalio has a wonderful video out there, and he's talking about how the economy works. Basically, his analysis, the supposition he has, we have a free economy, and those kinds of things work in a free economy. But since 1913, when we had the Fed, you'll see the free economy isn't really free to function anymore. And if you look at long-term charts up till 1913, before 1913, when we had the Fed, we had a fairly stable economy. We had blips, ups and downs, and so forth. But since the Fed's come along, it's enabled the Gavopoly system to put an effective tax rate on citizens and spend money in excess of what they can tax. There used to be a limit to government growth in the Gavopoly system. That limit was that they would have to tax people in order to fund the government. But they don't have to do that anymore. They can go to the Fed and they can get however the mechanism works, however you want to explain the mechanism. You can say they can print up money or get a line of credit or whatever. Basically, they can spend money before they tax. I've shown in my model if you keep government spending to under about 1.5% effective asset tax, so under 1.5%, government never can grow big enough to stop the growth of the free competition sector. But once you get an effective tax rate above that, then the government will grow, and it's like it's a parasite. It's the same mathematics of a parasite, where the parasite will grow and then finally it will take over the host, or like a cancer or a parasite. The mathematics and the dynamics are the same. It stays in balance. if you keep the asset tax rate under about 1.5%, but we're way over that now. And we are seeing a decline in manufacturing and in tool making, and we're consuming, or the Gavopoly system is now consuming the free competition sector. And when we run out of a free competition sector, which is imminent in my opinion, then we have a whole different economy where you have the Gavopoly system trying to manage the free competition sector, and it can't do that. It doesn't know how to do that. It's not set up to do that. It's set up to take and exploit. It's not set up to create and innovate. And so we're headed towards an economy in which we have basically a controlled economy, less freedom. I'm not suggesting this is going to change. I'm suggesting you've got to start admitting that's what's happening, and you got to cope with it. You have to cope with it in your decision making, and there are ways to cope with it. Wishing it'll come back and thinking you can vote for somebody that's going to turn it around, I think, is wishful thinking.
Let me take a step back, Ed. I want to kind of take a step back for a second, let you talk a little bit about some historical perspectives, your own in particular. And one of the things that I've always loved about you, and we're going to get back on the Gavopoly conversation and kind of take it to its natural ending and some of the solutions that you see, since if we're being faced with this Gavopoly situation, you do see some clear solutions, or at least some directions that people can go. There's no perfection for sure, but I think one of the things
I don't think there's a solution for the economy. I don't think there's a problem. This is just what it does. I think there are some things that people can do as individuals to cope with it as it evolves and changes, but I'm certainly not suggesting a change in the economy. I think this is just what it does. There's nothing to fix. This is what it does. Just like people, they get born, they grow, they mature, and then they die. That's the way it happens. And so you just have to learn to cope with things.
Well, you just made my point for where I wanted to go, which is, and correcting me on language. One of the things that I've always learned from you and admired from you is the clear thinking. And I always, when I try to respond to people, if I'm doing an interview or something in an online forum, I try to stay clear. I try to be as objective as I can. You are exceptionally good at this, and especially when people look at your writings, they can see it's very, very clear. How did you start to have this type of clear thinking as an individual, or was this something that you felt always as a young man and it's been with you your whole life? How did you develop this way to look at the world clearly?
Well, thank you. It's a struggle for me. I'm thinking about it a lot, and I always think, wow, I could have said that. I could have said that better. I'll probably hear this interview and I'll say, oh man, that's pretty lame. I do a lot of writing and rewriting, and I've always done that. And I try to think about something until it gets simple. And if it's complicated, I figure, well, I don't understand it yet. So one of the things I do is I just think about things till they get simple. And then they're easy to explain, and then they're pretty clear. And I've had some mentors in my life that have been sticklers. Jay Forrester, for one, absolutely unforgiving about any misuse of English or anything. Any equations, they ought to be annotated, and the units of measure had to match, and you just couldn't get away with anything. And so I developed that. I just developed that habit. I've developed this to such an extent that I have a language that goes with it, SVOP, which subject, verb, object, keep it in the present tense. That's a way that helps sort it out. If I find myself straying from that grammatical convention, I figure I don't understand something. Anything that's clear fits into that linguistic format. So I'm on this, and I enjoy it. It's just I probably take it to extreme. It's not. it's not a good strategy socially. Socially, people are very metaphoric, and they're very inaccurate, and they just say what they feel, and you've got to decipher their feelings and so forth. So I don't recommend this as a social method, but as far as thinking and trying to get logical answers, it's pretty good.
I was wondering maybe if you would go a little bit further on Jay Forrester. And for those that don't know, very well-known MIT professor, systems dynamics. And I think Jay is still with us. He's like 96, I think. Yeah.
Yeah. And prior to publishing my book, I went and visited with him, and I included him, some things on him in the book. Amazing person. He, at one point, held a patent on the core memory for computers, enabling some of the first of the world in computer. He was behind that. He was inventor of the radar positioning system, which was a servo control mechanism. And then he went on and applied servo control thinking to business situations and developed a modeling language, invented the whole field of system dynamics. To really understand how systems work, I think requires a lot of training. I think it's imperative to have some kind of an engineering background, preferably electrical engineering, preferably servo dynamics, to understand how systems work. So there's a whole field, and he pioneered it, and he's just this is an amazing guy.
I was actually, I'm working on a project right now, and I was reading a couple of his white papers recently, and it's, I can see how he influenced you on the clear thinking, because his white papers are just crystal clear. It's fun to read them because it's just there's no beating around the bush. It's all just direct. And it's understandable too. It's not an academic treatise. It's something that you can sit down and start to digest.
He would go to conferences on economics, and there would be a panel, and then they would have comments, and he would point out that a certain speaker in his speech had contradicted himself several times. And he would listen. He would really listen to what people say, and he would think about it. And then if it wasn't accurate, he wasn't shy about saying so.
No, like I said, I think for the audience out there not familiar, checking out your Trading Tribe website at edsakota.com, they could definitely get an understanding of, if they're not familiar with what you and I are talking about right now, they will definitely start to understand how you handle your FAQs, your frequently asked questions. But that's a completely different subject. Let me
go ahead. On the topic of getting things exactly right, I want to point out that's Sakota.com, not edsakota.com, SEYKOTA.com. Ed Sakota goes somewhere else. Yeah, and so do I, but the website is Sakota.com.
Ed, let me get back into the notion of Gavopoly for a second. So we've got this system that's operating, and as you kind of say, it's doing as it should. You are observing and you're describing it, but it's not a pretty conclusion to when the 39th day and the duckweed races across the pond. It's not a pretty conclusion, but I think what's tough when you look at the media and the political systems, everybody has a fix. If you vote for me, I can fix it. I've got this platform. The media says if we do this, we can fix it. If we watch this TV show, if we get upset about this issue, and I'm just as guilty as some people to get upset about things, but it's all seems to be one big dog and pony show. But if we get back to your modeling of the Gavopoly system, the dog and pony show just distracts us, but the system marches on.
Well, the dog and pony show is part of the system. The dog and pony show is purposefully orchestrated to distract people from the real issues. Nobody talks about the real engine behind this is the growth of the Gavopoly system and the fact that it has unlimited access to money. In my model, I've even tried to, even if you eliminate borrowing for the government and you reduce regulations, at this point it would take 20 or 30 years of austerity to get any meaningful change, to get us back to a free competition society. You're not going to get anybody elected on a 30-year austerity program in which the government decides that they're not going to borrow money anymore. That's just not going to happen. So nobody's even talking about this, or nobody's even interested in it. The real issue about how the economy works and how debt works and how deficit spending works and bailouts and all the rest of that. Those are just kind of accepted, and no one is concerned about it. What they're concerned about is there's a race riot, or there's police, or someone thinks the police are being too brutal, or one race group is beating up on another race group, or there's people coming across the border or not coming across the border. So we're talking about fixing things that are all symptoms, but nobody. There's a couple politicians. I don't care to name any of them, but there's a couple of them that try to talk about the real issues. They always get marginalized, and they don't even make the final cut in the political race. And what you have is the distinction between political parties is fairly obscure at this point. They're all voting for expansion of the duopoly system. They want to make this. The system is now in its final phases where it's taking over. There's no way to resist it. There's no way to stop it. I don't recommend spending a lot of time worrying about it. It's like a patient, or if you had a friend that was dying of terminal cancer, well, what do? You try to make the best of the time you have, but you don't spend a lot of time trying to fix it. There's nothing to fix. Or someone is just dying. There's nothing to fix. We're making a transition, or a caterpillar turns into a butterfly and is a change in form. There's nothing to fix. It's how it works. You don't have to use death metaphors, just a transformation metaphor. The economy is transforming from what used to be a free competition, innovative society. It's now transforming into a very controlled society. This is a transition. It's natural. It happens time and time again to all societies. There's a cycle. It goes back and forth, and there's the duopoly system grows until it finally renders the host society inoperable, and then it collapses, and then it starts over again. This is a long-term cycle. You don't find any currencies around that are more than a couple hundred years old. And if you had invested one penny at the birth of Christ, at year zero, or whatever year you want to make the difference between BC and AD, back then, that one penny growing at nominal interest rates of a couple percent would be more than all the money in the world. So you say, well, how can that be? Because there certainly was a penny, and there certainly was ways to invest, and how come nobody has done that? Well, because you earn a lot of money, and then you get these periodic resets in the money. So nobody's able to accumulate money for very long, because the money eventually goes worthless. And that's also part of the design. And you have hard money for a while. You have gold or sticks or some other tokens of exchange, cattle or whatever you have. And then you go off into currency, and then you get bankers decide they can loan out money, because not everybody's going to come and get the money at the same time. And then you get fractional reserve banking, and then you get a federal or a central bank, and then you get excesses, and you get huge bubbles, like having bubbles much more frequent and much larger bubbles now. And eventually the bubbles are just going to dominate, and every bubble becomes more severe than the last one.
Ed, I think for some people listening, I could see some in the audience already building up a criticism in their mind. And I think what people need to understand is that you're not, some people might be thinking, oh, Ed Seykota, he sounds bearish, or he sounds like a doom and gloomer. Whereas you are taking a very distinct perspective to where, like, look, I'm observing the system as it is. You're very clear about it. You're saying, you can't really worry about it. You can't stop it. And I think, and you're not trying to make a prediction of the timing of something. You're just objectively trying to analyze the economy that we all are in the middle of.
Yeah, I'm not saying anything wrong with it. I think this is the way it works. And that's basically what we do in the trading tribe, is we look at, how can we be more effective as people in coping with the environment? If you'd been around 100 years ago, or maybe back in the early 1800s, a whole different economy. You want to get out there and build machines, start factories, and hire people and participate in the greatest economic miracle ever. These days it's different. It's a different, and there certainly are pockets of innovation. There are very bright people coming up with whole new industries. And you got drones flying around that we didn't have before, and lots of advances. So there certainly are people innovating. But by and large, a lot of people are out of work. And you have a huge dependent class. And you have a huge amount of moral hazard in the economic system. And you have a disconnect between our governance and people. People don't even believe what the politicians are telling them anymore. So you have a whole different economy and a whole different society. And it's just part of the evolution. And you can find all kinds of books about what we ought to do to fix things. I don't think there's anything to fix. I think it's just how it works. And there's always people that think we should fix things. It's one of the symptoms of this transition we're going through. Is there's people who want to, go out there in the fall and pick up the leaves and glue them back on the trees because they liked it better in the spring when the leaves were green and on the trees. But you can't glue the leaves back on the trees. You just have to accept the fall for the beauty that's there and move with it. So that's what we do in the trading tribe is we try to, what can we do with our own attitudes and our own responses to cope with whatever the flow is, not try to change things, pretend they're different. What can we do to go with the flow? In other words, to use trend following in our own personal lives.
I know you look at trend following from not only from a trading perspective, but your own life perspective.
Yeah, and I think if you're going to really be a trend follower, you're going to have a lot of trouble limiting it to one area because let's say you have a trend following system. You say, well, okay, I'm gonna have a diversified portfolio, a trend following portfolio. So I'm going to free myself up from emotions. Emotions have always been the big problem here. So I'm going to have a diversified trend following portfolio, or I'm going to invest in somebody else's portfolio, and that's going to fix this emotional problem. And then what happens? Well, their investment or their portfolio goes up and down. And then I've got emotional problems with that. So you don't really fix your emotions by having a system. What you do is you just move them upstream. You move them upstream instead of you have constituents within the portfolio that used to bother you and they went up and down. And then now you have a portfolio that goes up and down. You just move the problem upstream. So ultimately you have to say, well, what is it that I'm feeling and what do I do when I feel these things, and can I come up with better and more useful or productive ways of responding when the thing goes up and down? And eventually you've got to come to terms with that. And so the best trend followers, I think, are the ones that have made peace with themselves and have said, well, this is what I do in the case of things going up and down. The value increasing and decreasing. This is how I behave, and this is how I act. And of course, as you know, there are all kinds of things you can do when things go up. Some people, when something goes up, they sell them. Some people, when things go up, they buy. And when they keep going up, some people sell more and some people buy more. And if you go to extreme in either of those cases, you're counterproductive, self-destructive. You've got to know how to do that, and you've got to do it consistently. You've got to do it in your personal life. I think if you do these things in your personal life as well, it supports a trend following. Because if you're not in alignment between your overall philosophy and how you behave as a person, and you try to do trend following, well, there's going to be conflicts. And so we in trading tribe, we hardly ever talk about actual trading or what the markets are doing. What we're working with is the emotional reaction to volatility, or emotional reaction to loss, or to structure or authority, or all these other issues. People straighten these things out. Their relationships with their significant others and their children get better. They report more satisfaction in all areas of life. And, oh, incidentally, their trading is getting better. And they don't quite know how that happened. But it's just that they've turned into a person that now can cope with uncertainty and can cope with volatility. And they couldn't do it before. And you can't, in my opinion, you can't take a system and use that to medicate your feelings. You've got to get your feelings. Some people say, well, I'm just going to suppress my feelings, stiff upper lip approach, or grin and bear it, or clench your teeth and hope for the best. I tend to go the other way. You try to say, what's the positive intention of these feelings? Celebrate them, find out the positive intention, and as soon as you do that, the feeling disappears and you go on to the next feeling. So I'm more of the go with the flow on the feelings as well. So there's a lot of different approaches. But by now, after we've been doing this a couple decades, we're developing a body of knowledge of how to do this, and to what extent can we actually reprogram response patterns. We're getting pretty good at this. As we've got, and you can follow what we're doing. I put it all on the blog at Trading Tribe, at tradingtribe.com. All this is free if people want to go on there and look at it. And we're documenting the growth of all kinds of people who are using this technology, and it seems to be, to the extent they use it, it seems to be working pretty well for them.
It always just seems like to me that the place that one is trying to find is just some peace and contentment. And there's this just, again, I start off with giving you the praise of the clear thinking. I think that's to just be able to sit in a room and not feel, I mean, you're not to have this anxiety and worrying constantly. And if one has that, to work on that. And I think it's just trying to find it. I see a lot of parallels to your work and some of the meditation. I read some of the Zen scholars like Alan Watts. It seems like there's some commonalities with some of your work in the Eastern thought process.
I believe every feeling has a positive intention. For instance, if you're in a house and you smell smoke, you hear crackling sounds and notice the temperature going up in the room, and you conclude that maybe the house is on fire. That would be a really good time to feel anxiety and to take some action in response to it. So I'm not so sure that you want to, medicate your mind, anesthetize yourself, and put yourself into some meditative state where you don't respond. That's not really what I'm saying. I think you want to notice the feeling you're having in the moment and act appropriately. And you want to learn the difference between medicating a feeling and responding to it proactively. So it's not always, I'm not suggesting you always aim towards peacefulness. Sometimes you want to get busy. You might want to get busy and put a trade on, or you might want to get busy and take some corrective action, some risk control, or you might want to take some action and get into some opportunity. But whatever it is, I think you can learn to come into harmony with your feelings. And to some extent, it's nice to just be able to be peaceful and watch your feelings and watch your mind and rest. It's important to rest particularly when you feel tired. But I don't recommend using either Trading Tribe technology, which I call TTP, Trading Tribe process, using that or anything else for medicinal purposes, like a drug or alcohol or a sedative. You have to watch out. There's a difference between using any of these technologies as a sedative, and I don't think any of the Zen masters really recommend blissing out and staying there permanently. I think they want to be responsive and proactive to whatever feeling arises in the moment.
I love the constant learning. What's the better way to handle expressing oneself? What's the better way there's always a better way to do it, right?
Well, I think so. I think I try. We're here in the moment, and I'm learning something. Learning something from you, and I'm trying to be responsive. And I'll think about this later, and I'll say, "Oh man, and now I really could have said that better." But that's how life is. I do the best I can in the moment, and then go back and maybe do it differently next time, and try to learn and try to learn and study my responses and say, well, can I change the response? And then that's what we do in a trading tribe. We try to look at what our responses are to our feelings, and then we practice identifying, well, what is it we are doing? How are we getting the result we're getting? And can we change our response patterns and get different results next time around?
The only way you can learn is to extend yourself to perhaps in front of somebody that has more experience. And once you extend yourself, there's the chance that you might be forced to learn something that makes you feel like, wow, why did I just say it that way? I could have said it the way he just told me. But you want to get to the point of knowing the better way until you extend yourself with the wrong way.
Yeah, we find in the right environment, and we take a lot of care to set up the environment correctly. Once you set up an environment in which the goal is for people to help each other improve, I think this is true in the trading tribe, and some companies have this down pretty well too. Some other organizations where when personal growth becomes important, then when people correct you or offer advice, you say, thank you. Thank you for helping me learn something. In a lot of situations, somebody will correct you or give you advice, and then you get upset about it, and you may say something to protect yourself or put them down or swear at them or tell them to keep their distance or whatever. So it's a different environment where everyone is trying to grow and do a better job. And that's another thing we had. When you have an expansive economy and a company that's growing and everybody's trying to do better, then the culture in that company, when you have growth, when you have a free competition society and free competition, you have a competitive startup firm, and somebody says to somebody else, there's a better way to do this, then they say, thank you for telling me. And they start doing it that way. When you get a survival company, one that's overly restrictive and political, and there's regulations, you better mind your own business and don't go talking to somebody else about what they should be doing. You see the whole environment, the whole structure. The environment in one case is pro personal growth and pro-learning, and the other one is not. It's very territorial and very defensive. You can walk into companies, you can sense this right away. Some are open to grow, and then they get mature, and then if they start getting kind of the Gavopoly model, and they start going the other way, and they don't want to have, you offer advice at your own risk.
Ed, one of the things that you do in the Gavopoly book and your premise is you talk about the strategy of trend following. And I don't want to phrase it as a solution, but you offer trend following as a way to perhaps, a better phrasing is to cope with as we move towards this Gavopoly system that you see as inevitable. And trend following is, and perhaps there's other solutions, and I'd love to hear if you think there are, but as you talk about trend following as one kind of a way to cope, I would love for you to go back in time a little bit, if you will, and because you've had an interesting career, you've had some interesting mentors, interesting students, but I know, and I mentioned this in my email, there's a couple traders in your early years that I think had a really strong influence on you. And I would love for you to share a little bit of wisdom or perhaps experience or thoughts or memories about two gentlemen in particular, if you wouldn't mind. And that'd be Amos Hofstadter and Richard Donchian. And Amos Hofstadter, he was at Commodities Corporation, and Richard Donchian at Hayden Stone, just two very accomplished early pioneers in the field of trend following. Would you share some wisdom?
I'll be glad to share what I know. I knew Donchian a lot better than Hofstadter, and Donchian had noticed this system. He noticed the 2-week rule in copper. 2-week rule meaning you buy something when it makes highs for 2 weeks, and you sell it when it makes lows for 2 weeks. And he just noticed this somehow, and he didn't remember exactly how he noticed it. I asked him once, how'd you come up with a 2-week rule? And he said, I don't exactly know, and you're the first person that's ever asked. He said he just kind of came up with it, as far as I can remember. And that was the start of that was I think the start of automated trend following was when he came up to the 2-week rule. And before that, you can look at some of Livermore's writings, and he had a system of pivot points and so forth. And there's other people that have talked about it. He basically started the 2-week rule. Now that won't work today. Back then you didn't have, you had a little different character of the markets. And the 2-week rule used to work in copper. And then we found that you had to lengthen those, and maybe you make the weeks longer, 6 weeks or sometimes. Now they've got 30 or 40, 50 weeks or much more than that. He had this system, and then he had a couple followers there in his office. He came up with a system. He didn't always follow it himself, but he had this system, and he had people on it, and he had people that were religiously following the system, and they seemed to do pretty well. And I came along, and I studied his rule set. He had Donchin's rules and Donchin's guidelines. And about that time, we had computers were starting to become within reach of people to use them. Although they didn't have personal computers, they did have mainframes at some companies, and I got, if you can believe this, I got to go into the major brokerage house at the time on the weekend, and I had access to their mainframe computers that they used to run the company. And I was in there, and there was a security guard, and there was me, and I had access to the complete computer base of the whole company. And I was just using it to do computer testing.
Were you pinching yourself at that time?
No, I thought it was just normal. I said, well, I want to do this research, and they said, okay. And in those days, nobody ever thought about anybody trying to go in there and do anything nefarious. I was just in there doing research. No one in those days, you wouldn't even think about something like that. But these days, you couldn't get anywhere close to the inner workings of a brokerage house. These days, you couldn't do it. But in those days, I did the computer testing on the mainframe computer of the brokerage house, and all of their discs and all their history and everything. They were just sitting around in this big room. It was a huge room, and all these mainframe computers and the big tape drives and so forth. It was this, now you can get probably all the computational power in that whole room. Probably you got more computational power in your cell phone now. In those days, that was quite the thing. So I would run back tests, and I would do a back test that you could do now in probably a second or two. It would take half hour, 45 minutes to do one set of tests. And I was using punch cards, and it was a different era back then.
Did you find it unusual, or what were your feelings at the time? Because there weren't a huge number of peers that you could bounce ideas off. I mean, you said you knew Dick Donchin, but there wasn't this. I mean, today there's a much wider network, and people are connected on the internet. They can reach out to you at FAQs, but there was no FAQs for you back then.
No, and I took Donchin's work, and he had a letter that he would publish every week. He would publish a letter which would have his rules on it, and it would also have a kind of a model account, and you could follow along. And the idea was you would follow along, and you would place your orders with him. I guess that was the way that was supposed to work. So I tested his rules, and I came back and said, well, the rules internally are not consistent. The rules you can't program all these rules at the same time because they conflict with each other. So I started taking rule sets that were non-conflicting, and I tried to tune it up and see, well, here's what we can do. And I would try different experiments with the rules, and I would check it with some brokers and traders in the office. And a lot of times I say, well, I'm going to change this. I'm going to make the system less responsive. So the market has to go up more before you start to buy it. So make the time constants longer. And people would say, well, that's going to make it more risky because your stop's going to be further away. And then we would test it, and we would get the exact opposite result. So all these things were very counterintuitive. I did some of the first testing, and you're right, there wasn't any other standard. Now I've got this on my website. if you or your listeners want to go on the website and replicate some of these tests to learn how to do it, I've got it on there, and there's a template, and you can do it on your Excel spreadsheet or whatever. And then enough people have done it, so they all get the same result to the penny. So I'm pretty confident I've got the right answer up there. But in those days, no, there wasn't anybody else. I was just curious, and I said, well, how does this work? And Donchen had set it up as a system. I said, well, okay, I'm going to simulate it. I'll go back in the computer and see if I get the same results that Donchen's getting, and I'll try to set up a diversified portfolio. And we did that, and the company I was with marketed it for a while, and we had a diversified portfolio, and it was all run on computer by a service bureau. I had a service bureau, and we would enter the data every day and then get the result, and then we would put the orders in. But the company couldn't stick to it. The company I was with couldn't stick to it. And they also couldn't resist the temptation of trying to get the customers to trade more often than the system wanted them to trade. The problem with the system was it worked, and it made money for the clients. But the problem was it made far less money for the brokerage house, because they were used to day traders, and they were used to people coming in and lasting a few months and then losing their money and moving on and doing something else. And so that's the way the brokerage house set up. People would come in and try to trade, lose their money, and leave. And here was something else. They would come in, and they didn't believe they were going to stay. And they said, well, commissions are like a tenth of what they used to be. They're staying with positions. And this is going to wreck our business model. And so there was all kinds of pressures to get people to trade more often. And then there was all kinds of pressures, like you pointed out in some of your letters to me. There was, they've got fancy names for it now, like disposition effect. But in those days, people just didn't want to hold on to something. It went up a little bit, and they want to take their profit. Went down a little bit, and they wanted to add more and hope it would go back up. And so you had lots of pressures against following systems in those days. So I had invented something that no one really wanted. And so then I left, and I went out on my own, found clients, and I found that some of the most important things was developing a relationship with the clients, that they really knew what to expect and they knew what was going on. Because if the client was not aligned to it, and if you didn't have emotional rapport and understand that the system is more than the mathematics. The system is the mathematics plus the willingness to follow the system. And when you increase your worldview to include the investor himself and his emotional responses to what's going on, when you finally get the system to include everything, you can design a system that works. But just going into a computer and tuning up your software and saying, well, here's the right set of parameters. Well, great. You've got something that theoretically will work for some theoretical robot that'll follow it. But there aren't a whole lot of robots that got money these days. Maybe someday, but right now you've got human beings with human feelings. And unless you include that into your system design, the thing's going to, the wheels are going to come off the cart around the corner.
Yeah, I think you really sum up so much of your ethos in those last few sentences for those that are paying attention. I'm curious, Ed, too. I want just a couple more questions. I won't keep you. But as you talk about, we're talking today about your research into developing this Gavopoli model. You're talking about your early research with trend following models. It seems like, and correct me if I'm wrong, but it seems like you've been highly motivated by the puzzle aspect of just figuring things out.
Yeah, I guess I like puzzles. I've got a huge collection of what you might call barroom puzzles, or these metal detanglement puzzles where you have metal pieces that fit together and you got to figure out how to get them apart and together. I've got a huge collection of those, and I in the morning I do chess puzzles, and I like figuring things out. It's always been something that I enjoy doing. I don't know exactly where that comes from. I think it's been I've been able to incorporate that in my life in such a way that it's useful. But yeah, I think that the puzzle aspect of what I did in the markets or what I did with the Gavopli book, what's driven me is I want to understand how it works. I want to know how it works. Then it works and it makes money. That's great. I mean, it's nice to make money, but I think I wouldn't have done it in the first place. Maybe figured out some other way of making money. But the puzzle was what got me. I said, I got to figure this out. Why does this guy Donchin has got this thing that's mechanical, it's making money? How can that be? How can you get something that's mechanical that can make money for nothing without doing any work? How can that be? And so I kind of got attracted to looking at it, but I don't think I would have gone into it. I wouldn't have gone into it for just the money. It was the puzzle. It was how does this work? I mean, how does this actually work? Can I build a model and can I understand this? And then when you understand it, then it becomes interesting to explain it to people for a while, or then you put it on the website, or you write a book, and you go on and you look for a new puzzle. So
I mean, when you were back in the day though, and you're in those mainframe rooms and you're by yourself and you're struggling. I mean, there's got to be a struggle, of course, to try and figure this all out. I mean, was it just pure excitement at the time, and this internal excitement that was driving you to just keep going and going till you got the puzzle solved?
Well, that's a good question. That's one of the best questions I've ever heard. What motivates somebody who's a researcher? What motivates them to go? I don't. You say, well, is it the pleasure of the puzzle, or is it the discomfort and not knowing? I think it's deeper than that. It's just, that's what I do. That's what I do. I do that and I play banjo and I get lost in it. Mm. That's my meditation. I have to do it. If I can't play music, something dies. And same with solving puzzles. That's who I am and that's what I do. And I don't think of it as there's something that pushes me to do it. That's just who I am, and that's what I have to do.
Yeah, I still feel like I'm in training wheels, but I sometimes feel like my career is the same way. I don't necessarily know why. I'm just driven to do what I do, and I'm not necessarily sure what I even do, but I just do it.
Yeah, I like that, and you're good at it, and you're that's one of the places I think we succeed in the tribe when we get people to this place you're at, where you find out who you are and what you do, and you just do it, and you express yourself, and you create a value by expressing exactly who you are, not pretending to be somebody else. That's a very high state. Congratulations for being there. It'd be a different world if everybody could get there, and I, would hope people would follow in your footsteps, and I've watched your career over many years, and I've seen you keep expanding and getting closer to who you are, and now you're really blooming and you're really making a big contribution. So, good job.
Well, I tell you though, for those that don't know, you I'm not going to tell the exact story, but you influenced me greatly when I met you for the first time in 2001, and I can still remember some of the things that you said to me. And I think for some people, they might have felt threatened. And I don't think I felt threatened. I probably was like, okay, what has he just said to me? Why is he saying it? What's the deeper meaning? So in many ways, as you talk about your love of puzzles, I felt like you were giving me a puzzle. Michael, you might want to consider this. Ba, 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 ba. And so then, of course, I just considered that. And you didn't give specific instructions. You gave some big picture insights. And I think that's probably how you like to be. I think you just want to see if there's more puzzle finders out there.
Yeah. And like you're open. You wanted to do something. You wanted to go somewhere. You were like on a growth path. And then you viewed, ideas from me and other people. And you've surrounded yourself with an amazing group of people who have amazing amount of ability knowledge and wisdom and resources. You've surrounded yourself with one of the most advanced group of mentors I think is possible. You just like to do that. So I think you had an attraction. You attracted people like that, and then you enjoyed hearing what they have to say. The people that are on your podcast, people in your life, all are people with strong opinions, all people that make you think and make you grow. And you just have some kind of a affinity for people like that. And that's part of what makes you good at what you do.
Well, if they keep talking to me, I should keep talking to them. That seems like a good rule. If really smart people will agree to talk to me, I should probably talk to them, because then I wouldn't be that smart.
Well, I mean, it seems to be working. It seems to be working.
Well, listen, hey, you are. I've kept you for too long. Hopefully, you will get on and have some conversations more regularly. I think I think you could appreciate. I'm sure you feel this, that the flow of our conversation, because we haven't really caught up on the phone for a long time. You can feel the flow improve as the conversation goes on, which is fun. So
yeah. It takes a while to get into it, and then it takes a while to get it to turn it off again. So
it's time to turn it off now. So hey, listen, Ed, I appreciate you taking the time. Everybody can make it to seykota.com, SEYKOTA.com, correct?
That's right. Yeah.
Okay.
Yeah.
Thank you, sir.
Thank you for making me think, and for I enjoy listening to you and talking to you. You always make me think, and I appreciate it.
Well, thank you, Ed. You always make me think as well. Appreciate it. Thanks, sir. Now, if you did not learn something from those three guys, retire, quit, go away. You're finished. You're over. You're like the guy who gave the most recent review on my trend following book. Oh, yeah, I take names. And some twit came on there and said, 1 star, I'm a newbie. I don't understand everything. It's too complicated for me. What a freaking loser. Oh, I know authors are not supposed to call their readers losers. But come on, seriously. Let's just be frank here. Let's be honest. Some people are losers. The big L imprinted across their forehead. Look, anybody that whines and complains, and so many interactions online, social media, reviews, etc., are a whine. They're a complain. They're just a loser. You have to learn that we're in this age of absolute white noise. And when you're in the land of white noise, where there are all kinds of secret agendas and little Weasley type people working around the edges, little jealous sons of bitches, you out there that's trying to learn, trying to figure out how it all works, just look for the whine. Look for the complain. That whine, that complain, it's a tell. It's a tell for a completely useless person. Yeah, there's 7.5 billion people on this planet. Ignore the useless ones and find the useful. That's it. That's our mandate. That's the goal for 2018. How can you get rid of the useless and bring in the useful? Now, damn it, go have some fun in 2018. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.